IndusInd Bank CEO terms the accounting lapse a one-off and says that there are no hidden skeletons in the cupboard. The management pledges to turn in a profit in Q4. Stock plummeted over 20% in yesterday's session. CPI data for the month of February is due today at 4 p.m. along with industrial output data for January. CNBC-TV18 poll sees Feb CPI at below 4% against 4.3% in January. Hello, good morning. You've tuned into Power Breakfast on CNBC-TV18 and I'm Vinny Motiwala. Thank you so much, as always, for tuning in with us. A quick look at what the Asian market has done. That's what we'll start with. A mixed opening is what we're seeing coming in for the Asian markets. Like you can see on your screens, Taiwan index is up 0.8%, but Hang Seng, on the other hand, is down 0.3%. With Hang Seng, what else is down in the Asian markets? We have ASX 200 that's seeing a bit of a decline of 1%, actually not bit, it's 1% down. We have Shanghai, which is down 2/10 to 0.3% as well. Nikkei, on the other hand, has opened with some bit of a gain of almost 0.3%. So very, very mixed opening that we're seeing coming in, given the handover that we have from the global markets. Now, obviously, that's Asian market, but Nifty implied open is indicating a flat to a mutish start for an Indian market. As of now, down 19 points. So not a very sharp decline that we're expecting this time, just 19 point. Muted start is what we're watching out for, and we'll see where the Nifty is headed through the day as well. But a look at the US markets. How did that close? Now, stocks finished lower, extending this week's tariff-induced sell-off to a second day. The Dow slipped more than 450 points, and S&P 500 posted back-to-back losses over President Trump's tariff uncertainties. CNBC's Steve Kovac gets us a wrap on all the action that has happened on Wall Street.
U.S. markets were down across the major indexes in Tuesday trading, recovering slightly from an earlier sell-off after President Trump announced new tariffs on Canada. The Dow shedding 478 points, the S&P 500 down by 42 points, and the tech-heavy Nasdaq was lower by 32 points. Wall Street getting hit with another case of whiplash from this trade war. President Trump said Tuesday morning that he would double to 50% the tariffs imposed on Canadian steel and aluminum in response to the province of Ontario putting a 25% tariff on electricity coming into the U.S. Then Tuesday afternoon, Ontario's Premier Doug Ford walked back the electricity surcharge, agreeing to temporarily suspend it after Commerce Secretary Howard Lutnick agreed to renewed trade talks. When asked later in the day, before markets closed, whether he would keep the additional steel and aluminum tariffs, President Trump said, quote, "I'll let you know." White House trade advisor Peter Navarro then told CNBC that the additional tariffs won't go into effect Wednesday. And bags will no longer fly free on Southwest Airlines, that budget carrier announcing Tuesday it will start charging some customers for checked bags, ending a long-standing free policy as it looks to boost profits. All passengers outside the top-tier fare class will have to start paying beginning on May 28th. Southwest will also start offering a basic economy fare as part of the changes being made to return to profitability. That's what's happening here in the U.S. Back to you, Mumbai.
Thank you so much for that. But let's in fact listen into Jeremy Siegel on what he has to say on the Trump policies and on his take coming in the market, and later on what Moody's chief economist has his take on the Fed as well.
Well, I'll tell you, if those two good developments, perhaps a stand down on the Canadian tariffs and hopefully a ceasefire in Ukraine, if they hadn't come up, I think we would have had another 1,000-point drop day today. I mean, it's clearly this destructive, if I should say so, up and down trade policy that has really worried the market and sowed uncertainty among consumers and businesses. I hope that the Trump team sees what the stock market and, in fact, some early polling of some of this impact has, so that this policy can be rationalized, because I think it is by far the major cause of the 10% decline that we've had over the last 6 weeks.
the economic uncertainty, the policy uncertainty, the uncertainty around economic policy, I should say, is a reason not to move. They're not under a whole lot of pressure. Inflation's on the high side of their target, but pretty close. And growth is okay. The economy is still pretty close to full employment, so no real pressure to move. And given the uncertainty around economic policy, and of course we're seeing that on a daily, hourly basis, no reason to move quickly here. They want to gauge how this is all going to play out before they take another step.
On that note, let's get to the final update from our global market wrap this morning. Markets in Europe traded lower after the trade tensions between US and Canada escalated. The French CAC index shedded almost 205 points, while the German DAX lost on nearly 300 points in yesterday's trading session. The FTSE also lost more than 100 points, and the Pan-European Stock 600 ended Tuesday's day down by almost 1.7% in the trading session. Yes, that's how the European market looked like as well. So a bit of a subdued and a red day what came in for the European markets as well. But that's all the global market action that we have for you all this morning. How is all this going to be impacting our Indian markets? We have a team of research who's standing by to set you up for trade, important stocks to watch out for, as well as cues in the world of F&O. Hormaz, let me start up with you. Good morning. And what are the important cues that are coming in from the markets today? What are we watching out for from the Nifty? What should we keep an eye out on?
Good morning, Vinny. A lot to watch out for in today's trading session, but considering the chaos that you are seeing on Wall Street, you would take yesterday's session and today's gift Nifty with both hands. And it was that kind of a session yesterday. The fears were of a gap down. We did open gap down, but unlike a previous selling days, we saw that the dip yesterday was bought into, and very convincingly at that. In a 200-point recovery from the lows for the Nifty. The bigger takeaway that we ended at the highest point of the day, near levels of 22,500. That was an added positive, and the recovery on the Nifty came despite the underperformance of the Nifty Bank. And what led the recovery? It was ICICI Bank along with some other names like L&T, Reliance, even those stocks that contributed to the recovery in yesterday's trading session. Of course, IndusInd Bank was the eyesore in yesterday's trading session. It was the biggest drag on the Nifty Bank as well. That led to its own underperformance, the biggest single-day drop on record for the lender. So we'll see if there are any follow-up moves in today's session. The Nifty Bank, though, continuing to find support at 47,840 on the downside. So that 1200 point range continues to remain the one to keep an eye out for the Nifty, with 49,000 on the upside being that higher end of the range. It was the real estate index that was the top sectoral mover yesterday on the upside, though after the budget that was presented in Maharashtra, stocks like Macrotech, Phoenix Mills, all of them doing well yesterday. So the important levels on the Nifty, of course, 22,450, 22,400 on the downside, of course, that remains the key. And last week's high, which was 22,676, which was Monday's high, that remains the key to watch on the upside. Now today's, of course, the CPI data gets reported today, so we get cues from there, both in India and from the US. Whether any more tariff flip-flops, whether that brings any funds back to the emerging markets, including India, that is something that you need to keep an eye out for. And of course, we expect some more consolidation because it's a truncated week, so whether traders remain light going into the holiday. For now, the subdued start in the offing, but we take that considering the global market volatility.
Okay, Hormaz, thank you so much for that. Nifty implied open actually right now is very, very flat. It's just down 6 points. So keep an eye out on the Indian markets. Let's go across to Abhishek, who's waiting by to tell us which are the important stocks to watch out for in today's trading session. Good morning, Abhishek.
Good morning, Vinny. So to begin with, Godrej Agrovet will acquire more than 48% stake in Creamline dairy products for a consideration of 930 crores. Now, Bharti Airtel has signed agreement with SpaceX to bring Starlink's high-speed internet to its customer in India. So this is Elon Musk Starlink, which has tied up with Airtel to come to India in the telecom space. Now, RVNL has emerged as the lowest bidder, that is L1, for NHAI project, which is worth nearly 555 crores. December telecom data is out over there. Reliance Jio has added more than 39 lakh customer versus 12.1 lakh customer addition in November. Bharti Airtel has added about 10.3 lakh customer versus a loss of 11.4 lakh customer in November. While Vodafone continues the losing momentum, they have lost more than 17 lakh customer versus more than 15 lakh customer in the month of November. Now, IRDA will consider enhancement of its borrowing program for FY25 on 17th of March 2025. TCS will acquire Darshita Southern India Happy Homes for a consideration of rupees 2,250 crores. Now, PB Fintech will invest 696 crore in their their arm PB Healthcare Services. With this, the total share, holding in the company goes up to about 33.63%. Back to you.
Okay, Abhishek, thank you so much for that. And Sudarshan is here waiting by to tell us what are the important cues in the world of F&O that we should keep an eye out on. Good morning, Sudarshan.
Good morning, Winnie. So yesterday it was a good day of trade considering the global cues that we had received, and we saw Sensex and Nifty recovering more than 200 points from day's low, and especially broader markets mid-cap index saw a huge recovery and closed with gains of almost 200 points. For today also, GIFT Nifty is indicating a start with minor cuts. It's down currently around 6 to 10 points. Now on the flows front, FIs remain on the sell side. Yesterday also we saw FIs selling nearly more than rupees 2,800 crore. But if you dig deeper in the index futures, FIs yesterday bought 80 crore, and in the index options we saw huge buying, and the buying figure was more than rupees 20,000 crore, and in the stock futures buying was more than rupees 600 crore. And with this they have added long positions of nearly 700 contracts. Also they have added short positions of nearly 200 contracts. With this, long exposure of FIs increased to 18%. On the options front, 22,900 and 23,000 call options were active, and on the put side 22,200 and 22,400 put options were the active. So basically it's telling you that on the downside it's tough for Nifty to slip below 22,200, but for now support is around 22,300 and resistance is around 22,760. Stocks that are in band, two stocks that have entered ban are IndusInd Bank and SAIL, and again BSE, Hind Copper and Manappuram remain in the ban.
Okay, Sudarshan, thank you so much for that. Keep an eye out on those cues in the world of F&O. On that note, let's slip into a very short break. After the break, we'll get you some excerpts from IndusInd Bank's management where they term accounting lapse as a one-off. So come back and we'll stay tuned with that conversation.
It's not a recurring item, and I think we should take it, we should get over it in this quarter, and after that, I think the bank should be back to the BAU, and you should see the growth that the bank is seeing and the profitability which the bank is used to.
Welcome back. Thanks for staying tuned into Power Breakfast on CNBC-TV18. Let's move on. An IndusInd Bank slumped in yesterday's trading session after the bank revealed a 2,000 crore rupees pre-tax loss due to incorrect derivative accounting. CEO Sumant Katpalia, in an exclusive conversation with CNBC-TV18, said that they did not report the anomaly earlier as they were not aware of the quantum of the hit. He also termed this and he said that this is a one-off lapse that has come in and was confident of reporting profits in Q4. Listen in.
During a review of the processes in connection with the compliance to the RBI circular on investments portfolios, we found that there were some gaps which were coming out. And that was really the start of the issue. We found this anomaly around October, and that is where we started our internal assessment as well as we hired an external agency. At that point of time, we did not know the difference, and we knew that there were two deals getting accounted incorrectly, but there's so many deals in that, so we did not know the real impact. And I think as soon as we got to know the impact, we held a board meeting and we informed our board and we did the disclosure. You know what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item, it's not a recurring item, and I think we should take it, we should get over it in this quarter, and after that, I think the bank should be back to the BAU and you should see the growth that the bank is seeing and the profitability which the bank is used to. The full year will not be a loss at all, and I think the quarter 4 itself also will be a profit.
Okay, on that note, we're going to slip into a very short break, and next up we'll get you the cues in the world of commodities, so stay tuned in. Welcome back. Thanks for staying tuned to Power Breakfast on CNBC-TV18. Now, let's get you the latest update that's come in on the tariff war. After hours of back and forth of tariff imposition between the United States and Canada, both of the countries have decided to pull back on their initial calls. Ontario Premier Doug Ford initially called for a 25% surge on electricity going into the United States. And in a retaliation, US President Donald Trump planned to initiate a 50% tariff on Canadian aluminum and steel. However, later in the day, a White House decided to retract on this decision. Listen in.
As you know, there's a very strong man in Canada who said he was going to charge a surcharge or a tariff on electricity coming into our country. He has called and he said he's not going to do that. Okay, he's not going to do that. And it would have been a very bad thing if he did, and he's not going to do that, so I respect that.
Will you make a different decision now about the tariffs on Canada? Will you reduce it?
At that, but probably so, yeah. He was a gentleman.
Does that mean that we're not going to see 50% tariffs come tomorrow on steel and aluminum?
Yeah,
okay.
Correct. Yeah, that's Secretary of Commerce Lutnick did a beautiful job negotiating that. But frankly, the Premier, he's been. I mean, look, just tamp it down, please, over there. Okay, just throwing down the hockey gloves and stop that rhetoric.
After a brief conversation with U.S. Commerce Secretary Howard Lutnick and Ontario Premier Doug Ford is expected to meet the U.S. trade delegations later today in Washington, but has assured Canadians if the tariffs from U.S. continue, Canada will not hesitate in imposing retaliatory tariffs. Listen in.
I had an opportunity to speak to Secretary Lutnick. And Secretary Lutnick has sent out an olive branch to us to come down and immediately meet with him, meet with the whole trade administration, and discuss the future. Rather than waiting till April the 2nd, threats going back and forth, tit for tat, I've agreed to suspend temporarily, and we always have that tool in our toolkit, until we sit down over the next day or two. I'll be heading down to Washington along with Dominic LeBlanc, and we'll have a good discussion. But if he continues with the aluminum and the steel, I just got off the phone with Minister LeBlanc. They will respond dollar for dollar, tariff for tariff.
Okay, now it's time to get you the updates that are happening in the world of commodities this morning. Manisha is here, as always, to give us that update. Good morning, Manisha. Today, what are we watching out for?
Oh, well, we're looking at steel and aluminum as we are looking at a very chaotic implementation of tariffs leading to a lot of uncertainty into the markets. So what we understand now, and as you were talking about it, there is now 25% tariff on steel and aluminum, and that goes into effect today, not the 50% on Canada, as you've just said. So, what we've seen in the overnight markets really has been a very, very volatile metals market. The dollar index now is trading at a 4-month lows. That in turn has been supporting the prices. And then it is also going to be about the U.S. inflation data. That is going to be in focus ahead of the U.S. Fed meeting that is slated for March 18 and 19. In sense of prices, there has been a very strong rebound after U.S. has taken back the 50% Canada steel and aluminum tariffs there. So we've seen copper prices gain for one. Aluminum U.S. physical price premium has hit a record high at $990 a ton. This is a 75% of gain in this year until now. The Canada smelters, remember, are the main source of primary and alloyed aluminum exports to the U.S. And whatever Canada exports, 70% of that goes to U.S. So it clearly is going to be about both the countries will get impacted when these tariffs come in, and that happens tonight at 12 midnight. So it's going to be very volatile day, as I can say, in sense of metal prices, whether it comes in form of tariffs, and then it is about the U.S. dollar, the currency movement itself, and the statements, as the Canadian Premier said that next 1 or 2 days is when they're going to be deciding on that. You are going to be looking at very, very volatile prices there.
Okay, very, very volatile day. At least keep an eye on those metals. Thank you so much for that, Manisha. But with that, we're absolutely out of time with this edition of Power Breakfast. Thank you so much for tuning in. Up next, we'll pass our morning call.
There was a cyber attack on X today, which shut it down and may have been foreign sourced.
Yes.
It's a big story. You want to give us a moment on that?
Well, we're not sure exactly what happened, but there was a massive cyber attack to try to bring down the X system with IP addresses originating in the Ukraine area.
They're setting fire to various Tesla charging stations near Boston. Shots were fired at a Tesla dealership in Oregon. Various nonviolent...
Shots fired, not a metaphor.
Shots fired, yes. Downtown New York, marching against the Tesla showroom. Your stock is way down. You've been criticized left and right.
But look on the bright side.
I mean, why are you doing this?
Always look on the bright side of life.
Yes. And you're on it.
Yeah. I mean, so the goal here is let's not have America go bankrupt with waste and fraud. So that's what I'm here for.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's the Wednesday morning and it's getting very, very dizzy. If you're trying to follow those tariff headlines, well, good luck. Well, that's what we've been doing here. We'll talk about it. I'm Surabhi Upadhyay. As always, with me is Nigel D'Souza. We have Rima with us. Guys, it's just too much news. I must admit, I'm a news junkie, a journalist at heart. But even for me, too much news for these markets.
Oh, indeed. It's 25%. Is it 50%? Is it on pause? Is it a 1 month? It's just dizzying, the kind of news flow that we've got over the last, month and a half since he's been in office. But it's just getting amplified, I feel.
Well, in the last few days, the feeling you're getting is, thank God you're in the Indian markets. Because you have a couple of global triggers that are working in your favor. You have policy that's supporting both from the RBI as well as the central government as well. So the Indian markets in a very wobbly environment seems like a good place to be in.
Yesterday's price action was very encouraging. Very encouraging. Closing at the day's high near to 22,500 in the face of the global.
But then that FPI sell number, it started inching higher. So, it's a fairly muddled situation that we're in the midst of, but I completely take that point that even if you exclude all the tariff headlines, we are a domestic-facing economy at the end of the day. Yes, exports are extremely important, more services than goods, But I mean, we have a lot going domestically for us as well. And maybe that's exactly what the bulls will eventually focus on.
And yesterday, Rhythm sounded very, very confident that the domestic flows will continue.
Yeah.
Today, we'll be hearing about the past month's
mutual fund
flows.
data. Yeah.
So that's going to be the big trigger to track. Retail is hanging on, holding in there, showing the big money. That's going to be important.
Okay, so let's straight away get to it. In terms of retail flows, hopefully we have absolutely no problems. We haven't had any for the past 6 months or so. But globally, those headlines, as we've been telling you, are, they just sends your mind in a tailspin. Because, I mean, just see what happened overnight. Very volatile session on Wall Street and indices sort of following different colors. What happened was there was this headline around 11:30, 12 o'clock our time that now instead of 25%, Trump has threatened Canada with 50% tariffs on steel and aluminum. And why is that? Because Canada said that we will be putting an additional tariff or a surcharge of 25% on the electricity exports going into the US. So there was this absolute trade war skirmish that was playing out. By the time we woke up, thankfully, it had been rolled back, and that's largely because Canada kind of dialed back on its position. You had the Ontario Premier Doug Ford saying that we will pause those additional 25% tariffs on electricity, which is, going in from Canada to the US. In response, President Trump also pressed the pause button, and he said that no, as of now, it'll be the original plan, which is 25% tariffs on steel and aluminum. So that's what happened. It did whipsaw the markets all over the place. The S&P actually intraday slipped into that technical correction territory, which is 10% fall from the peak, then kind of recovered a little bit, still ended with a cut of about 0.7%. Dow was down 1%. NASDAQ relatively better off because there was some buying, some bargain hunting going on in tech stocks, which are beaten down quite a bit. Yesterday, airline stocks are very weak. Some of the carriers in the US are coming out with a bleak outlook, cutting back their earnings expectations. So travel stocks, airline, travel, hospitality, stocks like Airbnb, they were down 4-5%. So that's where the hit was yesterday. Now, what has, Donald Trump said? For me, among all the commentary coming in yesterday, this one quote on the stock market was very, very interesting. Is the Trump put no longer available to the market? Remember, when he came into office, everybody believed that he will do whatever it takes. At the end of the day, he will keep Wall Street happy. That's not what the president is saying right now. He says yesterday, markets are going to go up and they're going to go down. But you know what? We have to rebuild our country. This is in line with comments that were earlier coming in where he said the economy is going through a transition. So watch the commentary very, very carefully. It's not what Wall Street was really prepared for. Let's move on. We've spoken about equities. Let's talk about bonds and currencies and what was happening there. And the movement in yields was about 4 to 7 basis points, depending on which one you're looking at. The 10-year has now pulled back up to 4.27, so a little bit of a rise in yields. The spotlight continues to be on the inflation number. Today, the US will look at the CPI number. Tomorrow, it's the PPI number. The CPI number is expected to show an increase of 2.9%. This is February CPI in the US. Year-on-year increase, 0.3% if you're looking at it month-on-month. Extremely crucial. It's all about inflation and inflation expectations. Are these, tariff worries feeding into the expectation on inflation going high? So that's why that data is extremely important. The dollar, at the DXY level, the dollar is still, it's just below 104. But it's a lot about, individual trading partners and how currencies are moving. Against the Canadian dollar, the US dollar actually rose yesterday. The Canadian dollar was under pressure because of all this tariff talk. Against the euro, the dollar continues to fall. The euro rose another 0.7% yesterday, now almost 109. I mean, historic levels for the dollar euro as well. That's how it kind of played out. Oil has been very range-bound. The good headline that we got was that Ukraine now finally, after that whole showdown in the Oval Office, Ukraine has relented and they're ready for a ceasefire deal if Russia agrees. So there's some breakthrough over there. Not much movement in the oil markets, actually. Oil is still very range-bound. But that was the other headline. Now, for us, the market was resilient, like, we've been talking about it. Extremely stable, one could say, in the face of this absolute global volatility. The bulls will hope, even if we can consolidate with a positive bias, slightly outperform global markets, the bulls will take it with both hands. And hopefully, the slam and dunk and the negativity around IndusInd Bank, that poison is already out of the market. So we can start getting some stability even in the bank Nifty. That's what I'll watch out for. Along with banks, I'll also look out for telecom stocks. And Rima will tell us why in just a bit. Because imagine this. Mr. Sunil Bharti Mittal was fighting this at global platforms, at local public platforms for the longest time against Starlink. And now I think it's that philosophy that if you can't beat him, join him. So that was the philosophy perhaps that was playing out because Bharti has announced that tie-up with Starlink. Starlink still needs to get its permissions to roll out in India, but that was a big one to watch out for. And in addition, PB Fintech is a stock that I'll watch out for because now we have the numbers. They're talking about this healthcare foray. Yesterday we got the numbers, 700 crores. That's how much they're putting to work. So it's sizable money. That's another one on my radar. Guys,
Well, there was one more headline from Trump that caught my attention. Is in the morning, one of the correspondents, ABC News correspondents, asked Donald Trump about the recession, right? Because it was the recession fears which roiled the markets over the last 24 hours, and this is what he had to respond. He says, "I don't see it at all. I think this country is going to boom, but as I said, I can do it the easy way or the hard way. The hard way is what I'm going to do, but the results are going to be 20 times greater." So he's downplaying the recession risks after raising it just 24 hours back. And even Commerce Secretary Howard Lutnick defended Trump's economic policies on Tuesday, saying that it's worth it, even if it leads to a recession. But as of now, Trump has downplayed the recession risk. That's the key takeaway. Now, getting back to that FI sell figure, on Monday, this FI sell figure was sub 500 crore rupees. 485 crore was the net sell. Yesterday, we got a massive 2,800 crore in terms of an FI sell, and that would worry you. But here I just want to add that maybe it's a lot to do with IndusInd Bank, because IndusInd Bank's delivery volumes was about 2,200 crore rupees, and we know the FIs own about 25% in IndusInd Bank. Now, onto the levels to watch today, just in the near term. Yesterday, we closed around the 22,500 mark. The key levels to watch on the way down, 22,314. That was the intraday low yesterday. And the high would be 22,676, which was the intraday high on Monday. So keep your eye on these two levels. Well, what will you watch today? Just a quick recap, because we've discussed this. 25% tariffs on steel and aluminium come into effect from today. US CPI inflation print. The AMFI data for February, as we've been highlighting, especially because the February demat additions were at a 21-month low. So the AMFI data, the faith, if the retail investors continue to pour in money in the Indian equity markets, it will be sort of a litmus test after the kind of mayhem we've seen in the markets. And important macro data from India, Feb CPI and the January IIP data.
Well, that's right. And I'll get back to the point when things are a little bit wobbly, do what's in your control. And it seems, the Indian markets, both on the policy front, whether you're looking what the RBI is doing, what the government of India is doing as well, and also the domestic flows have been good. So India seems to be a rather good place to be in. Now, the top cues that we look at, the Troika, well, that's well behaved. And that's something that's holding us in good stead. Dollar index is down, you have crude that's lower, and the yields as well, the 10-year yields, more or less stable. So that screen is working in our favor. Yesterday's performance was very, very encouraging. The final tick on the Nifty was at the high point of the day. So it was a resilient performance coming from the Indian markets. And the broader markets as well, pockets did very, very well. In fact, the mid-cap index was up. And now the margin trading book that had gone to 85,000 crores odd, that's come sub 70,000 crores. It's at around 69,000 crores. So a lot of that margin triggers that were getting called out and were getting, pulled out, that seems to be more or less factored in, because the margin book has come down. It was actually 85,000 crores plus, and then gradually it's been coming down. So that's good. Some of the poison out of the system. And off late, if you take a look at 2025, you'll say, well, the Indian markets have underperformed. Yes, we have underperformed, but just take a look at what we're doing in this month itself. Gradually, we're performing in line with the emerging markets. And in fact, I won't be surprised if we start doing a relative outperformance from here on, because valuations are far more palatable and domestic flows expected to remain quite solid. The pain point, that's the FI selling. That's been the problem pocket. Well, in the recent, downtick that we have seen, they've sold close to around 28 billion odd. The previous time that they sold a lot was, in 2021, 2022, when they sold $32.5 billion. So 85% of what they did that time around. And this time around, we've already corrected close to around 15 to around 16%. In yesterday's trade, yes, there was a net sell number coming in from the FIs in the cash market, but there was some buying as well that we saw in stock futures. So there was some part of that was that arbitrage that we have been talking about. Sell in the cash market, and they're buying in stock futures as well, and they're net long in stock futures. Yesterday, the markets ended up. The India VIX as well popped up very, very little. It was up close to around 0.5%, but the India VIX has been very, very well behaved. It's still holding sub that 15-16 mark, which is very, very important, indicating that there is some bullishness that's creeping back in. The options data comes up for you in the screen, and there was some put writing as well that we have seen yet again, which takes us straight to the levels. On the downside, 22,250, important mark that you're looking at. That's the near-term support that you're looking at. The firmer support comes in at around 21,800, while on the upside, closer to around the 20-day MA, that's the mark you're looking at. On the Nifty Bank as well, we're in that range. On the downside, that 47,700, that's the level that we visited yesterday as well. That needs to hold out, while resistance comes in at around that 49,000 mark, which would mean that we get past the 20-day. In terms of stocks that I'm looking at, IndusInd Bank, well, that's been the stock in focus. From from the group company itself, yesterday Ashok Leyland did see some selling pressure, and because the group now, in fact, is in a bit of a is in the spotlight for the wrong reasons, because that trust issue has hurt in IndusInd Bank. I'll keep an eye out on Ashok Leyland. Was it a knee-jerk reaction that we saw yesterday, or is there more pain in store? So that's the stock I'll be tracking.
Okay, absolutely. And take that point, yeah, we need to watch out for Ashok Leyland as well. And Rima, take your point as well. And yeah, that's important to keep that in mind, that the selling included IndusInd.
Included IndusInd,
X of that,
yeah.
maybe we should still be on a good wicket.
Well, let's see. As you said, right, perhaps most of the poison is out of IndusInd Bank in terms of selling. So today's FI numbers will be important. Mark Franklin, Deputy Head of Multi-Asset Solutions Asia and Manulife Investments, is now with us on the show. Mark, thank you very much for joining in. First, let's just get the top-down view on the US markets, because they're seeing the biggest sell-off that we've seen in recent times. So one, is there reason to be bearish on US equities? Two, at Manulife, do you think US economy is likely to head into a recession? And three, Fed rate cuts from here on the table or off?
Good morning. The recent price action in the US equity market is symptomatic of a rising degree of policy uncertainty. And policy uncertainty correlates quite tightly with risk premia. And what you're seeing is, at the start of the year, positioning was quite extended in the long direction, and you're seeing some money come out of the US equity market to factor in a higher risk premium, or the return that's required to effectively take that level of risk on. Now, with respect to your second question, do we anticipate a recession? I'd go back to the point around what we're seeing by way of signaling from not just President Trump, but also Scott Bessent, the Treasury Secretary as well. They're really singing from the same hymn sheet here, notably that the economy needs to go through a rebalancing away from an unsustainable fiscal and debt trajectory, heavily driven by government spending, more towards a pivot back towards the private sector and private sector job creation. That's going to create some downdrafts in the very short term, because it will take a while for the private sector to pick up the slack in terms of job creation and spending momentum from the public sector. But first, what they need to do is reduce the deficit in order to create fiscal room to start cutting taxes, push through deregulation, which will then drive the private sector. So we do expect a moderating growth path in the US in the early months of this year, but the potential for a re-acceleration later this year. But of course, when you try to rebalance the economy, there are sometimes unintended consequences. And the moderation that you're aiming for can also run the risk of becoming something more concerning. So we remain on watch in terms of the pace of the moderation of the data. And with respect to Fed cuts, we still think that 2 to 3 cuts by the Fed this year is a reasonable base case. And interestingly, the market has now pushed back towards pricing of 3.5 cuts this year. So that comes off the back of a much less reduced number of cuts priced in at the start of the year, about 1 cut. So we are seeing quite a significant amount of volatility in bond pricing and rate cut pricing. Don't be surprised if we see ongoing volatility moving from one data point to the next, because the visibility is really quite murky at this point in time.
Yeah, I don't envy your position at all, Mark. Hi, good morning. Thank you for being with us on the show. Literally, money managers like yourselves, I mean, probably not an easy time at all to figure things out. Which brings me to the question, since you folks look at multi-asset strategies, where are you putting the money? And is India featuring anywhere in your list?
Well, first thing to say is we actually relish an environment where you have to be more selective. We're effectively earning our fees by being selective and picking those spots in the market which are more resilient in the face of rising volatility, and avoiding those parts of the market which are perhaps overbought. In terms of where we've been putting our money, we've been much more positive on bonds, treasury bonds, and high quality credit bonds in the last few months, because we saw a potential for yields to come down as the data starts to moderate. But our broader view this year is that bonds will trade in a very wide trading range. And so we are expecting some potential reversals at some point. So that tactical shift into bonds, we're looking to lock in some gains there in anticipation that as we get into the middle of the year, maybe the data will stabilize. More broadly as well, we think there's a secular appeal for commodities, whether it's gold and precious metals as an inflation hedge, as a geopolitical hedge, but also some of the more cyclical commodities, which benefit quite nicely from this tariff policy introduction, but also a structural scarcity because of underinvestment in new supply over many, many years. So commodities, we think, deserve not just a tactical place, but potentially a secular position in portfolios. Now, with respect to India, we still very much remain supportive of the long-term structural story. And indeed, growth is holding up reasonably well in India. Q4 GDP growth at 6.2%, inflation coming in a very benign fashion as food prices cool, which is quite the opposite in terms of other economies and food price inflation that we're seeing outside of India. But in the short term, we do think that this valuation reset has a little bit more to run. And India very much played a safe haven status in the last couple of years within an emerging markets context, both in terms of China's cyclical challenges, but also other markets showing some moderating growth developments and tightening monetary policy. And as a result of a bit more enthusiasm towards Hong Kong, China markets, a bit more of a weakening of the dollar in recent weeks, you're seeing some money come out of very overweight positions by foreign investors and recycling that into laggard markets to play that catch-up trade. So we think that plays out a little bit longer, but we haven't seen anything to dim our confidence in the long-term story for India. So we are on watch for opportunities to re-establish an overweight position, having gone neutral to somewhat cautious on a tactical basis in the last few months.
All right, Mark, very quickly, from the global market perspective, where does India rank? You briefly spoke about US. I think you have a view on Europe as well, China and India. So where does India rank in that order from the equity market allocation?
Yeah, so from an asset allocation perspective, we've been overweight Asian markets, top down, but selective within that. So we have liked Hong Kong, China tactically. India's been towards the low end of that rankings on a shorter term time horizon, but we are looking for opportunities to increase that ranking within an Asia context and within a developed markets context. US markets have obviously had a tough start to the year. We still like the fundamental outlook, certainly for both large and small caps in terms of earnings momentum, but we did upgrade European equities to a confident neutral about 2 months ago. And we've seen a nice tailwind from, let's say, a reimagining of the fiscal policy outlook, particularly with defense spending. Fast forward to the end of this quarter and beyond, we think that we're getting a bit more of an opportunistic buying opportunity in US equities, but it remains to be seen whether any bounties hold and are significant enough to be able to trade around. So we're kind of taking a very selective approach, case by case, month by month. But as I mentioned earlier, we haven't dimmed our views around the structural, the secular opportunities that the Indian market presents, but it's about making sure that we're sufficiently confident that the valuation reset has fully played out and we do have a longer term buying opportunity in place.
All right.
Okay, all right. Thanks very much, Mark. We'll leave it on that note for now. Let's quickly move on. We have lots of corporate interactions and market views lined up on the show as well. So let's tell you about it. At 8:35, we'll get you excerpts from our conversation with Warren Harris of Tata Technologies on the automotive output and the impact of Trump tariffs. At 9 a.m., we discuss Starlink's entry into India along with Bharti Airtel. Balaji Subramaniam of IIFL will join in with some perspective. At 9:20, our special segment Market Masters with the City India team comes up. We will be connecting with Surendra Goyal, Samiran Chakrabarti, Kunal Shah of Citi with their call on India macros and, of course, the Indian market. After that, Sunil Bora of Uno Minda joins in. We will discuss the company's business momentum and outlook as we step into the new fiscal. And towards the end of the show in It's the Economy, Lata today will be speaking with the head of Credit Bureau Sybil on NPAs in retail loans.
Well, time to slip in a short break, but we've got a lot of stock-specific action that we're tracking for you. We get to that in just a bit in our special Top 10 segment. We're looking at Bharti Airtel, Tata Motors, SBI, ICICI Bank, IDBI Bank. All of them will be reacting to positive news flow. Add to the list, Axis Bank, you have PB Fintech, Paytm, Godrej Agrovet, and RVNL. Stay tuned. We'll get into further detail on all of these stocks that are expected to react to positive news flow.
Welcome back. So let's just pull up the Asian picture as well and get a sense of where the implied open is. Asian markets are very mixed this morning with this whole roller coaster on Wall Street. There's some green on, for instance, the Japanese market. The Hong Kong market and the Shanghai market are under a little bit of pressure, but not much, as you can see. It's barely down, the Hang Seng. Let's pull up the implied is right there. Implied is also very flat along with the Qs in the rest of Asia. So will today be the day of recovery? You get through this opening and then can the bulls build from there? It's also going to be a day to focus on a lot of individual stocks. There's plenty of news flow. So let's straight away get to our team for the CNBC-TV18 list of top stocks to watch. And topping that list, of course, has to be, morning to all of you guys, but topping that list has to be Bharti Airtel, Rima. So Starlink and Bharti, the tie-up is happening.
Indeed. So Bharti yesterday in a press release has announced an agreement with SpaceX to bring Starlink's high-speed satellite internet to the Indian customers. Now, right now, it's a partnership. Now, what they will explore is Starlink's equipment, because to get that satellite connectivity, you need certain equipment that will be available in retail stores. Airtel will be able to offer Starlink services to the customers, which hitherto they could not service on account of lack of last-mile connectivity. They didn't probably have the cables. So it's an opportunity for Bharti Airtel also to expand its service offering to enterprises. Maybe a corporate has, some headquarters in a very difficult location, say a mining location where you don't have that much connectivity. Then you can offer it to enterprises as well as customers. So it opens up new revenue streams for Airtel. But again, we don't know how much because, satellite connectivity would be more expensive than terrestrial. So how many people would, take that on board? Perhaps it will be more useful for enterprises. The release is not saying it's going to be an exclusive partnership. Also, Starlink is yet to receive its license in India. The spectrum allocation is yet to be done, which means at least in the near term, it's not that it's going to be, immediately money is going to start flowing into Bharti Airtel's coffers. But the good part is that Airtel is not fighting it out. Instead of it being Starlink being a competitor, it's now there's going to be collaboration, right? So whatever money has to come, it will be shared between the two. So in that sense,
it's neutralized the threat.
It's
so to
neutralized
speak, right?
the threat, right? Collaboration over competition.
Smart strategy, perhaps. Okay.
And it's not exclusive as well.
No, we don't know. The press release isn't saying that it's exclusive. Right? So who knows, right? They could just tie up with Jio as well or Vodafone Idea in the future, but we don't know right now.
All right. Okay. All right. Let's hop across to Sudarshan. He's here to tell us about Tata Motors. Sudarshan?
So good morning, Nigel. Tata Motors CFO held analyst meet yesterday, and the commentary coming out of that is largely positive. But first, talking about the stock is near 52-week low. It's down 12% in the last 2 to 3 months. Now, talking about the commentary, first on the JLR front, it maintains Q4 guidance, Q4 EBIT margin guidance of 10%, and it says that it will be net debt free by FY25 end. Now, on geography, it says US is progressing well. In EU, the environment has been less challenging that company had expected. In China, it's saying that it's outperforming industry, and for UK, it's saying that it's improving well. On domestic front, it says that CV segment has been doing good, but PV has to see an improvement, and going forward, the focus has to arrest market share loss, especially in the small CV segment. Even brokerages are largely positive on the stock. Nomura has a buy call with a target of 861. Macquarie has an outperform call with a target of 826. CLSA has high conviction outperform call and target is 930. Goldman Sachs has neutral stance, target is 690. And Nuvama has a reduced call and target is 720. But I'm going with green on Tata Motors on the basis of commentary coming out of the analyst meet.
Thank you very much for that. We were just talking about how the Bharti press release doesn't say it's an exclusive partnership with Starlink.
Well,
it's not because Jio Platforms has just announced that they too will be bringing SpaceX Starlink high-speed internet to all its customers. So SpaceX Starlink has tied up both with Bharti Airtel and Reliance Jio. Now, do they tie up with Vodafone Idea also? We'll have to wait by to see. But for now, Bharti Airtel and Reliance Jio.
So now they have to compete with each other, not with Starlink and Mr. Musk, because he's anyway tied up with everybody for last mile connectivity, because these companies know the Indian market, right? So he will continue to sell his services. It's between
So,
Jio and Bharti to fight and figure out who can do a better job.
So, all these big major, telecom company heads in India, they've always said that satellite connectivity should be used more and should be seen as something for greater good, because 40% of the Indian population is still not connected to the internet. And the problem is last mile connectivity. It's very hard to put cables, etc.
Yeah.
So therefore, we are trying to serve a greater good by providing them connectivity through the satellite.
Yeah.
So, that's always been the philosophy behind this, the satellite expansion and satellite communication.
Yeah.
So now they'll all come together and provide all Indians connectivity.
Well, that's the greater good, of course. And whether it starts impacting any of the, the wider services as well, we'll find out. 9 o'clock, a full-blown discussion coming up on this with the analysts and experts at IIFL. So wait by for that. We'll get you more on this. And that's the news on the screen, that it's now not just Airtel, but Jio is in this as well. They also have announced a tie-up with SpaceX's Starlink, high-speed internet to customers. Remember, Airtel was saying that they will be selling a lot of the Starlink equipment through their retail stores, etc. So we'll see how this plays out. But let's quickly move on. More stocks in news as well. And a lot of banks are going to be in focus because this big resolution plan for JP Associates. Let's find out what's the latest on this one. Ritu, good morning.
Good morning, Surbhi. Green for banks because, it's a landmark resolution nearly a decade in the making. 25 banks led by State Bank of India and ICICI Bank have finally executed the transfer of the stress loans belonging to Jaiprakash Associates to NARCL, which is the National Asset Reconstruction Company. Now, against the principal outstanding of 14,500 crores, banks get 12,000 crores from NARCL for the sale. Of course, the total outstanding debt for JP, including all the overdues, interest and penalties, since it's been an NPA since 2016, is well over 52,000 crore rupees. Now, the deal, we understand, follows that 1585 structure. So 1,800 crores of cash gets paid upfront and the rest in the form of security receipts. And it is going to reflect in the bank's balance sheet in the current quarter itself. So you have SBI alone recovering about 500 crores in cash, another 2840 crores in the form of security receipts, while ICICI Bank, IDBI Bank, Axis and others also secure some recoveries. Meanwhile, the insolvency process will continue. The EOI submission deadline has been extended to the 25th of March, and the final recoveries for banks from security receipts are going to depend on the IBC process.
Okay, all right. Thanks a lot for that, Ritu. Good to see you early in the morning. Well, let's hop across to Sapna. She's here to tell us about the news flow on Paytm. Sapna?
Well, what we have picked up is the fact that, the government may be reconsidering the exemption that has been given in terms of the merchant discount rates to UPI as well as the RuPay cards. If you recall, way back in 2020, from 1st Jan onwards, this exemption had rolled out. The finance minister had made a specific announcement in December 2019. But having said that, the way the digital payments ecosystem has grown, there are indications that capital is required for further investments and further growth. That's one aspect. Second, I think the government would also be liking to have a kind of a level playing field with the private card issuers like your Visas and MasterCards, where the MDR very much continues, but there's nothing on RuPay cards. And third aspect, of course, even while reconsidering this and doing a rethink on this entire matter, what they would like to emphasize is that if in case the MDR as a revenue model comes back, that cost should not be passed on to the customers. Well, all of this is at a very preliminary stage. Let me clarify that. But having said that, there's a serious rethink going on within the government circles on this matter. And probably over the next couple of months, we should hear something about this.
Thank you very much for that. It's over now to Vamakshi for the latest on Godrej Agrovet.
Well, good morning, Reema. The stock will be in focus because they will be acquiring the residual 48% stake in Creamline Dairy Products. This acquisition will be done for nearly 930 crores, and after this, it will become the wholly owned subsidiary of Godrej Agrovet. Keep in mind that Creamline Dairy is engaged in milk procurement, processing of milk, manufacturing and selling of milk, as well as some milk products. Now, when we talk about the valuation, at the 48% stake for 930 crores brings the company's valuation to 1,935 crores. The revenue for the company in FY24 was at 1,540.5 crores, which puts the price to sales ratio at 1.26 times. So overall, given this development, going with the green for Godrej Agrovet.
Okay, all right. Got that, Vamakshi. Thank you very much for that. Let's move on to, she's tracking the developments at PB Fintech because like I was saying earlier, now we have the numbers. This healthcare foray, they're almost putting 700 crores to work. Yash, on this?
Well, that's correct. This was awaited, the monetization value unlocking as far as the healthcare vertical is concerned, and the process has begun. What PB Fintech has informed the exchanges is that they would be infusing. This is the PB Fintech listed entity, would be infusing about 696 crore rupees to own a 33.63% stake in the healthcare foray, that is PB Healthcare. Now, this is with respect to PB Fintech, but certain senior employees of PB Fintech as well as the founder would also be infusing some money into the PB Healthcare or the healthcare foray. Yashish Dahiya would be infusing 87 crore for a 4.2% stake. 43.5 crore would be infused by co-founder Alok Bansal for a 2.1% stake. Sarabveer Singh as well as Mandeep Mehta and Bhaskar Joshi would be infusing 2.25 crore per 0.11% stake. A total of about 40.04% stake being given out through this particular transaction for a total infusion of 828.75 crore rupees. Left with is about 60% stake, and that will be very important because that will get money into PB Fintech and of course the healthcare foray itself from other investors. And this is just, just to put a number to it, this transaction has happened at a valuation of nearly about 2100 crore rupees.
Okay, all right, got it. So PB Healthcare, another stock on our radar today. Yash, thank you for that. Let's quickly recap the list then of all the stocks that we need to watch out for. The ones that have positive news flow around them: Bharti Airtel, Tata Motors, SBI, ICICI Bank, IDBI Bank, Axis Bank, PB Fintech, Paytm, Godrej Agrovet, and of course Reliance Industries. This is on the back of the Starlink development that's just come in today. No stocks actually that have negative news flow and that may open in the red because of negative news, that is, at least. Well, that's equities. Let's quickly figure out what's the latest in the world of commodities. We have Manisha joining in. Manisha, 25% tariff, 50%, now it's back to 25%. It's too much, right? But you tell us, what have you been tracking over the last 12 hours?
Oh, well, absolutely. So the chaotic implementation of tariffs is leading to a lot of uncertainty into the markets there. Well, as you said, we do understand that 25% tariffs on steel and aluminum go into effect today and not the 50% on Canada. But we also do understand that the US and Canada will hold negotiations this week on trade and tariffs. So the story is far from over. You will continue to see very, very volatile trades happening in metals. But in the meanwhile, overnight, as the street was reacting to all of this in the New York session, we've seen prices actually gain for many of these metals. Steel prices gained up by a percentage point. Iron ore prices have been holding around 2-month highs. Copper jumped up by 2.5%. We saw silver gain up by 3%. Gold was up 1% as well. The US dollar index trading at a 4-month lows clearly has been supportive. And the markets will watch out for the US inflation data that comes in today. And this is going to be the most important number to watch out for ahead of the US Fed meeting, which is on 17th and 18th of March. So clearly, there's a handful of stuff to watch out in sense of global events, and the market continues to be quite volatile.
Thank you, Manisha, for that important update on commodities. We'll slip into a very short break. On the other side, we'll connect with Deven Choksi for some fundamental stock talk.
Now, if you look at the foreign portfolio position in India, they are the most underweight they've been on Indian equities ever.
Yeah.
And most importantly, India is now a low beta market, unlike the past.
Yeah.
So if you go back 10, 15 years, India used to be a market which had a beta of more than 1. And for your listeners, that means that India used to go up or down a lot more than the world. Now, if the world is in a trickier position than it has been for many years, the likelihood is that India will outperform. India is like consumer staple stocks. It will outperform a bear market in the world. In February, a policy pivot which I will say is one of the biggest in my career, going back 35 years. The RBI has put a 3-pronged correction, cutting interest rates, committing itself to liquidity, and also starting to lift the regulatory burden on the banking sector. The RBI policy suite, the market has just ignored this, what I call as policy pivot. India's policy environment today is far more certain than the rest of the world put together, whether it's US, Europe or China. So you want to buy this policy certainty, and I think investors will buy it. Our retail investors get it, and I suspect that February may have been record inflows, and a lot of people have been quizzing me about when will retail give up, and I've got tired of saying this, they won't.
Welcome back. Well, the markets are indicating that we open up more or less flattish, but for the time being, let's get some fundamental analysis going. Devin Choksi of DR Choksi Finserv joins us on the show. Hi, Devin. Good morning. Always good to see you. And I think the markets are in a better space in comparison to maybe the last couple of weeks or so. So that's good news. Let's focus on a couple of names. Yesterday, IndusInd Bank was the big casualty. The stock lost more than 25% of its market capitalization in a single day. And the problem is not valuations, the problem is now trust. And that's why, on a 2.5% impact, you see the market capitalization getting eroded by close to around 30%. What's your view on the stock? And also it had a rub-off effect on Ashok Leyland. And now the fear is maybe, in fact, some of that promoter pledge will come into question. Your view on both these two names?
Hey, Nigel. Good morning. Well, I think without getting into what the domino effect it could have, I would think that on the fundamental merits, the IndusInd Bank probably, I think, will have to absorb this amount, I think, which they already said that they will. And maybe I think they have to get along with the entire subject hereafter. But more important aspect out there is that such a big item, I think, remains absent as far as I think the controlling mechanism is concerned. And as a result of which, I think the disclosure has not taken place. Both these issues, I think they go side by side. On one side, I think the hedging mechanism remain absent in this particular transaction, amounting to such a huge amount of loss. And on the other side, I think the reporting mechanism also remain absent, and that is where the issues of trust arises. At this point of time, though the price is significantly corrected, the downside may be less comparatively, but enough amount of confidence to gain. I guess I think one will have to pass through a quarter's result, and thereafter one can possibly look into this particular stock of hedge.
Since we're talking about IndusInd Bank, maybe we can get to those bites as well, because we did speak with Mr. Sumant Katpalia. This was just after market hours yesterday, and got his sense and his explanation about everything that's transpired, the massive destruction of wealth, and how the board as well as the management plans to win shareholder trust back. Take a look.
During a review of the processes in connection with the compliance to the RBI circular on investments portfolios, we found that there were some gaps which were coming out. And that was really the start of the issue. We found this anomaly around October, and that is where we started our internal assessment, as well as we hired an external agency, At that point of time, we did not know the difference, and we knew that there were 2 deals getting accounted incorrectly, but there's so many deals in that, so we did not know the real impact. And I think as soon as we got to know the impact, we held a board meeting and we informed our board and we did the disclosure. You know what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU and you should see the growth that the bank is seeing and the profitability which the bank is used to. The full year will not be a loss at all. And I think the quarter 4 itself also will be a profit.
Okay, so that's a statement on sort of getting back to business, Mr. Katpalia. But let's see if the market is willing to, show it some love again, because yesterday it was real break in perhaps confidence. That's what we saw yesterday. Anyway, beyond IndusInd Bank, Devin, hi, morning. More stocks to discuss with you. I wanted to put the spotlight on PB Fintech. I don't know if you caught this or not, because they announced this healthcare foray a while back, right? I mean, the intention is to create some sort of maybe a network of hospitals or something very specific so that they can keep costs in check. And now they're talking about infusing almost 700 crores in this company, PB Healthcare. How do you view the company and the stock?
Yes, sir. Good morning. Well, I think without getting into specific at this point of time, because I don't have complete detail in front of me, I believe that the healthcare market per se, I think, is growing and growing exponentially as far as I think the country's overall population is concerned. Now, given the kind of strength that they have demonstrated in the platform business, I think if they end up creating a similar kind of impact, probably in the healthcare segment, it could mean that significant amount of business to talk about. How they integrate themselves with the hospitals and other healthcare facilities is something which one needs to study based on, I think, the business model that they will probably disclose at some point of time. But the size of the healthcare market remains, I think, absolutely very convincing. And any player, I think, trying to integrate themselves into this particular business could possibly see better times going forward.
Okay, all right. That's on PB Healthcare. Devin, let's talk about the other big story. Starlink seems to be all set for its India entry. I mean, they still need to get government approvals, regulatory approvals. But they've tied up with both Jio as well as Bharti Airtel. What's your sense? I mean, I don't know if this is going to cause any sort of meaningful impact in terms of earnings, P&L in year 1 itself or not. But what would your call be on both the stocks? I mean, on Reliance as well as on Bharti in light of these developments?
Yes, I think this has been a missing link between both these companies as far as I think providing the broadband services to the satellite is concerned. Though I think both these companies have created their own setup, I think, for that, but still, I think this is an important tie-up that I would call it as. Even though I consider that out of 140 crore population, I think the uncovered segment of the population would be somewhere around between 9 to 12 crores, which is less than 10% of the population. It may remain uncovered through the current fiber network, the wireline network, and not forgetting the fact that government is significantly putting money in the fiber for BSNL to go to the last mile connectivity. Given the kind of a situation of a small population still remaining uncovered, I would like to think that largely this particular tie-up could possibly offer some of the related services in the defense as well as in the healthcare, which could possibly be a meaningful kind of a use of the satellite-based communication that these two companies will be providing. There is a rough cut estimate available about the size of the market, which is close to around $19 billion, but that needs to be established. I don't think that I think immediately one can count on that particular aspect. But yes, I think this is one missing link clause in the business model of both these companies, which is now getting plugged in. And should the regulatory clearance come in, we'll come to know about how they roll out the business models.
Okay, all right. Devin, what about Tata Motors? You know, there were the management met various sell-side analysts. The stock has seen a sharp pullback from the top. Do you think it's a good time to get in now?
Yes, Nigel, absolutely. I think the correction in the stock price is probably more than warranted. I think that the fundamentals of the business remain absolutely strong and convincing. In the passenger vehicle segment as well as in the commercial vehicle segment, I think this company has given, I think, a good amount of direction about how to manage the cost and grow the market share in the business. Passenger vehicle is a classic turnaround story that they have demonstrated. including in electric vehicles, wherein they have been early starters in this particular line of activity and have created the impact in the market by way of producing the profitable business. And same is situation with commercial vehicle, which is getting demerged from the mainframe Tata Motors in the current year. So obviously, I think we are likely to see the larger amount of growth coming into this particular business. We remain distinctly confident about the possibilities of some kind of synergy of the tie-up with the global markets opening up. And maybe I think some of the global companies want to take plunge in India. They may probably look at the synergetic tie-up with companies like Tata Motors. So that is a good possibility which can be ruled out. Current level, yes, I think everything is discounted in the price. Maybe the stock demands, I think, a fresh look into the portfolio.
Okay, all right, Devin. Good hearing your thoughts as always. Thanks a lot for joining in. Wishing you a good trading session ahead and looking forward to chatting up with you in the coming days as well. Well, time to slip into a short break. Up next, Sudarshan as well as Mitesh, they're waiting for us. They'll give us how do they see the markets pan out on the technical front. Stay with us.
Sabya, that we are at a point which is almost an existential crisis for a whole host of arts and artisans across this country. I mean, you were talking about the fact that this shouldn't be treated like a charity. It shouldn't be treated like a CSR project. What kind of interventions do you believe we need at this point in time to ensure that we keep this soft power alive?
You know, we don't need to do much because evolution will take care of itself. Because I'll tell you, so we were at the age of influence, which is moving into the age of intelligence. AI is going to come in. And I personally think that AI in many sectors, especially in performing arts and art, will be very short-lived. Because after the age of intelligence will come the age of wisdom. And when the age of wisdom comes in and people realize that the greatest gift to humanity is humans themselves and we should not robotize our existence so much that we forget to be human beings, then people will realize that art and craft is going to be the most important expression of humanity. We don't have to do much. Evolution will take care of itself.
We certainly hope so. Speaking of the dynamics changing, and you were talking about the consumer and the consumer being your biggest influencers, so to speak. You know, the Sabya bride, you kind of turned that on its head, right? I mean, the Indian brides were always coy, demure, shy. There was almost this invisibilization, and you kind of turned that around completely. How did that happen? I mean, was this because of the influence of the strong women in your life? You know, what was it that you were trying to tell by way of attempting to sort of turn this on its head?
See, I don't really understand gender inequality because in my head it doesn't exist. You know, I've been raised by, you know, thank you. And you know, sometimes I tell that, you know, the problem with gender inequality actually starts with bad parenting. Because I think if you raise your boys to believe that they're not better than women, but they're equal to women, I think men will be far more sensitive to gender parity than they are today. And, you know, I have grown up with women who I've looked up to. You know, my friends growing up, my girlfriends growing up, they were very strong women, and you know, I was in awe of them. And let's talk about the bridal market, for instance. You know, so I'll tell you a small story. So I meet a lot of women in India, mothers in India, who believe that I can matchmake for their daughters. And
can you?
No. No.
Wait.
Welcome back. As promised, we have Sudarshan and Mitesh who are both standing by. Good morning, gentlemen, and good to see you. Ben, Sudarshan, let's start with you first. Yesterday, you said, you know, dips should be used as buying opportunities provided the 22,250 level holds out. That's the way it panned out. So good on you. What's the trade for today, and where do you see resistance coming at?
Yeah, good morning. I think the trade continues. If you have a position, keep it. If you don't have a position, wait for intraday dips. They may not be as deep as yesterday, but they'll come and go long. It's always better to, you know, buy at a lower price, especially when the trend is not clear. So the trade is short-term trend remains intact. We have seen how the markets bounced back yesterday. Now so be long, and to your second question and where resistance could come in. See, once markets pick up momentum, resistance becomes immaterial. But even then, somewhere around 22,750, 22,800, I would expect the markets to pause if it goes there.
Okay, all right, got that, Mitesh. Let's come across to you. What's your trade this morning? The GIFT Nifty, at the last I checked, from indicating a negative 50 points opening, it's now indicating a more or less flattish start. What do you do?
I think, I've been looking at the charts, and now I think there are first signs that on the daily charts, till now I think all the reversals were on the intraday, hourly to hourly charts. Now I think there are first signs that we might be willing to move higher, because a lot of indicators are turning the direction from oversold levels. And while, there are significant supply pivots on the upside still left to be captured, I would, unless until we break 22,300, I would bet for a retest of 22,600, 650 zone, which is where there was a gap last Friday. And once that is being cleared, then I think we should head towards 22,750, 800. And beyond that, we get into a much stronger up move. So I'm considering that possibility is a very strong outcome which could happen over the next few days. So in that sense, I'm positive. My reversal point will come in case we see the Nifty start trading below 22,300 levels.
Okay. All right. So hopefully playing for a recovery and bounce. Got it, gentlemen. Let's come to stocks as well. Sudarshan, what would your list look like?
Well, it's mainly buying. Tata Motors is a buy with a stop at the 624. ABB is a buy with a stop at the 5,000. I have one intraday short, that is CDSL, Central Depository. It's an intraday short with a stop above 1150. And finally, CAMS, which has gone through a very deep correction, is now a buying opportunity with a stop under 3,200.
Got that. Mitesh, morning. What would your recommendations be?
Yeah. I have all buy calls in line with my outlook, which is slightly on the positive side. So Ambuja is a conditional buy. If it starts getting past 498, buy with a stop at 490. Look for a first target of 515. A buy on Asian Paints with a stop at 2270 for a target of 2340. BEL is another one which is looking good. Buy here with a stop at 270 for targets of 290. And after a long time, I have a buy on DMart with a stop at 3590 for targets of 3720.
Okay, got that. Mitesh, just a quick question on IndusInd Bank. I mean, of course, levels to watch, yes. If someone's still stuck, if someone couldn't get out yesterday, what would your advice be? And typically, when you've seen this with other big stocks, some event, some issue, when suddenly there's a collapse, 10-15% collapse, is there any lesson that one can take or any parallel that one can draw from the past? I mean, what should traders be doing with the stock that's gone into a free fall like this one?
I think the parallels are bad. I think I remember D1 Housing Finance and Yes Bank going through some accounting issues. Now, I don't know how serious this issue is, because obviously I'm not the one who is looking at balance sheets, etc. But just looking at the long-term charts, the damage is clearly there. I was hoping that if this decline could get arrested around 750 odd levels, which is where the markets had bottomed in June of 22, you could at least do some base building and try and look for some reversal. But now I think it looks like we are looking at 600 as the minimum, and in a worst case scenario, even 525, 530. So to me, it looks like it's just sell on rallies. I think that's the way I'll approach it.
Rally. Got it. Need to take a very quick break. We'll be back with the pre-opening trades in just a bit and a conversation on the telecom space.
Life.
About the consumer, not just the Indian consumer, but also the global consumer that you're hoping to tap into now, Sabya. What's changed? You talked about social media. You talked about the world of influencers and content creators and how that's also shaping the choices that consumers make. In your experience, as someone who understands the fashion industry, as someone who's been part of the fashion industry, what's the big change that you're seeing in terms of consumption and consumer behavior today?
I think self-confidence and self-expression. Truth be told, and I've said this in many forums, that fashion has made a lot of money by feeding on people's insecurities. So the more insecure you kept your consumer, the more they wanted to buy your product because they wanted to feel good about themselves. But what fashion didn't realize for the longest time, that the consumer was getting smarter and sharper. And anyways, I think the Indian consumer is probably the smartest consumer in the world. And, I think that when you have and also at a time, a lot of luxury goods were consumed by the idle rich. Today, if you look at the people who are really buying luxury in India, everybody's working, nobody has time, everybody's self-reliant, everybody has self-confidence, everybody has self-expression. And, then the consumer shifts from being brand supreme to product supreme. A consumer just wants to buy the right product, not the right brand. And at Sabyasachi, we want to get the product right. Whether the brand becomes a super brand or not, it's an outcome of the product, not the brand. And I think globally, when the consumer is going to now realize that that luxury is based on rarity, craftsmanship, authenticity, and provenance, where else can you find a luxury product more unique than what you would find in India? So I think whether people, no matter what happens, no matter how much artfully the spin doctors and the global markets try to dominate India, they can't put India in a corner because it's just not going to be possible because the consumers won't let them.
Fear today, what globally, and I did address that in the remarks that I made early on. There's this talk about the tyranny of diversity and inclusion. Do you worry that we're likely to see a pullback, a retreat from some of these issues that require urgent intervention and action?
So thanks, Shireen. I think firstly, Shireen, the minute you combine diversity and inclusion together, I think the likelihood of pullback is very, very low. Because what...
Welcome back. Just awaiting the pre-opening rates. But in the meanwhile, today is also a big day for bond markets. The RBI will be buying via an auction a massive 50,000 crore of bonds. Also, the February CPI is due today at 4 p.m. along with the January IIP data. A CNBC-TV18 poll sees the Feb inflation number sub 4%. Lata is here with us in the studio with more. Lata.
Well, the CPI number is going to be something people will watch out for because future rate cuts will depend on that. And it's almost certain that that number is going to be below 4%. So clearly that once you see that number, you can expect the April rate cut. The important number will be the food CPI because that's the one that's been between 8 and 11% for the better part of last 18 months. So that's going to fall all the way to below 5%, probably for the first time in 2-3 years. That number will be closely watched. The average we got in our poll is 4.1%. And core CPI will start inching up because of the low base, and that's expected to come at 3.8. The industrial output is not a number people watch out for. But anyway, the average over there that we have got is 3.2%, which means clearly industrial growth is not going anywhere. The key point is that it's a big day for bond markets, as you pointed out. It's not just that you will get a CPI number which is 3 point something, which is always a matter of exhilaration. But I can't remember when the Reserve Bank, if it ever bought in one shot, 50,000 crore of bonds. So it's going to be big in that sense. Will the market move? My guess is it won't, because both these are well telescoped events. For the longest time, we know that February inflation is going to fall. And we know, at least for the last 2 weeks, that the Reserve Bank is in liquidity infusion mode and will buy this 50,000 crore. So it's well telescoped. Also, people will be worried about the US CPI number, which is going to come later in the evening, after all this data, after our bond market stop trading, and that number is expected to be probably south of 3. If it is south of 3%, then it will be considered good for bond markets. So 2.9 is what the polls are throwing up. The real fall in bond yields in India is going to happen probably next quarter, when clearly the supply is going to be much less than the demand. Foreign funds coming back, RBI also buying, and a rate cut expected probably too. So we'll really see a rally only afterwards. For the moment, it's all in the price.
Thank you very much for that. But the big story is what's brewing in the telecom space, where Elon Musk's Starlink, which is under SpaceX, is tied up both with Bharti Airtel and Reliance Jio to provide satellite communication. Now, this is primarily to serve, remote regions where it's very difficult for the cable or wire to reach. So the underserved areas is what they're planning to tap into. But remember, as of now, Starlink does not have the required government approval. So it's not going to be an immediate, the revenues for the telecom, both Bharti Airtel and Reliance Jio, will not immediately accrue. And the other important point to note is that globally, it's also very expensive. India's terrestrial networks particularly are very affordable. But Ashmit is here with some more regulatory hurdles that Starlink could face. Ashmit.
Well, it's important clarification that you've given that both Airtel as well as Jio, while making their announcement with about their tie-up with Starlink, were careful to point out that as far as this entire process going forward is concerned, it is subject to Starlink's securing necessary approvals. So what are these necessary approvals? What are the regulatory issues that Starlink will have to watch for? There are three aspects to watch. Number one, Starlink will have to secure authorization from IN-SPACE, which is essentially the Indian National Space Promotion and Authorization Center. There's a standing committee that comprises of the Home Ministry as well as the Department of Space. Necessary approval and authorization from them to allow for these connection services, mobile connection services through satellite is something that they'll have to secure. We're given to understand that they've made this approval is in advanced stages. They've made various submissions. There are concerns that were raised by the MHA as well as by the Department of Space, which Starlink is trying to address. So that's one, that's the first step that Starlink will need to clear. The second is an operator's license from the Department of Telecom. That will be the second key hurdle. We've spoken to the telecom minister previously, Jyotiraditya Scindia. He was careful to point out that there are still some niggles left, especially from a security standpoint that Starlink is yet to resolve. And this entire process going forward will be subject to those satisfaction, the Indian government satisfaction of those security concerns. So Starlink is going to have to satisfy those concerns and then subsequently procure and the clearance from the DOT as far as the operator's license is concerned. The third aspect, and this is with respect to the TRAI, this is with respect to the spectrum. There has been a fair bit of debate ever since the Telecom Act was brought into place as to what will be the nature of spectrum allocation. Will it be allotted? Will it be auctioned? The view that has been coming from the DOT consistently, and we have spoken to the telecom minister on this as well, is that spectrum, especially for satellite services, given that it is a shared spectrum, will be allocated administratively. The question there is, what will then be the pricing of this allocated spectrum? That issue has been referred by the DOT to the TRAI. The TRAI is currently considering it. It has invited applications from various stakeholders. It has invited feedback from various stakeholders. Is yet to give clarity, but that will be the key to this entire aspect. You pointed out the pricing. Starlink is concerned. But if that is to be made affordable, if that is to be made comparable to the terrestrial networks, the pricing of this will again be critical for Starlink and any ambitions that it has in terms of widespread penetration.
No, absolutely, Ashmit. And many of these debates were very public debates. I think events that you were covering in Delhi, I remember at the Bharat Mandapam, I think it was the India Mobile Congress, right, where Mr. Sunil Bharti Mittal was making a very, very sort of public plea to say that maybe it should be a fair treatment should be given to all. A lot of Indian companies have put in millions and billions of dollars to roll out these terrestrial networks. It's very interesting now that these companies have actually tied up with Starlink. So maybe some of the background parlays have also led to some positive conclusions. Thank you very much for that. Let's actually take this forward with our next guest. We have with us Balaji Subramaniam, Vice President at IIFL Securities. Balaji, I want to pick up on that last part first. We'll come to, P&L impact and etc. later, if at all. But the issue here is whether Starlink, whenever it comes in India, how much will it have to pay for that spectrum? Like our colleague Ashmit was telling us, that it will probably be allotted. There's going to be no bidding war as such. It'll be allotted spectrum, Starlink pays, and then they onward tie up with Jio and Bharti to roll out this network. Ashmit was making the point that if it's subsidized to the extent of, to boost rural connectivity, etc., if the government decides to be a little charitable, then could it start competing with terrestrial networks at all? I mean, how should we understand this development?
Hi, good morning. Thanks for having me on the show. So my reading of this situation is that we have to see what exactly is the pricing modality that TRAI comes out with, and whether there are any revisions to that based on incorporation of feedback by DOT, etc. But my sense is that these would be the satellite services would be used to extend coverage into areas where currently as in there are challenges in terms of getting those areas connected through terrestrial means, either through mobile or through FTTH. So my reading is that at least in the foreseeable future, I don't see any risk of disruption or cannibalization to terrestrial services from satellite, simply because one, there are multiple technological challenges that need to be addressed. Some of them are being addressed, credit to the team at Starlink. And on the other hand, you also have affordability challenges, especially in a country like India, where you have mobile ARPU, which is less than $3, and you have unlimited fixed broadband plans starting at less than $5, which is not the case with many of the other markets, including the African markets where Starlink is present right now. So
what's
I
the
would think
pricing,
that,
Balaji, just a second, and that's why it's really important to understand how this works. What is the pricing at which Starlink operates in some of the international markets? You mentioned they're in Africa. I mean, that'll be a great sort of example for us to look at, because the whole point of getting them in to boost rural connectivity, to power up schools, etc., it'll have to come at an affordable price. I mean, rural schools cannot afford to pay top dollar. So how much is the pricing for Starlink services internationally, just to get a sense?
So it varies across markets. So in developed markets like US, Starlink plans start at $80 per month. So that is clearly quite expensive, especially from an Indian standpoint. Even in markets like Kenya, which is as per my knowledge, the market where Starlink offerings are priced the lowest, there you have plans starting at $10 per month. And that offers 50 GB per month limited data. So it is not like India, where you have Jio and Bharti offering unlimited fixed line plans starting at $399 or $499 per month, depending on which company you are looking at. So of course, the speed, there are speed considerations, but at least the data allowance is unlimited. While even in a market like Kenya, the $10 plan of Starlink comes with a 50 GB monthly data allowance. So I think, if Starlink has to match someone like a Jio in terms of terrestrial pricing in India, that is going to be a stiff ask.
So Balaji, a couple of questions. What could be the revenue opportunity? Because we know that the underserved region in India, underserved population in India is about 30 to 40%. So if we have to provide connectivity to them, what could be the total addressable market, which is now going to be shared between all these? And what about the timeline in terms of revenue accretion?
So the way I think it would work is with both these telcos now, tying up with Starlink. For starters, what Starlink will be getting is they will be getting the distribution reach of both Airtel and Jio, while each of them has more than 1 million retail outlets, at least in the areas where it makes sense for these companies to sell Starlink's offerings. At least those retail outlets will act as distribution channels for Starlink. So even though you talked about the geographical coverage number, let us not forget that both Jio and Bharti have north of 95-96% population coverage. So geographical coverage may be lower, but population coverage is also equally important, or rather more important in my view. My sense is that especially in places like, say, jungles or deserts, or even in the seas, where it is very difficult to have a proper terrestrial infrastructure, that is where Starlink's offerings will come in handy. So if you're a Jio or an Airtel subscriber who is roaming on to some of these areas, there you will get seamless coverage. As far as timelines are concerned, it is very difficult because we are still in very early days. Starlink is yet to receive regulatory approvals, including license, spectrum. So we don't know how long it will take by which all these are in place. And even once that all that falls in place, I think it will be more of a gradual process. It will also obviously depend on what is the pricing of both the Starlink terminal and the services. So there are multiple moving parts here, and we are still in very early days.
There's also a price associated with the device, the terminal. So can you tell us how expensive that is? And is it possible to summarize to say that B2C, that the regular consumers like you and me are not going to use Starlink services, even if we go to a remote location, but it's going to be an enterprise opportunity. Corporates in these regions where there is poor connectivity right now are likely to take on this service, and therefore they will be okay to pay 3x, 4x more in terms of pricing.
So that is right. So you have, Starlink device that is sold at $350 in a market like Kenya. I think the US it's even higher. These are pretty large sums for a retail customer, especially in India. Even for a high-income postpaid customer, unless he's a sailing enthusiast or he has some hobbies which takes him to the seas very frequently. I don't see anyone spending this kind of money, especially for having coverage in which may be of use to him very infrequently. So I think that is something which is very clear. In the enterprise space, there may be, that is where probably, the more action could be, where enterprises would like to have access to, network all the time, and they don't mind paying a bit of premium as long as the security aspects and all are, taken care of. So that is how I see it.
So Balaji, 30 seconds market, we're hitting market opening. Basically, is this a potential threat averted for Jio and for Bharti? What is the net takeaway? Is it absolutely neutral? Is it positive because now there is no overhang of competing with Elon Musk? What's the final take?
So in the near term, it is going to be neutral. And I think the very fact that they are tying up means that, one of the, at least some investors had a worry that this is going to be a disruption. At least, that disruption risk kind of, that overhang goes away, because even though the telcos were telling that there is no risk of disruption, but, I think actions speak a lot louder than words.
Right, thank you very much for making sense of this big development for us. We'll watch out for how telecom stocks open up.
Okay. All right. Well, we've got stock of the market then. First rates coming in there. The Nifty puts on a half a century. That's great news. 50 points higher after ending yesterday at the high point of the day. So good going out there. What's gaining? Bharti Airtel. That's up close to around 1.5%. Reliance Industries, the big boy in there. That's up close to around 1%. So both those two posts that Starlink, tie-up, both of them are higher. Good going on that front. Power Grid, that's up close to around 1.5%. And BPCL, the decline that we saw around crude oil prices is working well. I think Avendis as well has come out with the note. They have upgraded HPCL, upgraded IOC, and they maintain their buy rating on BPCL. So those stocks are doing quite well. What's not doing well? IndusInd Bank. After yesterday's, 27% cut, it's down another 4% or thereabouts. So that stock is taking a hard knock. And I think there's a downgrade that's come in from Motilal Oswal on some of these tech-related names. And some of them are reacting. HCL Tech is down close to 100%. Infosys is down close to around 1% or thereabouts. By the way, keep an eye out on Bharti Airtel. That's putting on good weight now. It's up 2.5%. So that's clearly the leader this morning, holding one end up. And the breadth of the market actually is very, very good as we speak. You have close to around 4 stocks that are advancing for 1 stock that's declining. And from the broader markets, BPCL was doing well from the Nifty. HPCL is the big move on the broader markets. BSE has bounced back. It corrected from 6,000 rupees to around 4,000 rupees. Well, today it's pulling back. And PP Fintech, so-called value unlocking, Street hasn't read it positively because they're putting more than 600 crores thereabouts, in that project, that healthcare project that they're talking about. So 2.5% lower on that one.
Okay, so it started off with a flare, and now it's becoming a little quiet, especially the mid-cap index. At one point in time, it was up 0.5%. Now it's about 0.2% higher. Let's take a look at some of the key gainers beyond the Nifty as well. We talk about some of the big movers. There is Senco that's trying to put on a little bit of weight. There's HPCL, which continues to move higher, about 3% up on HPCL as well. These are some of the names that are coming up early on the screen. Let's also take stock of, IndusInd Bank. and see what this one's doing. Look at the IndusInd Bank, 5.5% down after a 27% decline yesterday. There's just no let up. And a lot of the literature that's been doing the rounds, reports, etc., murmurs. I mean, despite the clarification from Mr. Katpalia, clearly the market's still very, very nervous. Aside of that, all of large cap IT is still falling. Infosys, Wipro, HCL Tech, TCS, all of these stocks down. So IndusInd Bank and IT, these are the big drags on the index. And Lever is the other one, which is lower. Aside of IndusInd, by the way, the other banks have managed to pull up smartly. HDFC Bank, for instance, is in pole position, 1% higher, looking fairly okay. SBI is also up and about. Reliance is contributing on the upside. And now again, I mean, there's a bit of volatility. Again, look at the indices. Nifty is now 66 points higher, cruising along nicely. And the mid-cap index up 0.5% again.
Well, just to elaborate a little bit more on the technology names and the cut that we're seeing. So Motilal Oswal has come out with a note and they're saying that the street was expecting FY26 growth to rebound because discretionary spending was cut in FY23-24 and now things are improving. Now in the coming year, growth will rebound. But now they're saying that given the uncertainty surrounding the entire tariff, sentiment has been hit. They no longer expect discretionary spend rebound in FY26. Companies, so therefore they have, lowered the growth assessment quite meaningfully. So for TCS in FY26, they were earlier anticipating a 6% kind of growth. They brought it down to 3.5%. For Infi, from 7.5%, growth is now seen at 5%. From Wipro, from +4, it's now down to, just 2.9%. For HCL Tech, from 6.6% down to 5.3%. So basically, growth estimates across the technology pack have been brought down significantly for FY26 and FY27 because the sentiment, according to them, has turned cautious from January to March. Enterprises are now adopting a wait-and-watch approach when it comes to discretionary spending. So growth estimates have been slashed. One more stock, Kaynes Technology. That's the one which is plunged after MD has received a show cause notice from SEBI. I'm just trying to find out what the reason for the SEBI.
So
this is violations in maintaining the structured digital database.
SDD.
SDD, relating to the company's financial results for the period ending FY23-24. So big fall in Kaynes Technology, and that one stands out on the mid-cap.
Just one point, what a lot of the sales notes are saying, that this is a show cause notice. It's not a conviction of any kind of wrongdoing as well. For the time being, the street is not taking it lightly. Stock at the low point of the day, down 8%.
Okay, all right. So that's Kaynes, another casualty of some issues with respect to regulatory misses, down 8.5% right now. Market overall has stabilized. Final tally as the opening settles is about 28 to 30 points higher on the Nifty, with the mid-caps doing a shade better. Time now to move on to our special conversation, Market Masters. Today we have with us the Citi India top team. Surendra Goyal, Head of India Research, Samiran Chakrabarti, Chief Economist, India, and Kunal Shah, Director, India Bank's Financials. Gentlemen, great to have all of you with us. Thank you so much for joining in. I could start with the banks question because that's become the hottest topic in the last, 48 hours. But we'll come to that. We'll come to banks in just a bit. Surendra, let's open with you because looking at some of your latest notes, it's quite evident that you folks have turned a little positive on the market and you're finding valuations also more palatable. So let's start there. Where does India stand now after this 5-month-old correction?
Sure. Thanks for having us on the show. Yes, we have turned more positive on India. Around a couple of weeks back, we turned overweight on India in our within our EM strategy framework. And there are a bunch of reasons driving that view. Firstly, growth did slow down, but we believe it's a cyclical slowdown and we should see improvement going forward. We have already seen certain actions by the RBI, government, etc., which gives us more confidence on the growth outlook improvement going forward. Of course, these things do take some time to reflect. So it will take time, but the outlook seems to be improving. From a EM perspective, what we noted in our US marketing trip as well, and even our regional data seems to support it, is that EM funds in general are underweight on India. And our regional team does this analysis on a monthly basis. And EM funds that we track within that study, they are around 150 basis points underweight on India, right? And if you look at the last 20 odd years, India has mostly been an overweight. And even if it has gone to underweight, it has been very briefly a few times. So that setup also is more favorable. On valuations, we have seen the market pulling back, like it had gone to highs of Nifty 22, 23 times earnings at the peak. Now it's kind of come down to 18.5, 19 times. So that looks a lot better as well from a valuation standpoint. And then finally, from a flow perspective, we have seen a fair amount of outflows since October. But the outflows on FII side seem to be slowing down. And so far, the domestic flows have been pretty resilient. So when you kind of put everything together, there has been a valuation correction. We believe growth should see pick up as we go forward. And the setup from a positioning perspective is also favorable. So that's the reason why we are increasingly, we have turned more positive on the market. And we recently changed our stance to overweight within our EM strategy.
So Surendra, just to continue that point, you're overweight India. So if someone has to buy Indian stocks or give us the way you would construct your portfolio, what are the sectors that you like and which ones would you avoid now?
Yeah, sure. So what, like in terms of sectoral overweights and underweights, where we are overweight today, firstly is financial services, where we think that things are kind of gradually starting to improve. And again, it's a modest improvement, but it's not getting worse. And valuations in the context of the market or in the context of history are quite attractive. And again, we are more positive on the larger names in that space. That's the first pocket. Secondly, there are a couple of sectors where there is good earnings visibility, be it the telecom players or the domestic healthcare space. So those are again another space or other spaces that we like. And then we have cement, where we turned positive a couple of months back or maybe 3 months back. So there again, our view was that things should improve, should pick up from here. And last year was a weak year. So stocks had corrected. So yeah, those are some of the sectors. And then beyond that, there are some specific themes also that we like. Like, for example, travel is one space where we think the domestic travel market is quite strong. And there are plays on that which should continue to do well going forward. Overall, like IT services and consumption in general, beyond a few pockets, those are the two sectors where we still have a relatively more cautious view. So that's how we are positioned right now.
All right. Good morning, gentlemen, and good to have you all on the show. Well, Surendra, let's push a couple of those points a little ahead then. You're broadly focused on the domestic themes. Cement, as you said, the healthcare space as well as what you're looking at. Let's, focus on a couple of things that you said. One is the rotation trade, the money moving to China. And China has done a relative outperformance in the last 6 to around 8 months. Bulk of that rotation trade, is it done? And since FIs have been, underweight on emerging markets on the whole, do you think it makes a strong case for them to come back? And should we see this big outflow gradually start reversing in the months to come in 2025?
Sure. So see, there are a few variables here to keep in mind. Like if you look at the dollar had gone from, say, DXY had gone from 100 odd levels to 108, 109 levels a month back or so. And from there, it's kind of retraced back to 103, 104, which is usually relatively better from a EM perspective. So that's something I would watch out for. And we have seen kind of outflows kind of slow down very meaningfully in the recent past. So again, we are monitoring trends, but overall it does look that at least things are not as tough from a foreign flow perspective as they were in October, November, December. So that's something to watch out for. Secondly, on the other part of your question, China versus India, again, obviously China, if you look at MSCI China this calendar year, there is a 20% outperformance versus India. And a lot of that has to do with the Chinese technology stocks, right? If you look at the tech index there, it has outperformed the broader market there by another 10 to 15%. So it is a tech-driven rally. So when we talk to clients, I think the market, Chinese market from a valuation perspective was obviously low in the historical context. So there is interest. But I think from an India perspective, what is really required is the visibility of a growth pickup. For a lot of investors we talk to, India continues to be a secular play within the EM space. Valuations had gone higher. And there was a cyclical slowdown, and that is what resulted in people taking off money from India, even within the EM framework. So I think that is what really needs to be visible, the growth pickup, for people to be more interested in the Indian market.
Okay, all right. Another level that we look at, the Nifty, well, we have come down from around that 26,500 or closer to around 22,500. What's the year-end target on the Nifty itself, given that earnings should come back, capex spends are picking up, the RBI is injecting liquidity as well? What's the level we should be working with for the next 12 months?
Sure. So we have a published target of 26,000 on the Nifty, which is like, say, 15-16% upside from current levels.
Okay. All right. So still looking at 26,000, perhaps by the end of the calendar year. Got that, Surendra. Let me come to, Samiran for a couple of questions. We're talking about this growth slowdown. Samiran, so, where do you think we're heading next? Because now we have a turbocharged RBI. I think your own models talk of 2 rate cuts somewhere in the middle of this year, 25 basis points, 2 rate cuts. There's this big liquidity bonanza just today. This big OMO is happening. So you think that will sufficiently propel us forward to meet our targets? I don't know. A lot of people say the fourth quarter sort of asking rate is too high. We'll have to grow at 7.5% to meet the full year targets for FY25. But given the pace at which the RBI is moving now, what do you think about growth prospects for the next year?
So from a policymaker's perspective, there are 2 different tracks that they're working on. On the fiscal policy side, we have seen a personal income tax cut, which is worth about 30 basis points of GDP. And from the monetary policy side, again, there are different approaches being taken. First is that the exchange rate has been allowed to adjust back from the overvalued levels to a much more fair value level now. Second is that the liquidity easing has been very, very consistent and much stronger than what market expectations have been. Third is the rate cut process has started. And fourth is there has been some relaxation on the macroprudential regulations. Now, this package in itself could be worth about 30-odd basis points of GDP, just from the perspective that 50-75 basis points of rate cut should bring down the borrower's borrowing cost by that much amount. So 30 basis points of GDP from the fiscal side and 30 basis points of GDP from the monetary policy side could be the immediate boost to the household's purchasing power, so to say. And then if this liquidity finally kicks into higher credit growth with a lag, then that can be another booster to overall growth. So we think that 6.5 to 7 kind of growth for next year is quite doable. Just on a small note, the estimated fourth quarter GDP number is probably not that important a variable to look at, because the first 2 quarters data will get revised as we move into the full year number to be released in May. Once that adjustment happens, then the whole profile of the quarterly numbers could be much more stable.
So, Samiran, hearing you talk about our domestic engines, one feels very, very confident, right? Because the twin engines are firing, both fiscal and monetary. And like you said, 30 plus 30, that's 60 basis points for Phillip to GDP straight away. But now we have to superimpose the global uncertainty and this absolutely dizzying, crazy tariff business. And we don't know where the parlays end up finally between India and the US. There's still a negotiation for a trade deal, so we don't know what the final numbers will look like. But even if we go with absolute reciprocal tariffs, what's the hit that will have to be perhaps penciled in, and will local growth still more than make up for it?
This is a very complicated exercise with incomplete information, because we just don't know how the tariffs are going to be imposed on different countries, whether this is going to be sector specific or it is going to go down to the product specific levels. So what we have done is we have done a very simplistic analysis of equalizing the weighted average tariff rates of both the countries. US will probably have to then increase tariff by about 8 percentage points. And given some elasticity estimates that we have, we think that's worth about $7-8 billion of impact on India's export, everything else constant. That's about 0.2% of GDP. However, we are very much conscious that this will not be as simple as it looks like. This game could be played from India's perspective by cutting down import duties also on some of the items. There could be, in fact, we think that beyond the tariffs, what is more important is that if India starts purchasing more of US energy and defense, that's a better way to reduce the trade surplus that India has with US. So it's too early to get into a very precise assessment of what the direct impact is going to be. But what we are also worried about is the indirect impact, because this uncertainty, the longer it lasts, it will affect private investment, it will affect markets, it will affect, through a negative wealth effect, the consumer behavior as well.
But Samiran, just to complete this point, in your projection of, I think, 6.6%, right? For FY26, you're at 6.6% GDP growth. What impact, if any, of this tariff issue have you factored in to get to that number of 6.6 for next year?
So at this moment, we have put it more as a risk factor rather than putting it into our baseline. Okay. So that's 0.2% of GDP. You can think of that more as a risk.
All right. Samira, one more point on the RBI cuts. I think you're factoring in 2 more cuts, right? What if the Fed doesn't move at all? You'll have considered that as well in your model. 2 rate cuts is what we're going to get, irrespective of what happens?
So in fact, we have used a very operative phrase that at least 50 basis point of rate cuts. Our City House view on Fed rate cut is 5 rate cuts this year. So we have taken that into consideration as well. However, I must say that at this moment, the RBI, the way they're positioning itself on the growth and inflation dynamics, it looks like there is scope for rate cuts in India, regardless of what happens in US. India's capital flows are less interest rate sensitive than growth sensitive. So if we can get our GDP growth numbers up, we'll start seeing the capital flows come back, and that will stabilize the BOP, that will stabilize the currency. We need not worry as much on the rate differential with US at this point of time, given where our macros are.
You said 5 Fed rate cuts or 5 rate cuts from RBI?
Fed rate cuts. I mean, we have a view of 5 rate cuts in US this year.
Oh, this year. Okay, got that. That'll be quite the bazooka for the markets. But Kunal Shah, Director, India Bank's Financial at Citi, has also been patiently listening in. Kunal, it's all happening in the banks and it's all happening with IndusInd Bank. We know your preferred financials include HDFC Bank and ICICI Bank and a Kotak Mahindra Bank, and not in IndusInd Bank. But give us your thoughts on what's transpired in IndusInd Bank over the last 24 hours, what your conversation with investors are, what are they doing with IndusInd Bank? Have they just thrown in the towel now? Share your initial thoughts on the fiasco that's played out.
Yeah, so in terms of the filing, we have seen that there has been discrepancy to the extent of 2.35% of the net worth. And that will be accounted for in 4Q earnings. That's what they indicated in the call. So people are looking forward to how the earnings are going to pan out over next 1 or 2 quarters. And the other aspect is in terms of the succession plan. So now post Mr. Katpalya, who takes up, who's coming over, I think that's going to be the key monitorable as we move forward over next couple of quarters.
But is the stock looking attractive to you after this kind of a fall? And there are some worries that, things could go downhill, on Twitter, which is not the, apt space to get your opinion in. But there are comparisons of fears being drawn. Will it be similar to, say, a Yes Bank? So, what would you advise doing with IndusInd Bank shares now?
So there are near-term uncertainties. There is an overhang which is there, both with respect to the earnings as well as on the succession, as I was indicating. But in terms of the valuations, again, when we look at it, it's closer to like 0.6 times multiple. And that's where, so maybe near-term, definitely we could see some kind of an uncertainty being there in the stock. But valuations, when you look at it, that has also come off and it's factoring in those kind of a risk currently, yeah.
All right, the market cap sub 50,000 crores for a business size of more than 7.5 lakh crore. Abhishek, our banking expert tells us that as well. So interesting to see how that pans out. But Kunal, what about for the banking, the credit growth itself? What are you factoring in? There was a bit of a scare a few months ago when it came down, I think, to around 10-11% or thereabouts. What are you factoring in for the coming year for the credit growth for the industry itself?
So we are looking at, we will see some kind of a boost to the extent of 1 or 2 percentage points in the credit growth from where it is currently. And as Samiran was indicating, now we have seen the liquidity injection. There will be some push towards the retail credit post this entire decrease in the tax rates. And in fact, RBI has also restored risk weights on a couple of business segments. So NBFC credit and when we look at it, unsecured credit was something which was driving down the credit growth over past 6-7 months. Maybe some normalization over there could also help boost it. And along with that, some pickup on the corporate credit side, which is still in the range of 6 to 7 odd %. We should see some upside as the investments kick in. So all three vectors, maybe I would say the retail credit, RBI's risk weight decrease, as well as some inch up on the corporate credit side, should help take credit growth towards 13 odd %.
Okay, Kunal, what about the big call you made in the recent past, last couple of weeks? Everyone was looking at stocks that have corrected and valuation-wise have become fairly okay. And SBI was one such name. Did a big change of stance on that one. Tell us more about that. Valuation's comfortable, decent return ratios, and you have credit growth as well. That's the big call, right?
Yeah, so overall PSU banks, when we look at it, valuations have come off a bit and we will see them getting the benefit on the credit growth side as well. And credit cost, when we are looking at for the PSU banks, that has been relatively low compared to their historical past. So all that is helping them in terms of sustaining the ROAs for PSU banks.
Surendra, I want to come back to the headline point that you made on FPI selling and the fact that the positioning is at now multi-decadal low, not even multi-year low. Aside of the fact that obviously this is tactical positioning, right? I mean, whether it was the home market bias, whether it was some tactical quick shifts to China, which one understands. Aside of that, is there anything else that FPIs have sort of had an issue with in India? There's been some murmur on taxation, for instance. We also hear some murmurs about how registering in India is very time-consuming and difficult. But I don't know, maybe these murmurs also come through when a market is falling. In a rising market, you don't hear them. But what's your sense? Any other issues that are bothering FPIs?
Yeah, so I think I just add the point there that India's weightage in the EM indices has also gone up substantially. Okay, so say 5-6 years back, India's weightage used to be 8-9%, today it's 17% or so. So the weightage of India has gone up substantially, so that also kind of needs to be kept in mind. On the other points that you mentioned, again, I don't think a lot has changed in the last 3-4 months. Okay, so to that extent, I think as long as investors see the secular growth in India that they come for, I don't think those will play a big role, at least from a medium-term perspective, right? If you think about like Indian markets, any major index in the last 15 years or so, there has been like low double-digit, 11, 12, 13%, depending on which index you look at, that kind of earnings compounding. And that, I think, remains very important. If you see where the market pulled back and where FI flows happened, one of the things was the cyclical slowdown, right? But the fact is FY25 earnings have seen a moderation versus the start of the year expectation of Nifty delivering low double-digit growth will possibly end up with mid-single-digit growth. So to me, earnings moderation was one of the reasons, in addition to the stronger dollar and then later on China bouncing back. I think a lot of things came together, but the most important variable that I'm watching out for is earnings growth visibility. As that improves, I think that is what really gets people back into India.
I absolutely agree with you. At the end of the day, I mean, earnings speak for themselves, and at times they can speak the loudest in the room. Speaking of which, for FY25 is over, like you're saying, it's been disappointing here, right? Maybe we'll get 6-7% at max. FY26, What's the growth that you're penciling in? And the larger question, do you believe this market can still keep compounding earnings at, say, 12 to 15% every year?
Yeah. So, see, what we are expecting, what our team is expecting is a low to mid-teens kind of a growth next year, FY26. And again, the drivers, again, Samiran kind of spoke about the view on GDP. And we should see an improvement pretty much across quite a few sectors. So to that extent, that's what is really required. You need to see the visibility of earnings kind of getting to that number. We have been in an environment last few quarters where earnings have been revised down. So I think stability in the earnings outlook is the first thing we would watch out for. So that, I think, that number staying at low to mid-teens, I think that is what is really required for the market to find support and start going up from here. Medium term, I think low double-digit growth still possible in our view. Like if you look at nominal GDP growing at 10-11%, which is what the expectations are, then I think a growth which is somewhere in that territory. Of course, it could be volatile year to year, depending on how each of the sectors move. Particularly commodities do add a fair bit of volatility and so on. But I think that kind of a medium-term compounding is possible. And that's what really makes India attractive from a EM and investors' perspective.
And just to complete that point on financials, which is one of your biggest overweight calls, Surendran, whatever's happened with IndusInd Bank, say, yesterday, or let's talk about the last 1 year, right? There are different regulatory issues with different banks that have cropped up. With Kotak, it was onboarding, new customers on the digital platform. HDFC Bank went through its sort of, period of regulatory changes and uptick as well. Now, the problem with large banks is that even if you're overweight, even if you have them in your portfolio, they'll not perform till those FPIs return, or at least if they stop selling every day. So then how is the best way to play financials, given the rate cut view that Samiran spoke of? Because with large banks, you're stuck. I mean, you'll always be subject to the vagaries of FPI buying or selling.
So, see, I would kind of highlight a point here that within some of the, and I can't comment on specific names, but within the large banks you mentioned, there are names, or there is a name which has kind of outperformed through this period. Okay, consistency in performance is very important. And I think what we are looking at is a framework of two things. Is the outlook getting better, both from a growth perspective, a regulatory perspective? Everything put together, is the outlook getting better at the margin? And secondly, where are valuations in the context of history and in context of the market? That's the broad framework, and all of these parameters, we find the large banks attractive. And I think finally the outperformance will come from consistent business performance, because even the names that you mentioned, if you kind of just go back and look at 1 year, 2 year performance, there is a fairly big divergence, while we tend to categorize them together. So I think consistency in operating performance is what will give you the returns going forward.
Okay, all right. We here in India, we're worried about these FI outflows, which have clocked $28 billion in the last 7 or 8 months or so. The question is, where are these flows going? Samiran, I believe you've done some work on that. The flows are out of India, and all of a sudden you have the European economy that's bouncing back. China is showing signs they're coming back to life. Where do you see, where are these flows going? Leaving India, FI flows, but going where?
So in general, this is the period where we have seen some new narratives cropping up. There is a US exceptionalism narrative which has brought flows to US. There's a strong dollar narrative which was going on that has taken money out of EM. Now in Europe, there is a narrative of European defense spending and infrastructure spending probably adding more than 1 percentage points of GDP every year for the next 5 years. That's probably dragging money into Europe. Whereas some other parts of the world, like Japan, like in India, we have seen outflows happening because there's not been a new narrative. It's not that there's been anything in particular negative about India, but it's just that there have been more attractive narratives elsewhere. Surendra was talking about the China tech being another narrative, which has also drawn interest from investors. I think this is markets. The markets will work on narratives, and at some point of time, different economies will be able to provide those narratives. We just hope that in the Indian context, the growth narrative comes back in FY26, given our expectations of the policy support that has already taken place.
Samiran, finally, since you mentioned Europe, I just want to ask you this, because this is a new game in town, right? First, it was US exceptionalism and the numbers were supporting it. Then there was a lot of the talk of Chinese stimulus, and then you had a tactical China trade. But Europe, like I said, is literally the new game in town. I mean, the amount of money that's pouring into European equities now, and we're seeing what's happening with German bond yields as well, with this whole so-called rearmament exercise. Do you think this is meaningful from near to medium term point of view, or is this just the market getting excited because we've not seen anything out of Europe in so long?
Yes, at this point of time, it's all about announcements. The next in line would be about trying to find the funding for this. At this moment, most of the funding is coming out of the national budgets rather than any specific fund at a European level for it. So we'll have to see which country has how much space in their budget to do these things. We are already seeing that countries which are closer to Russia are announcing a much larger defense plan compared to the rest of the countries. So that's the second part, which is the funding part. And then the third part would be the execution part on exactly how this money is going to be spent. If Europe just ends up buying or importing these armaments from somewhere else in the world, then it does not add up to the European GDP as much. But if this leads to more production within Europe, then the growth outlook becomes stronger. Our European economists, they think that the near-term growth impact for 2025 or 26 is relatively low, in the range of about 0.2 percentage point of GDP only. But if you move to 2027-28, then the impact could be more meaningful at 0.5 to 0.9% of GDP. In the context of Europe, which anyway grows only about 2% or so, this could be a very meaningful push-up in GDP growth if it actually happens.
That's very, very interesting. That's helpful perspective as well. I mean, really explains why the equity bulls are suddenly rushing and piling into European equities on that hope of that GDP boost coming through. But we hope, of course, that India continues its charting its own growth story as well. Gentlemen, thank you very much. It's been a pleasure having you on the show this morning. Thank you for all the perspective. Well, there you have it. That's the view coming in from the Citi India top team. We have to take a quick break right now. On the other side, we get chatting with Sunil Bohra of Uno Minda, talk about the company's business outlook in the face of a lot of tariff uncertainty.
We're going to get in people who are different, gender being one of the ways you can get in people who are different, and make sure that they feel included in an organization enough to be able to stay and progress. So I'm really glad that you combined the two words together, because the concern really is, and if I may, to your point, the concern on putting targets is that it signals, whether you mean it to signal or not, that you are willing to compromise on meritocracy. And I don't think there is any woman in this room or anywhere else who wants a suggestion that there is a willingness to compromise on meritocracy. I think the answer...
Welcome back. By the way, Infosys is down close to about 3.5%. It's not just Motilal Oswal which has downgraded Infosys. Even Morgan Stanley has downgraded Infosys to an equal weight, and they've cut the target price to 1740 from 2150. So two downgrades on Infosys, and that's putting pressure on the stock. Morgan Stanley too prefers TCS over Infosys. So keep your eye on the tech developments. But let's focus on Tata Motors. That's up more than 2%. Sudarshan joins in.
So Tata Motors is today top Nifty gainer. It's up around 3%. Remember, the stock has been amongst top underperformers if you check the graph of the recent past. And stock was around 52-week lows. It's down 12% in the last 2 to 3 months, basically in 2025. Now today it's higher because Tata Motors CFO had held analyst meet yesterday, and the commentary that's coming out of that analyst meet is looking largely positive. So first on JLR, company has maintained Q4 EBIT margin guidance of 10%, and the second guidance that has been maintained is to be net debt EBITDA positive by FY25 end. Now talking about geographies, company says that US continues to do well. In China, it's outperforming the industry. In EU, demand is less challenging than what company had expected, and even UK is improving. On domestic front, it says CV margin has been performing as per expectations. One segment that needs an improvement is passenger vehicle segment. And going forward, company's focus would be arrest market share loss, especially in the small CV segment. Now, following that, most of the brokerages have come out with a note, and most of them are largely positive on the stock. Nomura has a buy call, target is 861. Macquarie has an outperform call and target is 826. CLSA has high conviction outperform call and target is 930. GS has neutral call with a target of 690, and Nuvama maintains reduced call and target is 720. So overall, it's looking positive for Tata Motors, at least the commentary that has come out from the analyst meet.
Okay, all right, sir. And the big positive from an India market perspective as well as economy perspective is the decline we've seen in crude oil prices. That's what's caused OMCs to spike up. Today as well, they're surging. Tell us more.
So if you would have seen in the last few sessions, all these OMCs have been gaining except 1 or 2 sessions. In the last 5 sessions, these 3 stocks have gained somewhere in the range of 10 to 15%. Today, these 3 stocks are higher because Avendus has come out with a note, and it has upgraded both HPCL and IOC and has maintained buy call on BPCL. For HPCL, target is 460. For IOC, target is 155. And for BPCL, target is 400. So it has given 3 reasons. First, benign valuation. It says valuation is 15 to 25% lower against 10-year average price to book value. Second, crude prices. You would have seen that in the last few days, crude has seen a sharp fall. Brent has come below $70 per barrel, and that's the reason even Avendus is expecting Brent to remain below $75 per barrel. And third is stronger GRM that Avendus is expecting. It's saying that slowdown in refinery additions in CY 25 and 26 points to a revival in GRM, and that would be positive for OMCs. Second, expansion in auto fuel marketing margin and reduction in LPG losses will be a key play in FY26. And last is, it sees high chances of H1 FY26 profitability for all the 3 oil marketing companies to be more than 70% of FY26 estimates that it had earlier. So on the back of this, you are seeing a big move in all 3 names today.
Thank you very much for that. Moving on now to the auto sector. Domestic auto industry has seen muted growth in the second half of the year. And the question is, will Trump's tariff war impact autos, especially companies with exposure to the European region also? To discuss all this and more, Sunil Bora, Group CFO at Uno Minda, is now with us on the show. Mr. Bora, that's the first question, right? How do tariffs impact you? If you do get any sort of reciprocal tariffs, if you could lay out how you're assessing the impact for you, considering your export exposure, and also European markets were downbeat for you. You've highlighted that in the past. What are we seeing right now in the Jan to March quarter? Have things improved, and what can you guide for FY26?
Yeah, so thanks. In terms of your first question of tariff, so if you see our total revenues, we are largely a domestic company. Almost 89% of our revenues are domestic driven, and roughly around 18% is what we get from our global revenues, which includes operations in ASEAN, in Europe, and we have small plant in Mexico. So overall, if you see of the overall pie, the exports from India is roughly around 4%, 3 to 4% of our total revenue. So as of now, we don't see any significant impact based on whatever discussions we are having with our customers. The exports, whatever we are doing from India for some switches or seats, we are not seeing any material impact as of now, but definitely things are evolving as we speak on a daily basis. So we are keeping a close watch on that. So as of now, we don't foresee any significant impact in the short term. In terms of your second question, which is Europe in terms of our revenues, definitely things have been sort of stable to, I would say, marginally positive, because the revenues what we have generated from Europe in January and current February, whatever the trends are, they looks to be stabilizing in terms of volumes, and even our revenue is marginally better versus if I compare with the December revenue. So things are stable, but I would still be very little cautious, and we are not very too much optimistic in the short term in Europe, while things are stabilizing and looking little positive.
Okay, let's focus on the bigger part of your business then, Mr. Bora. Europe is still to come back to life, but you have 89% of your revenues from the India operations. Has there been any kind of slowdown? Is demand, ordering activity as good as what you expected in Q4? And what does this mean for the next couple of years? That's FY25, FY26 as well, on the base that you deliver on FY25.
So we have no reasons to complain in terms of volumes. Things are definitely, we are in a business and business will have ups and downs, but overall things are positive. In fact, if you see full year two-wheeler revenues, two-wheeler volumes are roughly around 9% higher. PV is roughly around 5%. In fact, last month is almost like closer to double digits in terms of volumes. And in terms of the medium term to long term, you spoke about 2 years and beyond. So we are very, very optimistic. And as you know that we are currently having 12 projects or 12 plants under construction, and we have been building some of the lands for our future growth. So we are very, very optimistic in terms of the industry growth. We are roughly at 4.5-5 million PV cars this year. Hopefully, we should grow 2x in next 7-10 years. We are way, way below some of the global benchmarks in terms of vehicle ownership. So we are very optimistic in terms of 2 to 5 year kind of a scenario. Yes, there are some ups and downs, as I said, because of being in business. And as we always say, we continue to maintain our guidance in terms of our performance. So while we don't comment on volumes, whatever industry grows, our goal is clear that we grow at least 1.5 times of industry growth. So if industry in next 5, 7, 10 years grows 2x, we have to see how do we grow 3x in terms of our revenue. So that's where we are, and we are quite optimistic, and we continue to invest in our expansion plans.
Okay, all right. Could you tell us about the EV focus of the business? You know, how much does it contribute? Because that's been growing at a very, very fast clip. And that's definitely going to help you in terms of a kit value as well. So how do you see it panning out from here on?
No, absolutely. So we have been front runners in terms of EV capturing the business for specifically two-wheeler and three-wheeler sector. And if you see the two-wheeler sector, we are almost 2x of the industry penetration in terms of revenue. So industry growth is somewhere around, industry penetration for EV in two-wheelers is somewhere around 6-7%. Whereas of our two-wheeler, the revenue pie is roughly around 13%. So we are almost running at 2x of the industry growth. And that's clearly demonstrating our ability to capture the EV market share. In terms of our kit value, as you rightly mentioned, while the ICE kit value is roughly around 10,000 rupees, our EV kit value is almost 35,000 rupees per vehicle. And that market is still in a developing stage in terms of what gets to outsource, what get in-house, etc. So we've been working very, very aggressively in that space. In fact, moving to the PV space, as you would have noticed, we have been front runner again in localizing, working to localizing some of the EV components for pass cars. And we have recently converted our TLA to a joint venture with Innovance. And currently, we are in the phase of preparing our detailed project reports. And hopefully, we should be coming out with the detailed project investment plan, etc. And once we do that, then it will take roughly around 2 years to localize. And as we know that the volumes for four-wheeler are also low. So we are trying to time with the industry penetration as the volumes increase. Our capex also is expected to align with that, and hopefully we should get advantage of the better volumes.
So 2 years before the localization efforts come into fruition. So how should investors look at your margins? You've guided for 11% margins for FY25. Do you think for FY26 it should be similar to 11%? When can margin expansion truly begin for you? How are you thinking about margins and raw materials cost?
So you have to see in two aspects. First, from the margins of RM cost you mentioned. So raw material for us is largely passed through, whether it's upcycle or down cycle. It's all passed through to our customers. We don't tend to benefit or we don't tend to lose on the commodity prices, right? But in terms of your question was on margins in terms of 11% plus minus. So next year we are currently working to see how do we maintain this margin. Specifically, we know that we have 12 projects under construction. As these projects come on stream, you have all the costs coming in. So you have to absorb those costs, whereas the revenue takes maybe 1 or 2 years, 3 years to stabilize and to deliver the target returns. So despite that, and still maintain our margin guidance of 11% plus minus 50 basis points.
Mr. Bora, thank you very much for joining in. By the way, the Nifty Bank, that's up close to about 300 odd points, and Innocent Bank, that's managed quite a steep recovery. It's up close to about 5.5%. From the day's low, it's a 14.5% up move on Innocent Bank. The Citi's banking analyst, Kunal Shah, was telling us that Innocent was at 0.6 price to book. So at least from a valuation point of view, it had dropped to significant levels. But other banks, Kotak Mahindra Bank, HDFC Bank, Kotak Bank is up nearly 2%. HDFC Bank has moved up more than 1%. So banks are providing support, and Reliance Industries is in the green.
Okay, all right. So that's the market, at least for the time being. But yeah, the color has slipped. We've not been able to hold on to all that green. Let's go back to Mitesh now for some trading advice and calls. Mitesh, so looking at the volatility early in the morning, what would the course be now?
It's been volatile, but I think, not giving you a clean directional bias. I think just stay put on the index. As I said, I think, buy it if you get it closer to about 22,300, 350 zone, otherwise avoid. And on the stock side, though, we have some buy calls purely because of the fact that a lot of the stocks are, kind of reversing from lower and oversold levels. So Crompton is one name on the list. That's a buy with a stop at about 346 for targets of 365. And a disclaimer, we have recommended Adani Ports to our clients, so there's some vested interest over there, but that's a buy with a stop at 1126 for a target of around 1200.
Okay, all right, got it, Mitesh. Thanks very much for that. With that, we have to slip into a very quick break, come back on the other side, and Manisha will round up the latest from the commodity markets.
To the question is, as you get them in for interviews, for discussions, that the slate is balanced, and then let the best person win to get the job. And if I may, sorry to Mr. Dave's point on, if I may say to the women in this room and beyond, there are many jobs that we've traditionally thought are not a great idea for women. And coming from an FMCG background, sales is one of them. Attracting women into sales actually is very, very difficult, because all said and done, it is a difficult job. But honestly, it is fantastic learning. And if you put yourself out there, the rewards that it gives you are tremendous. So if I could just urge the women in this room to take these challenges and take some of these leaps, it would really help as well.
What happens is that it makes a trade just a little bit less efficient. And therefore, if anything, it's got a positive impact on the market, as you said. The concern is if there are widespread tariffs, then it actually affects economic growth and underlying demand for the commodity, in which case that becomes a negative. On a ton-mile trading pattern basis, it's good for shipping. But if it affects demand for commodities, then that's bad for shipping because of general economic impact. Now, every day you have some added uncertainty around US tariffs, trade, etc. So I think it makes sense to wait for a bit. In the last term of President Trump, where there were some China tariffs put there, and China put some tariffs on US products, which they've already done, where they put some tariffs on US grain. And US is a significant exporter of soybean to China. So when those tariffs came in, basically the trades rerouted. China imported from Brazil, Argentina instead of the US, and US, instead of exporting to China, exported elsewhere.
Welcome back. Well, let's find out what's the latest in the world of commodities, given all of this tariff talk. Manisha is here. Manisha, so what's captivating your imagination now?
Well, my imagination, well, it's somebody else's imagination.
Apart from Donald Trump, what is it that you are able to pinpoint in commodities? Because everything is topsy-turvy, right?
Well, you know, if you look at the global markets right now, all impacts really seem to be coming in from there. But I want to talk about metals right now, and that is because the US dollar index is now trading at a 4-month lows, and that clearly has been supportive for many of these dollar-denominated commodities. And apart from that, it is the chaotic implementation of tariffs that has led to a lot of uncertainty. So from standing now, what we understand is that there is 25% of tariffs on steel and aluminum that goes into effect today. What we also understand is that the 50% tariff on steel and aluminum on Canada does not go into effect today. This is as of now, right now. But apart from that, it also is about the fact that the US and Canada will be holding negotiations over the next 2 or 3 days. So this week, in that sense, is going to be quite important. I want to talk about copper because overnight, we've seen 2.5% of gains in copper. And in Asia right now, we are trading 1% on the higher side. With that, copper is trading very close to its 9-month highs. There also are expectations of a China stimulus hopes, and that has been supportive. And then there also are concerns that China could be, or rather US could be, imposing tariffs on copper going forward. That has been a conversation for 3 weeks now, and the markets are waiting that report. That could be still 10 days away, but that is keeping the street jittery for sure. And then it is also about the kind of premium that copper is commanding in the US markets there. Not just that, when you look at the aluminum and 25% tariffs coming in today, the US physical price premium has hit a record high of $990 a ton. So aluminum is more expensive now in US than anywhere in the world. The street is also looking at the premium prices, which have continued to gain and have gained up by 70% since the start of 2025. Well, Canadian smelters really are the major source of primary and alloyed aluminum exports to US. So 70% of all aluminum alloys that goes out of Canada lands up in US. So that's a big chunk that the markets will be looking at that could be getting disrupted in sense of prices there. Apart from that, it also is about China, where we are looking at a slowdown in production for this year. Last year was a record aluminum production in China at 44 million tons, and China perhaps could be looking to curb that. Well, but apart from that, it is also about the US inflation data that comes in today, and that is going to be a major number ahead of the US Fed meeting, which is on 18th and 19th of March.
All right. Okay, Manisha, thank you very much. We will keep that in mind. We have to take a very quick break. On the other side, our special segment, It's the Economy. Lata today will speak with the head of Credit Bureau, Sybil, on NPAs in retail loans.
let's talk about your 2008 Olympics match. Tell us about your whole experience. That was your first Olympic match. What was the feeling? What was going on in your mind? Tell us all about it.
I think it was in 2008 and I was 18 years. And when I won my first international title, I was only 16 and I was there in the international circuit, and a lot of these Chinese and a lot of these Koreans were actually, they were worried like some Indian is coming and they're actually giving us tough competition because before me, we didn't have a female badminton player who was actually playing at that level, who was actually winning those international matches. Of course, we had Prakash sir and Gopi sir who did well, but I was just, you know, when I started playing badminton,
Welcome to It's the Economy. Bad loans in unsecured credit was a key factor that had hurt many banks and NBFC balance sheets in 2024. A sharp 30% or actually 28.5% increase in year-on-year growth in unsecured credit had led the Reserve Bank in November 2023 to increase risk weights on unsecured loans. Although they've removed the reduced the risk weights on NBFCs, the Reserve Bank has not reduced the risk weights on unsecured loan. Now, obviously, when risk weights are high, banks have to keep more capital for unsecured loans. The trend of rising defaults in unsecured loans, is it still a problem or has it receded? That's the question we are asking today. And who better to answer than the chief of India's largest credit scoring bureau, CIBIL. Joining me is Bhavish Jain, Managing Director and CEO at TransUnion CIBIL. Bhavish, thank you very much indeed for joining and coming over to our studio.
Thank you so much, Lata. Okay. Great to be on your show. Okay. And to your question around...
Yeah, mainly the question is unsecured credit. You know, we had that problem a year ago. Reserve Bank very importantly reduced risk weight on NBFCs. They did not reduce risk weight on unsecured loan. So is there still something to fear that, you know, there can be more NPAs?
So there's a good news that the overall retail delinquency, 90 plus on balances, have actually year on year improved.
Okay.
So
the number of people 90 days past due payment, defaults have come down.
Yes, defaults have come down. It's 1.9%. Okay. So 22 basis point reduction year on year. And that's not just year on year. In fact, quarter on quarter, so sequentially, when we look at December 24 quarter over September 24 quarter, it's actually reduced. It's reduced. And when we break down into secured and unsecured, secured actually housing loan, auto, two-wheeler, the delinquency have actually got better.
Okay, okay.
It's reduced. And only product which are actually deteriorated marginally is actually credit cards.
No, that is the point. Though. Even at that time, I don't think the RBI was worried about secured loans. You know, home loans and auto loans were not their problem. Their problem was personal loan, credit card and BNPL. You know, consumer durable, buy now, pay later loans. How is the numbers?
So personal loan has remained same. Okay. The reason I'm saying even the stabilization of delinquencies is good news, because delinquencies of ratio of your bad sort of loans going as well as in terms of the credit growth. So credit growth has slowed down. In spite of that, personal loan delinquencies have stabilized year on year.
So as a percentage, they have come down.
Exactly. On credit cards, there have been significant decline on growth, and hence you have delinquencies going up. And there is another reason that credit cards are used by consumers at different segments. And if they have to decide on a payment hierarchy, they would actually pay on a housing loan or two-wheeler and then pay on credit card.
That's true. That is true. Yeah, so that is another reason why it may be suffering. Okay, what is the performance of, you know, rural versus urban? Is there any finer distinction you can make in terms of unsecured loan? I mean, I'm veering around to the MFI problem. So is it that rural defaults more? Or tier 4 defaults more than, I think you all do a city-wise.
Yes.
So are metros defaulting more?
So actually, before I go into delinquency, the good thing is that when we look at the overall India credit market, the demand is higher post-COVID and specifically last 2 years from the semi-urban and rural locations as compared to urban. One. Second is that within semi-urban and rural, the credit demand is higher for younger consumers, which is less than 35 years. Third is that, yes, the Gen Zs prefer the consumption loan because they want to go for shorter tenures, the year and now needs. And then to your point, yes, bad borrower is a bad borrower, irrespective of the location. So those geographical nuances are not coming. It's more about a customer on the margin who is finding it difficult to pay in case of any instability in their financials.
I don't know whether you'll even take this, but are Gen Zs more likely to default? Is it that once you're over 35, you're less likely to default? Anything like that?
No, actually.
There's no age bias.
There is no age biases here. Gen Zs prefer the short-term loans as compared to the big-ticket loans. And there is a reason, if I may say, because when you look at the average age of consumption loan in the country is coming down every year. So it's in the early 30s where people prefer a credit card, a personal loan, or a consumer durable loan. That's the
And home loan is later, is it?
Actually, home loan is increasing every year. So home loan average age is now 41 years. 41 years and post-COVID...
And what, it used to be much younger?
Yes, it used to be in the late 30s. And post-COVID, it's inched up by few years because the increase in property prices, the consumer actually need to save money for down payments. And hence the average age is going up.
Okay. I take your point. Even I took my home loan in the early 30s. So clearly I'm not in the Gen Z category. Okay. What about MFIs? Do credit bureaus look at MFIs at all? Because when we did an MFI discussion, at the bottom of the pyramid, everybody knew about CIBIL. They were paying kyunki CIBIL kharab ho jayega. So do you have any data at all whether MFI loans have improved?
Yes, we have data for MFI loan. In fact, the NPS for the MFI industry is 51,000 crore, to be precise, out of a book of 4 lakh crore plus. Now, yes, enough has been spoken about MFI, NPAs and delinquencies. But going forward, what needs to get far more refined for MFI industry is actually looking at a consumer objectively, very similar to the way banks and NBFCs look for underwriting a credit card or a personal loan or a housing loan customer. Right now, it's more of the group parameters that one looks at it. How do you look at objectively? How you include credit score as part of your MFI underwriting? Because that sector needs infusion of credit. It's up to us as an ecosystem to make it more objective.
That's true. No, that's fair. It's just that over there is a lot of mess, as we discovered. They get a group loan as a self-help group, and they get personal loans for the person. So the person is indebted.
Yes.
That's how this 4 loans, 5 loans per person has been on the rise. But you all don't look at that data, loans per person. Is that tapered off?
So we look at the data that how is an MFI consumer graduating to a regular retail loan.
Okay.
So that over years and specifically post-COVID has actually slightly inched up. So today, out of the MFI customers, 15 to 18% across different geographies have either a two-wheeler loan or a personal loan or any of the mobile loans.
Okay.
So there is an
Likely a
overlap.
cell phone
Exactly. And that's where it's important that as lenders...
So credit scoring them is well on the way.
Yes.
Okay, okay. So data has reached there. Let me come to the current quarter itself. I think all the data you gave me were for the quarter ended December 2024. Yes. Do you have any, banks will be coming to you dynamically. Are you seeing any improvement in unsecured loan repayment?
Yes. So now, so RBI came up with a circular in January 2025 where banks need to submit data to credit bureaus on a fortnightly basis.
Yes.
Now, that's a very progressive step because it ensures that lenders submit data to CICs on a 15-day basis. So we see early signs of things only improving going forward because your lenders have actually tightened their credit policies and hence the consumer who are coming through the door have been screened rightfully by the lenders, and we expect going forward the delinquencies to improve. Yes, there might be an outliers. Like right now, when we look at all retail loan products, credit card is an outlier. But when we review the data on personal loans or any of the other two-wheelers, consumer loans, things look good.
Okay, that's very encouraging.
Yes.
And even credit card, I think the number showed that there is only a marginal year-on-year increase in the amount of days, 90 days past due. Okay, you know, we've been speaking about the negativity of credit scoring. You also have some idea of how credit itself is growing. One of the pain points was last quarter, bank credit fell below nominal GDP.
Yes.
Now 11%, I think. How is it looking to you? Can you see a rise in retail credit itself?
So, yes, with the rate cuts and further expected few other decisions in the upcoming policies changes, we expect the credit growth to come up, and especially post the festive period, because the country needs that infusion of credit. And if I have to put together some data points, as a nation post-economic liberalization, retail credit has grown significantly. Now, if I have to put some statistics, we have 103 crore adults in the country, 70 crore individuals data within CIBIL, 57 crore are with one credit line ever, and 27 crore Indians are credit active.
Okay.
That's a sizable population. So out of the adult population, 27% of India's population is actually credit active. And the good thing is that out of these 27 crores, almost 18 crore are sitting with only one loan. So it's a need-based requirement of either a home or a vehicle or a two-wheeler. But what has changed specifically in last 3 to 5 years, the new to credit has reduced significantly because the entire community is more, or the lending community is more comfortable with a credit-tested borrower vis-a-vis the new to credit.
So the lenders have become cautious.
Yes, lenders have become cautious, and one behavioral change has also happened, that pre-COVID, you had consumers coming, especially the new to credit coming through the two-wheeler channel.
Yes.
And agri.
Yes.
Agri continues to bring in a lot of new to credit customers, but actually the biggest new to credit customer base comes into mobile phone loans. And you look at it, why it has happened, because if you look at the top 20-25 cities, there is a public transport in all those cities. So if somebody has to come out of a college and join the workforce, they're actually using public transport, but for employment and productivity, they still need the mobile phone.
Okay. All right. Now, I forgot about MSMEs.
Yes.
How have you seen any improvement? Both now, I want volume as well as asset quality.
So asset quality is actually improved year on year, and it's almost on par with retail delinquencies. That's a good thing. Second is that
volume of credit?
So volume of credit has been more or less stable. It has not grown, neither it has degrown. It has been credit demand and supply has been range bound for last 2 years.
But what is the credit penetration? I thought you had a very revealing plate on, we have 6.5 crore MSMEs, but how much is credit active?
So, very interesting question, because as I mentioned, retail credit, we have come a long way. When we look at MSMEs, there are different data points quoted on NSS, 6.3 crore, 7 crore, 8 crore.
Yeah.
So if I, just for simplification, if I have to take, say, 7 crore MSMEs in the country, reported ever credited to CIBIL is around 3.4 crore MSMEs. Credit active is only 94 lakhs.
Not even 1 crore.
Yes. So out of the universe of MSMEs in the country, only 12 to 15% MSMEs are credit active, but their contribution to GDP is 30% for MSMEs. So there is definitely a huge headroom for us
credit
to
penetration in
credit penetration in MSME, because you have more than 50% who is not in the formal credit sector. So either they are relying on informal credit sector or trade credit.
Fair point.
So there is a huge opportunity there. And to bring in another flavor on the women entrepreneurs on MSME, some very stark data points come
No,
out there.
there's no time for that. Bhavesh, we will call you separately to discuss the gender issues. But very important data that unsecured loan is showing less pain. Credit card loan, yes, has increased a bit, but definitely not worrisome. And the recent data for the current quarter itself is that the amount of defaults in unsecured loan has clearly fallen. That's positive for the listed finance stocks. We have to wrap up on Bazaar on that note. After a break, Chartbusters.
My mom this question, why badminton? I don't know. It's such a difficult sport, and you have the Chinese in quarters, semis and finals. They're everywhere. So she used to be like, no, for me, you are the champion. You're going to do it and just believe in yourself. And imagine she's a housewife. She's just a housewife. She's not even a international level coach, or she's not someone who's seen what international badminton is. But she was like, you are my champion. You're going to do it. And with her belief, I was in the Indian team when I was only 13. Senior Indian team. Wow. And I won my first international when I was only 15, 16. So these things happened in my career really, really fast because of only one person's belief. And of course, the coaches come in, the trainers come in. But I think the first Olympic was, in fact, so early in my career that, I was like, my mom wished that I have to become an Olympic champion, and I'm here. I'm here so early, and I'm actually getting closer to winning the medal. In 2008, I lost in the quarterfinals. And I still, that one match gives me a lot of sleepless nights because it does, because even after having the medal, I was 11-3 up in the third set. And then I was actually getting all these things in my mind, saying that my coach was like, ek din tu world champion banegi. My mom was like, ek din Olympic champion. Not pressure, but I was happy that I actually was going near winning a medal. I was happy, I was excited that I'm actually doing it with my training, with my coach's belief and everything, I'm doing it. Suddenly the game just turns, and then she's just picking up everything. The rallies are going really longer, and she's everywhere. She's all over the court, not leaving anything. And after 11-3, you won't believe, I just got 2 points and she went on winning the match, 21-30.
My.
After that, I'm sitting there and I'm talking to my coach, what happened? Because every rally was a big rally. I didn't even do silly mistakes to lose the match. What just happened? So I was like, when I thought about it even more, I was like, next day I better start training to get the medal in the next Olympics. So yes, that match tortured me a lot, but I think it gave me that lesson as well, that you should not get too excited also sometimes. You have to control yourself. When you are actually going to achieve your goals, you have to control yourself, try to relax yourself. In fact, in that time, when I started doing well, I didn't have a mental trainer or a trainer. Only Sir, Gopi Sir was everything to us. And he being a coach, how much he could have helped in other things as well. So I feel, agar wo time pe I had a better mental trainer or someone who could give me advice about it, that you should just think about the next match, just think about the next point. तो उतना मतलब मैं उस मैच में excited नहीं होती. But I was so happy that tournament gave me so much of belief. And in India, everyone started to go to know what badminton is. And they were like, Saina is really doing well in badminton. And in 1 year, I
Tata Motors climbs more than 2.5% and now 3% higher as the management at the company's analyst meet suggests that Jaguar Land Rover will meet its fourth quarter EBIT margin guidance of 10%, will also turn net debt-free by the end of the financial year.
Brokerage firm Motilal Oswal says its view on the IT sector has turned cautious in March. Infosys and Wipro are the top losers on the Nifty, falling over 3% each. All constituencies of the Nifty IT index trade with cuts.
IndusInd Bank recovers from some ground from yesterday's sharp fall, now up 5%. The management exclusively tells CNBC-TV18 that although there could be some decline in the net interest income in the fourth quarter, the bank will show a profit in the fourth quarter itself. The stock, remember, has also entered F&O ban.
PB Fintech is under pressure today after its board approves an investment of up to 696 crore rupees in its wholly owned subsidiary, PB Healthcare.
Keynes Tech opens with cuts of almost 8%, though recovers from the lows after the company's managing director gets a show cause notice from the SEBI alleging violations in the maintenance of company's structured digital database. The stock is off the lows now.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. The markets have taken a bit of a U-turn at the low point of the day as we speak. The Nifty is lower. The good news is the Nifty Bank, that's showing a relative outperformance today. And the reason the Nifty is lower is because of the tech-related names.
Take that point entirely, Nigel. It was due for the Nifty Bank to be doing well today, largely because yesterday's decline was led entirely by IndusInd Bank. And now that the street is digesting that. The important part is that the stock has recovered some ground from yesterday's sharp fall. But then, yesterday we did not see as big a fall in the IT pack as the Nasdaq suggested, but 2 trading sessions declines in the Nasdaq, and that has had a bearing on the IT index as well. What's really taking place in the US is now impacting this one sector. But IndusInd Bank is definitely the stock of the morning. We have the stock which has recovered about 13 to 14% from the lows itself, currently sitting with a gain of about 5% after a big 27% decline yesterday. And this, remember, as the stock has entered the F&O band as well. We spoke with the management exclusively on CNBC-TV18, and the MD said that there could be some decline in the net interest income in the fourth quarter. The bank will, however, still show a profit in the fourth quarter, and come FY26, growth path will continue. Here's what Suman Katpalia had to say.
During a review of the processes in connection with the compliance to the RBI circular on investments portfolios, we found that there were some gaps which were coming out, and that was really the start of the issue. We found this anomaly around October, and that is where we started our internal assessment, as well as we hired an external agency. At that point of time, we did not know the difference, and we knew that there were 2 deals getting accounted incorrectly, but there's so many deals in that, so we did not know the real impact. And I think as soon as we got to know the impact, we held a board meeting and we informed our board and we did the disclosure. You know what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item, it's not a recurring item, and I think we should take it, we should get over it in this quarter, and after that, I think the bank should be back to the BAU, and you should see the growth that the bank is seeing and the profitability which the bank is used to. The full year will not be a loss at all, and I think the quarter 4 itself also will be a profit.
All right, quarter 4 will be a profit, full year will not be a loss. And yesterday, on account of the decline that we saw in IndusInd Bank, there was a decline in Ashok Leyland as well, a group company. Look at Ashok Leyland right now. That stock's moved marginally in the green to the high point of trade as IndusInd Bank comes out of the decline that we saw and has moved off the lows as well. So we'll keep an eye out on this, but also watch out for a few ideas for profit coming in from our colleagues at Money Control Pro. Neha joins in with a stock.
Today's stock idea is CSB Bank. CSB stock has tanked more than 30% from its 52-week high price seen in April 24. While the fall in the broader market has led to weak stock performance, the correction is surprising as almost half of the bank's loan book consists of gold loans, and gold prices are hovering close to all-time high. So then what led to the correction? The muted performance of the bank in the current fiscal so far led to the drop in the stock price. CSB Bank's return on asset declined to 1.4% in 9 months of FY25 from 1.8% in 9 months of FY24, mainly due to sharp fall in margins and higher operating expenses. Net interest margin of the bank has been declining since past few quarters due to tight liquidity conditions and consequent higher cost of funds. Banks' withdrawal from some of the high-yielding segments like microfinance loans, unsecured personal loans, etc. also added to the pressure on margins. Management clarified that the bank prioritized risk management over margin maximization. Thanks to this cautious approach in lending and gold loan portfolio, CSB Bank's asset quality continues to be very strong. Operating expenses are likely to remain elevated in the near term. However, management expects the cost to income ratio to start tapering down from FY26 onwards. On the business front, the bank's performance has been very strong with both advances and deposits growing much higher than the industry growth. Now coming to the valuation, the stock is currently trading at around 0.9 times the book value estimated for FY27. The valuation is very attractive given the return ratios and growth potential on a small balance sheet. With not much concern on asset quality and book value growth, there is no reason why a private bank should trade below book value. Long-term investors can start accumulating the stock.
All right, thanks a lot for that. Well, time to slip into a short break, but on the other side, we'll be joined by Mr. Riju Jhunjhunwala, who's the Vice Chairman of HEG, to discuss the company's proposed value unlocking in Bhilwara Energy. Stay with us.
Beating all these Chinese, I won the Indonesia Open. I became world number 2. So in 2010, I won 3 Super Series back to back, and in 2012, I got an Olympic medal. But I think that particular match taught me to be really thinking about that. Even after match point, you have 10 more points to go. Don't just think that the match is finishing. Just be there, and presence of mind is required. And I think that first Olympics really gave me that confidence that yes, I'm there and I can beat all these Chinese and Koreans, and I can be in top 10, top 5 for a long period of time. And when I look back, in fact, someone told me that I was in top 10 for almost 11 years. And when I became world number 1, that is when I was like, yes, it's possible. It's possible. In 2015, when I was world number 1, everyone was like, wow, from India, we can do, in badminton, we can do such wonders. And we can also beat Chinese, who are the powerhouses. Korea, Japan, they are the powerhouses. But now you see, badminton in India is grown so much. And we are giving good challenge to all these countries. And we are one of the top in the world now. So, yeah.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential
Welcome back. You're watching Chartbusters. You're on CNBC TV18. As promised, well, let's focus on that value unlocking that we saw in HEG. Now, the proposed value unlock in Bhilwara Energy, in which HEG currently holds close to around 49% odd. They have approved a fundraising in Bhilwara Energy to raise close to around 500 crore rupees, and Singularity AMC is the one that's going to be taking a stake. To understand more about that, we're joined by Mr. Riju Jhunjhunwala, who's the Vice Chairman of HEG. Hi, Riju. Good morning and good to see you in. Give us a few details. What we understand is Singularity will have close to around 9.6% stake for the 250 crores that they're going to be putting in. For the remaining 250 crores, at what valuations will it come in? And post the entire 500 crores, what stake will they have in Bhilwara Energy?
Good morning, Nigel. Nice to be back with you.
And this is basically in continuation to the last time what we discussed about the demerger process that we are going through in HEG. So Bhilwara Energy is and HEG Graphite Limited are getting demerged, and Singularity has come into the Bhilwara Energy level right now. And the numbers that you mentioned were exactly the same. So 250 in the first round and 250 in the second round, both at the same valuation.
So both at the same valuation implies that, by the time you raise 500 crores, they would have just below 20% stake in the company. That's Bhilwara Energy that we're talking about, right?
So in Bhilwara Energy, they would have around 17.5% stake to be exact.
Okay.
And then, of course, the demerger process would happen, post which they would be holding around 12.2% in HEG Green Tech, which is the proposed new entity. And the balance would be between the promoters and the current shareholders of HEG.
And what would the promoter shareholding be in both the companies post demerger?
So in HEG, it would remain exactly the same as what it is today, 55%.
Yeah.
And in Bhilwara, in the HEG Green Tech, which would be the new company. I'm just using the word HEG Green Tech because that is what we propose the new company's name to be. So in HEG Green Tech, the promoters would have held 70% stake because we are also bringing in 51% of our own shares of Bhilwara Energy. So that would have been 70 odd percent, but after this deal happening, it would be close to around 60%.
Got it. Okay. All right. So we have got that out of the way as well. Give us a breakup then, in terms of what is this money going to be used for? In your release, you're mentioning that 3,000 crores is the total capex you have for this renewable energy part, green tech part of your business. Break it up for us. I'm guessing anode gets the most, right? So break it up for us, the 3,000 crores. And how does funding come about? Currently in HEG, the listed entity, which has both the two, parts of the business, that's the graphite as well as the green tech business. Currently, there's around 700-800 crores odd. All of the money comes to HEG Limited?
So I'll tell you, Nigel, what is happening is that the reason for this demerger is for us to have a serious play in this whole energy transition space. And the breakup of that 3,000 that you started to begin with, approximately plus minus 5%, I can give you the breakup. Around 1,800 crores would be in this TACC entity, which would manufacture high-grade synthetic graphite anode for lithium-ion battery manufacturing. Around 200 crores we are investing in the graphene business, which is also, again, a very high-end, and we've already got a team of 7 to 8 PhDs with a lot of patents, etc., for which we'd be going ahead with a facility of around 200 crores. Another 750 odd crores will go into the bottle-to-bottle recycling business, in which basically we would be producing food-grade resins from PET bottles. Around our energy storage business, RE+, which currently comes under Bhilwara Energy Limited, that is seeing a lot of traction in the market, and we already have a 1 gigawatt factory which is operational near Pune. We are taking that up to 6 gigawatt hour. The work on that has already begun. So around 250 crores would be spent over there. And then, of course, with that particular business, you have a lot of government IPP tenders, etc., that you bid. So we won a recent tender with GUNL, in which around 200 crores will go into that. But that is money that will keep rotating from time to time when the project gets complete.
Right.
So the ideal breakup of 3,000 is 1,800 anode, 700 crores in your food grade bottle to bottle, around 200 crores in this thing, the graphene, and
the battery.
In RE+.
Got that. So then a follow-up two-part question on that. How long before all of this capacity is commissioned and fully utilized? And the obvious question is, once all of this is, utilized at optimum level, what is the revenue and EBITDA potential?
So for all these projects, we've already procured all the land. The bottle-to-bottle project is going to be coming up in the state of Rajasthan. The technology tie-up, etc., is all on its way. We have been working on this for the last 2 years. It kind of slowed down with the battery prices coming down across the world, as you saw in China in the last 18 months. But now we are in a position to start placing all the orders. And by December 2026, we'll start full commercial production in the anode plant. And also around September 2026, we would have full production in the bottle-to-bottle grade company.
And what's the revenue?
Already is RE Plus is already executing orders of more than around 500 to 600 crores. And the ramp up over there and the government traction that we are seeing over there is very, very significant.
So if we were to look at HEG Green Tech, what would the revenue and EBITDA of the company be?
So I mean, in lack of, because, in these businesses, things keep changing every day. But specifically, if you ask me for the anode business, we are targeting an EBITDA of around 700 to 800 crores by the year 2029.
700 to 800 crores will be on what revenues? Just want to understand the margin picture.
On revenues of around 2,500 crores. So you're talking about around 30%.
30%. 30%. So you're putting around 1,800 crores in this anode business. You'll be getting revenues of close to around 2,500 crores, and you're saying you'll do a bit around 7.
At 90%. That's why I'm here saying 29.
EBITDA of 700 to 800 crores, correct?
Correct.
And the cash that is there currently in the one consolidated entity, the Green Tech or the HEG limited part of business will get all of that cash. Is that correct?
So we don't get all that cash. That cash will already be spent by December. By the time the demerger happens and the NCLT approval happens, the work is in full flow in TACC. So we would have exhausted all the 750 crores cash that we are talking about into placing all the orders. So
the demerger happens by December. And what does the balance sheet of both these companies look like? You said the cash will all get exhausted. So what would the debt profile of HEG and HEG Green Tech look like?
So HEG would be a HEG Graphite, if I were to use the word, would be a debt-free company. And even the Bhilwara Energy, which is today debt-free, we have cash of 300 crores lying in its books. And obviously, it's a very, very valuable asset for us. 300 megawatts of run-of-the-river hydro plants. So you've got a constant EBITDA of 125 to 150 coming in from that as well. So as and when these projects start getting implemented, obviously we look at 30-70 kind of a debt-equity ratio.
All right, Riju, thank you so much.
But for the next 1 year, we would not be requiring any debt for any of these.
Okay, all right, Riju, we'll have to see how things evolve. Just a quick question on the graphite business. Will you be able to comment? Is demand as strong as you all expected? Have you seen any kind of price increases?
Manish would be the better guy to comment on that. But from whatever I've discussed with him this morning itself, I mean, next year we would be operating 100,000 tons and we would be close to around 80-85% capacity utilization over there. And for the first half, the demand remains a bit sluggish, as we've been talking. But the second half, all the graphite companies have announced price increases. So we should be able to full,
Got it. All right, Riju, appreciate you joining in and giving us all the details about the Green Tech business. When you'll report your Q4 numbers, we'll catch hold of Manish and ask him about how things are panning out for the graphite electrode business as well. Thanks a lot for joining in. For the time being, we'll slip into that short break. Come back, we'll continue to focus on markets and stock-specific action.
The most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Practice with at least the larger banks is to hedge their exposures with an external agency. Why wasn't IndusInd Bank doing this to begin with? And, specifically the September 2023 RBI circular does not deal with hedging per se. So we're still trying to understand, what led to the discovery of this change and the subsequent, despite appointing an external agency, delay in reporting this to exchanges and to investors at large.
No, Ritu, this was not a delay. We took a view that we should not be doing the internal deals and we should only go to the market hedge. And I think that is the call, and the circular clearly states that, and we changed the classification of our derivatives into what will go into hedge and what will go into mark to market. I think that's number one. Number two, in my opinion, there was no delay in reporting to the LODR. I think as soon as we discovered the number, the LODR. So as a process, we found that there may have been some gap, but very difficult to identify the gap. And as soon as we understood the gap, we immediately came into the LODR and reported the number. So if you think that we've hidden something, I don't think the bank had hidden any disclosure at this point of time.
Well, no, Mr. Katpalia, it's the markets that seem to believe there is a question when it comes to the credibility of the bank. And, I could recite several brokerage notes that talk about it, that, trust is very important for a bank. And because of this delayed disclosure, there is a lack of credibility, which is why you're seeing the kind of reaction we saw in the stock market, 20,000 crores of market cap wiped out in a day's trade. What will you say to these investors to allay their concerns that there will be no further shocks as well?
Ritu, I can only say that I think when the microfinance issue came in, it was really...
Welcome back. Even as the Nifty is down about 90 odd points, led lower by the tech index, the mid-cap index is down by about 1% as well, currently at the low point of trade. Let's get in Chandan Taparia, weighs in on his, weighs in on the market with his opinion. Chandan, quickly, your thoughts on the indices and stocks.
Good morning, Manglang. Thanks for having me. So the market has been consolidating in a range and finding support near 22,300, but at the same time, sustained supply is clearly visible near 22,600, 630 zone from last 5 days. So the follow-up is missing, and the weakness in selective counter and the Nifty IT is making the market to see the selling pressure at higher level. So again, it's going to be tough for index to hold, but good part is that Bank Nifty is holding. So as of now, I'll be having the neutral stance, or will be trading the broader range in between 22,200 to 22,700 zone, and market is likely to be volatile in this broader range. Now looking at the Bank Nifty index, some recoveries seen here. Bank Nifty has managed to hold, led by buying in HDFC Bank and Kotak Bank. So here with support of 47,700, one can place some recovery towards 48,500 level. So compared to Nifty and Bank Nifty, I'll prefer to go long on Bank Nifty, but Nifty looks weak. So can make the pair trade also, buy Bank Nifty, sell Nifty, or can avoid the trade setup as well. Now looking at the stock specific, we have to be with mix of buy and sell. Positive on the oil marketing company. Looking at the price behavior of the crude in last few days, the BPCL is our preferred pick, which has bottomed out in the last week and witnessing some sustained buying interest. The stock is holding well above its key moving averages. So one can buy BPCL with support of 260 or an upside target towards 282. And second trade will recommend on the sell side, that is sell on Dalmia Bharat. Structure is weak. We have seen liquidation of long position. Stock is trading at multiple months low level. price breakdown is at the worst to take the counter down by 5 to 10%. So one can sell with hurdle of 1660 for the downside target towards 1520 levels.
All right, Chandan, thank you so much for that. Sell on Dalmia Bharat and a couple of other stocks as well. Supply coming in at 22,600 for the frontline index. With that, we'll wrap up on this edition of Chartbusters with the news that the Nifty Bank is in the green, not so much for the others. Thank you for watching.
And we actually, you know what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU and you should see the growth that the bank is seeing and the profitability which the bank is used to.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Rima. With me is Vivek. Markets are at the day's low. The Nifty is now just about at the 22,400 mark, having given up close to about 85 points. The Sensex down close to about 230 points. The problem in the market is IT.
The Nifty IT index is down 3.5%. So despite banks doing well, Reliance Industries at least not declining, perhaps marginally in the green. IT is single-handedly dragging the benchmark indices lower. And here, in a nutshell, the principal concern is this entire global uncertainty, the possibility that US growth slows down will hurt IT. Investors are now in a wait-and-watch mode. Decisions are not being taken because you do not know what's coming next. And therefore, the expected recovery in FY26.
Expected recovery, expected rate cuts, right?
No, I mean, so the street was expecting that in FY26, growth will pick up for IT versus FY25 and FY24, which were tough years because discretionary demand spending came down. So that expected recovery, growth was expected to get back to 8%, 10%. That's not playing out. And now companies are sell-side lowering their estimates on IT. So that's the problem.
So today, I think two brokerages, both
Motilal Oswal and Morgan Stanley, have both cut the growth estimates for IT across the board for the coming 2 years.
In a little while, we'll discuss that a little deeper. But some other sectors also in focus, like you mentioned, a very choppy trading session. The intraday recovery sold into quite significantly. The only good part of the market is the fact that the banking space yesterday that saw significant sell-off, especially IndusInd Bank, that has recovered quite sharply. And Kotak Mahindra Bank yesterday was very strong. Today has continued to see strength. The other stock on the radar is actually Tata Motors. Yesterday, the company had an analyst meet. They reiterated their Q4 guidance, and this is something that the street has taken positively up almost 3% today. But on the other hand, one stock that's seen significant selling pressure is PB Fintech or Policy Bazaar. Remember, the company has gone ahead and approved the investment of close to 700 crore in PB Healthcare to acquire a little over 33.5% stake. The street clearly selling into that particular development. And Zydus Life yesterday made a very interesting acquisition. The only problem that the street has pointed out to is the fact that it appears to be a slightly expensive acquisition and will be EPS dilutive in year one. Under the back of that, as we can see, Zydus, which has been a significant underperformer, that particular stock has continued to see selling pressure even in today's trading session.
Okay, let's get to the other big story, and that's brewing in the telecom space. Bharti and Reliance Jio have both announced a tie-up with SpaceX, via which they will offer Starlink satellite broadband services to their subscribers. Now, this partnership, in principle, can expand connectivity to underserved regions where the traditional networks are limited. So what does it mean for Bharti and Reliance Jio? One, increased revenue opportunity. Earlier, Starlink was seen as competitors. Now there will be collaboration, which means some sort of a revenue sharing agreement. Bharti Airtel and Reliance Jio can sell Starlink solution through their retail stores and their online platforms. Also, the earlier fear was that Starlink will disrupt Bharti and Reliance Jio's existing terrestrial services. But analysts we spoke to say that's unlikely to be the case. Starlink, in fact, will be a complementary premium satellite broadband services, which will be complementary to the existing broadband or fixed wireless service that these companies offer. Now, the big question is, can SATCOM, that satellite communication, become mainstream in India in the medium term as it's been globally? Now, here it all boils down to affordability because Starlink is a premium service. Now, the IFL analyst we were chatting with earlier told us that Starlink pricing in the US is approximately $80 per month. Even in a developing economy like Kenya, it's priced at $10 per month. And there also you're going to get limited GB, like, data, 50 GB of data, which is still very expensive. In India, ARPUs are averaging $3 per barrel. If you look at broadband services, ARPUs are at $3 per month. And for broadband, you get at $5 per month. And you're getting unlimited data. So it all boils down to pricing. So that's going to be, one of the key things to watch. Most say that the revenue uptick may not be that much because this service will target select businesses or very small businesses who have that requirement. Also, another important thing to note that it's not an immediate revenue spinner. The launch is not immediate because Starlink needs government approvals and spectrum allocation in India still needs to be done. So that's the quick brief about the developments taking place. But let's invite Sanjay Kapoor, entrepreneur, TMT advisor, ex-CEO of Airtel India and South Asia. He's joining us on the show now. Sanjay, always a pleasure to have you on CNBC TV18. This is Rima here. So first, share your initial thoughts. Both of them are partnering with, Starlink. I'm sure you also have read the headlines, right? The whole of last year, there was public sparring between the two. They were concerned about Elon Musk's entry into India, and now they've joined hands.
Morning, Rima, and good morning to all your viewers.
Absolutely a pertinent question, and where we stand today actually emanates from the cardinal rules of telecommunications. Telecommunications is a service which is based on interoperability. It is an industry which over time has demonstrated to the world that collaborating is equally important as competing, and therefore you see tower companies and many other assets really shared between operators. And finally, the telecommunication service providers have to be technology agnostic. They cannot be married to any technology. It's 5G today, it could be 7G tomorrow. It could be satellite today, it could be something else tomorrow. And therefore, they will look at all possible avenues of reaching out services to their customers. And that's exactly what is happening in India right now. It's not one bit of surprise to me that both Jio and Airtel have tied up with Starlink, and they will do it with other service providers on satellite as well as time passes. Now, the challenge is that with these services, they want to reach out to those customers who are unserved, where terrestrial networks don't reach. This could be because of a couple of reasons. First of all, those areas where the government of India, because of security reasons, doesn't allow you to go. It could be because the terrains are really difficult and therefore you don't have the wherewithal to support those networks. And the last is the commercial returns on your investment. So there's a lot of ground in which the amount of investment that you have to put in doesn't return your capital. And, the government over time on the universal services obligations has not been able to really move the needle on serving such like customers. So I think absolutely right. These are complementary services which will probably reach out to the ones who are not served. But the dilemma in India is, in a market which is so low on ARPUs, will an individual customer residing in such far off places, will they be able to afford the services at the prices that they operate even in Africa, which is subsidized, I believe? It'll be very tough for those guys to afford these sort of services. Therefore, I think rightly, if you read Airtel's statement, and if you even allude a little bit to what Jio has to say, I think they're concentrating on serving the so-called B2B market, where either it's a healthcare service which is supported by the government of India, or there is some offshore drilling, or there is some other excavation that's happening on behalf of a large corporate, so that there's somebody who can afford and pay those. And the only thing is that they are deprived of those services today because the terrestrial networks have not reached there. So I don't see these services to be a threat. I think they're complementary, and smartly, the existing operators have tied up and also sell their CPs from their so-called outlets and shops, because they want a complete check on how fast the services are moving, what's happening, what types of customers. They want to dig into the whole knowledge, and they don't want to be surprised at any moment. Your last question, it is always the fear of the unknown, that when somebody comes in, and especially with the stature of Elon Musk, then you fear that, can he be more disruptive than what we can, imagine today? And I think that's the fear. But having been in this industry for that long, I don't believe they can ever disrupt the terrestrial networks, because India has a very strong regulation around who can provide these services and who can't. And I don't think the laws will ever permit the satellite providers to actually dethrone or overturn, any one of these operators.
Sanjay, all points very well put. You said that it's unlikely to take off, with regular consumers, B2C. The real opportunity could be B2B, which is what even the press release seemed to allude to. So how big is the B2B opportunity? What kind of revenues can Jio or Airtel expect from it?
It's a very catch-22 situation, because if the market was overly large and the terrestrial operators had some sort of a gauging of that size of the market, or a so-called addressable market, they would have by now gone and invested. I think that they have not invested thus far tells me that they are either tentative, or really they don't see the market to be that large. So once these terrestrial operators get there, I won't be surprised if they will also serve as the guys who will go and create that market for the terrestrial operators, because if the market really becomes of scale, then why wouldn't a terrestrial network put on their own network over there? So I think it's wait and watch for the moment. Nobody understands. It's difficult for us who live in these big cities and who are consumers to imagine that there are very large corporates who are waiting to be served there, can really pay a lot of money, and there's a lot of revenues and profits to be made. But the terrestrial networks have been, the network providers have been daft not to have encashed on that opportunity. So I think the jury is still out. We'll all figure out as time progresses and the services roll out.
Mr. Kapoor, the other question is, like we just mentioned, what kind of a tentative timeline can we work with in terms of actually being able to use these services? And secondly, can this give a material upside to ARPUs as far as, all of the incumbents are concerned? Because, that's been something that the industry has been asking for quite some time.
As far as the timelines are concerned, I think the technical availability of these services and a commercial application and rollout has already been demonstrated in some parts of the world. So I don't think it's a delay from the satellite service providers or now even the terrestrial network providers to partner with these guys. I think the delay is more on the part of regulation and government, where we need to have a firm policy on what happens to the spectrum, because it's a shared spectrum. If it's an administrative charge, then what is that administrative charge? Therefore, they can price it accordingly. And finally, what happens to things like lawful interception and all the controls that the government wants to build in to make sure the services are not utilized by people who should not be utilizing them. So I think that's primarily the delay. Now to come on to the timelines, I personally think the technology doesn't wait too long, and the life cycle of technologies have shortened. Therefore, to delay it for overly too long would be not pro for us. We should experiment with this early. Now, finally, coming on the ARPU question of yours, I think to begin with, at least in the first couple of years, the ARPUs and the revenues from here will be very small and experimentational. And I don't think they will move the needle for either Airtel or Jio, at least in the next couple of years.
Sanjay, always a pleasure listening to you. Thank you very much for joining in today. Get into a break. On the other side, we'll talk commodities. Manisha Gupta joins in on the other side.
There was a cyber attack on X today, which shut it down and may have been foreign sourced.
Yes.
It's a big story. You want to give us a moment on that?
Well, we're not sure exactly what happened, but there was a massive cyber attack to try to bring down the X system with IP addresses originating in the Ukraine area.
Welcome back to Trading Hour. Well, let's now shift focus to the commodity space. Manisha joins in, and today we are focusing on precious metals.
Yes, we're doing that because there's just so much chaos and uncertainty in the international markets on what way the tariffs are going. And that's exactly the reason that you have seen the safe haven buying come back strongly in case of gold and even more stronger in case of silver. So if gold prices gained up by a percentage point overnight, silver gained up by 2.5%. And we are inching very close to that 1 lakh rupees a kg mark yet again for the silver prices, with stakes much higher when it comes to silver, because silver is not just safe haven buying, it also is industrial metal, and demand for that seems to be going stronger. That clearly seems to be supporting silver. But the markets also are gaining because the US dollar index is now trading at a 4-month lows, and that clearly has been supportive. For gold prices, we've seen 2,900 regain in the sense of the markets there. And starting today midnight, US is imposing tariffs of 25% on metals like steel and aluminum, and that seems to be impacting markets in sense of inflation and uncertainty going forward. Well, while we do know that the US and Canada will hold conversations for the next 2 or 3 days, so there is going to be choppiness, and the markets are expecting more uncertainty there. The expectation also is that you could be looking at more stimulus coming in from China. That has been more supportive for silver rather than gold. And if you look at the chart in this year, we clearly have seen nearly 11% of gains come in for gold and 14% for silver. So silver clearly outperforming gold, platinum, palladium at this point in time. What the street will watch out now is the US inflation data that comes in today, and that would set you for the US Fed meeting for 18th and 19th March. So these are the two major events, especially from US, in sense of data and events that the street will keep an eye on.
Thank you very much for that, Manisha. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar will join in on the other side.
They're setting fire to various Tesla charging stations near Boston. Shots were fired at a Tesla dealership in Oregon. Various nonviolent...
Shots fired, not a metaphor.
Shots fired, yes. Downtown New York, marching against the Tesla showroom. Your stock is way down. You've been criticized left and right.
But look on the bright side.
I mean, why are you doing this?
Always look on the bright side of life.
Yes. And you're on it.
Yeah. I mean, just like I said, the goal here is let's not have America go bankrupt with waste and fraud. So that's what I'm here for.
Welcome back. Let's talk about the tech troubles that we can see in the markets. The Nifty IT index is down 3.5%. Wipro, Infosys down more than 5%, while HCL Tech is down close to about 3.5%. The problem is the street investors are now downgrading their earnings estimates. So today, Motilal Oswal has downgraded Infosys to a neutral, Wipro to a sell, and LTTS to a neutral on the back of valuation discomfort. Tech Mahindra, though, has been raised to a buy, and their target price in 1950 implies a little bit of an upside, 30% upside from current levels. The reason for the downgrade is the sentiment has turned cautious amongst clients from January to March. Most investors are adopting a wait-and-watch approach, and therefore, the earlier play in IT was play the companies which benefit from a discretionary demand revival, the likes of Infosys and Wipro. But now Motilal Oswal says the better companies to play in IT would be ones where you have a higher risk reward. And therefore, they've downgraded Infi and Wipro, which was seen as beneficiaries of the discretionary demand picking up. Basically, they don't expect discretionary demand to pick up. And therefore, the growth pickup in growth that they were anticipating in FY26 and FY27 is unlikely to play out. So they've slashed the growth estimates across the board for IT companies. So for TCS, earlier growth forecast was 6.2% for FY26. They've brought it down to 3.5%. For Infi, growth is now seen at just about 5%. Wipro is seen sub 3%. Basically, FY26 is seen in mid-single digits, while FY27 growth forecast is seen in mid to high single digits, ranging between 5 to 7.5%. So that is disappointing. That's the problem, that clients have turned cautious, and therefore growth is unlikely to pick up for IT companies. Morgan Stanley too has downgraded Infosys to an equal weight, target price lowered to 1740. They're also forecasting a slower pace of recovery, moderate growth for a prolonged period. Their key trades are TCS over Infi, Tech Mahindra over HCL Tech, Coforge over Emphasis. Also on the subject of valuation, they're saying that despite the recent corrections seen in IT names, valuations are still at a 5-year average, which is about a 14.5% premium to Sensex. But the long-term average for IT companies relative to Sensex was trading at about a 5% premium. And given that we are in a period of a prolonged growth slowdown, things are looking a bit murky, they believe there is scope for earnings downticks and even PE derating to take place. So, two negative calls.
Consistent downgrades in the IT pack, and the sector, the weakest sector in this session today. Well, moving on, time for a technical check on the market. Mitesh Thakur joins in. Mitesh, thank you so much for joining us. What are you making of the markets at current levels? We've seen a bit of a sell-off from the day's high.
Yeah. So I think, good morning. One, the markets haven't given a reversal on the upside, failing to get past 22,600. But I think 22,300 is the pivot which I'm watching. We've been contracting within this range for the last 2.5, 3 days. And the idea is that in case we break 22,300, then I think we might get into a marginally declining mode again. Otherwise, we'll keep chopping around, and the reversal on the upside will happen once we start getting past 22,600.
Mitesh, your individual calls for the market?
Yeah. So on the stock side, I have a sell on Ramco Cement. With a stop at about 826 and a target of around 780. And the other one is a buy on Reliance with a stop at about 1230 for a target of 1285.
Thank you so much, Mitesh, for joining us and giving us your view on the market as well as your individual stock calls. Well, Nigel joins us. There's some development as far as Tamil Nadu cement companies are concerned. Both Ramco and Dalmia are under pressure. Nigel, over to you.
Well, that's right. Ramco as well as Dalmia Cement, both of them are under pressure. And the street was puzzled as to why did we see such a big downtick on both these two names. The problem is that the Tamil Nadu government has gone ahead and now they have levied 160 rupees per ton on limestone that is mined. Earlier it was proposed, now this particular proposal has been passed. So that's why it's viewed negatively for these two companies in particular, because they have a high percentage of their total clinker mix that is in Tamil Nadu. For Ramco, it's close to around 45 to around 50% or thereabouts. And Ramco is the highest exposure to Tamil Nadu. So that's why, because as a percentage of their total clinker capacity, close to 50% is in Tamil Nadu. While for Dalmia, it could be in the vicinity of around 20 to around 25% or thereabouts. What happens next? Well, other state governments as well, since the levy of royalty on some of these minerals is in their hands, the other states as well could go ahead and start levying a similar amount of royalty, which will be a worry for the profitability aspect. What can the cement companies do? Well, they can go ahead and they can try to push it through via price increases. But as we know, prices have been rather weak. However, on the flip side, it could give reason to some of the cement makers that because of some of these royalties that are imposed now, we'll have to go ahead and increase the prices. Just a back of an envelope calculation, 160 rupees is the total hit if this price is not passed through. And for Ramco, it will be close to around 50%. So that will be close to around 80 rupees approximately. While for Dalmia, it will be in that vicinity of close to around 40 rupees on a per ton basis. As it is, the profitability has been under pressure. So for the time being, there's a bit of a knee-jerk reaction that you've seen both on Ramco as well as Dalmia because of this 160 rupees royalty that's been imposed on the limestone that is mined in Tamil Nadu.
Thank you very much for that important update. We will slip into a very short break. We'll come back and track the macros, the global markets, economy. Manish Dangi from Mosaic Asset Management joins in on the other side.
Now, if you look at the foreign portfolio position in India, they are the most underweight they've been on Indian equities ever.
Yeah.
And most importantly, India is now a low beta market, unlike the past.
Yeah.
So if you go back 10, 15 years, India used to be a market which had a beta of more than 1. And for your listeners, that means that India used to go up or down a lot more than the world. Now, if the world is in a trickier position than it has been for many years, the likelihood is that India will outperform. It's a very, India is like consumer staple stocks. It will outperform a bear market in the world. In February, a policy pivot which I will say is one of the biggest in my career, going back 35 years.
Welcome back to Trading Hour. Well, Manish Dangi, CEO and founder at Mosaic Asset Management, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much, Manish, for joining us. Well, at the current juncture, what are you making of the markets? There's been significant price correction. Any sectors you find attractive at current levels?
So if I'm more of a macro trader and actually trade beta instead of micro of it, in general, I think markets have sort of down corrected a bit, but I think the pain is still out there. You still have 6-8 months of listless in the best case scenario, and perhaps sort of even more downturn from here. So that's a big picture macro story. What I don't like, of course, is anything to do with what China makes well or US imports. I think those are the sectors which are going to get hurt sort of pretty significantly. Given that the Indian cyclical downturn is not very deep, anything to do with India consumption at margin, is where you should sort of begin to dial up. Finally, the next bull market, as it always happens, is led by BFSI, most importantly, banking. So, we've had sort of stresses, in very, very small financiers like microfinance, moved into mid-sized banks, and now at some point in time will enter into large-sized banks. So I think from a sequencing point of view, the incremental beta should be dialed in through financiers. So that's a big picture view of how I would dial up risk at margin in markets now.
Manish, let's talk about the global markets and economies at large. Now, US economy, do you think it's likely to get into a recession this year? There is talk about stagflation. Last week, we were talking about stagflation. This week, we're talking about recession. But, I mean, the US exceptionalism, right, is being questioned now. The AI dominance is now being challenged by Chinese makers. Some of the economic indicators are flashing warning signs. So what is your expectation of how US economy is likely to perform in the next 12 months and what it means for Fed rate cuts?
So in US, there are a couple of things. One, of course, in US, a little bit of a self-inflicted wound. Between DOGE and tariff, they didn't have to do it, and yet they're in some sense as if imposing austerity on themselves, and it's an active policy, so to say, to achieve something, and which that something is a little bit of a, I guess a policy shift in US. Of course, the side effect of that will be slower economy. So far, US is sort of pretty steady. I kind of thought 6 months ago that, US would enter in, significant slowdown by now, but hasn't happened. So, but to a certain extent, between DOGE and tariff, it's likely that in the next 6-8 months, US actually sort of very, very sharply slow down. That's one. But from a pure market standpoint, US has sort of other problems. One, pretty much like 2022, you are starting to see earnings roll over there in the tech market particularly. And so both investments are taking a hit there at margin. At least 4 or 5 months, if you're watching US tech earnings, they're starting to roll over. So I think that's going to be a bad news. And on top of it, as you said, China is clearly threatening US's hegemony in tech. And so to that extent, this exceptionalism, and US exceptionalism, by the way, has been mostly about techs, since 2006-07. I think that's getting threatened. So in some sense, if you were to sort of look at one market which perhaps is sort of most overvalued and is likely to get threatened most significantly, both from a fundamental standpoint, but also from the point of view that, there's been a huge positioning, I think that's the US market. And, I kind of called it out about a fortnight ago across many channels that, US is a market, you should be sort of super wary of and, exit risk as much as you can there.
So, Manish, Indian equities were the only game in town, and now everyone's talking about how asset allocation. So, if all options are open on the table, it's not for Indian equity investors, etc., people who are watching predominantly, but still, if all options were on the table, which asset class is now best placed? Give us your pecking order.
Sort of as a top-down asset allocator or macro allocator, you sort of first look at territories. So, of course, US is a market, at least personally I've been sort of overweight on because it's primarily a US dollar call. But at margin, of course, as I said, that looks the most fragile market. You really can't do big bets or position sizing in China and Europe. But almost certainly, Europe seems to have woken up. They seem to have sort of, turned back to sort of more defense spending, higher fiscal deficit. Of course, that means Europe most probably will not be sort of weaker forever, will begin to strengthen. And of course, bonds are taking a hit there. So So I guess, Europe is a small market, that you could do a little bit of a position sizing. China, again, moves sort of from one extreme to another, from sort of a darling of the market to, non-investable market. But again, small positioning there. But for a local investors, I understand that, mostly it's going to be a call between fixed income versus equity. And I made this point to you since last September, October, that, it's likely that for 3-4 years, bonds, simple bonds, fixed deposits will likely earn more than equity. So I don't sort of want to change that view yet. I think, Indian markets are still sort of fragile. I think the positionings are very, very strong. Margins still have to roll over. And the scarrings of last 6-8 months will stay. So I think it's going to remain a sell on sort of rally instead of buy on dip market for at least 6 to 12 months time.
Thank you so much, Manish, for joining us and giving us your view as far as various asset classes are concerned. Well, time now for a short break. Parag Thakkar from Fort Capital joins us next to discuss the latest trends from banking sector and the developments related to IndusInd Bank.
RBI has put a three-pronged correction, cutting interest rates, committing itself to liquidity, and also starting to lift the regulatory burden on the banking sector. The RBI policy suite, the market has just ignored this, what I call as policy pivot. India's policy environment today is far more certain than the rest of the world put together, whether it's US, Europe, or China. So you want to buy this policy certainty, and I think investors will buy it. Our retail investors get it, and I suspect that February may have been record inflows, and a lot of people have been quizzing me about when will retail give up, and I've got tired of saying this, they won't.
Do you worry today, Sabya, that we are at a point which is almost an existential crisis for a whole host of arts and artisans across this country? I mean, you were talking about the fact that this shouldn't be treated like a charity. It shouldn't be treated like a CSR project. What kind of interventions do you believe we need at this point in time to ensure that we keep this soft power alive?
We don't need to do much because evolution will take care of itself. Because I'll tell you, so we were at the age of influence, which is moving into the age of intelligence. AI is going to come in. And I personally think that AI in many sectors, especially in performing arts and art, will be very short-lived. Because after the age of intelligence will come the age of wisdom. And when the age of wisdom comes in and people realize that the greatest gift to humanity is humans themselves, and we should not robotize our existence so much that we forget to be human beings, then people will realize that art and craft is going to be the most important expression of humanity. We don't have to do much. Evolution will take care of itself.
We certainly hope so. Speaking of the dynamics changing, and you were talking about the consumer and the consumer being your biggest influencers, so to speak. The Sabya bride, you kind of turned that on its head, right? I mean, the Indian brides were always coy, demure, shy. There was almost this invisibilization, and you kind of turned that around completely. How did that happen? I mean, was this because of the influence of the strong women in your life? What was it that you were trying to tell by way of attempting to sort of turn this on its head?
See, I don't really understand gender inequality because in my head it doesn't exist. I've been raised by, thank you. And sometimes I tell that, the problem with gender inequality actually starts with bad parenting. Because I think if you raise your boys to believe that they're not better than women, but they're equal to women, I think.
Welcome back. IndusInd Bank has recovered today, 2.5% higher. It's come off from the highs, but still, after the thrashing that it got yesterday, there is some green on the screen. The management exclusively told CNBC-TV18 that although there could be some decline in the net interest income in Q4, the bank will show a profit in the fourth quarter. Listen in.
what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU, and you should see the growth that the bank is seeing and the profitability which the bank is used to. The full year will not be a loss at all. And I think the quarter 4 itself also will be a profit.
To take the discussion forward, Parag Thakur, Senior Fund Manager at Fort Capital, is now with us on the show. Parag, you would have analyzed IndusInd Bank even before the events of the last 48 hours unfolded. The RBI extension coinciding with this update about discrepancies in their derivatives portfolio. Were you bullish on IndusInd Bank in the first place? And now what have you made of these recent updates?
So basically, first of all, thanks a lot for having me on the show. So IndusInd Bank, basically from valuation perspective, always looked very attractive. The only problem was when the microfinance issue started, we became very cautious and we sold it out. And luckily, so we were not holding any IndusInd Bank stock because of and not because of this particular episode, but we sold it because we thought that 11% of the loan book was microfinance, and microfinance was going through a lot of stress, and we were not finding any answers to that. And so we sold. So we just got lucky, I should say. And after this now, in my view, of course, management has clarified a lot of things, and promoters have also given statements that they are ready to increase stake and all. But I would say that the governance part of it, I think, because every bank, what I am being told is that after 2013, when taper tantrum had happened, RBI came up with many regulations in order to restrict this forex swap related losses, and which can be reported on M2M basis. I would say that I would still go with banks like Kotak, ICICI kind of banks, or HDFC Bank kind of names, where you are 100% confident that this kind of episode is not going to happen. And plus, there are other tailwinds also. Definitely, as you were discussing just now, that the entire growth narrative of US is taking a backseat, and so there is a selling in US market. We are hoping that some part of those can come back to India, and which can come into large cap banks, because what they sold was large cap banks. So from that perspective, we like Kotak the most, because it is the most, I would say Kotak and ICICI, followed by HDFC Bank, of course. They are most well-governed banks, and plus Kotak has many levers. Recently, their embargo got lifted on credit card. Their NIMs are 4.93. And I think they have very good levers to protect their NIMs in terms of their CET1 is 21%, CD ratio is 87%. Plus now they can grow their credit card book, which is high yielding, so they can protect their margins that way. Plus they have a very good secured retail book, which is construction equipment, tractors, which is doing well because of rural India recovering. Commercial vehicles, where they yield slightly higher than mortgage and AAA rated corporates, right? So they have margin levers also. They have clearly stated that their growth will be 1.5 to 2x nominal GDP growth. So there's a growth also. There is some margin protection also. And asset quality, as usual, remains pristine.
Right. Parag, take that point completely. You didn't have IndusInd Bank in your portfolio, but the stock is now almost 50% cheaper from where it was, maybe just around 6-8 months back. So at this price, does it warrant a fresh look at? And the other bigger worry as far as mid-cap private banks are concerned is there a possibility of a contagion effect? Could other banks see something similar play out? And in that case, would you like any of the other names? Some of them have seen significant corrections, names like AU Small Finance, an RBL Bank, a Bandhan Bank. Would you like any of those names?
No, I will. So it has been my stance since long that I have to be in a lenders where I am confident about governance first, and second, it should be a secured lending, whether it is banking or NBFC. I prefer secured lenders because in unsecured lending, when economy goes through such kind of problem, when last year government was not spending because of election when RBI was keeping liquidity very tight to control inflation. In this kind of environment, if you have an unsecured loan book, it becomes very risky. So my entire portfolio is tilted towards secured lenders, whether it is Kotak, ICICI, SBI, or whether it is Federal Bank in the mid-cap space. My portfolio, and I like to keep it that way only because I don't think so. That, see, what I'm feeling is that government has started to spend. The effect of that has still not transmitted in the economy on the ground. RBI has done phenomenal work by infusing liquidity, by reducing repo rates, but that will show result in 2 to 3 quarters from now. So it is not a time to take extraordinary risk in the market. And lending is a very risky business because 80% of your total book is borrowed. So it's a highly leveraged business. So you have to stay with disciplined, well-governed, secure lenders. That is the message.
Understand that and take that point completely, Parag. Thank you so much for joining us. Hope to see you more frequently on the channel. Well, time now for a short break. We put the spotlight on JP Associates on the other side.
Far more sensitive to gender parity than they are today. And I have grown up with women who I've looked up to. My friends growing up, my girlfriends growing up, they were very strong women, and I was in awe of them. And let's talk about the bridal market, for instance. So I'll tell you a small story. So I meet a lot of women in India, mothers in India, who believe that I can matchmake for their daughters. And
can you?
No. No, I don't even have a social life.
About the consumer, not just the Indian consumer, but also the global consumer that you're hoping to tap into now, Sabya. What's changed? You talked about social media. You talked about the world of influencers and content creators and how that's also shaping the choices that consumers make. In your experience, as someone who understands the fashion industry, as someone who's been part of the fashion industry, what's the big change that you're seeing in terms of consumption and consumer behavior today?
I think self-confidence and self-expression. Truth be told, and I've said this in many forums, that fashion has made a lot of money by feeding on people's insecurities. So the more insecure you kept your consumer, the more they wanted to buy your product because they wanted to feel good about themselves. But what fashion didn't realize for the longest time, that the consumer was getting smarter and sharper. And anyways, I think the Indian consumer is probably the smartest consumer in the world. And, I think that when you have and also at a time, a lot of luxury goods were consumed by the idle rich. Today, if you look at the people who are really buying luxury in India, everybody's working, nobody has time, everybody's self-reliant, everybody has self-confidence, everybody has self-expression. And, then the consumer shifts from being brand supreme to product supreme. A consumer just wants to buy the right product, not the right brand. And at Sabyasachi, we want to get the product right. Whether the brand becomes a super brand or not, it's an outcome of the product, not the brand. And I think globally, when the consumer is going to now realize that that luxury is based on rarity, craftsmanship, authenticity, and provenance, where else can you find a luxury product more unique than what you would find in India? So I think whether people, no matter what happens, no matter how much artfully the spin doctors and the global markets try to dominate India, they can't put India in a corner because it's just not going to be possible because the consumers won't let them.
Here today, what globally, and I did address that in the remarks that I made early on. There's this talk about the tyranny of diversity and inclusion. Do you worry that we're likely to see a pullback, a retreat from some of these issues that require urgent intervention and action?
So thanks, Shireen. I think firstly, Shireen, the minute you combine diversity and inclusion together, I think the likelihood of pullback is very, very low. Because what that says is that we're going to get in people who are different, gender being one of the ways you can get in people who are different, and make sure that they feel included in an organization enough to be able to stay and progress. So I'm really glad that you combined the two words together, because the concern really is, and if I may, to your point, the concern on putting targets is that
Welcome back to Trading Hour. Well, in what's a major breakthrough as far as lenders are concerned, sources tell CNBC-TV18 that banks have completed the transfer of 12,000 crores rupees in stressed loans belonging to JP Associates. Ritu joins in with more details.
Well, in what is a landmark resolution for banks nearly a decade in the making, we understand banks have concluded the transfer of stressed loans belonging to Jaiprakash Associates to the National Asset Reconstruction Company, or NARCL, and against a principal outstanding amount of 14,500 crores, these 25 banks led by State Bank of India and ICICI Bank get 12,000 crores from NARCL. Of course, the total outstanding debt for JP, including all of the overdue interest, penalties, etc., is well over 52,000 crore rupees. Now, the deal follows a 1585 structure, meaning 15% upfront cash, which is about 1,800 crores, and the rest in the form of security receipts. But importantly, this will reflect in the bank's balance sheets in the current quarter itself. Among the key lenders, SBI alone has recovered about 500 crores in cash and another 840 crores in security receipts. ICICI Bank has received 270 crores in cash, another 1,550 crores in security receipts, and IDBI Bank, Axis Bank, LIC and Canara have also secured recoveries through the transaction, among others. Now, while most of the banks did agree to the transfer, Yes Bank and DBS Bank, with very small exposures, we understand, opted not to participate in the sale. But importantly, even though banks have now transferred this exposure to NARCL, the resolution of the company will continue under the IBC. We understand the deadline for submission of expressions of interest has now been extended to the 25th of March, and the ultimate recovery through the security receipts will be dependent on this resolution. Nonetheless, a significant development for banks in the case of JP Associates, which has been an NPA since 2016 and at the center of one of India's most protracted corporate debt struggles.
Thank you, Ritu, for that. By the way, markets are slipping. Now sub 22,350. A level to watch will be intraday low of yesterday, 22,314. That was the low the markets hit yesterday, and whether we can hold on to that level. For now, things are looking weak. Benchmark indices down over 0.5%, mid-cap index down 1.5%, nearly 1,800 stocks declining. IT continues to remain under pressure, but Reliance Industries too has dipped into the red. It's a wrap on Trading Hour. Thank you for watching.
Whether you mean it to signal or not, that you are willing to compromise on meritocracy. And I don't think there is any woman in this room or anywhere else who wants a suggestion that there is a willingness to compromise on meritocracy. I think the answer may be a little bit to the question is, as you get them in for interviews, for discussions, that the slate is balanced, and then let the best person win to get the job. And if I may, sorry, to Mr. Dave's point on, if I may say to the women in this room and beyond, there are many jobs that we've traditionally thought are not a great idea for women. And coming from an FMCG background, sales is one of them. Attracting women into sales actually is very, very difficult, because all said and done, it is a difficult job. But honestly, it is fantastic learning. And if you put yourself out there, the rewards that it gives you are tremendous. So if I could just urge the women in this room to take these challenges and take some of these leaps, it would really help as well.
What happens is that it makes the trade just a little bit less efficient. And therefore, if anything, it's got a positive impact on the market, as you said. The concern is if there are widespread tariffs, then it actually affects economic growth. And underlying demand for the commodity, in which case that becomes a negative. On a ton-mile trading pattern basis, it's good for shipping. But if it affects demand for commodities, then that's bad for shipping because of general economic impact. Now, every day you have some added uncertainty around US tariffs, trade, etc. So I think it makes sense to wait for a bit. In the last term of President Trump, where there were some China tariffs put there, and China put some tariffs on US products, which they've already done, where they put some tariffs on US grain. And US is a significant exporter of soybean to China. So when those tariffs came in, basically the trades rerouted. China imported from Brazil, Argentina instead of the US, and US, instead of exporting to China, exported elsewhere.
Stocks are trading soft after another down session in the US, but the advances and the declines seem to be in the balance. IT and healthcare are the big drags, while utilities and financials eke out gains. Starlink looks set for an India entry, with SpaceX tying up with Jio Platforms and Bharti Airtel to offer its broadband services via their distribution network, subject to regulatory approvals, of course. Analysts see little impact on existing services, expect Starlink to be used by customers in low or no network areas. IndusInd Bank CEO Sumant Katpalia says the accounting lapse is a one-off event while defending the timing of the disclosure. He promises that the bank will post a profit in the fourth quarter, though the interest income can take a hit. Donald Trump blows hot and cold on tariffs, with Canada rolling back duties on metal imports after doubling them. He also says that the stock market will do great, but he must press ahead on tariffs. Good afternoon, you're with us here on Halftime Report, live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Vatakia. With me as always is Mangalam Malu, and the little bit of resilience that we saw yesterday amidst the global market sell-off appears to be tapering off a little bit, and that is of course courtesy the IT names. What's holding out today is of course the Nifty Bank, which was the underperformer in yesterday's trading session, but at the lowest point of the day currently is the Nifty, 160 points down, now below the 22,350 mark. The Nifty Bank continuing to see some support at that 47,840 level, has also given up all the gains, but still holding on to the flat line as of now. Mangalam, good afternoon.
Good afternoon. So it's very interesting. Yesterday we expected, because of the global weakness, the IT index to underperform and the Nifty Bank to hold out because it is more domestic facing. However, the opposite happened. The IT index was impacted, or IT index was resilient, and the Nifty Bank was impacted by what took place in IndusInd Bank. Right now, as we speak, we have the IT index, which is playing out the global weakness that we've seen. There's also a domestic brokerage note that has come by. We'll speak about that on, downgrading IT. And today, IndusInd Bank, after a big drubbing yesterday, has recovered from the lows. Mind you, the stock is also in FNO band, so that is exaggerating some of the moves that we're seeing on the counter. Yesterday's downtick of 27%, today's recovery of around 11% from the lows is supporting, the banking index in the way that it's not falling as much as the other frontline indices. But be that as it may, the Nifty is down about 150 points, led lower by the IT pack. the mid-cap index, that's been underperforming for 2 straight sessions. And after falling 1.5% today as well, and about 1.8% yesterday, we've seen a big decline in the mid-cap index from the highs that we saw all of last week as well. So nearly given up all the recovery that we saw in the last week for both the mid-cap and the small-cap index. Despite that, we have one of the stocks which is doing well, and this is from the frontline Nifty pack itself, up around 2% because of good commentary coming in from the management. The stock that we're talking about is Tata Motors. Sudarshan joins in with that. But just before we go to Sudarshan, we have the Feb MF data that has come in as well. 29,240 crores versus 39,000 crores in terms of an inflow. So the inflow month on month for February has reduced, though we'll look at more details out there. The net equity inflow perhaps could have been lower on account of a couple of factors. One, there might not have been as many offers openings. And secondly, there could have been some redemption. So we'll keep an eye out on further detail that comes in here. Feb MF data is what we have right now. Net equity inflow at 29,241 crores. Sudarshan, we'll look at this data in just a bit. But in the meanwhile, do tell us a little about Tata Motors. Okay, we'll get back to Sudarshan in just a bit. But that's the data that we have right now. February mutual fund data, 29,241 crores.
It'll be interesting to see what the SIP number comes out with, because even after the correction that we have seen from the highs, the SIP number has remained largely resilient. The large cap fund inflow still almost the same as it was in the previous month, around 2,800 crores compared to an inflow of 3,000 crores last month. Now, the consensus building up that large caps are the place to be as of now, and that is why you can see the flows on the large cap side still being fairly okay on a month-on-month basis, but the overall inflow number has seen a substantial downtick compared to the last month. Of course, there were a lesser number of NFOs if you could attribute it to that, and of course the market correction playing a big role in that as well. The small cap fund inflow at 3,700 crores compared to 5,700 crores last month, so a big downtick there of around 2,000 crores. And the mid cap fund inflow too, seeing at least around about a 1,700 crore downtick from last month at around 3,400 crore rupees from 5,100 crores last month. We'll get more insights on this as the guests and experts join us on this. But as of now,
Sandeep, what explains this, difference in the numbers that we've seen? If you look at the last 4 months, the average has been close to around 38,000 crores on a monthly basis. In February, it's come down to sub 30,000 crores. What do you think explains this? Is it the weakness that we saw in the market, the lack of new fund offers, or, is there anything else that you think has happened?
No, I completely agree with you. Your analysis is correct. So the flow has somewhat decreased in the new fund offerings. So anecdotally, what we were hearing, that there has considerably slowed down in terms of bulk money which is coming through the NFOs, and number of NFOs have also sort of reduced. So investors will be guided by the immediate past experience of the NFOs and of the markets. So it's quite natural that, while it is heartening to see that the inflows are quite strong, 30,000 crores is not a small number. So it is quite good to see that the numbers are quite strong, but the trend would weaken a little. So that is all right. I think what we need to focus is that the money flow is positive and it's quite substantial. And depending on the market and with the confidence coming back, I think we will see these numbers grow gradually.
One of the more volatile numbers is actually the liquid fund number, which has fallen from about 91,000 crores to about 4,900 crores. My sense is that this 91,000 crores itself was an aberration, and as a result of which this 4,900 crores also is a bit of an aberration. So do you have any thoughts on this? The liquid fund inflow, which has come in just sub 5,000 crores versus 91,500 crores month on month?
Yes, so liquidity has been extremely tight on a couple of counts. So liquidity is, has been uniformly, consistently in the deficit to the extent of 1.5 to 2 lakh crores. While the rate has been cut, the liquidity has not flowed into the system yet. And I think government is also, wants to keep the fiscal deficit down for the year and has been deferring payments. So I think in April, liquidity will improve. And that is when we will see, better numbers for liquid funds, because local liquidity is tight, right?
All right. And what would your sense on the SIP number be? You know, because it's been holding closer to that $3 billion per month sort of mark over the last couple of months. But what's worrying is the increasing trend of withdrawals in SIPs as well. Where do you think that number settles this month at least?
So, you know, I think the mutual fund industry and the distributors, the MFDs have done a fantastic job in terms of taking the message of mutual fund sahi hai to the masses. And people are putting recurring deposit kind of investments like SIPs, and that is really growing. I think these numbers will continue to grow on a trend basis. And I think few people who have started this habit in the recent times might experience some volatility and might get, second thoughts about it. But I think the distributors are doing a great job, and I think the mutual fund industry is doing a great job in terms of reassuring and re-emphasizing that we are here for the long run. So one should not get influenced by the short-term volatility. The markets are correcting from extreme optimism scenarios to realistic scenarios. So I think there will be volatility, but I think we will tide over it. I think the numbers will settle down in the short run around these numbers and gradually grow going forward.
Right. Sandeep, the large cap fund inflow has remained pretty resilient so far, even on a month-on-month basis, but you can't say the same for the mid cap and the small cap fund. Do you see this now becoming a sustainable trend, as there is some consensus building that, okay, large caps is the place to be and mid caps and small caps might just see some more pain going forward?
Yes, see, so what has happened is that, what we were initially, when we are investing in small caps or mid caps, we are giving more weightage to longer term growth. Now, those are not a clear and current reality that is in the future. I think the market mood has shifted, that more money is getting allocated to current cash flows and current earnings. So yes, this trend is there, but one single swallow does not make a summer. Right. So I don't think this trend is going to last for very long. The current volatility has given rise to a situation where we are allocating more money to large caps, and this is happening across fund managers and investors and distributors. I think once the situation settles down, we will come, the flows in small caps and mid caps will start.
All right, Sandeep, just one last question before we let you go. You've been around for a while. You've been tracking this, and you've seen markets through cycles. A lot of people say that flows keep markets resilient. The counterintuitive thought is that markets keep flows resilient, because if the market continues to do well, flows keep coming in. It's been 6 months of underperformance of the market itself, negative returns for the frontline index itself, and a lot more for the mid and small cap indices. For how long do you think the market has to be this way for flows to actually, take a leg down or maybe not grow as fast as we've seen earlier itself? Just wanted your thoughts on how it goes.
I will answer that. See, people make the mistake of putting the cart before the horse. The horse has to lead the cart. The economy has to grow, because of which companies will do well, because of which earnings will do well, because of which flows will come. So flows are not coming because the growth aspect is slowing down. So once the growth and the visibility in earnings will come, and before they come, maybe probably markets will try to, to preclude, focus that possibility and build that earlier before the flows actually happen, before the earnings actually grow. So flows will come when valuations are a little better and earnings improve, when the visibility on earnings improve.
All right, Sandeep, thank you so much for sparing time and joining us today. Looking forward to chatting with you more often on this platform. But some interesting insights coming in with the large cap flows being resilient, the mid cap and small cap flows seeing some outflow, and you can saw the sectoral and thematic funds number just flashing on your screen as well, lower on a month-on-month basis. We also being joined by Anand Varadarajan, who is the Chief Business Officer of Tata Asset Management. Anand, good afternoon. Thank you for joining in. What do you make of this, right? With these large, firstly on the total inflow, you attribute that to the correction in the market as well, and of course with the resilience in the large caps and the decline seen in the inflows by the small and mid cap funds?
So I think the way to think about this is 1 year returns of mid and small turned negative sometime in Jan and Feb, and that could have had a bearing on flows consequently in these categories. Large cap, for instance, I think turned negative. 1 year would have turned negative very recently. End of Feb, I think large caps would have turned negative. But I think there has been a lot of commentary which has been on, which has been saying that large caps on a relative basis look attractive, and not surprisingly, we've seen better inflows in large cap compared to its own past. But small and mid languishing relative to its past because of I think performance pressure.
All right, we take that point, Anand. We had a fair bit of discussion on this itself. Just a final word on SIP. What would you hazard that number would be as a guess? 26,000 is what we've been doing for the last 3 months. Do you think this is going to come down or maybe stick around at these levels itself?
My sense is that it could possibly kind of see a bit of softening in February. Let's wait for the numbers to be out. But if at all there is anything the same, I would attribute the same reason if it is any softer, because I think 1 year returns of SIP could look very, very soft to even potentially negative. So if investor sentiments could weigh in, then maybe that could seem a bit muted. Suffice to say that, of course, these are then times to kind of bump up or increase. But clearly, I think, if you were to look at past returns, and investors often look at that as a decision point for making future investments. But I think we often keep saying this in our to our clients that as markets rise, it only your risk increases, and as markets fall, your risk decreases. This is something which is very simple but not easy to digest and action upon.
Right.
And that behavior comes across sometimes in flows.
All right, Anand, thank you so much for joining in.
And if you were to look at it in mid and small last year, I think
we've got him on a scratchy line, but we've got his point. Anand, thank you so much for joining in and giving us your views. We will obviously connect with a battery of experts once we get the SIP number that comes in as well, and more details as the Association of Mutual Fund Industry, the AMFI as we know it, will do a conference call with everyone and give us some more details of the flows that were in February. Take a short break, come back. On the other side, an important corporate conversation lined up for you. Management of Supreme Industries joins in to discuss the acquisition that they've made very recently.
Let's talk about your 2008 Olympics match. Tell us about your whole experience. That was your first Olympic match. What was the feeling? What was going on in your mind? Tell us all about it.
I think it was in 2008 and I was 18 years. And when I won my first international title, I was only 16. And I was there in the international circuit, and a lot of these Chinese and a lot of these Koreans were actually they were worried like some Indian is coming, and they're actually giving us tough competition, because before me we didn't have a female badminton player who was actually playing at that level, who was actually winning those international matches. Of course, we had Prakash sir and Gopi sir who did well, but I was just, when I started playing badminton, I used to ask my mom this question: why badminton? I don't know. It's such a difficult sport, and you have the Chinese in quarters, semis, and finals. They're everywhere. So she used to be like, no, for me, you are the champion. You're going to do it, and just believe in yourself. And imagine, she's a housewife. She's just a housewife. She's not even a international level coach, or she's not someone who's seen what international badminton is. But she was like, you are my champion. You're going to do it. And with her belief, I was in the Indian team when I was only 13, senior Indian team. Wow. And I won my first international when I was only 15, 16. So these things happened in my career really, really fast because of only one person's belief. And of course, the coaches come in, the trainers come in. But I think the first Olympic was, in fact, so early in my career that, I was like, my mom wished that I have to become an Olympic champion, and I'm here. I'm here so early, and I'm actually getting closer to winning the medal. In 2008, I lost in the quarterfinals, and I still, that one match gives me a lot of sleepless nights, because it does, because even after having the medal, I was 11-3 up in the third set. And then I was actually getting all these things in my mind, saying that my coach was...
Welcome back. You're watching us here on Halftime Report. The company that we're going to talk to is Supreme Industries. It's signed a memorandum of understanding with Wavin Industries to acquire their Indian piping business for about $30 million. We have Mr. MP Taparia, who's the managing director at Supreme Industries, joins in to give us his perspective on that. Mr. Taparia, the first question is that, the reported revenue of this business is close to around 1,000 crores, of which you will be selling the tanks business to Vector's promoters itself. So on a net basis, what is the revenue run rate of this acquired company? What is the EBITDA and net loss?
Revenue expected when we operate the plant fully will be around 700 crore per year.
EBITDA and
700 crore presently they are running at loss, but we believe that with all the overhead expenses they have got, once we are able to sell 65-70% capacity, which we are confident with a network of distributors, which is what we have, we must attain 10% EBITDA for sure.
Mr. Taparia, good afternoon. Thank you for joining in. By when do you see this 65 to 70% capacity happening for this and the resultant profitability? If you could share a timeline, sir.
Normally, we are running already plastic piping business in several locations in the country, and we see that we achieve 65 to 70% capacity utilization every year. This is our past experience, so we are confident.
Okay.
Actually, we were short of capacity, so we were going to put a plant in Madhya Pradesh. Now we have a ready-made plant running in Madhya Pradesh, and we wanted to enter into state of Rajasthan. We got a ready-made plant operating in Rajasthan. So we are quite happy with this acquisition.
Okay. So of the 3 facilities that you've acquired, of this company, there's one in Banmore, one in Hyderabad, and one in Nimrana. How much of it, how many plants are owned by the company, and how many where the land is actually leased?
One plant is owned completely by the company. 2 plants are on lease.
Okay, so then it means that you are just, paying for one plant, and you are getting 700 crore revenue. So I'm just trying to understand, with the kind of money that you've paid, it appears that it may be a lot more than you actually having set up your own plant. Would that be the correct assessment?
About 2 plants are on long-term lease. So that is because as if they borrowed money. They pay annually some 5 crore rupees annual lease rent. So we considered that it may be a value by 60 crore rupees. When we gave the value of $30 million, we counted that this is 60 crore rupees value for the 2 property which are on a rental basis.
Mr. Taparia, what is the net debt on the books of the company that you have acquired, and how much of that is likely to spill over into your book?
The company has got no debt. And we will be having outgo of around 350 crore rupees. Apart from the acquiring the asset, the net working capital and incidental expenses, we will be required to have a cash outflow of 350 crore.
Okay. You know, I also wanted to understand if there is any more than just you acquiring the capacity. Will there be any sort of, you know, brand? Did you acquire the company for the brand that they have, the distribution that they have? Apart from just the manufacturing and the geographies that they are present in, is there any other rationale that you had in acquisition here?
The biggest rationale was that we have got access to their technology, exclusive basis, not only for India but also to export to SAARC countries. There is a huge need of having a better, by this tie-up, we will be able to provide excellent water management requirement of our country. This is going to be quite helpful technology tie-up. They got a plethora of technology in their arsenal, and they have given us access to all the technology for a 7-year period, which is a very great asset for our company going forward.
Okay, and in the MP plant, you also have the ability to expand the capacity. Are you planning to do that as well?
No, in the plant, definitely, as far as we will plan, once we take over the company in our hand from 1st July, we will definitely plan expansion there at Rajasthan and at Madhya Pradesh, both the locations.
Is there any capex that you have zeroed in upon for that, Mr. Taparia, or would you be taking a look at that once the entire acquisition is complete?
That we will discuss and give all detail once we take over the company in our portfolio.
Okay, and you will keep the brands Wavin and Vectis, right? Or will you let them die?
Now, whenever we are going to sell a product under their technology, we are permitted to mark goods manufactured under Wavin technology. Otherwise, whatever product they were making, in 6-month period, we will put Wavin brand, instead of Wavin brand, we'll put Supreme brand.
Okay, and do you have to pay anything for the technology share arrangement apart from the 350 crores that you've paid already?
We have got agreement for 7 years. We'll be paying technology based on the technology what to take from them.
How much?
Based on every year, we will decide based on the technology what we are acquiring from them. As I told earlier, it will be our exclusive basis.
One final question from my side, Mr. Taparia. The last time you spoke to us, you had cut your FY25 volume growth guidance from 14 to 12. Do you maintain that as of now?
I think this is our silent period. So how we operate this year, we will talk in the month of April.
But so far in the quarter, the trends that you've seen, will you be comfortable meeting that guidance, or there could be a chance that you may not meet that? Qualitatively, I'm not asking for absolute numbers. If qualitatively you can tell us how the quarter has been so far.
We believe the polymer price have come down very substantially. We also believe that now they have reached to their bottom level. This will enable the country to have a good growth next year.
And demand, how has demand been in the fourth quarter? Has it been any different from the third quarter?
With a lower price, definitely demand should be better.
So you expect that 12% will be met?
I will talk to you in April.
All right, Mr. Taparia, thank you so much for sparing time and joining us. Wish you good luck for the rest of the year.
Restriction from the company. I can't talk anything in the silent period. Sorry for that.
We understand. We understand
that. Thank you so much for sparing time and joining us today. Thank you so much. The management there of Supreme Industries on the latest acquisition and, of course, and how the demand trends have panned out in this quarter. We take a short break. On the other side, Apurva Seth of Samco Securities joins in with a quick chart check and some strategies as well. Stay tuned. We'll be right back.
बनेगी. My mom was like, एक दिन Olympic champion. not pressure, but I was happy that I actually was going near winning a medal. You know? I was happy, I was excited that I'm actually doing it with my training, with my coach's belief and everything, I'm doing it. Suddenly the game just turns and then she's just picking up everything. The rallies are going really longer and she's everywhere. She's all over the court, not leaving anything. And after 11-3, you won't believe I just got 2 points and she went on winning the match 21-30. After that, you know, I'm sitting there and I'm talking to my coach, what happened? Because every rally was a big rally. I didn't even do silly mistakes to lose the match. What just happened? So I was like, you know, when I thought about it even more, you know, I was like, next day I better start training to get the medal in the next Olympics. So yes, that match tortured me a lot, but I think it gave me that lesson as well that you should not get too excited also sometimes. You know, you have to control yourself. When you are actually going to achieve your goals, you have to control yourself, try to relax yourself. In fact, in that time, you know, when I started doing well, I didn't have a mental trainer or a trainer. Only Sir, Gopi Sir was everything to us. And he being a coach, how much he could have helped in other things as well. So I feel agar wo time pe I had a better mental trainer or someone who could give me advice about it, that you should just think about the next match, just think about the next point. तो उतना मतलब मैं उस मैच पे excited नहीं होती. But I was so happy that that tournament gave me so much of belief. And in India, everyone started to go to know what badminton is. And they were like, Saina is really doing well in badminton. And in 1 year, I was there winning, beating all these Chinese. I won the Indonesia Open. I became world number 2. So in 2010, I won 3 Super Series back to back. And in 2012, I got an Olympic medal. But I think that particular match taught me to be really, really thinking about that even after match point, you have 10 more points to go. Don't just think that the match is finishing, you know, just be there, and presence of mind is required. And I think that first Olympics really gave me that confidence that yes, I'm there and I can beat all these Chinese and Koreans, and I can be in top 10, top 5 for a long period of time. And when I look back, in fact, someone told me that I was in top 10 for almost 11 years. And when I became world number 1, that is when I was like, yes, it's possible. It's possible. In 2015, when I was world number 1, everyone was like, wow, you know, from India, we can do, in badminton, we can do such wonders. And we can also beat Chinese, who are the powerhouses. Korea, Japan, they are the powerhouses. But we are, now you see, badminton in India is grown so much. And we are giving good challenge to all these countries. And we are one of the top in the world now. So, yeah.
Make informed decisions with comprehensive analysis on the go.
Welcome back. The markets continue to slide and the Nifty is down 130 points. It's led by the Nifty IT, even as the banking index is holding mildly in the green. So if you look at all the 3 frontline indices, the IT index is the one which is dragged the overall markets. The Nifty bank is still holding mildly in the green, and that is limiting the losses that we're seeing on the Nifty itself. The broader markets are in poorer shape. So we have the mid cap index down 1.5%, small cap index down almost by 1%, and we have the advanced decline chart telling you that the lines are at the widest distance that they've been from the start of this day itself. However, all is not lost. What we know is that there is supply at higher levels. That's why 22,500 call and 22,400 call writers are active. They believe that around 22,500 to 22,550, there could be some sort of supply that would come by. Those levels are far from where we are right now. But at the lower levels, 22,300 put is fairly active as well. And that's telling you that between 22,250 to 22,300 itself, which was incidentally yesterday's low too, there would be some support that would come by. A lot of long positions added on Kotak Mahindra Bank, and we are seeing a lot of short positions being added on Ramco Cements rather. And we'll keep an eye out on these stocks. With that, let's go across to Apurva Seth of Samco Securities as well, who joins in. Apurva, your thoughts on the markets and individual stocks quickly.
Good afternoon. Thank you for having me on the show. So we have a positive outlook on the markets
for short to medium term. So the prime reasons behind that is that roughly 10% of the stocks are trading of CNX 500 stocks are trading above their 200 DMA. And the last time, in the last bottom, significant bottom which was made was in June 22 with a number of 20%. So we are currently way below this, and during COVID times this number was down to 7.6. Now apart from that, nearly 927 stocks hit a new 52-week low on 3rd of March. Now this is also a big number after the COVID lows, and apart from that, the Nifty P, which is currently trading at 20, we have seen that in the past, whenever Nifty trades in the P bucket of 15 to 20, the average 1 year forward return is roughly 17%. So all these things put together, we believe that over the short to medium term, there is good chance that we might bounce back to levels of 23,000 and then 24,000 in the next 1 or 2 months before we drift lower again. So that is on the view on the Nifty. And on the stocks front, we believe that HDFC Bank and Kotak Bank, these two stocks are likely to show resilience and are likely to head higher if we bounce back. So on HDFC Bank, our short-term target would be 1775 with a stop loss of 1670. The stock is trying to break out above the falling trend line drawn from the all-time highs, and there is also strong call and put writing seen around 1700 level. So that is likely to act as a good support. And on Kotak Bank, it is already trading very close to its all-time highs, just 10% below its all-time highs. So once the stock starts trading about 2000 levels, we will see good rallies coming in the stock as well. So I would recommend to buy 50% now and 50% later once it breaks about 2000. So the stop loss would be 1900 and target would be 2200.
All right, Apurva, thank you so much for sparing time and joining us with your views on the index and on specific stocks as well. Take a short break. Up next, we get you excerpts from the exclusive conversation with IndusInd Bank's MD and CEO, Sumant Katpalia. Stay tuned.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen.
Welcome back. The stock on the radar right now is IndusInd Bank, seeing some recovery after the drubbing that it saw yesterday. Mind you, of course, the stock is in the FNO ban, so no new positions there, still 4% higher. But we spoke to the management yesterday and they told us that although there could be some decline in the net interest income in the fourth quarter, the bank will show a profit. Let's listen in to some excerpts.
We found this anomaly around October, and that is where we started our internal assessment, as well as we hired an external agency. At that point of time, we did not know the difference, and we knew that there were two deals getting accounted incorrectly, but there's so many deals in that, so we did not know the real impact. And I think as soon as we got to know the impact, we held a board meeting and we informed our board and we did the disclosure.
Okay. No, is it, in your analyst call, you said that this practice of differential accounting by the ALM department and the Treasury is about 5 to 7 years. Then how come you got to know of it now? Is it that the amounts were very small in the initial years, but the amount you lost because of premature withdrawal of deposit was higher in 23-24, and so it became a larger number? Is that why you missed it in the earlier years?
No, not at all. I think it is spread over 7 to 8 years, like we said, and it came over a period of time. So there's no 1 year which will show the blip. I think it was evenly spread out over a period of time, as and when you do the premature withdrawal and the early termination of the deals created that impact.
And when did you appoint the external agency?
October 24th.
Okay, but you could have told the investors at that time you wouldn't appoint an external agency unless it was a somewhat sizable problem. You didn't know it was 1,000 crores or more than that.
The external agency was appointed, No, it was not, the number was not known. Lata, let me repeat it again. I think the external agency was appointed because we were not sure, and they were appointed for two specific purposes. Once, to understand the derivative accounting, and second, we are going into the new version of the Treasury backend system, which is collapsed, to understand the processes and restate our processes to make sure that we are in compliance with everything.
Yeah, the general practice with at least the larger banks is to hedge their exposures with an external agency. Why wasn't IndusInd Bank doing this to begin with? And, specifically the September 2023 RBI circular does not deal with hedging per se. So we're still trying to understand, what led to the discovery of this change and the subsequent, despite appointing an external agency, delay in reporting this to exchanges and to investors at large.
No, Ritu, this was not a delay. We took a view that we should not be doing the internal deals and we should only go to the market hedge. And I think that is the call, and the circular clearly states that, and we changed the classification of our derivatives into what will go into hedge and what will go into mark to market. I think that's number one. Number two, in my opinion, there was no delay in reporting to the LODR. I think as soon as we discovered the number, the LODR. So as a process, we found that there may have been some gap, but very difficult to identify the gap. And as soon as we understood the gap, we immediately came into the LODR and reported the number. So if you think that we've hidden something, I don't think the bank has hidden any disclosure at this point of time.
Well, no, Mr. Katpalia, it's the markets that seem to believe there is a question when it comes to the credibility of the bank. And, I could recite several brokerage notes that talk about it, that, trust is very important for a bank. And because of this delayed disclosure, there is a lack of credibility, which is why you're seeing the kind of reaction we saw in the stock market, 20,000 crores of market cap wiped out in a day's trade. What will you say to these investors to allay their concerns that there will be no further shocks as well?
Ritu, I can only say that I think when the microfinance issue came in, it was really not an issue. And we actually, what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU, and you should see the growth that the bank is seeing and the profitability which the bank is used to.
Okay. What is the likely impact on NII and net profit in Q4 itself? Will Q4 be a loss, but not the full year for sure?
The full year will not be a loss at all. And I think the quarter 4 itself also will be a profit. After taking this into account, if we have to. Because I...
Okay. Why do you say if we have to take into... I would assume you have to take it into account in Q4, right?
No, I'm just saying let the amount crystallize, ma'am. I'm still not aware of the full amount. I think it will be this amount. I'm 99.9% sure. I think we will absorb this loss in this quarter itself.
Okay. Can you give us some idea what will be your capital adequacy after you take into account this loss? What is it now and what might it fall to?
Will be above 15%. Will be above 15%. I can tell you we've gotten a relief on the MFI because the MFI we had taken at 125%. Now the MFI will work at 75% for business and for consumption purposes at 100%. So even if we take at 50%, we'll gain about 60 basis points on the MFI. So you take any calculation, we would still be above 15%.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Practice with at least the larger banks is to hedge their exposures with an external agency. Why wasn't IndusInd Bank doing this to begin with? And, specifically the September 2023 RBI circular does not deal with hedging per se. So we're still trying to understand, what led to the discovery of this change and the subsequent, despite appointing an external agency, delay in reporting this to exchanges and to investors at large.
No, Ritu, this was not a delay. We took a view that we should not be doing the internal deals and we should only go to the market hedge. And I think that is the call, and the circular clearly states that, and we changed the classification of our derivatives into what will go into hedge and what will go into mark to market. I think that's number one. Number two, in my opinion, there was no delay in reporting to the LODR. I think as soon as we discovered the number, the LODR. So as a process, we found that there may have been some gap, but very difficult to identify the gap. And as soon as we understood the gap, we immediately came into the LODR and reported the number. So if you think that we've hidden something, I don't think the bank has hidden any disclosure at this point of time.
Well, no, Mr. Katpalia, it's the markets that seem to believe there is a question when it comes to the credibility of the bank. And, I could recite several brokerage notes that talk about it, that, trust is very important for a bank. And because of this delayed disclosure, there is a lack of credibility, which is why you're seeing the kind of reaction we saw in the stock market, 20,000 crores of market cap wiped out in a day's trade. What will you say to these investors to allay their concerns that there will be no further shocks as well?
Ritu, I can only say that I think when the microfinance issue came in, it was really not an issue. And we actually, what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU and you should see the growth.
Welcome back. The Nifty is down about 145 points, but as we speak, the number that we were awaiting at the start of the show itself is the SIP flows, which is coming at around 25,999 crores, just kissing that 26,000 crore mark. So it's the fourth consecutive month where the SIP flows have been stagnant around that 26,000 crores itself. Yes, it is a good number, but it's not growing at the pace at which it was growing 4 months ago. So 25 to 26,000 crores is where the SIP number is stable right now. What will be important is to see the number when it comes to SIP withdrawals as well. Withdrawals have been rising over the last 3 months or so. Inflows at around 26,000 crores. A mild decline month on month, but it has stayed stable around this 26,000 crore mark itself. And this coincides with the markets once again hitting the lows of today's trading session, especially in the broader market, and the mid-cap index down about 821 points. What we'll do is take a short break on that note, come back, focus on all things commodities. Manisha Gupta will join in.
The profitability which the bank is used to.
Welcome back. Joining us on the show now is Nitesh Jain. He's Managing Director at Purple Jewels. Nitesh, hi, thank you for joining in. And it's all about silver right now, because when you look at the last 24 hours, the best of the gains within commodities actually came in for silver. We've seen almost 3% of gains overnight at almost $33 an ounce and 98,500 on the screen in cents of silver. What is it really calculating at in the physical markets if somebody was to step out to buy silver?
Silver presently is doing well, and a lot of investors are all, looking at a great commodity as a investment. The reason being, a lot of it was earlier just domestic usage, but now in the new age, with all usage of it in the silver panel, solar panels and EVs coming into play, a lot of manufacturing happening in India, like Vari being one of the biggest solar panel manufacturers here. So green energy, all that, जहाँ पे silver का usage बहुत ज़्यादा हो गया है. So silver has, so, and if you see that, the ratio what used to be gold to silver is comparatively today at its quite low. It's around 88, 89. The comfort zone would be about 75 to 80. So it is the gold rally is also going to pull silver quite high now.
Oh, absolutely. And you put it on point that there is a lot of industrial demand coming in for silver. Nitish, also, how is silver selling in the physical markets right now? Because what we see on the screen is 98,000, but I'm assuming you will add GST to it and making charges, etc.
So yes, the bank rates are close to about ₹1 lakh. So, in the physical market, the retailer, like a jeweler, would charge 1 lakh, 2,000 rupees per kilo. And over that, the making charges and all that, if at all you're taking articles and if it is jewelry, then the prices are much higher. And but if you see that silver today still, I feel is, quite affordable, and it's a nice price to enter into.
All right. So, Nitish, I can comfortably, safely say that if somebody was to step out and buy silver, it's above ₹1 lakh a kg in the physical markets.
Yeah, definitely. The bank rates are above ₹1 lakh today.
Nitish, also, what are people really buying at these levels? I mean, we do understand that a lot of physical buying is happening. There's a lot of silver. ETF buying finally seems to be picking up in India. How have you seen on-ground buying in silver?
See, as an investment, people have always invested in gold and silver in India. And today, if you look at, as a comparison, see, people are today looking at an opportunity. Basically, the opportunity lies with the fact that gold prices are very high. This rally of gold is going to pull silver a little higher. So definitely, we see at 15 to 20% growth from here in silver prices. And that's why I think, people must be interested in buying silver. And they are buying actually in form of physical. We are seeing a lot of investors buying a lot of silver these days. Apart from the industrial usage, there's also a lot of investor buying happening there.
Nitish, a lot of gold jewelry guys tell us that the gold jewelry buying is down by 30 to 50% given the high and volatile prices. Are you looking like that when you look at silver as a segment, or no, there hasn't been much impact?
No, see, people are not buying gold because they are buying silver, I feel.
Okay. And how much of silver imports have you seen? Because last year was good and 2023 actually was a record number. How are we looking at this?
This year it's a bigger record. This year actually the silver imports have almost doubled. Not exactly doubled, but almost doubled. Okay. And again, the industrial usage is one of the major factors for it. And because a lot of make in India is happening and all that. So, in EVs, in EV batteries, and silver being a component, which is good at conductivity, much better than copper. So the usage today, towards energy, silver is being used quite a lot.
So any sense of numbers on what have we seen for imports in the month of January or for this financial year until now?
January, February has been close to about 1,800 plus tons.
Okay.
So that's a huge number.
It is. And, this being a March ending as a month, has the buying slowed down a bit? Have you seen that creep in?
Domestically, yes. A little bit about, I would say, in silver, definitely the sales has in the retail end has come down by almost 20-25%. But we have a good season ahead. We have Akshaya Tritiya coming up, and post that a lot of marriage season is there. So domestically, definitely we are seeing a lot of silver is going to be purchased.
All right, a lot of silver is going to be purchased. Up until now, Manisha was telling us that gold is only getting expensive, and now it appears that silver prices are rising, and now the demand for silver will take those prices higher as well. Manisha, what does one buy?
₹1 lakh a kg. I've been telling you that.
I'll just drink my glass of water and wrap up on this edition of Halftime Report while you take your business lunch and the market action forward with the next show.
There was a cyber attack on X today, which shut it down and may have been foreign sourced.
Yes.
It's a big story. You want to give us a moment on that?
Well, we're not sure exactly what happened, but there was a massive cyber attack to try to bring down the X system with IP addresses originating in the Ukraine area.
Markets give up morning gains to trade near the day's low. Nifty and Sensex trade with 0.5% cut. Mid-cap drags while financials eke out some gains. Starlink seems to set for an India entry with SpaceX tying with the Geo platforms and Airtel to offer its broadband services via their distribution network subject to regulatory approvals. Analysts see little impact on existing services, expect Starlink to be used by customers in low and no network areas. IndusInd Bank CEO Sumant Katpalia says the accounting lapse is a one-off event while defending the timing of disclosure. He promises the bank will post a profit in Q4, though interest income can take a hit. Trump blows hot and cold on tariffs with Canada, rolling back duties on metal imports after doubling them. He also says that the stock market will do great, but he must press ahead on tariffs. Hello, good afternoon. You've tuned into Business Lunch, coming live from CNBC-TV18 Motilal Oswal Studios. I'm Vinny Motiwala, and thank you so much for tuning in to CNBC-TV18. Quick look at what the market is doing. Day's lowest point is what the Nifty is trading at, almost near that level. 22,359 is what we're looking at in terms of the level. 0.6% of decline is what we're seeing coming in for the Nifty. Sensex 2 is down almost 0.5 to 0.6% in trade. Bank Nifty, that's holding on to some bit of a gain. So banks and financials are some of those positive signs that are coming in is only from Nifty Bank and financial side. So yes, that's the only green on the screen today. What we're seeing in top sectoral losers today, Nifty IT, that's down and out in trade. And obviously what is seeing a sharper fall in Nifty IT also is coming in from TCS, HCL Tech. All these are seeing a sharp fall. Also look at Infosys. That's also a bit down and out in today's trading session. We have Nifty Realty, that's also under pressure today. So yes, that's what we're keeping an eye out on in terms of top sectoral losers coming in on the trade. Now, other than that, when you're looking at it, which are the stocks that have fallen from those intraday high levels, the sharp fall that they've seen? Let's pull up Firstsource. That's down almost 6% from the day's highest point, more than 6% from the day's highest point. So Firstsource is that one. Then we have Ramco Cement. That is also under pressure today, and Ramco Cement is down almost 7 to 8% from the day's highest point. So keep an eye out on Ramco Cement. Indegene, Century Textile, all these are some of these stocks that have fallen from the day's highest point and seeing a sharper decline coming in today's trading session. So yes, that's how the market setup is looking like. Let's also pull up the mid and small cap and what that is doing versus the benchmark indices, because these names are coming in from the broader market front, right? So Nifty mid cap is down as of now, you can see 1.5%. So underperformance coming in from Nifty mid cap as well as the small cap front as well. So yes, that's what we're watching out for in today's trading session. A bit of a red. Next half of the session will be important to watch out for.
But let's move on. An IndusInd Bank recovers some ground from yesterday's sharp fall that we saw with some gains today. And this as the management exclusively tells CNBC-TV18 that although there could be some decline in net interest income in Q4, the bank will show a profit in the fourth quarter. Listen in to what the management commentary is coming in.
During a review of the processes in connection with the compliance to the RBI circular on investments portfolios, we found that there were some gaps which were coming out, and that was really the start of the issue. We found this anomaly around October, and that is where we started our internal assessment as well as we hired an external agency. At that point of time, we did not know the difference, and we knew that there were two deals getting accounted incorrectly, but there's so many deals in that, so we did not know the real impact. And I think as soon as we got to know the impact, we held a board meeting and we informed our board and we did the disclosure. You know what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU and you should see the growth that the bank is seeing and the profitability which the bank is used to. The full year will not be a loss at all. And I think the quarter 4 itself also will be a profit.
Also, we spoke to Kunal Shah, Director of India Bank and Finance at Citi for their perspective on the ongoing IndusInd saga. Listen into what he had to say.
People are looking forward to how the earnings are going to pan out over next 1 or 2 quarters. And the other aspect is in terms of the succession plan. So now post Mr. Katpalia, who takes up, who's coming over, I think that's going to be the key monitorable as we move forward over next couple of quarters. Valuations, again, when we look at it, it's closer to like 0.6 times multiple. And that's where, so maybe near term, definitely we could see some kind of an uncertainty being there in the stock. But valuations, when you look at it, that has also come off and it's factoring in those kind of a risk currently, yeah.
Okay, and let's focus on the top story for today. Now, Jio Platforms and Bharti Airtel have announced tie-ups with Elon Musk's SpaceX, under which they will offer Starlink satellite broadband services to its subscribers. But will Starlink become mainstream in India? Rima is joining in with us to explain us all of this. Rima.
Thanks so much for that. It looks like the stars are all aligned. Bharti and Reliance Jio have announced a tie-up with SpaceX, under which it would offer Starlink satellite broadband services to its subscribers. Now, the biggest advantage of this is servicing the underserved. Now, the partnership can help expand connectivity to underserved regions where traditional networks find it hard to reach. The second important thing is that there is a revenue opportunity for both Bharti and Reliance Jio, because erstwhile, and if you remember, they were initially seen as competitors, but now they would be collaborators. For instance, Bharti and Reliance Jio can sell Starlink solutions through their retail and online platforms. So if you remember earlier, the fear was that will it disrupt the existing services of Airtel and Jio? Will it be a threat to terrestrial services? That, according to analysts, seems unfounded. In fact, most of the ones we spoke to said that this would be seen as a complementary satellite broadband services to the existing services. Now, the question is, as you said, will it become mainstream in India in the medium term, as Starlink has been globally? Now, here the answer, and it all depends on affordability, because Starlink is a premium service. We were chatting with the IFL analyst, and he said Starlink pricing in the US is $80 per month. Even in a developing economy like Kenya, where it's subsidized to some extent, it's priced at 10 GB. It's priced at $10, and you still get only 50 GB of data, which is still very expensive compared to a market like India, which is very sensitive. So in India, your average mobile ARPU is just about 3 dollars. Your broadband ARPU would be $5 to $10, and that also you would get unlimited data. So in that context, Starlink is seen expensive, and therefore it's unlikely that the consumers would be using these services. It would be enterprises. In fact, Bharti release, the Bharti Airtel release also speaks of the opportunity from businesses to connect communities, schools, health centers, many others in the rural India. Also bear in mind that it's not that the launch is going to happen immediately. Starlink still needs government approvals. Spectrum allocation is still pending in India. So in the near term, it's unlikely to move the needle too much.
Rima, thank you so much for that. In the near term, not likely to move the needle too much. But like Rima was mentioning as well, Starlink's launch is not anytime soon and not an immediate event, and it still has to get the necessary approvals. Let's go across to Ashmit to understand what he is picking up from his sources in the ministry. Ashmit?
Well, just as Rima was pointing out, it's important to point out that both Jio as well as Airtel have been careful to flag that Starlink will be required to source the necessary approvals. And when we speak of approvals, there are three key aspects to watch for. Number one is that the DOT will, of course, have to grant the license. We've spoken to senior officials within the ministry, previously to the telecom minister as well. What they've clarified time and time again is that there are security concerns that need to be satisfied, that the government is open to the idea of licensing Starlink to come here to India. No concerns there, but there are some security issues which need to be ironed out. Those issues are yet to be ironed out. Once they are cleared, Starlink will be a go as far as a license from the DOT is concerned. But that's just one part of the story. The other part is the space regulator. They will also need to get, Starlink will also need to get authorization from the space regulator. In space, there again, there are a few concerns that have been flagged by the space regulator in terms of the monitoring mechanisms, in terms of the areas that will be covered. Those are aspects that we believe there are advanced talks in between the two sides, Starlink as well as the space regulator, and that is the second piece of authorization that Starlink will require. But once the authorizations are through, there's still another key component, and which is the TRAI, which is the question of spectrum. Now, DOT, ever since the Telecom Act came in 2024, has been consistent. The government has been consistent that there can only be allocation of spectrum for satellite use. The government's position is, look, it's shared spectrum, and therefore it can only be allocated, but at and from the government to the telecom regulator, the TRAI. The TRAI is in the midst of extensive deliberations. It's invited consultations and feedback from various stakeholders, and will give the final word. Will give clarity on what the pricing mechanism may look like as far as satellite spectrum is concerned, which again will be critical for Starlink in India with respect to its Indian operation if it's looking to make any meaningful headways and meaningful penetration of the Indian market. Back to you.
Okay, Ashmit, thank you so much for that. So that's all the update that we have coming in on Starlink this afternoon. But let's move on. Key macro data is going to be in focus for the day, and we have Feb CPI that is going to be due later today at 4 p.m. along with January's industrial output data. CNBC TV18's poll is seeing that Feb CPI is expected at below 4%. Lata is going to join in with us to give us more details on this one. Afternoon, Lata.
Well, the CPI number is going to be important simply because the market is watching whether the Reserve Bank will give another cut and how many cuts. Now, the poll says that it is 3.85, and which means it is under 4% for the first time since August. Now, August had a base effect. So this becomes prominent because the CPI is coming down primarily because of food inflation. Food CPI is seen coming down to 4.1%. Now, this is historic. In January, it was 6.02 to be precise, which again was a very big fall because for the previous 18 months, food inflation has between 8 and 11%. So January, we had a substantial fall and we had a rate cut in February. Now we are going to see a substantial fall probably to 4.1 because those key three items, TOP, tomatoes, onions and potatoes, have been under control, and therefore we are going to see a good food inflation number. These are the two numbers that will be closely watched. The headline inflation, 3.85, and the food inflation, 4.1. Core inflation, of course, will be important, but it has been sub 4 for a very long time, expected to be 3.9 in our poll, a little higher because of the base effect. Otherwise, in any case, under 4 will be seen as very positive. the core inflation expected to come at 3.8. The other number is, of course, the January IIP industrial output number. It's a lagged number, January, we are about 45 days after that month. But that number is seen rather mediocre at about 3.4%. And it's been low for some time now. The full year GDP figures itself indicate that industrial growth is only 4.3%. Now, if you take the April or December IIP number, you still get only 4%. So this is going to be a bad number, and the market is aware of it.
Okay, Lata, thank you so much for that. Surely an important data point we'll be keeping an eye out on today. 4 p.m. is when it will be released. But on that note, let's just actually sip into a very short break, viewers. Don't go anywhere. We'll be back with more news and updates after the break.
To various Tesla charging stations near Boston. Shots were fired at a Tesla dealership in Oregon. Various nonviolent...
Shots fired, not a metaphor.
Shots fired, yes. Downtown New York, marching against the Tesla showroom. Your stock is way down. You've been criticized left and right.
But look on the bright side.
I mean, why are you doing this?
Always look on the bright side of life.
Yes. And you're on it.
Yeah. I mean, just like I said, the goal here is let's not have America go bankrupt with waste and fraud. So that's what I'm here for.
Welcome back. Thanks for staying tuned into CNBC TV18. Now let's move on a high-powered commentary of the Indian Air Force headed by Defence Secretary R.K. Singh has identified key areas for the modernization of the Air Force. Now speaking to CNBC TV18, the Defence Secretary said that the ministry is looking at all options to scale up the depleting squadron strength of the Indian Air Force. He added that while the Air Force would get 12 Tejas aircrafts this year, other options are also being looked at to meet the operational requirement. Listen in.
I think it's not a secret that their force, their squadron strengths has been depleting, and we need to do something about that. So one part is already out and clear, which is that the Tejas production line is hopefully will stabilize now that the engine issues have largely been sorted out. Of course, we will look at other options also to ensure that any capability gaps are offset or neutralized in the shortest time frame possible. We need to move beyond it to competitive bidding. That applies not only to the Air Force, but to other procurements in the defense sector. That process will, to the extent possible, wherever private capacities are available, and there are good capacities in areas like land systems, artillery, certain types of munitions and small arms. All of these areas, we would expect that the processes should, even shipbuilding to some extent, we should try to follow competitive procedures to ensure proper price discovery and more economical use of public money.
Okay, on that note, we're going to step into a very short break. When we return, we get you all the latest updates on US President Donald Trump's tariff announcements.
Now, if you look at the foreign portfolio position in India, they are the most underweight they have been on Indian equities ever.
Yeah.
And most importantly, India is now a low beta market, unlike the past.
Yeah.
So, if you go back 10-15 years, India used to be a market which had a beta of more than 1. And for your listeners, that means that India used to go up or down a lot more than the world. Now, if the world is in a trickier position than it has been for many years, the likelihood is that India will outperform.
Welcome back to Business Lunch on CNBC TV18. Now let's move on and let's get you the latest on the tariff war. After hours of a back and forth of a tariff imposition between US and Canada, both the countries have decided to pull back on their initial calls. Ontario Premier Doug Ford has called off the 25% surge on electricity going into US. President Donald Trump also pulled back the 50% retaliatory tariff imposed on Canadian aluminium and steel. Now, Ace Investor and Bridgewater Associates founder Ray Dalio comments on the effect of tariffs on global trade on the back of the recent spat between the two countries. Listen in.
It's just an extension of the patterns of history. So if it, like, for example, if you looked at European countries in the 30s, like Germany in the 30s, and take an economic policy, there was write down the debts, create tariff revenue, because you can get a lot of money from tariff revenue, and then build up your domestic, be nationalistic, be protectionistic, be militaristic. That is the way these things operate. So I would say, again, lessons from the past of what that looks like. And the issue is really the confrontation of all of this, the fighting of all of this. So tariffs are going to cause fighting between countries. But think about US, Canada, Mexico, China, and all of those types of fighting. There will be fighting.
Now let's bring you a significant development from the Russia-Ukraine war. Now, Ukraine has reportedly accepted a 30-day ceasefire deal brokered by the United States. Days after the ugly spat between Ukraine President Volodymyr Zelensky and US President Donald Trump. Watch this next report for more.
Ukraine on Tuesday agreed to accept a U.S. proposal for an immediate 30-day ceasefire in the conflict with Russia. U.S. Secretary of State Marco Rubio announced the agreement after more than 8 hours of talks between Ukrainian and U.S. officials in Jeddah, Saudi Arabia.
Today, we made an offer that the Ukrainians have accepted, which is to enter into a ceasefire and into immediate negotiations to end this conflict in a way that's enduring and sustainable and accounts for their interests, their security, their ability to prosper as a nation.
Rubio said he would now take the offer to Moscow.
And we hope that they'll say yes to peace. The ball is now in their court.
The development comes after a stunning Oval Office shouting match between the presidents of the two countries.
You're gambling with World War III.
The rift had immediate repercussions for Ukraine. President Donald Trump canceled military support and ended crucial intelligence sharing. But as part of accepting the proposed ceasefire, National Security Advisor Mike Waltz said Washington will resume sharing aid and intelligence with Kyiv.
And that's effective immediately.
Outside the White House, Trump said there would be a U.S. meeting with Russia to discuss the ceasefire plan soon.
Hopefully President Putin will agree to that also, and we can get this show on the road. I think it's a big difference between the last visit you saw at the Oval Office and this. So that's a total ceasefire. Ukraine has agreed to it, and hopefully Russia will agree to it. We're going to meet with them later on today and tomorrow, and hopefully we'll be able to wipe out a deal. If we can't, we just keep going on, and people are going to get killed, lots of people.
Is Zelensky invited back to the White House?
Sure, absolutely.
Later, Russia's foreign ministry said it didn't rule out contacts with U.S. representatives over the next several days, according to state news agency RIA. Ukrainian President Volodymyr Zelensky, who was in Saudi Arabia but did not participate in the talks, said the ceasefire was a positive proposal.
Вважаємо це позитивним.
He also said the two countries would work to finalize a minerals agreement.
Okay, but a quick look at the market because we've seen it recovered from the day's lowest point and a significant recovery in the last half an hour. Now it's about 22,400 levels. So when it started, it was below that. It was somewhere around 22,330, 350 levels. So keep an eye out on that, and especially some of the stocks that have recovered significantly. Keynes Technology from the day's lowest point. We've seen, Piramal Pharma. That's the one also we should keep an eye out on. Some bit of a recovery is coming here. NLC India up 4% from the day's lowest point. So that's interesting to watch out for, as well as GSPL among some of the names, and BSC also seeing some good recovery. So yes, we're seeing some recovery coming in the last few minutes of the trading session right now. But with that, we're absolutely out of time on this edition of Business Lunch. Thank you so much for tuning in. Up next, your Midcap Radar.
India is like consumer staple stocks. It will outperform a bear market in the world. In February, a policy pivot which I will say is one of the biggest in my career, going back 35 years. The RBI has put a three-pronged correction: cutting interest rates, committing itself to liquidity, and also starting to lift the regulatory burden on the banking sector. The RBI policy is sweet. The market has just ignored this, what I call as policy pivot. India's policy environment today is far more certain than the rest of the world put together, whether it's US, Europe or China. So you want to buy this policy certainty, and I think investors will buy it. Our retail investors get it. And I suspect that February may have been record inflows, and a lot of people have been quizzing me about when will retail give up, and I've got tired of saying this, they won't.
Do you worry today, Sabya, that we are at a point which is almost an existential crisis for a whole host of arts and artisans across this country? I mean, you were talking about the fact that this shouldn't be treated like a charity. It shouldn't be treated like a CSR project. What kind of interventions do you believe we need at this point in time to ensure that we keep this soft power alive?
You know, we don't need to do much because evolution will take care of itself. Because I'll tell you, so we were at the age of influence, which is moving into the age of intelligence. AI is going to come in. And I personally think that AI in many sectors, especially in performing arts and art, will be very short-lived, because after the age of intelligence will come the age of wisdom. And when the age of wisdom comes in and people realize that the greatest gift to humanity is humans themselves, and we should not robotize our existence so much that we forget to be human beings, then people will realize that art and craft is going to be the most important expression of humanity. We don't have to do much. Evolution will take care of itself.
We certainly hope so. Speaking of the dynamics changing, and you were talking about the consumer and the consumer being your biggest influencers, so to speak. You know, the Sabya bride, you kind of turned that on its head, right? I mean, the Indian brides were always coy, demure, shy. There was almost this invisibilization, and you kind of turned that around completely. How did that happen? I mean, was this because of the influence of the strong women in your life? You know, what was it that you were trying to tell by way of attempting to sort of turn this on its head?
See, I don't really understand gender inequality because in my head it doesn't exist. You know, I've been raised by, you know,
We're heading into the business end of the trading session, and it's time for Midcap Radar on CNBC-TV18. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. With me, as always, is Vivek Iyer. Vivek, good afternoon. Some bit of recovery seen in the last few minutes of the trading session, but there are plenty of stocks that are bleeding in today's set.
Absolutely right, Hormuz. Good afternoon. The good part is there's been quite a bit of a sharp recovery, especially as far as the last half hour of the trading session is concerned. And some NBFCs, some autos, they are the ones that are actually seeing a certain amount of recovery. But we have quite a lot lined up on the show. Let's start off with the top headlines. Markets give up morning gains to trade near the day's low. There's been a bit of a recovery in the last half hour. Nifty Sensex trade with 0.5% cut. Midcap drag while financial eke out gains.
Brokerage firm Motilal Oswal says that its view on the IT sector has turned cautious in the month of March. Now, all constituents of the Nifty IT index are trading with cuts, and the index has now entered bear market territory. L&T Tech, Persistent, LTI Mindtree, Coforge, all of them are down over 3%.
Ramco Cement and Dalmia Bharat under pressure after Tamil Nadu government imposes rupees 160 rupees per ton royalty on mined limestone. The move is expected to set a precedent for other states.
PB Fintech is under pressure today after its board approved an investment of up to 700 crore rupees in its wholly owned subsidiary, PB Healthcare.
Zydus Life under pressure after it announces an acquisition of Amplitude Surgical, which manufactures knee and hip prostheses. UBS has a sell call on the stock, says the acquisition looks expensive and is likely to be EPS dilutive for the first few years.
Almost 100 points off the lows of the session is the Nifty, heading back towards that 22,450 mark that the bulls have been trying to defend with all their might over the last 3 to 4 trading sessions. So it's some bit of recovery seen on the benchmark indices, at least for the bulls. IT is not lending any support whatsoever. The support though is coming from banks, and it is the two large banks, be it HDFC Bank, Kotak Bank, and of course Bajaj Finance, contributing to some of the recovery, as is ITC. But the broader markets though are continuing to remain in the red, and the mid-cap index, although recovering from the lows, is still down almost 1%, as is the case with the small-cap index. The small-cap index has been the bigger underperformer in comparison to the two, is down almost 0.3%, also recovering from the lows of the day. But Vamakshi is joining in now to tell us all the movers in the broader markets. Vamakshi, good afternoon.
Good afternoon, Hormaz. The mid-cap index is definitely under a fair bit of pain as of now. And let's look at some of the stocks that are actually contributing to this kind of moves that we're seeing. Indegene is one such counter. That stock is down nearly 9%. Ramco Cements too, down and out in trade today, down nearly 5%. First Source as well as Godavari Power and Ispat are some other counters that are declining in trade today. We also have a whole host of telecom stocks that are down in trade. Bharti Hexacom is one such name, down nearly 5.8%. Vodafone Idea, Indus Towers are both down over 4%, and HFCL too seeing a cut of 1.5%. Apart from that, IT stocks are taking a very sharp knock in trade today. It is in fact one of the top sectoral losers today. L&T Tech Services, that stock is down nearly 5.4%. Emphasis, Cyient, Oracle Financial all taking a knock in today's trading session, down over 3%. On the flip side, let's look at the stocks that are gaining momentum in trade today. That list includes NLC India, trading close to the day's highest point, up nearly 4.7%. We also have BSE. Keep in mind, BSE has been under significant pressure over the last couple of trading sessions and is finally recovering today, up nearly 5%. But Rampur Chini and GSPL are some other counters that are gaining in an otherwise weak market.
Thank you so much, Vamakshi, for joining us and outlining the stocks that are doing quite well in the session today. Well, moving on, Anupam Rasayan is the first management on the show today. The company recently signed a 10-year letter of intent worth 922 crore rupees with a Korean MNC. They also signed a deal with Elementium Materials to supply advanced solvents for EV batteries. To discuss this, we have Vishal Thakkar, Deputy CFO of Anupam Rasayan, with us. Thank you so much, Vishal, for joining us. We, a lot of news flow that's come in as far as Anupam Rasayan is concerned over the last week or so. We also understand you held a plant visit for the sell-side analyst community, so it's very good to have you on the show. First up, outline the details of the LOI with us. Are you able to disclose the name of the MNC with whom you've done this particular deal, and how will revenue recognition be done over the 10-year period?
Hi, thank you and good afternoon. Thank you for having me on your channel. Yes, I think the recent quarter has been a more buoyant quarter for us, especially in terms of order intake as well as the ramp up that we are seeing in terms of revenue. Let's now talk about the contract, the LOI that we signed recently. This is again a specialty chemical, more on the polymer side, which is going to go into the applications which are more niche in terms of defense and aerospace segment. This is again with a Korean company. Unfortunately, under the CDA, I would not be able to share the name, but it's a good thing is that it's a diversification in terms of geography also. It is coming from a Korean multinational, which is a very large player in this industry. And this, we will have a 10-year contract here. So every year we will start to have around about an average of 92 crores of revenue from there. It will take, it should start getting commercialized in FY26 and it will ramp up from here on. So all in all, good one on this. On the aluminum side, again, this is a new age battery chemical, especially as an electrolyte, which goes into improving the efficiency and the energy density of the product for the battery, especially in the EV space. So this is a very strong recognition coming from our customers in terms of our ability to give a very high quality new age molecule. So again, that's a very interesting one, and there we see that the validation, the commercialization will happen now, and then the validations will take place, especially of my customers' products as well, and then we will see the ramp up from then on. It's a large volume. It should give us a good traction in the future.
Vishal, good afternoon. Sorry to cut you in, but you'd mentioned you'd start supplying by FY26. If you could be more specific on which quarter do you start doing that, and what does that do to your top line margins in the immediate term? If you could share some numbers on that.
So see, I would rather see, I would give you a broad context of how I'm seeing the quarter 4 and then the quarter FY26 as well. We believe that the quarter 4 should look more robust than the Q3. So I should have a QOQ and YOY decent growth in terms of Q4. FY26, we see that we should be having a good growth coming from there for 26, and our growth journey should be now back on track from what we had seen in the 5 years before the last 2 years, which were the dip. And largely, I would see that would come in from 3 broad categories. One, agrochem cycle coming back and the volumes coming back, and that's what we've been seeing in Q4, and we see that will continue over the FY26. Also, if you see the pharma is really picking up for us, that would again give me the growth. And polymer, as I was saying, is going to give us additional growth. And to my mind, these 3 drivers would ensure that for the near term, we should have a strong growth during 26-27 period. And LOIs would be one of the strong contributors to that. Today, it has been contributing around about 20-25% of my revenue. Around 20% of my revenue. And I think this should continue to give me a higher contribution as we go forward.
Right. Vishal, the other thing that analysts have pointed out is the total value of a lot of the LOIs that you have signed are now almost in excess of 10,000 crore, right? Please correct us if it's wrong. So, FY26, you've indicated that revenue visibility is quite strong, and the LOIs that you've signed since 2022, we want to understand what portion of those LOIs you have already started recognizing revenue in. The other thing is, for some of the newer LOIs that have come in, what are the EBITDA margins that you will be operating at, and what will be the working capital cycle that you will also be working at? Eventually, what will be the ROCE that one can enjoy on these products?
Lovely. So let me first talk about the revenue recognition, then I'll talk about the margin, and then I'll talk about the working capital, and then also about my capital employed.
Right.
So let's talk about the revenue. So the LOIs that I signed in FY 2022. So typically, if you look at any of my process, you should look at an LOI process of 2 + 2 + 2. So what do I mean by that? It takes me around 2 years to get from a R&D to an LOI kind of LOI stage. It takes me around about 2 years, give or take 6 months, depending upon the plant availability and the validation. Typically, it takes me 2 years to get to the commercialization, and then another 2 to 3 years to ramp up to the potential that it would typically have. So when I have signed an LOI, which means that I've taken care of the first 2 years. The next 2 years is where we are sitting with the customer and saying where would the larger volumes be coming from, where would the plants be established, and all that stuff will come into play. And that is where, if you see the FY 2022 LOIs, we have commercialized all of them. And FY 23, we should be the one that we have signed in FY 23 and 24 onwards, we should be commercializing in FY 2026. So next year, we should have commercialized most of the LOIs that we would have signed. Now, as I was saying, so let's say in 2022, I had signed an LOI worth of 2,600 crores. So if I divide it by 5, I am around about 475, 500 crores of revenue, of which 200 plus revenue has been recognized in this year itself. Now, as we go next year, we should be able to recognize at least double of this, if not more of this. So that's what I'm trying to say. Now, further, if you look at when I say 10,000 crores of LOI, typically you should say that 10,000 divided by 6 or 7 years as an average period. So around about 16 to 1700 crores of revenue should be added on the base revenue that I would have had. So that's what I'm saying, that in next two years time, I should have commercialized most of them or all of them. And then it will be a couple of years to get to the full potential of that.
All right,
Now
Vishal. Right. If you could quickly summarize this, we are running out of time. So if you could quickly summarize what you meant.
Yeah, on the margin side, see, we are a CSM player, so margins will try and keep it in the band of 26 to 28% typically. Yes, there will be some bit of a buoyancy because of the economies of scale. To working capital, you would see that there will be a far more improved working capital as we go, and even these contracts will have a fairly bit of a more tighter working capital requirement. So that should be adding to us in terms of our working capital efficiency. And the last one on the capital allocation side, all my plants are now fully deployed. So in terms of capex has been completed, and whatever small validation and other stuff are there, which should be completed in next quarter or two. In terms of capex implementation, and then whatever is the time for validation ramp up will come in. So I don't need any more capex. Working capital, it will be more efficient, and hence I think you would see a strong ROC coming from here.
Right, Vishal. Thank you so much for sparing time and joining us. Wish you good luck for the road ahead. The management there of Anupam Rasayan. Take a short break. On the other side, the management of Ola Electric joins in as the company completes the implementation of its network transformation and OPEX reduction. So you won't want to miss that conversation. Stay tuned. We'll be right back.
We just don't know how the tariffs are going to be imposed on different countries, whether this is going to be sector specific or it is going to go down to the product specific levels. So what we have done is we have done a very simplistic analysis of equalizing the weighted average tariff rates of both the countries. US will probably have to then increase tariff by about 8 percentage points. And given some elasticity estimates that we have, we think that's worth about $7-8 billion of impact on India's export, everything else constant. That's about 0.2% of GDP. However, we are very much conscious that this will not be as simple as it looks like. This game could be played from India's perspective by cutting down import duties also on some of the items. We have used a very operative phrase that at least 50 basis point of rate cuts. Our City House view on Fed rate cut is 5 rate cuts this year. So we have taken that into consideration as well. However, I must say that at this moment, the RBI, the way they are positioning itself on the growth and inflation dynamics, it looks like there is scope for rate cuts in India regardless of what happens in US. India's capital flows are less interest rate sensitive than growth sensitive. So if we can get our GDP growth numbers up, we will start seeing the capital flows come back, and that will stabilize the BOP, that will stabilize the currency. We need not worry as much on the rate differential with US at this point of time, given where our macros are.
Welcome back, and shifting focus now to Ola Electric. The company says that it has completed the implementation of its network transformation and OPEX reduction program and delivered the cost reduction of 90 crore rupees per month. To discuss this and more, we are being joined by Harish Abichandani, who is the CFO of Ola Electric. Harish, good afternoon. Thank you for joining in. Firstly, congratulations on completing this implementation. And if you could elaborate more on this, that how much would this reflect on your bottom line as well? Would you have given a guidance that your automotive business will be EBITDA positive in the first quarter of FY26? Tell us more on that.
Yeah, Shona, thanks for having me on the show. I think our path to profitability journey began, since quite some time. We have spoken about it in our Q2 and Q3 numbers, and a lot of work can happen in the back. As you see our today's disclosures, a significant rationalization of cost, efficient across multiple processes, whether it is on the front end, whether it is on the operations, etc. All this culminated into a significant cost saving on a structural basis and a steady state basis. This will be reflected in our Q1 numbers, as already mentioned today. So we see the impact coming in quarter one of FY26.
Okay. The other question which we want to ask you, Harish, is that in this press release, you've also indicated that by Q1 FY26, we can see EBITDA break even in this particular segment. We recall that last time you had joined us, you told us that you would reach EBITDA break even once you hit the landmark of 50,000 monthly deliveries. So can we expect that by Q1 you will be hitting this particular number, or will the EBITDA break even be achieved by other means?
Yeah, see, we had discussed this 50,000 number of turnover while we were discussing our Q3 numbers. And that was based on a certain cost structure prevailing then. We always had a path to path profitability, and since then we have actually done significantly more on the cost than even envisaged and planned. So we've done a lot more on the cost side, and I think the goalposts accordingly could shift positively towards profitability much earlier.
Harish, you've also mentioned that your new initiatives have resulted in reducing your average vehicle inventory to 20 from 35. Do you see that number trending down further? And how has demand looked like in this month? For the month, we're almost halfway through March. How has demand looked like on ground?
2 points to raise in terms of how the delivery schedule with the customers. Ideally, one would like to deliver to the customer the scooter in 24 hours. That's the customer's absolutely platinum standard. Now, there are certain processes, there are certain requirements from a local regulation perspective. We have significantly transformed our network design. We have almost eliminated a layer in the network design of the distribution centers, moving inventory much closer to the customer through our stores itself. So hence, this has resulted in this significant reduction in delivery time. This will continue to significantly drop given as the network matures and this process continues to grow. So we see this further coming down from 12 days. And personally speaking, I would want to deliver a customer the scooter the same day. That should be the target. But yeah, this continues to go down. On your question on demand, I mean, you see our Jan and Feb numbers. We have maintained our market share leadership over Jan and Feb. Feb, we are at 28% market share on sales, and March trend is almost similar and if not better as we go into the last 2 weeks of March, given that the subsidies are expected to drop effective April 1. So we see continued customer interest and engagement on our products, significantly momentum going into the last 2 weeks of March.
To deliver a scooter on the same day, Harish, would you want to partner with a quick commerce platform to do that?
Why not? And we have a Ola consumer business which can do it for us.
Absolutely. Harish, the other question which we want to ask, and something that's discussed quite a lot, is the issue of market share. Where does market share stand currently? And aspirationally, FY26, as well as realistically rather, FY26, FY27, how do you see market share trends move?
See, I think the market share is an outcome of multiple things. And one is, of course, the product portfolio. Our motorcycles are coming. We have spoken about it. We have showcased it. It's on the road. We can test drive it. So the motorcycles are out there. They'll start deliveries will begin end of this month or very early April. So we are on track to significantly expand our product portfolio. And market share is an outcome of continued expansion of distribution and our products on ground. We have reported market share of 28% for February. We continue to see strong momentum going into March also. And with newer products, this will only get better going into the new financial year.
Based on all of this, how do you expect sales to pan out in FY26? Harish, have you set a target for that?
I can't disclose my sales targets for FY26, but yes, as we mentioned, path to profitability is something we will deliver by Q1 of FY26.
Thank you so much, Harish, for joining us. We wish you all the best as you head into FY26. Thanks once again for joining us. Let's now slip into a short break. We'll get him on the markets and stock-specific action on the other side. Stay tuned.
President Trump. Are you looking to buy or lease today?
Well, I'm going to buy, and I'm going to buy because, number one, it's a great product, as good as it gets, and number two, because this man has devoted his energy and his life to doing this. So I think he's been treated very unfairly by a very small group of people. And I just want people to know that you can't be penalized for being a patriot, and he's a great patriot. And he's also done an incredible job with Tesla. And I mean, nobody else has a car company started up in the last 30 years that's been successful. I don't think so. And not only successful, but super successful. And because he's able to find billions and billions and billions of dollars of fraud and waste and all of the things, I mean, our country is going to be very strong very soon because of a lot of the things that he's done and a lot of the things that I'm doing. And there's no better team, but there's no better for what we're doing. There's nobody like this, and he shouldn't be penalized. Now here's the bad news. I'm not allowed to drive because I haven't driven a car in a long time, and I love to drive cars. But I'm going to have it at the White House, and I'm going to let my staff use it. I'm going to let people at the place use it, and they all are all excited about that. I'm not allowed to use it. Can you believe it?
Welcome back to Midcap Radar. Well, as you can see on the screen, the Midcap Index continues to slump and it's down a little over 1%. In the last half hour, what's actually seen some selling pressure emerge is the entire FMCG pack. So names like Colgate-Palmolive, Hindustan Unilever, Nestle India and Titan. These are four stocks, especially from the FMCG pack today. All of them have witnessed selling pressure, and this selling pressure has actually intensified in the last half hour or so. The other stocks continue to see selling pressure, include the entire mid-cap IT space. And within the mid-cap IT space in the last half hour, Coforge has hit fresh day's low. Coforge now down almost 4.5% in the session. So again, significant selling pressure as far as the mid-cap IT space is concerned. But with that, it's all the time we have on this edition of Mid-Cap Radar. Your stocks when we return.
practice with at least the larger banks is to hedge their exposures with an external agency. Why wasn't IndusInd Bank doing this to begin with? And, specifically the September 2023 RBI survey.
Hello, good afternoon. Welcome to Your Stocks on CNBC-TV18, coming live from CNBC-TV18 Motilal Oswal Studios. I'm Vinny Motiwala. Thank you so much for tuning in this afternoon. A quick look at what the market has been doing, because the market has recovered from the day's lowest point, a slight bit of a recovery that we've seen, and managing to hold on to 22,400 levels even as of now. As of now, the cuts that are there on the Nifty 50, 0.3% of cut is what we're seeing on the benchmark indices. Though broader markets continue to underperform, we've seen a Nifty mid-cap down almost more than 1%, 1.5% approximately, and small cap is also seeing a decline of almost 0.7% in today's trading session. So yes, mid-cap is where the severe pressure is coming in. A Nifty small cap also has seen some bit of a recovery. One sector that has moved into the green in the last 1 hour is the Nifty Auto. Let's pull that up, because Nifty Auto is trading with gains of almost 2/10 to 0.3% in the last half an hour. We've seen that uptick coming in for the Nifty Auto. Banks continue to do well and continue to hold on the positive side. So Nifty Bank also managing to hold on to the green that it has been seeing, recovered from the day's lowest point, 48,000. About that mark is what the Nifty Bank is holding on to. So yes, that's how the market setup is looking like as of now. But this is a show where we solve all your stock related queries. And to solve all those doubts today, we have our experts joining in with us. We have Asta Jain, research analyst at Hem Securities, as well as Somil Mehta, head of alternate research capital market strategy at Mirae Asset. Sher Khan joining in with us on the show. Good afternoon, Asta, as well as Somil, and thank you so much for joining in with us on the show. Let's get started with the queries for today then, and we'll start with the first query. Nidhi Parmar is writing to us from Gujarat. She's holding 100 shares of Titagarh Rail Systems. This is at a price of 1,600 rupees per share, so making considerable loss on this one. As of now, she wants to know whether she should continue to hold this for the long term. Asta, good afternoon, and talk to me about the fundamentals for this one first.
Hi, good afternoon to both of you. Talking about this counter, fundamental seems to be okay, because this is the only Indian company which is into the wagon manufacturing. And we know their market share is also very strong in the wagon manufacturing, although they manufacture coaches as well. And in fact, the order book is also very strong. It is more than 13,000 crores of order book that they are having right now. So all in all, I think this stock is poised for show more upside from here. Maybe it will take some time, because we all know that at one point of a time, railway stocks were in the demand, and that's why valuations were a little bit stretched. So now they are just correcting. So my idea here is that for the longer term perspective, this stock is a hold from our side with the price target of 750 to 780, but it is only for long term. In the short term, we might see some more volatility on the downside.
Okay. That's the view coming in from Asta on Titagarh Rail. Somil, good afternoon. And what is your view coming in for Titagarh Rail? Because we've clearly seen it fall from those 1,400 levels somewhere in September 2024 to now at 699. And the viewer has also bought it at around 1,500 levels, 1,600 levels. So what should the viewer now do? Should she continue to hold, look to average, or what is the bet here now?
At the moment, I think from here on, I'm expecting short to medium term targets of around 600 levels. So definitely short term bias and the medium term bias both remains negative. The person is holding this stock from 1,500 levels. That is way too high, and it may take a lot of time for these prices to come back again. So I think from here, maybe hold on and add more on around 600 levels. But personally, I would never suggest anyone to average out on the losing trades.
Okay, let's move on to the next query then for today. We have Ikambarai, who's writing to us from Hyderabad, holding 50 shares of GE Shipping. This is at a price of 985 rupees per share. Wants to know whether to average at current levels. Your view coming in on GE Shipping. Asta, let me take it to you first.
So I don't recommend averaging at this point of a time because we may see some more downside in the stock prices. So I think there will be more opportunity on the lower side to average this counter, at least not at present moment of time. Now talking about the fundamentals of the counter, although management says that their order book has been doubled in the last 12 months, but what we have seen in their Q3 of FY25 numbers was that the bottom line was mainly grown on account of high other income because their other income has rose significantly. So if I take out that part of the element from the company's financial, then definitely there is a degrowth as compared to Q3 of FY24. So the financial performance was not up to the mark, and that's why we have seen the stock correcting a lot. So I don't recommend averaging at this point of the time. Maybe we can see lower prices from here. At that moment, again, the query can be reviewed. But as of now, if someone has this counter in the portfolio, they can remain invested in. I'm seeing the price target of somewhere around 950 to 980, but that is purely in the longer term, not in shorter term.
950, 980 is something that is coming in the long term, not in the short term. Near term, maybe we could see some bit of a decline also is what Astha is saying. GE Shipping for you, Saumil, on the charts, how is GE Shipping looking like?
I think the short to medium term bottom is already formed here. A small inverted head and shoulder pattern has been forming in on the daily charts. Momentum indicators on the buy side. I think it should start a new rally on the upside, and the target should be around 1050, which is very close to 200 daily exponential moving average. And I'm expecting a sharp bounce from here because momentum indicators already have a positive divergence. So bias remains positive, and the target should be around 1000 to 1050.
Okay, let's move on to the next query for today. This is coming in from Raja Rao Kumar, who's writing to us from Bangalore. He's holding 125 shares of KC International. Price is 500 rupees per share. Wants to know whether to continue to hold, sell, or look to sell at current levels, making some bit of profit on this one. Astha, KC International, your view?
So I would recommend to book partial profit since the investor is making profits as of now. So booking partial profit is recommended at this point of a time and remain invested in the partial quantity for the price target of again 750 to 780. Now talking about this counter, KC International, one of the engineering infrastructure company, and their main merit is about their T&D segment, which is seeing huge traction. If I talk about the demand, if I talk about the order book. So I think, and in fact, they are getting orders from the international market, especially Saudi Arabia, if I talk about that market. So T&D segment is looking very strong in this company, and that's why we believe in the long term, this stock might show some more upside from here. But right now, markets are in a very volatile mood. So we recommend to book partial profit, at least as of now, and remain invested for the price target of 750 to 780.
Okay, can book partial profits is what Astha is saying right now in this current market scenario. KC International, on the technicals for you. Saumil, what is it looking like on the charts? Because I think somewhere around in December, it made those highs in the last 1 year, and then it started seeing that fall coming in. So are you expecting more of a downside now for KC International?
I think KNC International, the lows which we have seen 650, those are very crucial levels to watch out for in the medium term outlook. And I think a short term bounce is definitely expected because there's a small ending diagonal pattern formed. However, there's no breakout yet. Once it closes above 740, I think the next level would be around 885, which is very close to 200 daily exponential moving average. We shouldn't forget that this stock is trading below 20 daily moving average for a very long time. So the short-term bias and medium-term bias is negative. However, close above 740 will give us good short-term bounce.
Okay, let's move on then to the next query, and this one is on Zomato. Now, Zomato, I think everyone has a lot of queries because every time we take it, there is a new query coming in. This is from Deepak Jain, who's writing to us from New Delhi. 70 shares of Zomato, price is 100 rupees. Wants to know whether to book profits, continue to stay invested. Your view, Astha, the viewer has bought it. They're making profits on this one as well. I think one of those few viewers right now who's making a profit. So what should they be doing?
So this company has a very strong position in the food delivery market, and now they are expanding well in the quick commerce market also. Despite the competition, which seems to be very stiff for this company, they are continuously adding new stores, new warehouses, and in fact, expanding their mobile usage also. So I think all these will help the company in posting good set of numbers in the longer term, but in the short term, we are quite skeptical about the stock prices momentum. So my idea here is to book partial profit at current juncture, since the investor is making good profit, and remain invested in the partial quantity for the price target of again 230 to 240 odd levels, but this can be a longer term target, not in the shorter term.
Okay, and Zomato on the technicals for you?
Zomato is definitely looking negative, medium term bias negative, short term bias negative. It has just taken resistance at 200 daily exponential moving average and has broken out of a small triangle pattern on the downside. The next target would be around 180 in the medium term outlook, and if it closes below 180, then it goes to 165. So for short term targets, I would be around 180 levels.
Okay, on that note, we're going to step into a very short break. Viewers, don't go anywhere, because after the break also, we'll be still answering all your stock-related queries. Stay tuned then.
Hedging per se. So we're still trying to understand, what led to the discovery of this change and the subsequent, despite appointing an external agency, delay in reporting this to exchanges and to investors at large.
No, Ritu, this was not a delay. We took a view that we should not be doing the internal deals, and we should only go to the market hedge. And I think that is the call, and the circular clearly states that, and we changed the classification of our derivatives into what will go into hedge and what will go into mark to market. I think that's number one. Number two, in my opinion, there was no delay in reporting to the LODR. I think as soon as we discovered the number, the LODR. So as a process, we found that there may have been some gap, but very difficult to identify the gap. And as soon as we understood the gap, we immediately came into the LODR and reported the number. So if you think that we've hidden something, I don't think the bank has hidden any disclosure at this point of time.
Well, no, Mr. Katpalia, it's the markets that seem to believe there is a question when it comes to the credibility of the bank. And, I could recite several brokerage notes that talk about it, that, trust is very important for a bank. And because of this delayed disclosure, there is a lack of credibility, which is why you're seeing the kind of reaction we saw in the stock market, 20,000 crores of market cap wiped out in a day's trade. What will you say to these investors to allay their concerns that there will be no further shocks as well?
Ritu, I can only say that I think when the microfinance issue came in, it was really not an issue. And we actually, what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU, and you should see the growth that the bank is seeing and the profitability which the bank is used to.
Welcome back to your stocks on CNBC TV18. We still have with us Asta Jain as well as Saumil Mehta to answer all your stock-related queries. Let's move on to the next query, and this one is on Power Grid. Now, Kamal Sharma is writing to us from Bihar, holding 70 shares of Power Grid. This is at a price of 162 rupees per share. Wants to know the prospects of his investments in this one. So they're making a profit of this one. Asta, your view for Power Grid in the long term, how is it looking?
Long term is looking strong for this company because first of all, they have got a very good market share in the new project win. In fact, they have recently won the bid for 190 billion of transmission projects. So their order book is looking very strong. And I think on that basis, long-term outlook is very positive for this company. Recommend a hold on this counter with a price target of 280 to 290 at the current levels.
Okay, that's a view coming in from Asta. But on the technicals for you, Saumil, what should one do with the Power Grid right now? They're making a profit. So continue to hold this for the short term, long term, medium term, and the targets that you would have.
Definitely bias positive in the short term, in the medium term. The fall which we have seen in last 6 months, I think the bottom is in place. For medium term outlook, at least the next target in the medium term would be around 300 levels and strong support around 261. A long term trend line has the stock has hold a long-term trend line, and now the height of high bottom formation has already started. So I think the next target would be 300 and strong support at 260.
Okay, let's move on then to the next query for today. We have this is NTPC Green, which is the stock that the viewer has a query on. Himani is writing to us from Bihar, holding 100 shares of NTPC Green Energy. This is at a price of 85 rupees per share. Wants to know whether to continue to hold or look to sell this one at the current levels. Asta, your view on NTPC Green?
I think one can continue holding this counter, but there were certain issues. First of all, the IPO, which came back at 108 issue price, I think in November last year, that was a great success, but we have seen a sharp fall from the issue price also, because 108 was the IPO price at the higher end of the price band. Now, talking about the fundamentals of this counter, because this being the wholly owned subsidiary of NTPC, one of the Maharatna with a renewable energy public sector enterprise, its main positive was that they have the revenues which were continuously growing, and in fact, their credit ratings were very strong, which enabled them to have a low credit cost. But if I talk about the financial performance of the company, especially in the Q3 of FY25, other income just was very high. And if I take out that other income, then the bottom line growth was not seen as was expected from this counter. So maybe that can be one of the reasons that we have not seen stock prices moving in that great manner. But I think in the longer term, it is a good story to believe on. Remain invested in this counter with the price target of 107 to 112.
Okay, and Saumil, do you have any view on NTPC Green? I know not much in terms of historical charts, but anything on NTPC Green?
The best part about this stock is that it has started making high tops, high bottom. It does not have much data, but started making high tops, high bottom. And this stock has never started making high tops, high bottom since the time of its listing. So this is a very good sign at the moment, but keep a very strict stop loss of around 91, and the short-term target would be around 108. Once it closes above 108, the next level would be 118. So these are the short to medium-term targets.
Okay, let's move on to the next query then. This is coming in from Himanshu Jain, writing to us from Madhya Pradesh, holding 150 shares of One Movie Quick. This is at a price of 270 rupees per share. Currently also it's trading at 270 approximately. Wants to know the outlook for this company going forward. Asta, your view on MobiKwik?
So outlook doesn't seem to be that positive. Now, I tell you again, this was one of the listing because the IPO came again in December 24 and the issue price was 279 at the higher end of the price band between 265 to 279. Now, what we are seeing that the stock has fallen below the issue price of 279. So first of all, the main reason which I think that was the main contributor towards this downfall is that their results were not up to the mark, especially they have posted losses, and that losses were not on the operating level, but it was on the bottom line also. And when the IPO came, the only talk was that this company, being a technology platform company, has started posting, profit, and that was the major feature of this company. But right now, I think due to these losses and all that stuff, maybe the stock prices are not getting that attention. So my idea here is either partially exit from this counter at the higher level, because the cost price is somewhere near to the stock price as of now, or to hold this counter for a very long term with a price target of 290 to 300.
Okay, and Saumil, what is your view coming in on this one? I know it's just listed in December, but since December, we've only seen a downside coming in for the stock, right? So anything that you've seen or anything that you're noticing in terms of a pattern?
Right, it has never closed above 10 daily moving average or a 20 daily moving average. It is always closed below 10 daily moving average, which is a sign of weakness. And I don't see any bounce at the moment. Short-term bias, medium-term bias remains negative. If the stock by chance gives a close above to 306, which is a 20 daily simple moving average, only then the bias will change to positive. But I don't see any reversals at this point of time.
Okay, not much of a reversal that you are seeing at this point of time as well. Let's move on to the next query, Dixon Technologies. Now, Rashmi Kapoor has got 20 shares of Dixon Technology. This is at a price of 10,000 rupees per share. Wants to know in the near-term outlook of the stock as well. There was a split also that happened, and then post that also, again, it's seen such a sharp run-up. As the Dixon Technologies, EMS players surely are doing well. You know, they have that base, but in the recent times, we've seen a stock correction coming in. So, Dixon Technology, fundamentally, how are you viewing it?
So fundamentally, I think what we have seen in the result was the growth was mainly led by their EMS and mobile segment. And in fact, the company has just doubled their, mobile segment also, volume in the mobile segment. But what I feel that we really need to see how the valuation pan out for such kind of performances. So idea here is, since the investor is making profit as of now, so just book partial profit and remain invested in the partial quantity with a price target of 13,500 to 13,600 in the medium to long term.
Okay, that's the view coming in on Dixon Tech, but we're absolutely out of time on this edition of Your Stock. So, Saumil as well as Asta, thank you so much for joining with us on the show. And viewers, thank you so much for sending us your queries. Keep sending them in. We'll always be taking them on Monday, Wednesdays as well as Fridays. So don't go anywhere. Up next now, you have Closing Bell to take you through the last hour of action and trade.
There was a cyber attack on X today, which shut it down and may have been foreign sourced. Yes. It's a big story. You want to give us a moment on that?
Well, we're not sure exactly what happened, but there was a massive cyber attack to try to bring down the X system with IP addresses originating in the Ukraine area.
They're setting fire to various Tesla charging stations near Boston. Shots were fired at a Tesla dealership in Oregon. Various nonviolent...
Shots fired, not a metaphor.
Shots fired, yes. Downtown New York, marching against the Tesla showroom. Your stock is way down. You've been criticized left and right.
But look on the bright side.
I mean, why are you doing this?
Always look on the bright side of life.
Yes. And you're on it.
Yeah. I mean, just like I said, the goal here is let's not have America go bankrupt with waste and fraud. So that's what I'm here for.
Go beyond market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index is up 0.8%, but Hang Seng on the other hand is down 0.3%.
In the spotlight for the wrong reasons, because that trust issue has hurt an IndusInd Bank. I'll keep an eye out on Ashok Leyland.
Food CPI, because that's the one that's been between 8 and 11% for the better part of last 18 months.
The revenues for the telecom, both Bharti Airtel and Reliance Jio, will not immediately accrue.
They will be getting the distribution reach of both Airtel and Jio.
The Nifty puts on a half a century. That's great news. 50 points higher after ending yesterday at the high point of the day.
Where does India stand now after this 5-month-old correction?
So at the day's low, the Nifty is now just about at the 22,400 mark.
Numbers are quite strong, but the trend would weaken a little.
The government has been consistent that there can only be allocation of spectrum for satellite use.
The Nifty heading back towards that 22,450 mark that the bulls have been trying to defend with all their might.
Well, that was the day so far. It's been a tough one because we've still got a little bit of red on the screen. The mid-cap index is down a little more than the Nifty, but we have the last 1 hour right here, and the team of Closing Bell is here to take you through it. I'm Surabhi Upadhyay, with me Nigel D'Souza as always, and we have Manglam with us as well. Some green, I should not forget to add. There is some green. At least the Bank Nifty is positive, guys.
Well, that's right. And in fact, the Nifty has seen a good recovery from the low point of the day. I think getting into those amphi numbers, the street was a little bit nervous. But give and take everything, it's not so bad as yet, at least. The domestic investors still, putting in a decent amount of SIP flows. And I think that's given some heart. And in fact, even the Dow futures, currently, the last time I checked, they were in the green. I'm wondering whether it is positive or negative, because actually the Indian markets, we had formed a trajectory of our own. So let's see how things pan out. But otherwise, the screen is not looking too bad. We went through a couple of weeks where there was a lot of pain. Select buying in broader markets, a couple of large caps doing well as well. Not too bad, I would say.
I'm looking at just 2 data points. The first one is that yesterday we expected the IT index to drag the overall markets and the banks to support because it was more domestic facing. We had a domestic problem of our own with IndusInd Bank, and as a result of which the IT index, which did not fall as much, and the banking index fell, and that kept the Nifty afloat. Yeah. Today, the exact reverse has happened because IndusInd is now getting digested by the street. The stocks recovered from the lows. The banks are not falling further. In fact, in a couple of the private sector banks, we are seeing some purchases. So as a result of which, the Nifty Bank is doing well. The IT index, however, is now catching up to the weakness that we saw over the last 2 trading sessions overnight, and that is the one which is under pressure, but at the same time, it's recovered from the lows for that IT index as well, perhaps on account of the recovery that we've seen in Dow futures, as Nigel pointed out. The second data point that I'm looking at is that the low on the Nifty yesterday was 22,313. The low on the Nifty today, 22,329. So the low on the Nifty today has been higher than the low that we saw yesterday as well. So give or take, whatever weakness we've seen in the IT pack as well, we've managed to make a slightly higher low. which is good for the market. We've recovered from those levels as well. The only fly in the ointment is that every time we go to 22,550, 22,600 thereabouts, we see some supply. But so long as there is support at the low levels, no real worries perhaps.
Well, that's right. Mangalam, just a couple of stocks I want to highlight, and that's what's telling you the mood of the market is not too bad. Keynes in the morning, it was down close to around 8% because of that show cause notice that was served to the MD for financial year 2023. From a negative 8%, the stock is now up close to around 2%. So it's recovered a good 10% from the low point of the day, because the point was it wasn't a conviction of any kind of wrongdoing. It was a show cause notice that too dated back to a couple of fiscal years earlier. So that's recovered. I recall when things were going very, very weak for the markets at that point of time, well, the stock would have still been under pressure, but that dip has got bought into. The other point is, IndusInd Bank was lower.
Yes.
The problem is now the trust. Valuations could support everything. The problem is trust. The street is a little bit nervous. From the lows of the day, the stock has recovered, but a group stock, which is Ashok Leyland, out there, that stock is still down close to under % after falling close to around 4% in yesterday's trading session, just because it belongs to the same group. And there's, as it is, a promoter pledge on their holding in this company as well. So the market doesn't like these kind of things. Valuations, numbers, they matter secondary. First is the trust. And what's happened in IndusInd Bank, that's what's hurt the trust of investors in IndusInd Bank. And in turn, the Hinduja group stocks as well. Could explain why Ashok Leyland is a little bit lower. But I think let's get a call on the markets. We have recovered from the day's low, as we had mentioned earlier. Mitesh is with us. Hi, Mitesh. Good afternoon. Not too bad, right? We had the flows numbers that came in. They aren't looking that bad. And, in fact, the markets are seeing a buy on dips. That seems to have resumed. Where are we going from here? Would you buy this 30, 40 point downtick that we're seeing even as of now?
That's right, Nigel. I think the market has kind of held up very well, and my worry was in the morning was whether we'll start trading below 22,300. We got a low of 22,329 and have bounced back from there. I think holding on to 22,300 means that we are in that range of 22,300 to about 22,600. But the way the charts are shaping up, there's a good chance that we'll eventually cross 22,600 and attempt that big level of 22,750, 800, which was acting as a support. Once we cross that, then I think we are looking at even some kind of an up move starting. But at least till then, the holding of 22,300 means that, that bounce back game is not yet over, and we are still attempting to claw higher and look at higher levels. So in that sense, staying positive. ICICI Bank is a recommendation on the long side. Buy here with a stop at about 1230, targets of 1275. And HDFC Life is another one. It gave a breakout yesterday. Today it's giving some kind of a pullback, but my sense is that the pullback might be over. So buy here with a stop at 624. Look for a target of 655.
Okay, all right, got that. Mitesh, just hang on for a second, because, we wanted to discuss some of these IT stocks with you as well in levels. Let's pull up IT. For me, the only real worry in the market today is the selling in IT. Now, it's been triggered by a couple of brokerage notes. Motilal Oswal wrote a report, and then we had Morgan Stanley come in and downgrade Infosys. I must add that Morgan's target, even after the downgrade, is higher than where the stock is. The stock has already fallen more. Morgan, I think, is at about 1,700 on Infosys, and Infy is now sub 1,600. Motilal's larger point was that this whole sort of expectation of a rise and recovery in discretionary spending in the US, that seems to be coming under a bit of a cloud. And you never know, because how US businesses eventually feel given the tariff uncertainty and the economic uncertainty that's looming on the US itself right now. So that's what's making them a little cautious. We'll get Rima in to dive a little deeper into those notes to understand what the concerns are. But and it's not just today, might I add. Of course, let's look at all the IT big boys today. Infosys is down about 4.5%. Wipro, Tech Mahindra, HCL Tech, TCS, all the stocks are down. But even if you look at this calendar year, then IT has actually led the fall. Leave aside accidents like IndusInd, leave aside a Trent, which is the worst performer of the year after IndusInd, because that's a separate matter altogether. If there's a sector that's led the market down this year so far, it's actually IT. So, Mitesh, very quickly on technicals, on the large cap names, what would the advice be? Any red flags, any line in the sand, anything that you'd want to put out as a caveat for anyone tracking or trading IT stocks?
I think short-term pain definitely is there. For example, if I was to look at the chart of Infosys, it's broken below a very key level of on the monthly basis. On the long-term chart basis, it's broken below a very key level of 1650 odd zone, and I think that's happened today. Yesterday we saw a low of 1637, but the closing was 1661, and I was hoping nothing, no further damage happens. But today we are trading down. So I think that's one name which is clearly high on the casualty list. Tech Mahindra, I think similarly, had this breakdown a few weeks back when it broke the pivot of 1640, and then following that broke the 200 average at 1580. So I think my idea is that from a investment point of view, IT is to totally avoid. Yeah, you might get a bounce back once we see the stocks are extremely oversold and they're getting close to it. So they might give you a trading rally, but I would just look at a small 1 2 day through 2-3 day kind of a bounce back and then avoid these stocks.
Okay, all right, Mitesh, thanks very much. I will come back to you after a bit. We have Rima with us now, so let's ask her exactly what the concerns are. Rima, so what is Morgan saying, and what is Moti's point of view?
Well, for starters, both Motilal Oswal and Morgan Stanley have downgraded Infosys. Morgan Stanley has downgraded Infosys to an equal weight. Their target price stands at 1740, while Motilal Oswal, it's a neutral rating now. Target price at 1650. Motilal Oswal separately has also downgraded Wipro to a sell and an LTTS to a neutral. And both Morgan Stanley and Motilal Oswal prefer TCS over an Infosys. Motilal says LTI, Mindtree, TCS are their preferred picks because of the risk reward, while for HCL Tech, it's a more balanced portfolio. Morgan Stanley too echoes the same thing. TCS over Infi, TechM over HCL Tech, Coforge over Emphasis. Now the key reason, what makes both of them bearish or a little concerned. Well, if you remember, FY24 was a solid growth year, right? It was all about digital transformation. Growth rates for IT shot up. Then FY23 and FY24 growth started slowing down as companies started prioritizing cost optimization over discretionary demand, largely due to inflation. High inflation rates in the US had started pinching the tech budgets. So FY23, FY24 growth had slowed down. But the expectation was that FY26 and FY27, courtesy Fed rate cuts and generally 2 years of slowdown, things will pick up for IT companies. Growth rates would recover to high single digits, perhaps even hopefully double digit. That was the expectation, and now brokerages are reassessing that expectation of a growth recovery in FY26 and FY27. So, Motilal Oswal talks about how clients are back to being in a wait-and-watch mode. Decisions are not being taken. Discretionary demand recovery, which was expected, is unlikely to play out, and therefore growth forecasts have been slashed. You can see on your screen, for FY26, we're talking about mid-single-digit kind of a revenue growth. Even for FY27, it's not that growth is, coming back. It's still about 5 to 7% across large cap IT names. So that's the key concern, that expected recovery in FY26 and FY27 is unlikely to play out compared to what the street was hopeful about over the last couple of months since that IT recovery in stock started in June. Back to you.
That's a sobering play, Rima. I mean, in terms of the toned down expectations of earnings, especially FY26 is quite stark. FY27 maybe street is still thinking it will even out, sort itself out, but FY26 expectations are really coming down. Let's take this up with Prakash Diwan, who's with us on the show now. Prakash, watching Rima's graphics, I was just thinking you could replace the IT names and put all the FMCG names there. You'll have the same growth numbers, 3, 4, 5%, and that really makes you think. Two large parts of the market, the large cap market, struggling with similar issues of a growth slowdown, and one can argue when valuation, separate argument altogether. But yeah, that's the reality of our large cap market right now. On IT, what's your call?
So, Surabhi, good afternoon. Very pertinent comparative, but I can only tell you that FMCG is under-owned as compared to IT, which was over-owned. And that's precisely where the disappointment is getting to be very starkly reflected in the prices. Nobody would have expected a TCS or Infi to lose ground in such a rapid fashion. But remember, in this last, 45 odd days that we've, 65 odd days, 55, 60 odd days that we've been seeing, the Trump administration do its bit. There's absolutely no indication of what was earlier anticipated, which was tax breaks, and that would have led to further growth and new TCV wins. Nothing of that is happening. The other thing that's happening is that China is taking the entire limelight away in terms of what IT is going to shape up like. It's more what China brings up that's going to probably decide in terms of the trend, in terms of allocations of fresh capital. I don't think Indian IT companies are anywhere close to bracing up for that kind of a leadership position. So it will be a while before we weather the storm. I think IT is still going to find its way down. FMCG, to be honest, could probably spring a surprise at some point in time once money starts coming back, but then that's for a separate discussion. But IT, I'm absolutely not positive. I cautioned about IT some time back when we thought that there was a spark, this could do well. But I don't think it has the conviction to defy the overall slowdown and the fall in indices.
Right, Prakash, thanks a lot for that. The other one is the more interesting one that I'm looking at. The reason why I'm looking at that is because it's the telecom space. You have Jio Platforms and Bharti Airtel. Both of them announced tie-ups with Elon Musk's SpaceX, under which they will offer Starlink's satellite broadband services to its subscribers. But will Starlink become mainstream in India? Rima joins in to explain that. Rima, the street was hoping for some benefits coming in to the listed telecom players. Bharti Airtel opened well, but from there it's seen a 4% decline. And thereafter, we also expected some fears on Vodafone and Indus Towers. Both those stocks are lower as well. So one is just trying to understand what exactly is happening. What should one make of the business case of Starlink itself?
Well, it's hard to know because we don't know the pricing, in what form and fashion Starlink is going to come. But here's what the consensus opinion now seems to be. Yes, there is an opportunity because India has a very large underserved population. Bernstein, in their note on 4th of March, talked about 40% of India is still not connected to the internet. So there is an opportunity to serve places which terrestrial networks cannot reach. That said, it depends on the affordability because Starlink's offerings are expensive. Just to go back to the conversation that we had with Balaji of IFL, the telecom analyst at IFL, and he said Starlink is priced at $80 per month in the US. Even in a subsidized developing economy like Kenya, it's priced at $10. Well, that is still expensive compared to what Indians pay. Indians are paying $3 in terms of an average revenue per user. That's what the ARPU is, between 200 to 250 rupees per month. That's $3. Even for broadband services, which is where Starlink will come in, it would still be $5, maybe at best $10. So Starlink is going to be expensive, and plus there is a hardware cost associated with it. That's reason number one. Secondly, it's not that even if whenever revenues start accruing, it's not going to be immediate because as of now at least, Starlink is yet to receive its license in India, and secondly, spectrum is yet to be allocated. So at least in the near term, nothing changes. Back to you.
Okay, all right. Thanks a lot for that, Rima. Well, Prakash, coming across to you, your view on these names. The stocks are a little bit under pressure. It seems it's going to take a lot of time. It could be more of a parallel play rather than being a threat. And also, I wanted your view on Indus Towers because that one has lost 4.5%. The fear is that that this will take over, which is unlikely to be the case. But that's the fear. Would you buy into this dip on Indus Towers, or do you think you like to stay away?
Good afternoon, Nigel. So, first and foremost, the reason why the market is celebrating a bit of a uptick on Reliance is that before this announcement came in the morning today, you really didn't have, it was thought that Reliance probably was losing out to the new invasion from the satellite channels, and it could probably lose some ground. But this kind of, equals the entire thing where both the players have an equal opportunity. So instead of competing, they end up collaborating. So that's great news. As Rima said, it's not going to make a material difference very soon. At least for the next 18 months, you won't see any material improvement in ARPUs. And even when that happens, it's going to be incrementally very, very small. Remember, India is not a market which is price insensitive. And these areas that you're talking about could probably be, getting broadband connectivity on airplanes and in, offshore rigs and in areas like Ladakh, or, all of those. So it's not a big segment that it will kind of start catering to. On this whole thing of Indus Tower losing out or a Vodafone losing out, I think a satellite communication is agnostic to the terrestrial setup that we have. We are a very vast country and we are still underserviced in that sense. I don't see any reason why an Indus Tower will lose out of this business. In fact, the number of towers required to do 5G connectivity, including BSNL's own initiative, is about 12 lakhs. And the number of towers that we have in play at this point is about 7.5 lakhs. So we're still way short of what's the optimal requirement. There's room for enough growth. I don't see any reason why this. In fact, if somebody were to look at allocating money to this sector, instead of the OEM, it could probably be Indus, which is a great play. So things are looking up very positive for the sector, and of course, this dip that you get in index is probably even a better entry point.
So more complementary in nature rather than a substitute, right? Indus Stars, you believe there's a better amount of penetration. You'd rather be a buyer on this name. Is that correct?
That's right.
Okay, all right. Prakash, before we let you go, just very quickly, I wanted to ask you about the cement pack. You track the space closely. Dalmia and Ramco are under pressure because of that additional royalty that they'll have to spend on limestone that's mined in Tamil Nadu. Your view on it? Actually, it gives them an excuse to go ahead and hike prices from here on as well. What do you make of it?
You said it, Nigel. I think the price hike is probably overdue, not just for these players, but if you look at some of the expansion that's happened in volumes in the eastern market, there's been absolutely no talk about price hikes. Consolidation has probably kept the industry busy. One thing you need to understand, before the monsoon kicks in, there's going to be a very hectic level of activity on the construction side. And the next 2-3 months is probably going to see a lot of demand pick up, the volumes pick up because of the demand pick up. And once that happens, there won't be any inventory that dealerships would be probably left with where price hikes would not be constructive. So I think the timing would probably be right. You could hear about that sometime in April. I don't know what quantum it happens, how staggered it is, but these players will be able to absorb this cost because it's incrementally not very significant. Overall, I think from a pricing perspective, the sector hasn't had any improvement for a long time. And on an EV/EBITDA level, if you see, things have just been kind of moderating. So the valuations are very, very soft. There's nothing to lose out there, and that's exactly why you don't see too much of selling out here in even the larger names.
All right, we take that point. Just to complete the whole loop, we started with IT versus FMCG. Right now, as we speak, ITC's moved to the high point of trade. Are you a buyer in any of the FMCG names, hoping that maybe at some point there would be some recovery?
There will be, and you track this sector so well, Mangalam, you know that the consumption side will always grow with a lag. If you look at all the data that's coming through, whether it's CPI, whether it's even IIP for that matter, I mean, not that it's directly correlated, but you will see that the basic consumption trend is positive. And once rural consumption picks up, you'll have a host of improvement in numbers that will see volumes from Dabur, Britannia, and a lot of those names. But it's just that IT will only draw attention once there's some sort of a money getting allocated to it, and that could probably still be some time away because most of them are large caps, and that would mean that you would have to see some sort of return from the FI side as well to make them perk up. But from a risk reward perspective, IT probably is very well placed, and don't miss out on the HULs of the world as well. When the elephants start dancing, you know what happens. So it's been a while that this happened, and probably it's time for that rotational thing to start favoring FMCG as the monsoon comes closer.
I have a feeling that the elephant may start dancing very soon.
Hasn't danced in a while. It's been sleeping.
So typically, what we've noticed is that the elephant has a longer slumber period.
That's true.
And the minute it starts dancing, the way it dances, the impact that it creates is incredible. So we'll watch out for that. Prakash, we'll take a short break, come back. On the other side, we'll have the Blackstone Group, which is bullish on India. We'll bring you Money Control's exclusive conversation with Stephen A. Schwartzman, who's the chairman and CEO of the Blackstone Group.
do you worry today, Sabya, that we are at a point which is almost an existential crisis for a whole host of arts and artisans across this country? I mean, you were talking about the fact that this shouldn't be treated like a charity. It shouldn't be treated like a CSR project. What kind of interventions do you believe we need at this point in time to ensure that we keep this soft power alive?
You know, we don't need to do much because evolution will take care of itself. Because I'll tell you, so we were at the age of influence, which is moving into the age of intelligence. AI is going to come in. And I personally think that AI in many sectors, especially in performing arts and art, will be very short-lived. Because after the age of intelligence will come the age of wisdom. And when the age of wisdom comes in and people realize that the greatest gift to humanity is humans themselves, and we should not robotize our existence so much that we forget to be human beings, then people will realize that art and craft is going to be the most important expression of humanity. We don't have to do much. Evolution will take care of itself.
We certainly hope so.
Welcome back. You're watching us here on Closing Bell. The market's recovering a little bit. The Nifty is now down just about 26 points. And the reason for that is the outperformance that we're seeing from the Nifty Bank, which has now hit a double century, up around 205 points. So that index led higher by a couple of these heavyweights. We have ICICI Bank, which is doing well. HDFC Bank as well was doing well, though saw some bit of supply at higher levels, currently still holding with gains of about 1.5% itself. Let's welcome Rashi Talwar Bhatia, who joins in on the show. She's the partner and portfolio manager at Ashmore. Rashi, always a pleasure speaking with you. Just what are your thoughts on what you make of the market after this correction? What are the kind of opportunities that you find attractive at these levels?
So, Mangalam, actually, I think the markets, we've seen quite a serious sell-off on the large caps. But when it comes to the small and mid caps, we're still trading at one standard deviation above long-term average. Large caps are now trading at about 16 times 1 year forward in a good range where you're starting to see some price corrections in stocks where they're starting to look interesting. And I think, we've seen nearly $26 billion of selling from FIIs over the last 6 months. I think most of it is done, so a lot of it is behind us. And when they start to come back, you will see them starting to come back first in the large caps. And that's where they will, that's where the flows will come initially. So honestly, on the small and the mid, I still continue to be not so constructive. You've seen sharp drawdowns on a bunch of names, and one-off stocks may start to look interesting. Where the earnings growth story continues to remain strong, but you've just seen a really sharp sell-off because of flows, etc., or somebody facing redemptions or something like that. But that would be an exception and not the rule per se. In terms of where I am more constructive at this point of time is the larger cap stock names.
Okay, all right. Hi, Rashi. Good to see you. When I recall the last time you chatted as well, you were tilting more towards large cap names in compared to the mid and the small caps. And you said the next couple of months are going to be fairly cautious. 2 months have passed. What do you think? On the headline index, are we closer to the bottom? Or do you think much of the pain is already in the price with a 15% correction on the Nifty? And also in terms of stock sectors, there are opportunities out there. Many stocks have fallen 20, 30, 40% as well. I think on some of those marketplaces, if I remember correctly, I think the commodity exchange was something that you all were betting on. You could correct me on that. Any fresh buying that you'll have done, a sector, a particular theme you like, a stock?
So, I think you're absolutely right. I think on the large caps, we've seen the selling, as I mentioned before, and things are starting to look a little interesting over there. I would have hoped for more policy stability when it came to the US, and that would give us a little more guidance on how things will play out on the tech and healthcare sector. And I think that will happen, but I think the correction in the large cap names in the tech space looks to be, they're now trading in the range of 20 to 22 times 1 year forward earnings. they have bottomed in the worst of times with the US recession at 15, 16 times, right? So we're not very far in terms of what we're looking at. And I'm talking about US recession, which, 2 quarters of negative GDP growth is something I'm not so sure about at this point in time. But if you look at the mid-cap IT names, they're still trading at pretty lofty valuations, and therefore the ask rate for growth for them is much higher than what today the large caps are looking at, and where earnings have been moderated. And that leads me to the second part of what I want to say, is that we've seen earnings for the large caps moderate in the 12 to 13% 1 year forward growth, 12 to 13% growth for 1 year forward earnings. But when you look at the small and the mid cap names, that has not happened. People haven't cut estimates. People are still hoping for some improvement in liquidity in markets, and don't believe that's going to happen. I think fourth quarter earnings and first quarter earnings, you're going to see those earnings cuts come through. And as those earnings cuts come through, you will see these stocks correct. You rightly said there are some stocks which do look interesting, where the growth story is very strong, but they've seen a sharp sell down because just the sector has, or peers have, etc. And those are the opportunity dislocations that we're constantly looking for, but it's very stock specific. It's not something that is broad based at this point of time. It's, like I said, a few which are more the exception and not so much the rule.
Okay, all right, Rashi, request you to stay with us. It's at around 3 p.m. or where we get Nimesh, who joins us to tell us what he's picking up in D Street action. Nimesh, hi, good afternoon. You're in the market's not too bad, down 20-25 points after being down 150 points. Pretty okay, I think. What are the flows looking like?
Absolutely, Nigel. If you exclude the IT fall, then probably the Nifty is in the green. So that's a kind of a day, a big drag from the IT stocks, but overall a bit of recovery as well. And I think, Nigel, the big takeaway for me was the fact that, from a flow perspective, the feedback is that the selling intensity has definitely come down from the larger FIs as far as India is concerned in the last couple of days. And also the overall inquiry levels have also gone up as far as India is concerned. It doesn't look like there is commitment to buy. But at least there is an interest to look at India again after the fall that we've seen, and definitely the selling intensity has come down. So that's positive at the margin from a flow perspective. As I said, tech has been the biggest drag today, but barring that, you've seen a decent recovery in the other stocks as well. I think there is a bit of rotation happening as well. So technology is down. Well, there is a bit of rotation back into the financial stocks, barring IndusInd Bank, where there was a massive selling yesterday, and I guess even today, while the stock is recovered, some of the domestic mutual funds are still sellers, is what I understand. But there is buying back in the financial names and largely the large private banks, private bank stocks. So clearly a rotation from IT to banks is what I can see. But the big feedback is that at least the selling intensity has definitely come down from larger FIs.
That will make a lot of people very happy. The selling intensity does come down. Nimesh, individual stocks, what do you have on your list?
Well, so the first stock on my list today is Crompton Consumer. Again, a bit of recovery in today's trade, but again, the stock is sharply corrected from the recent highs. But here at these levels, the selling is largely done, is what I understand from larger FIs, and there is a small buying as well, and that's the reason why I've seen a bit of an uptick in Crompton Consumer today. The second stock is Century Ply, marginally under pressure today, but I assume that the buying interest has resumed. There are some buy flows as well, is what I understand from larger institutions in a stock like Century Ply, so that stood out for me. The third is a couple of stocks where there is delivery-based selling even after stock hitting 52-week lows. Samudra Motherson is one stock, massive selling again in today's trade. And Lupin, for a change, there is a delivery-based selling, is what I understand from larger FIs today.
Take that point, Nimesh. Thank you so much for that. With that, let's go to a network exclusive, which is Money Control's Bodhisattva Ganguly caught up with Stephen Schwartzman, who's the chairman and CEO of the Blackstone Group. Let's hear him out.
When we decided to come here, we announced that we would put $1 billion in India.
Right.
And people here probably forget that 20 years ago, that was a huge number. And we were on the front pages of all the newspapers. And now, as you say, we're many times what we expected to be, because the country is such a great place to operate. India happens to be our #1 performing market in the world. for Blackstone. Our returns here on a gross basis are somewhere around 40% a year, way in excess of any other market. And we've spent our time building businesses in India to make India better. And we foresee being able to double where we are, to have a total exposure of $100 billion at some point in the future. We're rapidly growing here in India. We're the largest foreign company in the country. We're the largest owner of real estate in the country. We're the largest private equity firm here. We're in all kinds of interesting areas. And we've found that operating in India is great, and we're very bullish on the future of the country. I know the stock market's gone down a bit lately, gets people nervous. In 20 years we've been here, this isn't the first time we've seen that. So we look at the fundamentals in the country. You have excellent stability of political leadership. Regulations have gone down from where we started. We see a very vigorous population, a lot of young people, sort of a preference for technology, technology industries. So we are very positive on the country, and it's great to be back.
Thank you. So you're talking about 100 billion of assets under management in India over, that is, if you were to double that number.
No, you gave us the right number, and we think we can grow.
So you're the country's largest landlord. You also have a large presence in the healthcare industry in the recent past. What are the other sectors that you could get into? Would you get into areas like data centers, for instance, or some of the what is referred to here as startups, consumer-enabled internet companies, those kind of areas?
Oh, actually, our biggest exposure here, we'll continue to do more, is in technology.
Right.
And in all kinds of expressions of what technology means. So, for example, Blackstone is the #1 developer of data centers in the world. And we're also the #1 owner of data centers. And this is just the start of the data center industry for India. And we can see very substantial growth there as artificial intelligence becomes much more widespread. The growth numbers are stunning in the rest of the world. And off of that base, along with the energy that's needed to power data centers, we would call it energy transition investing, is a big focus here. As you mentioned, healthcare is also important, given the size of the population in India. We have the second largest hospital group in the country,
That's right.
Among other things, and we can see more growth in that area as well.
You worked closely with President Trump, especially in his first term. India is about to negotiate a trade deal with the US. One doesn't know exactly how much time it will take. What would you advise India's political leadership to do when they approach negotiations with President Trump's administration?
Well, let's just start out. I'm not a government official.
No, of course.
I'm just.
We're very clear about that.
Somebody who knows almost all the people involved with these types of things. First of all, Prime Minister Modi and the President had a very good meeting, which is a great start, and they agreed to have a trade agreement between the two countries.
Right.
And they also made some other mutual understandings, evidently, at that meeting. And so I think that the baseline for India seems to me to be very good. There's a good relationship with the two principals. There's a lot in common. There's a favorable attitude, each country to the other one. And I think you just sort of start with a discussion. Evidently, there's already been a number of adjustments that the two countries have made. So I know there's always a high level of anxiety when anybody brings this subject up. But I think the quality of your leadership in India and the ability to reach agreements should be very good.
Insightful commentary coming in from the top boss at Blackstone. Meanwhile, just keep an eye on a couple of these stocks. Geo Financial Services, that's the one that should come up for you, up at the high point of trade, surging and how. This is the next Nifty entrant, so just keep an eye out on that stock. It's moved to the high point of trade. Tube Investments started moving in the last hour yesterday as well, and currently that repeats. The stocks recovered about 2.5% from the lows. That's moved to the high point as well. And we are seeing some traction in a couple of these FMCG names. We spoke about ITC earlier. Look at Godrej Consumer. That too has moved to the high point. Take a short break, come back, get you more on the markets and a lot of individual stock related action. We also get you the tomorrow trade.
Speaking of the dynamics changing, and you were talking about the consumer and the consumer being your biggest influencers, so to speak. The Sabya bride, you kind of turned that on its head, right? I mean, the Indian brides were always coy, demure, shy. There was almost this invisibilization, and you kind of turned that around completely. How did that happen? I mean, was this because of the influence of the strong women in your life? What was it that you were trying to tell by way of attempting to sort of turn this on its head?
See, I don't really understand gender inequality because in my head it doesn't exist. I've been raised by, thank you. And sometimes I tell that, the problem with gender inequality actually starts with bad parenting. Because I think if you raise your boys to believe that they're not better than women, but they're equal to women, I think men will be far more sensitive to gender parity than they are today. And, I have grown up with women who I've looked up to. My friends growing up, my girlfriends growing up, they were very strong women, and I was in awe of them. And let's talk about the bridal market, for instance. So I'll tell you a small story. So I meet a lot of women in India, mothers in India, who believe that I can matchmake for their daughters. And
can you?
No, I don't even have a social life.
About the consumer, not just the Indian consumer, but also the global consumer that you're hoping to tap into now, Sabya. What's changed? You talked about social media. You talked about the world of influencers and content creators and how that's also shaping the choices that consumers make. In your experience, as someone who understands the fashion industry, as someone who's been part of the fashion industry, what's the big change that you're seeing in terms of consumption and consumer behavior today?
I think self-confidence and self-expression. Truth be told, and I've said this in many forums, that fashion has made a lot of money by feeding on people's insecurities. So the more insecure you kept your consumer, the more they wanted to buy your product because they wanted to feel good about themselves. But what fashion didn't realize for the longest time.
You asked for green, you got green. The Nifty has moved into the green as we speak. The Sensex as well has seen a good recovery from the low point of the day. And the Nifty Bank, 250 points higher. Good move is what we're seeing out there. A couple of names that have moved up. I think JSW Steel was down more than 1.5%. That's down only around 0.5%. So that's recovered from the day's low. ICICI Bank, that's the big point that has a good amount of weight as well. That as well was trading in the red. That's moved into the green. Apollo Hospital that has visibility with regard to the inorganic growth and the EPS moving up from here on. So that stock as well has moved up, and Trent is the other one that's done well. Short point, Nifty moves into the green. Mitesh Thakkar is with us. Mitesh, good on the headline index. If you bought the dip, you'll be happy. What about individual stocks? What do you have for us?
Well, certainly, I think again, as I was saying earlier, I think the lower level got confirmed. So that still is good. What we need actually is the break on the upside. I think if that happens, that will be much better. But let's see. For the timing, I have a BTST and Aurobindo Pharma with a stop at 1099. And I'll look for a target of roughly around 1120, 1125, 1130 kind of level for tomorrow. And the other stock which I like is Indian Hotels, which I would want to see the stock get past levels of 755, it's at 751, 52. So around buy about 755, keep a stop at about, and more of a trading call, keep a stop at about 739 and look for a target of 79.
Got that. Thanks for that, Mitesh. By the way, keep an eye out on Coforge. The stock was down 4.5%. It's down 2.5% now. It's cut its losses big time. And Adani Green as well. Take a look at that beauty. From the lows of the day, it's seen a big recovery. Now up close to around 3% or thereabouts. But the big cue today was the mutual fund data for the month of February. And the equity flows did see some bit of a pullback. But otherwise, the SIP flows were more or less steady. Surbhi is Arena's expert. Surbhi, tell us, how do you read those numbers?
Okay, so let's look at the big headline, and the headline is that indeed there is a dip in equity inflows, and it's the first time we're seeing this sort of a dip come through in the last several months. In fact, it's the lowest level of flow since April of 2024. How much is the dip? 26% month on month, if you're looking at it. The numbers now have come down to about 29,241 crores. So where is the pain or the slight pressure coming in? Large cap inflows are actually fairly okay. There's a minor dip, even month on month in large caps. But the bigger issue is with the mid and small cap side of the market. It finally seems that with the market correction ongoing, some sort of sentiment souring has actually happened. So now you can see that dip. In the small cap and the mid cap tally, that dip is a lot more apparent. The flows there have dipped about 33 to 34%, depending on which one you're looking at. The silver lining, however, is that the SIP number is still very, very strong. It's intact. 26,000 crores of flows coming in a month, by the way, which you must remember has a lesser number of days, 28 days in February versus the others. And this kind of a market environment, look at those pillars, rock steady and solid on SIP. So that's the good news. Why are the overall flows down then? Well, a couple of reasons. First, of course, is market sentiment. The market has been really testing the nerves and patience of retail investors. So that's something that you can't escape. Number two, the whole era of big bang NFOs, that's behind us. Even this month, the total cumulative inflows coming in through the NFO route, they've been dwindling down. Now it's sub 4,000 crores. Which is actually a 13% decline even month on month. So NFOs are not pulling in the money. Then I mentioned lesser number of days. More importantly, in mid and small caps, there is a dearth of now lump sum flows. A lot of advisors are telling investors to stagger out their investments, which is why SIPs are not falling, but that big lump sum gush of money, that's missing in the market. And for mid and small caps particularly, some SIPs where the terms are ending, the maturity is happening, those SIPs are not getting renewed. This is the feedback that I've picked up from the industry. Plus, there is redemption in mid and small caps. No denying that or taking away from that either. Again, one more interesting aspect of trade beyond the equity space is actually gold. Remember, gold funds actually blew through the roof because gold has been doing so well. In January, the inflow was as high as 3,700 crores. It's come down a little bit in February, but nonetheless, the number is not bad at all. I mean, gold funds have pulled in about 1,980 crores. So gold is still shining. People are chasing those returns. Equities are steady, but mid and small caps, that's where some profit taking seems to be happening.
Okay, all right. Good one. Thanks a lot for that, Surbhi. Well, let's focus on a couple of other names in the broader markets that are doing quite well. Akums Drugs, well, that one's moved higher. Citi has initiated coverage on the stock with a buy rating. Vinny has got details of that report. She joins us to fill us in with all of that. Vinny, stocks up close to around 2% or thereabouts. Tell us more.
Absolutely. We're seeing a good move coming in the stock, and the note was released somewhere around this afternoon. Now, what Citi has done, initiated coverage, like you mentioned, buy rating, target price of 700 rupees per share. Currently, the stock is around at 520 rupees. So, considerable upside is what we're expecting here. The company has, got a good edge over its competition in the near term is what Citi is highlighting in terms of scale, manufacturing capabilities, as well as has a potential to scale up internationally in terms of the international business. Other than that, what Citi highlights that the recent weakness that we saw coming in for Akums Drugs in the recent times was mainly because of the API prices as well as the product development revenues in FY24 didn't come back and didn't recur in FY25. That is what we saw so far. But in FY26 and FY27, we are expecting that to come back, and that is a key highlight that will be driving the CDMO side of the revenues for the company. Now, they expect CDMO overall to see a good pickup in terms of growth in the first half of FY26. Around a 9 to 12% growth is what they're expecting for domestic CDMO business in FY26 and FY27. Also, in terms of the recent agreements or tie-ups they do have, the Euro 200 million CDMO contract in the international market is something that is a very good deal for the company. They've already received 100 million from this 200 million, and there is more growth potential going forward over here. Currently, when you're looking at it in terms of valuation also, it's trading at around 12 times FY26 EBITDA, which is around a 30% discount to the second largest player in terms of the pure play CDMO game. And that is why we're seeing Akums Drug is buzzing in trade today. Good growth is what Citi is highlighting about the company.
All right, we take that point up around 1.5% for that stock. Vinny, thank you. Just keep an eye out on Balrampur Chini. Something's up with that one. It's a big mover. Up around 9% right now as we speak, at a time when the mid-cap index is actually down by 264 points. And what's interesting is that typically when the sugar stocks rise, they rise in tandem and they rise in a pack. But this one's the only one which is rising today. If you pull up all the other sugar stocks, right, you pull up something like a Dhampur Sugar or Sri Renuka Sugar, all of them are lower. Dhampur just about 1% higher. We have Sri Renuka, which is actually at the low point of trade. So in light of that, it's just Balrampur Chini that stands out in terms of gains. And what quantum of gains? Up 9% right now as we speak. This month, in fact, this year so far, it's rallied about 35% in the last 12 months. This year, it's been a bit of an underperformer, down about 7%. The last 12 months, a 31% move, 9% happening just right now. What we'll do is we'll listen into some important market opinion. We had the top team of Citi India join us earlier today to discuss the impact of Trump's tariff war on India, the domestic macro picture, and the expectations coming in from the equity market in 2025. Let's listen in to what they had to say.
We just don't know how the tariffs are going to be imposed on different countries, whether this is going to be sector specific or it is going to go down to the product specific levels. So what we have done is we have done a very simplistic analysis of equalizing the weighted average tariff rates of both the countries. US will probably have to then increase tariff by about 8 percentage points. And given some elasticity estimates that we have, we think that's worth about $7-8 billion of impact on India's export, everything else constant. That's about 0.2% of GDP. However, we are very much conscious that this will not be as simple as it looks like. This game could be played from India's perspective by cutting down import duties also on some of the items.
Did slow down, but we believe it's a cyclical slowdown and we should see improvement going forward. We have already seen certain actions by the RBI, government, etc., which gives us more confidence on the growth outlook improvement going forward. Of course, these things do take some time to reflect. So it will take time, but the outlook seems to be improving. On valuations, we have seen the market pulling back, like it had gone to highs of Nifty 22, 23 times earnings at the peak. Now it's kind of come down to 18.5, 19 times. So that looks a lot better as well from a valuation standpoint. And then finally, from a flow perspective, we have seen a fair amount of outflows since October. But the outflows on FII side seem to be slowing down. And so far, the domestic flows have been pretty resilient.
They have, yes. Minor dip in this month, but otherwise picture has been pretty solid. Well, we also caught up with Kunal Shah, Director of Banks and Financials at Citi. And of course, we put that question to him. IndusInd Bank investor confidence has been shaken big time. So how is Citi as a house looking at these developments? Take a look.
People are looking forward to how the earnings are going to pan out over next 1 or 2 quarters. And the other aspect is in terms of the succession plan. So now post Mr. Katpalya, who takes up, who's coming over, I think that's going to be the key monitorable as we move forward over next couple of quarters. Valuations, again, when we look at it, it's closer to like 0.6 times multiple. And that's where, so maybe near term, definitely we could see some kind of an uncertainty being there in the stock. But valuations, when you look at it, that has also come off and it's factoring in those kind of a risk currently, yeah.
Right, with that, we'll take a short break, come back, getting more of the markets on the other side.
getting smarter and sharper. And anyways, I think the Indian consumer is probably the smartest consumer in the world. And, I think that when you have and also at a time, a lot of luxury goods were consumed by the idle rich. Today, if you look at the people who are really buying luxury in India, everybody's working. Nobody has time. Everybody's self-reliant. Everybody has self-confidence. Everybody has self-expression. And, then the consumer shifts from being brand supreme to product supreme. A consumer just wants to buy the right product, not the right brand. And at Sabyasachi, we want to get the product right. Whether the brand becomes a super brand or not, it's an outcome of the product, not the brand. And I think globally, when the consumer is going to now realize that that luxury is based on rarity, craftsmanship, authenticity, and provenance, where else can you find a luxury product more unique than what you would find in India? So I think whether people, no matter what happens, no matter how much artfully the spin doctors and the global markets try to dominate India, they can't put India in a corner because it's just not going to be possible because the consumers won't let them.
Here today, what globally, and I did address that in the remarks that I made early on. There's this talk about the tyranny of diversity and inclusion. Do you worry that we're likely to see a pullback, a retreat from some of these issues that require urgent intervention and action?
So thanks, Shireen. I think firstly, Shireen, the minute you combine diversity and inclusion together, I think the likelihood of pullback is very, very low. Because what that says is that we're going to get in people who are different, gender being one of the ways you can get in people who are different, and make sure that they feel included in an organization enough to be able to stay and progress. So I'm really glad that you combined the two words together, because the concern really is, and if I may, to your point, the concern on putting targets is that it signals, whether you mean it to signal or not, that you are willing to compromise on meritocracy. And I don't think there is any woman in this room or anywhere.
Careful.
Welcome back. Well, Mangalam was just talking about Balrampur going to the high point of the day. We have Mayuresh Joshi as well. Mayuresh, what's your view on some of these sugar-related names? Balrampur Chini?
Afternoon, Nigel. No, again, I think all these companies were in a spot of bother in terms of restrictions, in terms of pricing-related issues as far as their distillery operations were concerned. But as pricing has now become normalized, the expectations in terms of the throughput that is probably expected, specifically from the distillery operations, should be holding them in good stead. Again, I think in terms of raw sugar prices itself, the kind of estimates that one is receiving, specifically in terms of raw sugar output when it comes to Brazil or even Indonesia to a large extent, it probably seems that sugar output might be on the lower side as far as the global demand supply is concerned. And considering the inventory carryover in the Indian context as well for the next sugar season, it seems to be on the lower level as we speak. So I think things are turning out for the better. Balrampur being one of the largest distillery capacities that we probably have within the sugar makers might probably benefit as all these things probably come into the fore over the next few quarters.
What about the capital market players, Mayuresh? We did see a big decline in a lot of these stocks, believing that maybe there could be some volume downtake that would come by, etc. BSE, for instance, has corrected about 35% from the top as well. Right now, it's pulling back up around 6% right now. Do you think some of these capital market plays will come back into fashion, especially after the data that we got from the mutual fund industry today? It's not as bad as it seems.
Afternoon, Mangala. Oh, absolutely. And I think the big picture argument stays with all these players, because it's over the next 5 to 10 years, if one really expects the kind of flows, both in terms of SIPs, the addition in terms of demat accounts, and the expectations in terms of transaction processing, I think the entire ecosystem, right from exchanges to wealth managers to asset management companies to brokers, might continue doing well. In terms of the key macro stat, 5.5% of the asset ownership is in equities as part of household savings, which is absolutely low compared to the global average, and in fact, even in terms of the emerging market average itself. So there is significant amount of growth that can probably come through. But at this juncture, and as we see the placement in terms of our rating and rankings parameters, I think a few of the wealth managers probably look a tad bit better placed among them. Case in point being either HDFC Asset Management Company as a case in point, or Anandarati Wealth Managers. The thesis here is that in expectations of managing wealth per se, and specifically for the private wealth managers, the number of households, specifically in the elite category, might actually double from 8 lakh households to 16 lakh households over the next few years. And that probably gives a larger impetus in terms of all these wealth managers probably coming into focus and foray. So I think a few of the asset management companies to the likes of HDFC, AMC, a few of asset managers per se, like Anand Rathi, over a medium to longer term might actually do that.
Okay, all right. We just have a couple of minutes to go, Mayuresh, before the day winds up. So just allow us these few minutes. We will recap what the day has been like. So the market has managed to recover from the lowest levels of the session, but we've still not seen green on the screen, which is interesting because actually European markets have managed that green. And even Wall Street futures right now are trending higher. But here the enthusiasm was curbed to an extent, and the mid-cap part of the market has seen a slightly deeper cut than the Nifty. Mid-cap index is down about 0.5%, little over 0.5% as we speak. Let's look at the large-cap picture then. What didn't work for the market? IT obviously is a theme, as we've been telling you. A couple of downgrades, couple of brokerage notes, Morgan Stanley, Motilal Oswal questioning some of the companies like Infosys because of their additional exposure to the US. That led to a broad sell-off. Infosys is the weakest stock on the Nifty, 4.5% lower. Wipro, Tech Mahindra, HCL Tech, TCS, big drawdown because of the IT part of the market. What else was weak? Nestle lost about 2.5%. Asian Paints was down about 1.5%. And names like Tata Consumer and Lever also didn't quite fare too well. So that's two large parts of the market, both under pressure, IT as well as FMCG. Let's look at banking now. Relatively better off. Bank Nifty is actually the only major index which is in positive territory, about 0.5% higher. Let's start with IndusInd Bank. After yesterday's, absolute slam dunk, about a 5% recovery on the stock coming in. HDFC Bank was the other one that did really well today, 1.5% up. ICICI Bank was flat, absolutely at the flat line. SBI was down. So very mixed trends for some of the large cap banks. Axis was also lower. The firefighting and the heavy lifting was largely because of HDFC Bank. Let's talk about the other gainers then. Tata Motors, 3.5% higher. Bajaj Finance did fairly well. ITC bucked the weak trend in FMCG otherwise, up about 1.5%. And some gains coming through for Trent as well, 0.5% higher. Reliance was the other big boy. So these two, HDFC Bank along with Reliance, they were the batsmen that were firing on the front foot, but wasn't enough. Still down about 25 points on the Nifty.
Well, since Reliance has found its form yet again, Jio Financial Services, which gets most of its value coming in from Reliance, well, that one as well popped up in trade. Remember, it's going to be part of the Nifty in the next few trading sessions. So that stock saw a good surge, was up close to around 4%. Yeah, to talk about IndusInd Bank, well, Indus Stars. The fear was that, in fact, Starlink comes into India, then maybe there could be a threat to the TARs. But most analysts believe that it was an over-exaggerated negative tick today, and it will actually be complementary for their business. So let's see how that goes. For the time being, the stock was under pressure. SEPC, a stock we don't talk about very often. They won an order today. The stock was up close to around 20%. One of the top volume gainers. That's why we're pointing it out. NLC was the other one that was up close to around 4.5%. So big move was what we saw out there. And otherwise, NHPC, NTPC Green, both of them were up marginally in today's trading session. Mangalam, let's wind it down with a few more.
A few more mid-cap IT names. You had First Source, which is down about 7.5%. L&T Tech Services down about 5%. PB Fintech, the street did not like the divergence or the diversification move that they've made by investing in a healthcare company. That was down about 5%. Delivery continued to weaken. And from the cash market names, we had Spencer's Retail, which is down 7-8%. Bharti Hexacom, a stock that did well yesterday, is now down 7% in today's trading session as well. So we had a couple of gainers. We had Carousel, which was up around 20% after a tie-up with a US-based company. With that, we'll wrap up on this edition of Closing Bell. You stay tuned though, Markets Forward comes up next.
A suggestion that there is a willingness to compromise on meritocracy. I think the answer may be a little bit to the question is, as you get them in for interviews, for discussions, that the slate is balanced, and then let the best person win to get the job. And if I may, sorry to Mr. Dave's point on, if I may say to the women in this room and beyond, there are many jobs that we've traditionally thought are not a great idea for women. And coming from an FMCG background, sales is one of them. Attracting women into sales actually is very, very difficult, because all said and done, it is a difficult job. But honestly, it is fantastic learning. And if you put yourself out there, the rewards that it gives you are tremendous. So if I could just urge the women in this room to take these challenges and take some of these leaps, it would really help as well.
What happens is that it makes the trade just a little bit less efficient. And therefore, if anything, it's got a positive impact on the market, as you said. The concern is if there are widespread tariffs, then it actually affects economic growth and underlying demand for the commodity, in which case that becomes a negative. On a ton-mile trading pattern basis, it's good for shipping. But if it affects demand for commodities, then that's bad for shipping because of general economic impact. Now, every day you have some added uncertainty around US tariffs, trade, etc. So I think it makes sense to wait for a bit. In the last term of President Trump, where there were some China tariffs put there, and China put some tariffs on US products, which they've already done, where they put some tariffs on US grain. And US is a significant exporter of soybean to China. So when those tariffs came in, basically the trades rerouted. China imported from Brazil, Argentina instead of the US, and US, instead of exporting to China, exported elsewhere.
Bharti Airtel slips in trade after Starlink announces a tie-up with the Jio platforms and Airtel post regulatory approvals. The Indian market mirrors global sentiments. However, the market recovers in the last hour of trade, even as Trump's tariffs on aluminium and steel take shape. The Nifty ends around the 22,400 levels, while the Sensex ends around 74,000 odd levels.
And Bharti Airtel slips after Starlink announces tie-up with Jio platforms and Airtel post-regulatory approval. Starlink is set to offer its broadband services via its distribution network in India. Analysts see little impact on existing services. Expect Starlink to be used by customers in low or no network areas.
The CEO of IndusInd Bank terms the accounting lapse as a one-off, says there are no hidden skeletons in the cupboard, pledges to turn a profit in Q4 after absorbing the estimated hit of 1,500 crore rupees. That's an exclusive. Hello and welcome to Markets Forward, your go-to show. We'll get you up to speed with regard to today's trading action, and we'll set you up for tomorrow as well. I'm Nigel, and joining me today is Reema. Well, Reema, pretty okay trading session at the end, right? Where you wake up to various global tremors, and if you end with a mild cut, I think the bulls will take that.
Indeed, we're closing once again closer to the 22,500 mark. Nifty and Sensex ending mildly lower, and a significant recovery from the day's low in the second half of the trading session. So in the face of, the kind of global news, headlines, and the weakness, not bad.
Well, that's right. It was a day of consolidation with a bit of a negative bias. That's the way I like to put it, because you go home with a cut of closer around 30 points or thereabouts. The problem was the markets have two pillars. One is the IT index and the other one is the Nifty Bank. In today's trading session, the problem was we had a lot of downgrades, a lot of question marks on the growth you're going to see from IT companies. Various brokerages had written about it. And because of that, tech was under pressure. The good news, though, was that the Nifty Bank, that's holding on to that 47,500 odd mark. Valuations are in favor for the Nifty Bank stocks. But, last couple of days, it's been a little bit under the weather. Today, though, it was up close to around 200 points or thereabouts. The advance decline ratio, though, you had a high number of stocks that were declining than advancing, but there were various pockets of strength as well. So 1:2 is what we saw out there. And the mid-cap index as well did end in the red in today's trading session. The fund flow picture as well, not too bad. SIP numbers maintaining the pace. That was one fear. So that as well got digested by the street today.
Indeed. Let's also tell our viewers what we've lined up for you on our show today. We start with the top movers and shakers with Vivek. The stocks of the day were Bharti Airtel, Ramco and Dalmia Bharat. We'll give you the key reasons why these stocks were buzzing in trade, and we'll tell you the key market events to watch tomorrow. Last trading day of this week. But it's over now. To Vivek, he's at the big wall for the top stock movers of the day.
Well, thank you so much for that. Again, a session, very volatile, very choppy trading session. But in the last hour, you did see quite a bit of buying emerging. Well, in terms of which were the key gainers today, it has to be IndusInd Bank right at the top, after the sharp knock that the stock took yesterday. Today, you saw very sharp recovery, especially after the stock actually saw a gap down opening. So very sharp intraday recovery. But remember, the stock was in the F&O band, so no fresh F&O positions were taken in the session today. The other stock on the radar was Tata Motors. Continued to see strength throughout the trading session. The company had an analyst meet where they went ahead and reiterated their Q4 FY25 guidance, and that particular stock managed to end with gains of over 3%. The other stock on the radar, one stock that was the highest gainer, or one of the top gainers as far as the NSE 500 index was concerned, was actually KC International, ended with gains of over 3.5%. And another stock, especially in the last hour, that saw some buying emerge was Akums Drugs. This particular stock, there was an initiating coverage note from Citi today, and they have a buy target on this particular stock, target price of close to 700. That stock too ended with significant gains today. But on the other hand, the entire IT pack, all the stocks on the back, something you highlighted at the start of the show, multiple downgrades coming in from many brokerages. The entire IT pack today saw significant selling pressure. L&T Tech down over 5% today. Ramco Cement, Dalmia Bharat, some of the southern cement companies, the Tamil Nadu-based cement companies to be precise, they were the ones on the back of worries of royalty as far as limestone mining is concerned. Ramco ended low by over 4%. PB Fintech, this particular stock sold off quite significantly today. The company went ahead and approved an investment of close to 700 crore in PB Healthcare for close to 34% stake, something that the street didn't like, over 4% lower today. And Zydus Life, again, there was a significant acquisition that the company had announced yesterday. Brokerages see this particular acquisition as EPS dilutive, at least in the first year. That stock too recovered a little bit of the day's low, but again ended with minor cuts today.
Okay, all right. Thanks a lot for that, Vivek. Well, let's welcome our guest on the show. We have Mayuresh Joshi, Head of Equity Research, William O'Neill, and Shrikant Chavan of Kotak Securities. Hi, gentlemen. Thanks a lot for joining in. Well, Shrikant, would it be too soon to say that this market has turned into a buy on dips market? Because at least as of now, the 22,000, 22,250, that's holding out. And on a periodic basis, you're seeing either the Nifty Bank, Reliance Industries, or the Nifty IT index is batting for the bulls. What are the levels you're looking at, and how would you trade the Nifty?
Yeah. Good afternoon, Nigel and Riba. Yes, for Nifty, it is like it has been consolidating since the last 5 days, and till the markets are not crossing 22,600 convincingly, I think we are going to see range-bound sort of activity. But yes, at the same time, in case if it breaks the levels of 22,300, then again we could see the levels of 22,000 on the downside. So broadly, I am of the view that all these indices, like even Bank Nifty, if you see, there also we are seeing consolidation. It is not breaking the level of 47,800. It is not crossing the level of 48,500, 700. So there also we are seeing consolidation sort of activity. But yes, Nifty IT, that particularly has broken its important support levels, and we could see some more correction, close to 5-6% more from current levels. So broadly, I am of the view that till the Nifty, Bank Nifty is not taking the charge, we are going to see sideways sort of activity in this market.
Nifty IT index down 3% for the day, and from the start of the year, it's down 16.5%. But Bharti Airtel too slipped in trade. There was considerable excitement in the morning. It had a gap up opening after the company announced a partnership with Starlink. Starlink is owned by Elon Musk's SpaceX, and Starlink provides satellite communication. Soon after Bharti Airtel announced that they're tying up with Starlink, even Jio Platforms announced that they too will be tying up. So there is revenue potential, and it opens up an additional revenue stream because this will serve areas which hitherto were not connected. So for instance, in areas where the cables, the typical, telecom cables and wires don't reach, so your rural areas where the density is low and therefore it makes less commercial sense. But the way to read it from an analyst and stock market point of view is that it's not going to be a big game changer. It may not, be a big money spinner. One of the reasons is that Starlink is a premium offering. As one of the analysts pointed out, it's priced at $80 per month in the US. Even in a subsidized country like Kenya, that's in Africa, it's priced at $10 per month. In India, the ARPUs hover at about $200, $250. That's $3. For broadband, which is your home wireless, you pay a little bit more. You'll pay $5. But even then, it's cheaper in India. And India is a very price-sensitive market. Plus, we're not talking about the device cost, because in India, if you want Wi-Fi, companies, all the telcos provide that, the fittings free. So that's reason number one. Right? Can it become a mainstream, mode of communication? Unlikely. It's going to be used more by the governments or large enterprises and less so consumers. And secondly, in the immediate term, there is limited impact because one, Starlink hasn't got its licenses yet. Spectrum allocation is also still left. So at least in the near term, nothing really changes. Stock, as I said, opened up in the green but slipped 1.2% by close. Mayuresh Wain on Bharti Airtel. Analysts on the whole are very bullish, and now they're watching out for the dividend prospects as the free cash flow in companies like Bharti Airtel improves because their capex is moderating, and the tariff hikes. But what about Starlink in particular and this particular partnership?
Absolutely, Rima. No, I think you have summed it up perfectly. I think on top of that, the rural market or the unserved market is extremely price sensitive in the Indian context. And therefore, even if you take the base prices that Starlink has offered in regions in Africa, specifically in Nigeria, I think that's the lowest that they've probably offered outside the US. So even if they go lower, I think to match the broadband rates that India has at this juncture might be a tad bit difficult because the equipment cost itself is significantly higher. And again, looking at technology, I think the expectation in terms of pulling it down below that $10 or $15 mark that they are offering in a few countries in Africa seems to be improbable. Having said that, the kind of pool that is unserved, around 300 million odd households that you probably got, fair estimate suggests that ARPUs for broadband services can anywhere be in the range of 470 to 525 odd rupees. And in a way, if they find a way out, both Starlink, Bharti stroke, Jio, in terms of providing these services at a cost which does not hit them in terms of provision of these services, maybe I think the addition in terms of broadband subscribers might aid growth going forward. But nobody on the street is probably penciling that in at this juncture. And therefore, the core growth in terms of the wireless business with ARPU increases is the best case scenario for these telcos. As we see at Markets Today, I think the ratings rankings look just fine as we speak. And therefore, anybody holding a stock like Bharti Airtel should continue.
Okay, all right. Thanks a lot for that, Mayuresh. Well, let's focus on the cement pack. Ramco Cement as well as Dalmia Bharat, both of them were under pressure after the Tamil Nadu government went ahead and imposed 160 rupees per ton royalty on the limestone that it's mined out there. Let's explain it in greater detail. Why is this important? Well, for both these two companies, they got harder hit because a large percentage of their clinker is in that state, that is in Tamil Nadu. So for Ramco, it's close to around 50%. For Dalmia Bharat, it's close to around 20 to around 25% or thereabouts. Just to give you a reference point, since you're talking about these numbers of 50% and 25% or thereabouts, the EBITDA per ton that you're expecting for the coming year for both these two companies is between 800 to around 900 rupees on a per ton basis. So you give it that they're going to be hit by around 160 rupees per ton. That's on the whole. But only 50% of Ramco's clinker will be coming out of there. So for Ramco, the effective hit could be around 80 rupees. While for Dalmia, 25%. So 25% of 160 rupees, which will be effectively 40 rupees. So you're looking at a 4 to 10% hit on the EBITDA number in the coming year if it's not passed through. So the street is hoping that some part of this hit will be passed through. The other problem is the other states may say, hey, they are putting in a limestone royalty of close to around 160 rupees. We could do the same, which will be a bit of a threat. Mayuresh, what are you making of these names? if you want to look at it as a blessing in disguise, now they have a reason. Go ahead and we have to increase it by 10 to around 12 rupees per bag to pass this through. And then, in fact, that's what could kick off the price increase cycle, which has been missing for many, many months. Your take?
Well, absolutely. I think that can be the base case scenario, Nigel, that can get worked out, because I think the companies are not completely going to absorb this if this does come through. And therefore, I think it's going to be a partial or a full pass-through that probably happens in terms of these royalty hikes that take place in terms of the end product prices as well. And that probably gives a base case scenario for the entire industry as well. Obviously, prices have not got increased. There were large expectations that prices per bag across India, across different regions, should so increase once the monsoons are over, but that's really not happened. You've seen some element of input cost stability, but there have been sporadic increases in input costs as well. And therefore, I think this might actually be an excuse for the industry to probably hike prices if these firms probably do it. And obviously, these firms are not going to take a hit. So in my opinion as well, I think the pass-through will happen, and probably the whole industry might have some element of pass-through coming through. Not good from an inflationary point of view, but I think it was a much-needed hike that the industry probably needed.
Got that. Let's talk about technology names, because tech led the fall today with a cut of close to about nearly 3%. Now, the reason is some downgrades coming through. So first, Morgan Stanley downgraded Infosys to an equal weight, target price at 1740. Then Motilal Oswal also downgraded Infosys to a neutral, target price 1650. And across the board, both these two brokerages lowered the target price and growth estimates. Morgan Stanley also downgraded Wipro to a sell and LTTS to a neutral. And both Morgan Stanley and Motilal Oswal prefer TCS to an Infosys. Morgan Stanley says their key trade is TCS over Infi, TechM over HCL Tech, Coforge over Emphasis. Now, the key concern is growth. Growth was expected to rebound in FY26 after being tepid in FY25 because discretionary spend was held back for the last 2 years as high inflation in the US was hurting tech budgets. So the hope was that after 2 years of, slowdown, discretionary, spending purse strings would open up. Fed rate cuts would happen, inflation wouldn't hurt, and the companies would have more to spend. But now, given the uncertainty that we're seeing in the global environment, clients perhaps are back to a wait-and-watch approach and monitoring things. So decision-making has delayed, and this is going to affect growth in FY26 and FY27. And on your screen, you can see Morgan Stanley's numbers. For FY26, they are expecting a recovery compared to FY25, but growth would be, 3-5%? At best, it's HCL Tech at 5.3%. And for FY27 as well, growth rates have been lowered compared to their earlier estimates. And now we're talking about a 5 to 7% kind of a growth. So the hope was, Nigel, high single digits, double digits, getting to 10-12%. But that's, not playing out because of this uncertainty.
Yeah, brokerages are questioning that, right? Well, let's get to the other big cue that we got today. The February mutual fund equity flows, they fell by close to around 26% on a month-to-month basis to around 29,241 crore rupees. Falling markets coupled with the lack of big bang NFOs and higher redemptions are believed to have led the slowdown. While large cap category was more or less steady, the mid and the small cap funds saw month-on-month decline of close to around 30 to around 34% inflows, a first in several months. The silver lining, however, were the SIP flows, which remained fairly steady amidst the market correction at around the 26,000 crores odd mark, virtually unchanged from January 2025. And also on a year-on-year basis, it was much higher than the sub 20,000 crore figure that we were working with same time last year. Well, let's quickly get in Shrikant. Shrikant, we discussed a few stocks. Your view on the tech pack, is there some kind of support coming in there? Any stock you would like to give us a recommendation on? And also, since we discussed cement, is there any kind of support for Dalmia Ramco, which got hit hard today?
Yeah, Nigel, I think, because of this particular news flow, we have seen these stocks breaking their important support levels, specifically Infosys, which was which has been consolidating within the range of 2,000 and 1,700 for almost 8 months. Now it has broken that support. And now we may even see the levels of 1,400. That's the view on Infosys. So we could see some 7 to 8% sort of correction in the near term for Infosys as well as for TCS. There also, I am expecting stock to fall to the levels of 3,000, 3,050 based on technical formation. For Dalmia Bharat and Ramco Cement, there also, if you see, they have also broken their important supports, and there also we could see the correction of minimum 8 to 10%. So all these stocks have means they were consolidating, but now maybe because of the news flow which was there, and maybe the companies, they were maybe expecting such type of news flow, and that is why the overall bearishness was there, and now they have broken their support levels. So broadly, I am of the view that yes, some more pain is near term for all these stocks.
Got that. Mayuresh, come in on technology names, a quick word, and are you a bit concerned, and is there more derating or EPS cuts ahead?
Also, I think a large part of the price damage, Rima, is probably in the price. So to a large extent, the markets are now penciling in that there might be some element of earnings hit that these stocks might take. Now, it really depends in terms of Q4 commentaries on how management are probably perceiving the entire environment that is probably expected to play out, both in terms of North America as well as the European markets. And therefore, I think the Q4 numbers as well as the Q4 commentary is going to be extremely critical for all these stocks under consideration. Any commentary which is a little bit detrimental in terms of order flows, in terms of pricing, in terms of how margins might play out, might actually then pull down earnings and probably derate the sector a tad bit more. But till this point of time, my take is that a large part of the price damage has probably happened. Q4 numbers and commentary is going to be extremely critical for the whole sector.
Okay, gentlemen, thank you very much for joining in. Get into a short break. We'll come back with the corporate voices and the key market events to watch on the other side.
Welcome back. You're tuned in to Markets Forward. Well, as promised, let's get you the key market voices that we received during the course of the day. First up, we have IndusInd Bank. The stock gained after the management reacted to the accounting gap disclosure. The management says that this is a one-off and the problem was related to forex currency liabilities, and that the anomaly was discovered in October and started assessment since. The management said that the bank could see some decline in NIs and that the bank will not need capital for the next 4 quarters. Also, the bank will see great profitability from the first quarter, and it guides to get back to 4% margins.
Next up on our radar is Uno Minda. The company does not expect any impact from Trump's tariff, adds that domestic auto volumes remain healthy. They're optimistic about the auto volumes for the next 2 to 3 years. The management also believes they will continue to outperform the industry, and for FY26, they're guiding for margins around 11%.
Well, before we wrap up, let's get you all the key market events you need to watch out for. Vinny is standing by to run us through that list. Vinny, take it away.
So in terms of global events that you should keep an eye out on tomorrow, in the United States, let's keep an eye out on the PPI data as well as the weekly initial jobless claims data. That is going to be important in the US market. In the Eurozone, we are watching out for the industrial production data. So that is going to be key to watch out for there. And coming to the domestic front now, obviously Nifty weekly expiry is what we're keeping an eye out on. So that is important in terms of the volatility that we may see tomorrow in the markets. Corporate actions to watch out for on the domestic front. Gensol Engineering, the board will be meeting to consider stock split or fundraising plans that they have. So keep an eye out on that. Kolte Patil also to consider fundraising plan. And in other news flows that we'll keep an eye out on, the Commerce Minister Piyush Goyal will be meeting Export Promotion Council. That is going to be tomorrow. Now, obviously, this is important this time. Why? Because the Trump tariffs and all those issues around that. It is said that maybe they will pick up that topic and maybe some announcement would come in on that front. So that will be key to watch out for.
Thank you very much for that. And before we wrap, we leave you with some key market commentary from Citi's top team. Listen into that and thank you for watching the show.
We have used a very operative phrase that at least 50 basis point of rate cuts. Our City House view on Fed rate cut is 5 rate cuts this year. So we have taken that into consideration as well. However, I must say that at this moment, the RBI, the way they're positioning itself on the growth and inflation dynamics, it looks like there is scope for rate cuts in India regardless of what happens in US. India's capital flows are less interest rate sensitive than growth sensitive. So if we can get our GDP growth numbers up, we'll start seeing the capital flows come back, and that will stabilize the BOP, that will stabilize the currency. We need not worry as much on the rate differential with US at this point of time, given where our macros are.
I think as long as investors see the secular growth in India that they come for, I don't think those will play a big role, at least from a medium-term perspective. Right? If you think about like Indian markets, any major index in the last 15 years or so, there has been like low double-digit, 11, 12, 13%, depending on which index you look at, that kind of earnings compounding. And that, I think, remains very important. But the most important variable that I'm watching out for is earnings growth visibility. As that improves, I think that is what really gets people back into India. So, see, what we are expecting, what our team is expecting is a low to mid-teens kind of a growth next year.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Indian equities end with minor losses after a healthy intraday recovery raises most early losses. Sensex and Nifty both close around 0.1% lower, but Nifty Bank gains nearly 0.5% as financial counters find their stride. Equity mutual fund inflows take a 26% hit in February amid the market sell-off. Net inflows into mid and small cap funds see a bigger dip. Steady SIP inflows, the sole silver lining. Elon Musk SpaceX ties up with both Jio platforms and Bharti Airtel individually to offer Starlink's broadband services in India. Telecom department sources say Starlink is yet to comply with the prescribed security norms to qualify for a license. US government's 25% tariffs on steel and aluminium imports come into effect from today. The European Union announces retaliatory tariff, says levies will take effect from April and target US products including bourbon, whiskey boats and motorcycles. The White House also pauses its plan to charge an additional 25% levy on metal imports from Canada. Banks conclude sale of Jaiprakash Associates loans to the National Asset Reconstruction Company for 12,000 crore rupees. 25 banks, including SBI, ICICI Bank and Axis Bank, to collectively get 1,800 crores upfront and the remaining as security receipts. India is Blackstone's best performing market globally with gross returns of 40%, says founder and CEO Stephen. Adds the PE firm's assets under management could double to $100 billion in the future. Also says rising global tariffs are a short-term issue that will stabilize over time. That's a money control exclusive. Ukraine agrees to a 30-day ceasefire in the ongoing war. Russia launches an air attack on Kyiv hours after Ukraine's declaration. USA says that the ball is now in Russia's court, says that it will lift the pause on intelligence sharing and resume military aid to Ukraine. Kremlin says it is waiting for America to inform them about Ukraine's proposal. Pakistan security forces claim that 190 hostages have been freed in the train siege as rescue operations entered day 2. 30 militants belonging to the Baloch Liberation Army have been killed so far. The militants had stormed the train, which was carrying over 400 passengers and was en route Peshawar. And we'll come to that and much more in a bit. But first, the market action of the day. Indian equities end with minor losses after a healthy intraday recovery raises most early losses. Sensex and Nifty both close around 0.1% lower, but Nifty Bank gains nearly 0.5% as financial counters find their stride. The government has just released inflation figures for the month of February and IIP data for January. The consumer price index for the month of February has come in at 3.61%. This is at a 7-month low. My colleague Lata Venkatesh is here with more. Lata, take us through the CPI and IIP inflation data.
This is about the best set of data that we've got because inflation is lower than expected and growth is higher than expected. You can't ask for a better combination, but more important are the inflation numbers because interest rates are set on the basis of the CPI number. CPI number has come in at 3.61. The CNBC poll was 3.8%, 3.85 actually to be precise. So this is a good 20 basis points lower than what the street was expecting. And it's 40 basis points below the mandated number given to the Monetary Policy Committee. Monetary Policy has to keep the committee has to keep the inflation at 4%, at 3.61. This is crying out for an April rate cut. Even more important is the food inflation. For all these months, if inflation was above the 4% mark and well above the 4% mark, it was because of food. It was between 8 and 11% for 18 months up until December 2024. January 25, we saw it come down to 6%. And today, the expectation was it will be around 4. It has come at 3.75. So much below. As you can see in the bar chart itself, you can see how much it has fallen from previous months. Let's get to the food inflation. That's the bar chart that we should be really looking at. That is a huge relief for both the government and the Reserve Bank, simply because the less you pay for food, the more money there is available for other consumer durables. So in a way, it becomes even a pro-growth number, this 3.75. We will get to the core inflation in just a bit, but the numbers that I'm just reading out to you, food and headline inflation, are going to be hugely positive for the economy. I'll just give you a few other numbers. The CPI for oils and fats is up only 0.1% on the month. Edible oils were flying away, especially after the government raised the import duties on edible oils to protect farmers. And that appears to have just come down a bit. Not a great deal, but at least it's come down a bit. Likewise, the food price index is also down 2% on the month. You have cereals and products which are up only 0.8%. Now, that would be a bit of a worry. One would have liked it to be flat or negative because this is the height of the Kharif arrivals, but cereals are still 0.5% up on the month. Vegetable index is down 11.2% on the month. Very important, pulses are down 3.6% month on month. That was a very high inflation contributor. That's come down. Oils and fats, as I told you, is still up a bit. Now let me come to the growth numbers. The index of industrial production, or IIP, that's come 5% higher, and our average was 3.8 for the CNBC-TV18 poll. So that again, growth coming in way better than expectation. I'll just tell you, actually the IIP number has come in at, the average that we got was, 4.8%, I think. It is still much better than what the poll said. So that again is a positive. Within the IIP number, the consumer durables growth is 7.2%. Again, very encouraging. It is the non-durables output which is going to be a bit of a worry because it is minus 0.2, and that's been persistently the problem. That is the informal sector. You know, consumer non-durables would be all the milk, sachets, shampoo, soaps. Over there, if growth is not picking up, that's a bit of a worry. The bottom of the pyramid is still not demanding enough. But otherwise, infrastructure growth plus 0.7%, very good number. Intermediate goods up 5.2%, again, a very good number. Consumer durables, like I told you, it's a good number. And capital goods growth is 7.8%. So on IIP, it's a positive number. And on inflation as well, like I told you, largely a very positive number. One should expect bond prices to react positively. But of course, there is the US CPI number coming later on in the evening. We don't know if that is a spoiler. Bond prices will not react. But otherwise, there is enough in this number for the bond prices to react positively tomorrow.
Right. Thank you so much, Lata, for that comprehensive update. Moving on, inflows into equity funds fell 26% in February compared to January as the market sell-off intensified. Inflows into small caps and mid caps saw a bigger dip. However, steady SIP inflows was the sole silver lining. Surbhi Upadhyay is here with more. Surbhi.
Large cap inflows are actually fairly okay. There's a minor dip, even month on month in large caps. But the bigger issue is with the mid and small cap side of the market. It finally seems that with the market correction ongoing, some sort of sentiment souring has actually happened. So now you can see that dip. In the small cap and the mid cap tally, that dip is a lot more apparent. The flows there have dipped about 33 to 34%, depending on which one you're looking at. The silver lining, however, is that the SIP number is still very, very strong. It's intact. 26,000 crores of flows coming in a month, by the way, which you must remember has a lesser number of days, 28 days in February versus the others. And this kind of a market environment, look at those pillars, rock steady and solid on SIP. So that's the good news. Why are the overall flows down then? Well, a couple of reasons. First, of course, is market sentiment. The market has been really testing the nerves and patience of retail investors. So that's something that you can't escape. Number two, the whole era of big bang NFOs, that's behind us. Even this month, the total cumulative inflows coming in through the NFO route, they've been dwindling down. Now it's sub 4,000 crores. Which is actually a 13% decline even month on month. So NFOs are not pulling in the money. Then I mentioned lesser number of days. More importantly, in mid and small caps, there is a dearth of now lump sum flows. A lot of advisors are telling investors to stagger out their investments, which is why SIPs are not falling, but that big lump sum gush of money, that's missing in the market. And for mid and small caps particularly, some SIPs where the terms are ending, the maturity is happening, those SIPs are not getting renewed. This is the feedback that I've picked up from the industry. Plus, there is redemption in mid and small caps. No denying that or taking away from that either. Again, one more interesting aspect of trade beyond the equity space is actually gold. Remember, gold funds actually blew through the roof because gold has been doing so well. In January, the inflow was as high as 3,700 crores. It's come down a little bit in February, but nonetheless, the number is not bad at all. I mean, gold funds have pulled in about 1,980 crores. So gold is still shining. People are chasing those returns. Equities are steady, but mid and small caps, that's where some profit taking seems to be happening.
Right. Thank you, Surbi, for that. The Reserve Bank will buy government securities worth 50,000 crore rupees in the open market. This in a bid to inject liquidity in the banking system. This will be the first tranche of the transaction. The second tranche will be conducted on the 18th of March for the same amount. The central bank will also conduct a dollar-rupees currency swap auction amounting to $10 billion rupees for a tenure of 36 months on 24th of March. Shares of IndusInd Bank rose 6% in intraday trade after falling 26% yesterday. Remember, the stock fell after the bank revealed a 2,100 crore rupee pre-tax loss due to incorrect derivative accounting. Speaking with CNBC-TV18 yesterday, IndusInd Bank CEO Sumant Katpalia said the accounting lapse was a one-off event while defending the timing of disclosure. He also promised the bank will post a profit in the fourth quarter, but alerted that interest income might be impacted.
Around October, and that is where we started our internal assessment as well as we hired an external agency. At that point of time, we did not know the difference, and we knew that there were two deals getting accounted incorrectly, but there's so many deals in that, so we did not know the real impact. And I think as soon as we got to know the impact, we held a board meeting and we informed our board and we did the disclosure. There is no 1 year which will show the blip. I think it was evenly spread out over a period of time. We will absorb this loss in this quarter itself.
US President Donald Trump's 25% tariffs on steel and aluminum imports have come into effect with no exceptions or exemptions from today. The duties will affect Canada, Australia and the European Union. Among others, the EU was quick to respond by announcing retaliatory tariffs on over $28 billion worth of American goods from April. These include metals, agricultural products, motorcycles and bourbon whiskey. Now, the tariffs also sparked criticism from Australian Prime Minister, who said that they were entirely unjustified. However, the Australian Prime Minister ruled out imposing reciprocal tariffs on US imports. Earlier, Trump also threatened to double import duties on metals from Canada after Ontario revealed plans for a 25% tax on electricity exports to the US. However, that won't be happening as of now, as Ontario put a hold on the 25% surcharge following talks with US Commerce Secretary Howard Lutnick. Meanwhile, India's Steel Secretary believes that the tariffs won't impact the country much as it exports less than 1 lakh tons of steel to the US.
As you know, there's a very strong man in Canada who said he was going to charge a surcharge or a tariff on electricity coming into our country. He has called and he said he's not going to do that. Okay, he's not going to do that. And it would have been a very bad thing if he did, and he's not going to do that, so I respect that.
Will you make a different decision now about the tariffs on Canada? Will you reduce it?
At that, but probably so, yeah. He was a gentleman.
And speaking of President Trump, speaking to the media, he once again dismissed concerns about a potential recession. While answering a question on the topic, Trump said, and I quote, "I don't see it at all. I think the country is going to boom." End quote. Trump's statement comes at a time the global market is taking a massive beating amid the tariff threats.
Ruling out a potential recession seemed to rattle the stock markets. The Commerce Secretary said there wouldn't be one.
Boom. Just so you know.
Just specifically on the recession.
Yeah.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom. But as I said, I can do it the easy way or the hard way. The hard way to do it is exactly what I'm doing, but the results are going to be 20 times greater.
All right, time for a short break. Coming up next, banks conclude sale of Jaiprakash Associates loans to the National Asset Reconstruction Company for 12,000 crore rupees. More on that when we return.
Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour. drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
We just don't know how the tariffs are going to be imposed on different countries, whether this is going to be sector specific or it is going to go down to the product specific levels. So what we have done is we have done a very simplistic analysis of equalizing the weighted average tariff rates of both the countries. US will probably have to then increase tariff by about 8 percentage points. And given some elasticity estimates that we have, we think that's worth about $7-8 billion of impact on India's export, everything else constant. That's about 0.2% of GDP. However, we are very much conscious that this will not be as simple as it looks like. This game could be played from India's perspective by cutting down import duties also on some of the items. We have used a very operative phrase that at least 50 basis point of rate cuts. Our City House view on Fed rate cut is 5 rate cuts this year. So we have taken that into consideration as well. However, I must say that at this moment, the RBI, the way they're positioning itself on the growth and inflation dynamics, it looks like there is scope for rate cuts in India regardless of what happens in US. India's capital flows are less interest rate sensitive than growth sensitive. So if we can get our GDP growth numbers up, we'll start seeing the capital flows come back, and that will stabilize the BOP, that will stabilize the currency. We need not worry.
Welcome back. India's top telecom operators, Jio Platforms and Bharti Airtel have joined hands with Elon Musk's SpaceX to introduce Starlink internet services in India. The agreement will help Starlink provide fast connectivity in remote areas. Ashmit Kumar joins us now with the details. Ashmit, from competitors to collaborators, what will this mean for India's telecom space now?
Last few years, our social media feeds are full of Elon Musk's SpaceX rockets taking off and landing, making for fascinating visuals. But ever wondered what exactly were they shooting up in space? Well, the answer, a web of over 6,000 satellites to connect the entire world with the internet. And in the last 24 hours, Musk has announced his first major step towards bringing that constellation to India. Musk's SpaceX-backed Starlink has inked agreements with world's largest telecom network, Jio Platforms, and its largest competitor, Airtel. Last evening, Airtel announced the partnership with Starlink, and just hours later this morning, Jio made the big reveal. The two telecom behemoths who once looked at SpaceX as a competitor have now opted for a hybrid approach to bring the terrestrial and satellite networks together. Now, Starlink's agreement with Jio and Airtel seems to be configured towards penetration of the Indian market using the vast distribution network and on-ground presence of both the telecom bellwethers. Now, Jio Platforms in its release has proposed offering Starlink solutions through its online and brick-and-mortar stores. Other than equipment, Jio also expressed willingness to provide installation, activation and customer support solutions to Starlink users via its network. Similarly, Airtel has proposed to offer Starlink equipment in its stores. Airtel has also proposed exploring how Starlink can use Airtel's network. Additionally, Airtel is also keen on exploring how it can offer Starlink's bevy of enterprise solutions to its own business customers and communities. So how exactly does Starlink work? How is Starlink different? Well, broadly speaking, a terrestrial network works by connecting your mobile device to the local telecom towers. We've seen lakhs and lakhs of them around our homes, around our workplaces. Now, Satcom works a little differently. It has no towers. Instead, Satcom players like Starlink deploy a web of low Earth orbit or LEO satellites. Now, users of Starlink can buy a dish for their home or business. This dish will then use airwaves for transferring data and providing internet connectivity directly via the satellite. But does it make sense for India? Well, the latest data by the TRAI reveals that teledensity in urban India is at an impressive 131%. But for rural India, this number falls off a cliff to just 58%. For internet penetration, the number of those connected is pegged at 944 million. Clearly, large geographies and large segments of the population are yet to be covered. Despite several attempts by the government, conventional telecom networks comprising of towers and fiber have struggled to cover rural and remote areas. Satellite-based players can help provide stable internet connection to such areas. Moreover, Starlink offers a bevy of enterprise solutions that can help businesses operating in remote areas. But there are three key regulatory hurdles that Starlink will need to cross. Number one, the DoT has maintained that Starlink is yet to address security issues. DoT officials are open to granting a license, but only after security concerns are met. Similarly, Starlink will also require authorization from the space regulator in space. While in advanced stages, few issues such as monitoring and sensitive locations still remain. And finally, how will spectrum for satellite communications be assigned and priced? Key questions that the telecom regulator, the TRAI, is yet to answer. Now, speaking of pricing, is Starlink even affordable? Well, just for context, for residential connections, Starlink charges rupees 31,000 for equipment and a monthly charge of about 4,000 rupees in Indonesia. It charges 33,000 rupees for equipment and a monthly charge of 2,100 rupees in Nigeria. This when India already has one of the lowest data charges. Starlink may have taken the first big step here in India, but there are still a few challenges on penetration, regulations and affordability that Musk will need to manage.
Right, banks have concluded the sale of Jaiprakash Associates loans to the National Asset Reconstruction Company for 12,000 crore rupees. Ritu Singh is here with more. Ritu.
Well, in what is a landmark resolution for banks nearly a decade in the making, we understand banks have concluded the transfer of stressed loans belonging to Jaiprakash Associates to the National Asset Reconstruction Company or NARCL, and against a principal outstanding amount of 14,500 crores, these 25 banks led by State Bank of India and ICICI Bank get 12,000 crores from NARCL. Of course, the total outstanding debt for JP, including all of the overdue interest, penalties, etc., is well over 52,000 crore rupees. Now, the deal follows a 15-85 structure, meaning 15% upfront cash, which is about 1,800 crores, and the rest in the form of security receipts. But importantly, this will reflect in the bank's balance sheets in the current quarter itself. Among the key lenders, SBI alone has recovered about 500 crores in cash and another 840 crores in security receipts. ICICI Bank has received 270 crores in cash, another 1,550 crores in security receipts, and IDBI Bank, Axis Bank, LIC and Canara have also secured recoveries through the transaction, among others. Now, while most of the banks did agree to the transfer, Yes Bank and DBS Bank, with very small exposures, we understand, opted not to participate in the sale. But importantly, even though banks have now transferred this exposure to NARCL, the resolution of the company will continue under the IBC. We understand the deadline for submission of expressions of interest has now been extended to the 25th of March, and the ultimate recovery through the security receipts will be dependent on this resolution. Nonetheless, a significant development for banks in the case of JP Associates, which has been an NPA since 2016 and at the center of one of India's most protracted corporate debt struggles.
Thank you, Ritu, for that. The Prime Minister Internship Scheme was launched in October 2024 with an initial outlay of 800 crore rupees to provide 1.25 lakh internships in its pilot phase. However, it has faced challenges in attracting and retaining candidates. Sources in the Ministry of Corporate Affairs tell CNBC-TV18 that the ratio of registrations to internship opportunities remains low during the second phase of the pilot as well. Shivani Bajaj joins us now. Shivani, what's the government's game plan?
Well, yes. Now, the government has extended the registration deadline for the Prime Minister Internship Scheme from the current March 12th to March 31st now, aiming to boost participation in the scheme. In this phase, applications have reached 70,000 following intensified state-level campaigns. That's what sources are telling us. MCA has been doing campaigns in smaller cities and villages in various states to spread the word about the scheme and attract more applications. However, with 1.18 lakh internship opportunities available, there's concern about potential low acceptance rate. Sources have told CNBC-TV18 that in the previous phase, out of 80,000 offers made, only 30,000 were accepted and merely 8,700 candidates joined the internships, indicating that just 10.8% of the total offers were taken up. Now, MCA sources say that many candidates declined offers due to relocation costs outweighing the provided remuneration. In response, companies are now offering additional incentives like free food and travel to attract more interns. To enhance engagement and transparency, the government plans to launch an internship portal app this week also, detailing these extra benefits to assist candidates in making informed decisions. Back to you.
Right. Thank you, Shivani, for that. With that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
On the rate differential with US at this point of time, given where our macros are.
President Trump. Are you looking to buy or lease today?
Well, I'm going to buy, and I'm going to buy because, number one, it's a great product, as good as it gets, and number two, because this man has devoted his energy and his life to doing this. I think he's been treated very unfairly by a very small group of people. And I just want people to know that you can't be penalized for being a patriot, and he's a great patriot. And he's also done an incredible job with Tesla. And I mean, nobody else has a car company started up in the last 30 years that's been successful. I don't think so. And not only successful, but super successful. And because he's able to find billions and billions and billions of dollars of fraud and waste and all of the things, I mean, our country is going to be very strong very soon because of a lot of the things that he's done and a lot of the things that I'm doing. And there's no better team, but there's no better for what we're doing. There's nobody like this, and he shouldn't be penalized. Now, here's the bad news. I'm not allowed to drive because I haven't driven a car in a long time, and I love to drive cars. But I'm going to have it at the White House, and I'm going to let my staff use it. I'm going to let people at the place use it. And they all are all excited about that. I'm not allowed to use it. Can you believe it?
Hello and welcome to this special edition of the State of the Economy. I'm Lata Venkatesh, and what we are discussing are two important macro numbers that have just been announced by the National Statistics Organization. The CPI inflation for the month of February has dipped to a 7-month low of 3.61%. Now that's compares with a CNBC-TV18 poll of 3.85. So a good over 20 basis points lower than what the street expected. But more importantly, 40 basis points below the mandated level at which inflation needs to be kept by the Monetary Policy Committee, which is 4%. The other delight in the data is that the index of industrial production for January has come in at 5%, and the CNBC-TV18 poll was, I think, 3 or 3.6%. So it's much better than what the CNBC-TV18 poll indicated or what the market was expecting. Double delight in terms of growth being higher than expected for January and inflation being lower than expected for the month of February. In particular, the food inflation has come in at 3.75. The CNBC-TV18 poll was 4%, and the January inflation was 6%. I must add as well that for the previous 18 months, food inflation has been between 8 and 11%. So that drives home the importance of the 3.75 food inflation that we have achieved. It is a sight for sore eyes. With that initial preface, let me invite the experts whom we have lined up on the show for you. Joining me to discuss the IIP and the CPI numbers are Aditi Nair, the chief economist of rating agency ICRA, Devang Shah, the head of fixed income at Axis Mutual Fund, Sameer Narang, the head of economic research at ICICI Bank, and Radhika Rao, the executive director and senior economist at DBS Bank. Ladies and gentlemen, thank you very much indeed for your time. Radhika, I'm going to start with you because the sun is perhaps already set in Singapore, so you get the privilege to leave the show early. What have you made of the inflation numbers? Are they a pleasant surprise for you too?
Hi, Lata. Certainly, I think both the numbers, IIP and inflation, have moved in the right direction. Inflation has come down much faster, the 7-month low. And I think when you see the components is mainly driven by food, as was largely expected. In fact, if you see year-on-year number in terms of the subsegments among food, you really see the relief in pressure, especially on the vegetables. It's declined on the year-on-year terms, and certain other categories like pulses as well. Certainly a good number to have. And I think from the central bank point of view, this is exactly what they were wanting to do, which is to not only bring it back into the target range, but below the midpoint or towards the midpoint. Of course, the next question thereafter becomes, is it going to be sustainable, durable, will remain close to 4%? I think at least for the next couple of prints, it does look like that. Thereafter, of course, probably in the interview, we will talk about it, that you will have other things that might play in the hand. But just like high frequency numbers have suggested, certainly inflation being lower is a very good piece of news.
Okay. Well, actually, the Reserve Bank number is 4.4 for the full quarter. Jan, Feb, March, Q4. That was the forecast they put out. But now we are having an average of, I think, 3.85 or thereabouts for Jan and Feb. So, Sameer, that question to you, what would your March number be? And do you think we will seriously undershoot what the Reserve Bank forecast?
So, in March, veggie prices are pretty much flat, Lata, as of now. So, if you look at that trend, the number for March comes around 4%. And that implies closer to 40 basis points undershoot from where the RBI's number was for 4.4%. And let me add that if you go back a little bit in history and observe whenever veggie prices or food inflation has remained elevated for, as you pointed out in your introductory remarks, for a period of 18 to 20 or 24 months, the next 2 to 3 years, food inflation has been very benign. So you could see a situation in which the RBI is likely to hit its target over the next 2 to 3 years on a durable basis. Having said that, the international equations also in terms of commodity prices and oil would also have to fit in well with that forecast.
Okay. Literally, tumhare muh mein ghee shakkar. if it is going to be, lower food prices for the next 2 to 3 years, because it has been the bugbear. It has been the government's and the Reserve Bank's headache. A lower food inflation will also mean more money available in the hands of people to shop. And therefore, it will be a definite growth booster, something which the Reserve Bank has repeatedly been saying, that even if food inflation cannot be controlled by interest rates, the point is it leaves less for growth, and therefore we have to control inflation as well. Aditi Nair, would you want to change any of your forecasts now? Your current year's forecast as well as next year's GDP forecast? CPI forecast.
So, Lata, for March, I broadly agree with Sameer. We're all so expecting an uptick to about 3.9 to 4%. And therefore, for the full year, our number is now coming in at 4.7% instead of 4.8% for the CPI. For next year, certainly today's number is going to kind of, have to feed into the trajectory the way that we're forecasting it over the next year. As of now, we were at 4.2%. I'm not sure we're going to lower it too much in terms of the FY26 CPI inflation number. Having said that, it's definitely a relief to have food inflation coming off when overall the global economy is in so much flux. It certainly gives us a lot more leverage to be able to deal with an unfolding, growth inflation dynamic situation.
Okay. The important point to ask all of you is whether you all are changing the number of rate cuts expected from RBI. But before I come to that, let me get to the most important person now, Devang. Will the markets react at all, or are you going to hold out because we are now so following what is happening in the US?
So the markets are on, Lata, and probably if you look across, they have behaved positively to the CPI release. We have actually seen yields picking down by around 1 to 2 basis across the curve. Our perspective is that somewhere down the line at this point of time, yes, obviously government bond yields should trend lower, but a lot of other options are available to investors. If you have looked across, thanks to the increased supply on the corporate bond side, we have a mammoth supply this quarter in SDLs. So all this put together, investors have a lot of options. That is why probably they are shifting to other asset classes like corporate bonds and SDLs and probably switching out from government bonds. That is why we are not seeing the rally in bonds. Coming to your specific question on this CPI print, definitely leads to positive momentum for the bond markets, and definitely we believe that April rate cuts is definitely on the card. US CPI will be looked at. But our perspective is, I think somewhere down the line, people have now started focusing more on the growth side than the inflation, because the actions from Trump has been quite slower than anticipated on tariffs and other policies. And that is why I think somewhere down the line, the US growth trajectory is now looked at more closely, where people have started forecasting a contraction in this quarter. So our view is that, yes, this print is definitely positive, and global data at this point of time is not too much of a worry.
Okay. No, actually, with President Trump saying that, a temporary recession may be on the cards or something to that effect, I agree with you that that is weighing down on bond yields. But let me first clear out what we are expecting in India itself. Radhika Rao, after looking at these numbers, what is your expectation in terms of the April policy, and how many rate cuts?
Sure, Lata. Just before going into the RBI response mechanism, I think I just want to also make a point that core inflation has actually ticked up. It has gone up to about 3.95% from 3.6, 3.7 the month before. But I would really put that all to the personal care segment under miscellaneous, which is got to do with the gold prices. So I don't think again that will be much of a hurdle. It used to be mentioned in the past by the central bank that that is a source of worry. So not so much that as well at this point. Coming back to your question, no, we haven't changed our call after this, reduction in inflation. We were expecting a 25 basis points this kind of in April, and this kind of cements that. I think the bigger question I would think would be about the stance of policy, whether that changes or not. And I wouldn't be surprised if that were to change from neutral to accommodative. I think that's when there'll be a very clear signal that move down is the only way that the central bank is exploring. And of course, they have done a lot more along with just rate cuts, right? They've done macroprudential easing. They've also taken a lot of proactive step on the liquidity front. So they're really going all hands on deck in terms of trying to stimulate the economy. So certainly 125 expected in April, and I'm holding up for another 25 within the second quarter of the calendar year.
Okay, so 2 cuts and a change in stance is what you would pencil in April itself, Radhika?
Yes, that's what I'm hoping. I think that would really kind of validate and align with what their policy response has been overall.
Fair enough. Samir, what would be your expectations April and thereafter?
So April, yes, a rate cut, a possible change in stance as well. Effectively, Lata, what they've done in terms of injecting liquidity, durable liquidity in the month of March, by month of March itself, effectively, in terms of durable liquidity, the stance perhaps has already changed. So we'll wait and see what they do in terms of the April policy, in terms of voting on that stance. And in terms of thereafter, we do expect one more rate cut after April. If growth numbers and inflation align, that could be front-loaded in June, or it could happen later in the year, depending on how growth-inflation mix pans out. But given the global backdrop, things have become favorable in terms of policy framework in India than earlier, what we have seen, particularly in terms of dollar index.
Okay, so you're saying that we are going to see a rate cut in April itself. That is the consensus view. I'll come to Devang in just a minute. But Aditi, what are your expectations in terms of rate cuts? Would you agree 2 more cuts and change in stance in April?
So Lata, definitely a rate cut in April. I'm not so sure on whether we'll get a change in stance in that policy meeting or not. And I think for the timing of the subsequent rate cut, which we're also expecting, the data that we'll get at the end of May for the Q4 GDP will be quite important to basically guide whether we do get that final rate cut in the June policy, or does it get deferred to maybe the August policy. As of now, if we look at what is implicit in the NSO's estimates for Q4, is a very sharp upturn in the GDP growth with a very mild upturn, or rather a milder upturn in the GVA growth. So there is, it's coming in from an expected contraction in subsidies in Q4. Our own view is that the upturn in the GDP growth may not be as sharp as what the NSO's implicit numbers are suggesting. So overall, I think, it'll be interesting to see finally what kind of numbers we'll get. We'll end up with another round of revisions for Q1 to Q3 as well in the May data. And that would really guide what happens in the June policy.
No, I'm taken by what Radhika is saying in terms of a change in stance, also because the month of May should also see the declaration of the RBI dividend. And while they have infused a lot of liquidity, that is something seen like between 2.5 and 3 lakh crore. Ahead of that, if you're still going to say neutral, when the accommodation is very clear, there is going to be liquidity of a unprecedented level compared to the previous 2 months. So, is there an argument, Aditi, that you might as well change the stance in April? Because you are going to give liquidity in May.
That's a good argument, I think, Lata. That is something that we could end up seeing. Of course, the exact quantum of the dividend, how different it is from last year, the timing is going to be the same as last year. I think the question is basically on the delta. And of course,
I agree with that.
Government spending will start much earlier than it did last year also. So that's going to be another factor that's going to help liquidity.
No, I take your point because the RBI also announced that they have put in an internal committee because the Bimal Jalan Committee on Capital requires that it should be reviewed once in 5 years or something, and that's come up for review. So it's possible that they want to keep a little more capital and not declare the entire, I think, 3.5 lakh crore. If you do the math, the RBI has only sold even more, so their dividend will actually be higher. But the point is there is going to be plentiful liquidity. Samir, you want to take a jab? Given the liquidity ahead, you think there could be a change in stance?
No, I agree with you, Lata. In fact, in the month of March itself, they injected 1.9 lakh crores proposed to inject 1.9 lakh crores of durable liquidity. So the March end number on durable liquidity will be in excess of 1 lakh crore itself. So that tells you that on paper, in fact, from durable liquidity standpoint, the stance has effectively changed. And given the dividend could be closer to 3 lakh crores, you are looking at a situation where durable liquidity remains in surplus for an elongated period of time. And that implies that effectively, from a durable standpoint, stance is accommodative.
Okay, could be accommodative. Then that makes for a sea change. Devang, now to you. By the time we come to April, it looks like the repo rate is going to be 6, and by the time we come to June, if you go by the votes here, it could even be 5.75, and then you're going to have a great deal of liquidity. So tell us, what do you see in terms of the 10-year in April itself, first in March end, then April, and then June?
Yeah, we believe that, so I agree with large part of the panelists and what you spoke across. In fact, we think so that now liquidity is going to remain surplus for most part of the second half of the year. So somewhere down the line with the liquidity and possible rate cuts, we believe that by March end, 10-year G-Sec yield should be close to 660, and getting into April to June quarter, it should trade between 640 to 650 levels. So that's our view on the on bonds. I just put across that, as I highlighted, I think because now we are looking at liquidity significantly in a surplus zone, I think somewhere down the line, the spread trades and the short-term bonds also will make a lot of sense. 3-year, 5-year corporate bonds today are available at 7.5, 760 levels. They will make a lot of sense getting into the next quarter, where you are looking at a 575 kind of an operative rate. The corporate bonds can't trade at such high elevated levels. So I think investors will have a lot of opportunities into the next quarter, and it's going to be a good quarter for bond markets.
Okay. Well, there are 2 points that emanate from what you are saying, Devang, that cost of capital is going to fall a lot. That will mean that corporates, we could see much better numbers in terms of growth. And the second point that we are not discussing is there is a big external unknown in terms of what happens on April 1st or April 2nd in terms of reciprocal tariffs. And then if there is, external imbalance or external threats, can the Reserve Bank be so loose in its policy? Will there be still some problems in terms of currency? Both those questions after a very short break. Welcome back to our special State of the Economy show. We've just been discussing The lower than expected CPI print that we have got for February, the print has come in at 3.61 against expectations of 3.85 and against an MPC target of 4%. We've also got an industrial output number, which is higher than expected at 5%. The CNBC poll was much lower than even 4%. Joining me, speaking to me on these issues were Aditi Nair of ICRA, Sameer Narang of ICICI, Devang Shah of Axis Mutual Fund and Radhika Rao of DBS. Ladies and gentlemen, thank you very much for your patience. Radhika, we also have a higher than expected IIP number at 5%, which we didn't discuss. And as all of you agreed, there is a clear lower cost of capital coming for corporates. So are you wanting to pencil in a higher growth number in the coming months?
Certainly. So IIP number has surprised on the upside. And if I caught the internals right, it seems to show buoyancy in the infra and construction sector as well as capital goods sector. Now, if that is the case, that is actually reflecting, to my mind, what is happening on the center's capex plans. After a lull of about 6 to 8 months, we've actually seen a sharp pickup, especially in December and January. And I think some of that is percolating through the headline. So certainly encouraging from that point of view. Consumer durables, non-durables, again, a bit lackluster. But overall, at the headline level, I think it bodes well. But at this point, I would think this is an assumption we have already made into our GDP numbers, that government's capex is going to be a point of support. Real purchasing power improving because of lower inflation is another point that we have already assumed. So I don't think that would justify a change in forecast as of now. And, just like Aditi mentioned, there's going to be a bit of a mathematical influence on the real GDP at the headline level. But really, at that point, we should look at the GVA for the, what's happening in terms of the momentum. So
no, I agree with you. No, GDP is a huge googly. But what is your, just the number, what are you standing at for the FY26 GDP? And I mean, you're not likely to change it. What is that number?
For FY26, we are looking at about 6.4%, and we have not changed that. For FY25, we are close to where the consensus is about 6.4, 6.5%.
Okay. Sameer, yeah, I get your point. Sameer, just wanted to highlight that the manufacturing number has come in at 5.5. That is the bulk of the IIP number. What is let down and come to 5 is electricity coming in at 2.4%, could be seasonal as well. And mining coming in at 4.4, but manufacturing coming at 5.5, and the April-January number is actually 4.2. So really this stands out. And as Radhika already pointed out, very good capex numbers. If you looked at both December and January, capex, infrastructure, consumer durables, all of them are running north of 7.5%. Your views on growth, both FY25, 26?
So, very true, Lata. January, great month. February, not so much. If you look at some of the high-frequency indicators, particularly retail sales for two-wheeler passenger vehicles was a bit soft. But electricity picked up in the month of Feb, so that was good news. Overall, mixed bag, I would say, in Feb. Jan was much better. And our number for Q4 is around 7%. That's a tad bit lower than what is implied in the CSO estimate. So overall for the year, our growth number is 6.3, and we see it going up to 6.5% next year, essentially driven by consumption push that has come from the budget.
0.3, you said, your GDP for next year?
No, next year is 6.5. This year is 6.3. But the Q4 ending is 7%.
I get that. Yeah, I'm hoping, of course, that will be a big fuel for the stock markets. Just the sight of the number 7. Aditi, your FY26 number?
So Lata, just to add to what Sameer said, for February 2025, unfortunately, the base effects are on the negative side because we had a leap month last year. So that's part of the reason that the high frequencies are looking duller than they were for the month of January. For FY25 as a whole, we're looking at a GDP growth of 6.3%, and FY26 we expect it to climb up to 6.5%.
Okay, so no one's going above 6.5. I can understand the global headwinds are serious, especially if there is a US recession. Final question to you, Devang. What is your year-end, December 31, 10-year number. If I heard you right, the lowest we will go to is 6.4?
Yes. So I think probably as everyone explained, I think growth is coming around 6.5%. So it is not somewhere that India is going to a significant down cycle. Yes, inflation is on a positive surprise, and for the near term, we don't see any kind of concerns on a significant uptick on inflation. Probably inflation should settle around 4%. With that perspective, I think RBI is looking at rate cuts. RBI has done a lot of quick fixes to liquidity. They have actually stabilized currencies, allowed currency to depreciate around 3-4% in the last 3 months. So our perspective is that if growth is getting a cushion, they probably might do a 25. And as you highlighted, because global headwinds still continue, they should not be significantly aggressive. So 25 is given, keep the liquidity comfortable and ensure credit growth and growth back to the economy. With all this context on the macro side, we don't see yields significantly falling below 640s, 45 levels. The only reason can be if for some reasons Bloomberg adds us to the indices, that it comes for review in September. And if they add us in the global aggregator index, then somewhere down the line, we get a 25-30 billion of flows. That can be the reason which leads to 10-year bond yields going below 640. Otherwise, our perspective is that 640, 6.5 is where we see 10-year yields going into this cycle.
Fair point. Thank you very much, Devang, for that explanation that, we cannot take the last rate cut, the third rate cut of this cycle for granted simply because we could be faced with global headwinds. We will have to wait and see on that, if it is a recession or is it, great turbulence because of reciprocal tariffs. But otherwise, the set of takeaways from today's numbers and the prognosis for the months seem fairly positive. Thank you very much, Aditi, Devang, Samir and Radhika for joining me in this conversation. Key takeaways on the state of the economy: inflation number lower than expected, and therefore the Reserve Bank may bring down the quarterly estimate. The Reserve Bank's estimate for Jan, Feb, March is 4.4. We may end up even south of 4. So that makes the April rate cut almost a given. The fact that there will be a Reserve Bank dividend in the third week of May also indicates liquidity will be plentiful, and therefore perhaps the third rate cut may not be in June, could get postponed given global headwinds. The important part is that the food inflation fear seems definitely out of the way, with the food inflation for February coming in way lower than January and even lower than the CNBC-TV18 poll, coming in at 3.75%, a number we have not seen in years. Maybe probably for 3 years we have not seen that kind of a low food inflation number. IIP number stronger than expected at 5%. But there the only color is, will that continue in February? As our experts pointed out, the two-wheeler sales, etc. for February are a little under the weather. So we have to wait and see. But nevertheless, with rate cuts, with so much of liquidity and rate cuts, the expectation is that growth should be good in FY26. That's it on this edition of State of the Economy. Thank you very much for watching. More news and updates are lined up for you.
Practice with at least the larger banks is to hedge their exposures with an external agency. Why wasn't IndusInd Bank doing this to begin with? And, specifically the September 2023 RBI circular does not deal with hedging per se. So we're still trying to understand, what led to the discovery of this change and the subsequent, despite appointing an external agency, delay in reporting this to exchanges and to investors at large.
No, Ritu, this was not a delay. We took a view that we should not be doing the internal deals and we should only go to the market hedge. And I think that is the call, and the circular clearly states that, and change the classification of our derivatives into what will go into hedge and what will go into mark to market. I think that's number one. Number two, in my opinion, there was no delay in reporting to the LODR. I think as soon as we discovered the number, the LODR. So as a process, we found that there may have been some gap, but very difficult to identify the gap. And as soon as we understood the gap, we immediately came into the LODR and reported the number. So if you think that we've hidden something, I don't think the bank has hidden any disclosure at this point of time.
Well, no, Mr. Katpalia, it's the markets that seem to believe there is a question when it comes to the credibility of the bank. And, I could recite several brokerage notes that talk about it, that, trust is very important for a bank. And because of this delayed disclosure, there is a lack of credibility, which is why you're seeing the kind of reaction we saw in the stock market, 20,000 crores of market cap wiped out in a day's trade. What will you say to these investors to allay their concerns that there will be no further shocks as well?
Ritu, I can only say that I think when the microfinance issue came in, it was really not an issue. And we actually, what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU, and you should see the growth that the bank is seeing and the profitability which the bank is used to.
Hello and welcome to News Center. I'm Parikshit Luthra. The top corporate story we are tracking this evening. India's top telecom operators, Jio Platforms and Airtel, have joined hands with Elon Musk's SpaceX to introduce Starlink internet services in India. Jio Platforms has proposed to offer Starlink solutions through its online and retail stores. Other than equipment, Jio also expressed willingness to provide installation, activation and customer support solutions to Starlink. Similarly, Airtel has proposed to offer Starlink equipment in its stores. Airtel has also proposed to explore how Starlink can use its network. Does Starlink make sense for India? The latest data by TRAI reveals that tele-density in urban India is at 131%, but for rural India, this number dropped to just 58%. For internet penetration, the number of those connected is pegged at 944 million. However, there are 3 regulatory hurdles that Starlink will need to cross. There are a few regulatory hurdles as well. The government has maintained that Starlink is yet to address security issues. Officials are open to granting a license after the security concerns are met. Starlink also requires authorization from space regulator InSpace. While it's in advanced stages, few issues still remain. Joining us now to take this forward are Akhilesh Tuteja, partner and national leader of technology, media and telecommunications at KPMG, and Varun Gupta, senior analyst at Counterpoint Research. Gentlemen, thank you very much for joining us. Let me go across to Akhilesh first. Akhilesh, when it comes to the tie-ups, the MOUs that both Jio and Airtel have signed with SpaceX, how are they different in terms of providing services to customers on the ground, bringing Starlink to India, and also helping them in installing Starlink's platforms such as their dish or their Wi-Fi router at customers' locations across the country?
Thank you so much, Parikshit. First of all, there is very little information available which one can really say is credible about a lot of things. But yes, the good news is that Starlink is going to be available in India, subject to all the clearances which you just talked about. And this kind of partnership allows us as a country to also propel forward, because when you have such 2 large platform and network providers like Airtel and Jio partnering with such an interesting technology like Starlink, it creates a lot of possibilities. So unlike any other player who would come into the market, set up the network, and will take time, I think this clearly gives a head start to Starlink to go accelerated path very soon. The key driver being that such a kind of satellite connectivity is required for a country like India to reach places where the traditional network cannot reach. I think we need a partnership which allows us to grow faster and get all the results soon. So I'm excited about it. And as you said, that this partnership allows Airtel and Jio platform to market, sell, service, and also install these customer equipment so that we can get the results faster.
All right. I would also like to ask you about how this really boosts our digital ecosystem. One thing is that this is satellite-based broadband, so you have consistent speeds and they can also support internet connectivity at the remotest corners of the country. So does this really help in improving our internet penetration?
Absolutely, it does. While it's a less understood fact that half of the world isn't really connected by the classic broadband connection. India is no different. We also have a fair bit of coverage left. Now, most of the broadband connection is much easier to do in dense cities and towns and all that, where lots of people live. But there are places where we do need network connectivity, but the tele-density is so low, it isn't really viable to set up classic networks in those places. So what a satellite type of technology allows, it allows us to reach every part of Earth and therefore every part of our country, which makes it transformational, because unlike the traditional network or the wired network, which I would say, you got to take time to lay cables, get there and provide connectivity. Here it is typically you just switch on and you're connected. So that's the one thing. I wouldn't really yet say that this is going to be the fastest and the best way to connect, because one is that the equipment cost is very different from the traditional broadband wireless and wired broadband connection. And also it has a very different type of threshold when it comes to connectivity speed. The traditional satellite, prior to this low Earth satellite which you're talking about, those traditional satellites suffered from the latency, which means that the wired network was faster or the broadband was faster if we looked at the classical satellites. But this Starlink and these kind of satellites which operate in low Earth orbit, they're actually much closer to Earth. They're much closer to Earth than the other satellite. And therefore, the time it takes for the data packet to go from Earth to the satellite and come back is much faster. But the second thing, which is actually quite...
Right. I'm going to come back to you very shortly, Akhilesh, but let me also go across to Varun Gupta at this point. Varun, how do you think this impacts competition in the Indian broadband space, especially with fiber broadband? Also in terms of pricing, the pricing of Starlink is likely to be higher than fiber services already available in the country. Could you give us some examples and the comparison?
Yeah, sure. Thank you, Parikshit. So I think in terms of the competition, if we talk about the fiber and the FWA space, which is currently the hot topic in the country right now, so we see that it won't affect the classical broadband connections or the classical broadband techniques, because those are designed to give the broadband connections to the urban areas which have the higher tele-density. However, this satellite broadband is more suited towards remote network areas, especially in the northern parts of our country and the northeastern parts of our country, where there is a upgrowing and upcoming a growing business economy. Small and medium businesses are also coming up over there, and there's a large user base after COVID that has moved to their hometowns, and they are doing their work from home over there, which will require this higher connectivity to do their businesses. And in terms of pricing, yes, I would agree that it could be slightly higher, because the cost of equipment right now, of course, it is as compared to the classical broadband connections of fiber and FWA, it will be higher than that, because it involves a dish antenna as well as a higher grade router with a higher antenna and higher gain RFFE system. So that would be costly. However, it would be good to see that how these operators will manage to subsidize this pricing. And we had a very similar chat with the FWA as well. Over there, the cost of that equipment was very high. However, Jio was able to subsidize that along in their pricing. And we would also like to see that how Jio and Airtel would like to subsidize this equipment cost within the planned pricing, because that will be crucial for this satellite broadband to propagate further. Otherwise, the consumers won't actually accept that if it is very high priced.
Right, that's an important point. Let me go back to Akhilesh at this point. Akhilesh, there are clear regulatory hurdles which need to be crossed, and both the press releases from Jio and Airtel say that this MOU, the implementation is subject to SpaceX getting authorization in the US to provide satellite-based services in India as well. Considering all of this happens, how much time do you expect for Starlink services to actually reach India? And what's going to be the cost to Airtel and Jio for subsidizing such services, as Varun is also pointing out?
You pointed a hard question at me. It's very hard to determine the exact time frame. But I would say that there is a desire to kind of get it done faster. And we all know the situation right now in the US and in India is getting more and more friendlier. So from that perspective, I would think it should be faster than what it would have been otherwise. But clearly, these clearances require several considerations. There are considerations around security, because as we have seen with any large-scale new technology which gets developed in markets like US, they would like to have the ability to manage and control in terms of how it gets used in other parts of the world. Satellite as technology is far pervasive. It is one of the most powerful technologies available, and therefore I think those considerations will come. And then the third one is also about this whole thing about how does it interconnect with the regulatory ecosystem in India as well as US. So those are the considerations, but I'm hopeful. When it comes to cost, it is going to be not so significant in my view, because while the equipment costs much more right now, but over time it is likely to get significantly lower as the scale increases, not just in India and other parts of the world. And one of the things which I do want to highlight, very interesting about the Starlink technology, is in the past, even the satellite communication required the data to jump back to the Earth station. And the new technology Starlink allows it to have satellite-to-satellite communication. And therefore, you are able to reach with lower latency, high data transfer rate, and also relatively lower cost. So this is definitely a better and much improved situation from what we have seen in the SATCOM before.
Right. And Varun, coming to you, what does this really mean for the Indian consumer in terms of the options that he will have available in the India market? And how will this be a compelling offering to the Indian consumer?
Right. So I think in terms of the offering, definitely for the Indian consumer, it is going to be a plethora of option now. Now we have fiber, fixed wireless access, and hopefully in future, the satellite broadband. So in that matter, it will be increasing the competition, and that will definitely reduce the cost of acquisition as well as the cost of plan to the consumer. And one interesting point I want to highlight over here is that with this partnership with Jio and Airtel, Starlink will be able to offer this satellite broadband connectivity at par with the fiber and FWA offerings. That is the bundling of OTT services with the hybrid set-top boxes that these players are already doing with the other services. So in that matter, it makes the offering very compelling to the Indian consumers, because now they will have equal options of getting a satellite connection or a fiber or a FWA connection. And definitely, as Sir mentioned, that it is the latency has come down. So the performance has also increased for the satellite broadband connectivity. And this will help the user to go for the right choice for their offering.
Right. Akhilesh, my final question to you. Now, when we look at the competition in this space, there is, of course, competition from OneWeb, which has a tie-up with Airtel, Amazon, Uxnet, Viasat. How do you think the space is going to evolve in the next few months? And for the success of this venture, what are some of the facts that will be actually necessary? And when we speak about high-speed internet, how is the consumer going to benefit over the plans already available in the India market?
Sure. So the first good news is that there are more players in SATCOM than what we have ever seen before. So when I see more choices, it allows us to have more power in the hands of consumer, relatively low cost services, flexibility, and also the speed of growth of innovation. As I mentioned earlier, that the old technologies like Inmarsat and others, where it used to connect a phone to the satellite, it's very different. So it's connecting to a CPE or customer equipment to the internet, which kind of changes the game substantially in terms of allowing multiple access. Also, as I mentioned, that this new Starlink has the ability to do satellite-to-satellite laser-based communication. I think many other companies will catch up to that, and they will even take it further. So to me, like any other industry which is in a growth stage, it is important to have more players, more choices, and which is what we are seeing here. And therefore, I see this competition as a positive move. When it comes to for the consumer, I think right now my hope will be that it allows us to do things which we have not been able to do before, which is basically taking us to uncovered areas. So that would be my first desire, hope, and thing. And then to the other urban users like us, I think it will provide a very different level of connectivity, but that's not something which I'm looking at in tomorrow morning short-term kind of thing. But that will also happen and will provide a lot more different use cases than what we have seen here before, providing us much deeper penetration and connectivity at a very different price point and with different kind of technologies.
Right. Akhilesh Suteja, thank you very much for joining us, and Varun Gupta as well. We take a break at this point, but lots more on the other side. US tariffs on steel and aluminium exports come into effect from today. China has vowed to take all necessary actions in retaliation. Let's see what happens in the days to come. We will be speaking to Jonathan Cheng, the China Bureau Chief at the Wall Street Journal, up next.
There was a cyber attack on X today, which shut it down and may have been foreign sourced.
Yes.
It's a big story. You want to give us a moment on that?
Well, we're not sure exactly what happened, but there was a massive cyber attack to try to bring down the X system with IP addresses originating in the Ukraine area.
Welcome back. Let's now turn the spotlight on Trump's trade war. US President's 25% tariffs on all steel and aluminium imports into the country took effect today. The European Union retaliated with the move, which affects $28 billion worth of EU exports into the US. The countermeasures will come into effect in April. India's Steel Secretary Sandeep Pondrek has said that the duties won't impact the country much as it exports less than 1 lakh tons of steel to the US. China also responded to the tariffs, saying it will resolutely counter the measures. The Chinese Foreign Ministry has said that the move has violated World Trade Organization rules. America imports very little steel from China directly. Trump has already imposed a 20% across-the-board tariff on Chinese imports. The US president had cited Beijing's alleged failure to curb the export of fentanyl to the US to justify the tariff levy. Beijing hit back soon after, with tariffs on 10 to 15% on numerous US agricultural goods. The tariffs went into effect on Monday. Last month, China had announced a 10% tariff on crude oil and a 15% levy on coal and LNG. So how will Beijing respond now? To take this forward, I'm now joined by the Wall Street Journal's China Bureau Chief, Jonathan Cheng. Thank you very much for joining us, Jonathan. To today, the Foreign Ministry spokesperson in China has said that China will use all possible measures to retaliate against the 25% tariff on steel and aluminium imports into the US. The tariffs were already there on China, so this is going to be over and above. What are some of the steps that you're expecting the Chinese government to take in the days to come?
That's a great question, and I think some in Beijing are probably asking themselves that very same question. Of course, there are a lot of tools that China can use. They've shown off some of them already, regulatory measures against U.S. companies, raising tariffs on, of course, things that they import from the U.S. But I think the real question is not what can they do? The question is what should they do? What pace of response should they have? Because obviously, we may just be in the early rounds of this tariff war, and you don't want to use all your ammunition so quickly. So I think that's the difficult part here, is figuring out where we are in the ladder of escalation. It's also interesting because when we saw the first round of additional 10% tariffs on all Chinese exports to the U.S., that was just a few weeks ago. China was the only country targeted there. In this case, it's not China that's being targeted in particular, but China is getting hit like everybody else. As you mentioned, the EU has responded. So I think China just really needs to calibrate what their response is going to be.
Right. What I'd also like to ask you is, how does this change China's position as the largest producer of steel in the global supply chain?
Yeah, no, I mean, it's a big question. I mean, China has relied on steel to help prop up its economy. Obviously, if you look more broadly at the Chinese economy, they have a lot of issues. Property is one big piece of that. And steel, of course, would have fed a lot of the apartment buildings and towers that are no longer going up or are not going up as quite as quick a pace. Of course, like every other country, China needs to think about employment. They have to think about their population and how they're going to feed themselves and what their level of satisfaction with the government is. So they do need to talk tough. They do need to show that they're responsive. But again, I think the big question really is, how do they send a message back when you know that this is just, I mean, this is the third hit that China has taken so far in just the last few months, but there may be a long road ahead. I mean, Donald Trump said on the campaign trail that he was looking at tariffs of 60% on all Chinese goods. So you're only about a third of the way there. You don't want to use it all. And I think the other thing is we've reported that Xi Jinping and Donald Trump are talking, or their people are talking about a potential summit. If they do have a summit meeting, of course, you're going to expect a lot of horse trading, a lot of negotiations behind the scenes, and this is probably part of it. So it's a complex calculation. I don't think that they're going to just do something reflexively, because it does need to feed into all these other larger considerations.
Right. Jonathan, we also hear that it's quite possible that US and China will reach an agreement, a deal very soon. When do you expect that summit to happen?
Well, we've reported that it could be in June, and the reason why is Donald Trump and Xi Jinping's birthdays are separated by just one day. I mean, they're 7 years apart, but I believe it's June 14th and 15th. So that is one idea that's being bandied about. Of course, things can change. There's a negotiation about the negotiations. It's possible that one side or the other will want to have the summit come sooner, because you don't want this situation to drag on. On the other hand, I mean, when you compare it with Trump's first term, I think, you know, China here is very much in the same boat as many other countries. I mean, in the first trade war, it really was targeting China, but now you have traditional allies of the U.S., neighbors of the U.S. that are being targeted. And so there may be a different strategy here as China maybe says, well, maybe we have an advantage here. We can work with Canada, Mexico. I don't know what exactly they're thinking about, but there are a lot of things that both sides want from the other. And so we'll see whether or not a deal can materialize.
Right. And finally, if we were to ask you about what's happened with Walmart, there have been reports that many American companies are seeking lower prices from Chinese suppliers in the context of tariffs that the US is imposing worldwide and also on China. There have been some reports that Chinese government officials called Walmart officials for a meeting to discuss this. Could you give us a sense of what's happening, what was conveyed to Walmart, what was the nature of the meeting?
Sure, yeah. I mean, this was reported in Chinese state media, so that is quite official. I think what happens is when you have the Trump administration slapping tariffs now of an additional 20% on all Chinese exports to the U.S., somebody needs to pay that. Of course, the importers will pay that to the U.S. government, but at the same time, they're either going to have to swallow the extra cost, take the hit to the profit margin, or they're going to have to pass it along to the consumers, or they're going to try to force the exporters to take some of it. So I think what China's responding to here is that when you have a company as big as Walmart, when they make orders for products, for goods from China, they have a lot of bargaining power. In the same way that the U.S. on a national level has a lot of bargaining power, has a lot of power to basically throw its weight around. And so if you have Walmart trying to protect its margins as well as not pass along costs to its consumers in the U.S., then the only place where that is going to manifest itself is on the Chinese exporters. So our understanding is that indeed Walmart, Target, Sam's Club, some of these big U.S. retailers are trying to do this and ask their Chinese suppliers to basically not raise prices on them or even to cut prices. And I think China here is stepping in and saying, you can't have your government bully us with these exports or with these tariffs and then also have your companies try and push the cost of that onto us. So there's dynamics happening at every level here, and I think it remains to be seen how this will all play out. But certainly the tariffs that have now been imposed are putting a lot of strain on this global supply chain and on a lot of the way that global commerce has been done for the last 20, 30 years.
Right. Jonathan Cheng, thank you so much for joining us here on CNBC-TV18, giving us your view on the tariff wars and China's reaction to U.S. tariffs that came into effect on steel and aluminium today. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
They're setting fire to various Tesla charging stations near Boston. Shots were fired at a Tesla dealership in Oregon. Various nonviolent...
Shots fired, not a metaphor.
Shots fired, yes. Downtown New York, marching against the Tesla showroom. Your stock is way down. You've been criticized left and right.
But look on the bright side.
I mean, why are you doing this?
Always look on the bright side of life.
Yes. And you're on it.
Yeah. I mean, just like I said, the goal here is let's not have America go bankrupt with waste and fraud. So that's what I'm here for.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, on this program over the last year or so, you would have heard a lot of experts, a lot of personal finance pundits come and tell you that asset allocation is crucial. Now, let's face it, when the equity market is roaring, we rarely give enough importance to that advice. But the last 6 odd months have taught us the importance of asset allocation. When you see equity struggling, you see your NAV is down in the equity funds, but you realize that gold has been shining, or even some debt funds could have been outperforming. So asset allocation is important. The question is, how do we do it in our portfolios? Well, joining me to answer this are Mohit Gang, who's of course founder and CEO at Moneyfront. And today I have also with me Ihab Dalwai, Senior Fund Manager at ICICI Prudential AMC. And Ihab manages ICICI Pru's multi-asset allocation fund, among others. Gentlemen, thank you very much for joining us on the show. So I'll open with you, and I'm sure today people will listen to both of you more carefully, because otherwise this asset allocation gyan, as it's called, sometimes, in a roaring bull market, people don't want to pay too much attention. So Mohit, opening thoughts with you.
Thank you so much, Surabhi. Always a pleasure to be on your show. Look, I think for ages, portfolio managers, asset managers, and we wealth managers have been crying hoarse that perhaps the best thing to do for a client is to have good balance between equity, fixed income, commodities, and maybe a few other assets, depending on the profile, right? It's oft ignored, as you rightly said, because of the market movements. Once you get carried off in a market frenzy, then you typically tend to ignore the basic fundamental principles, the 101 of finance. But if you watch the data for last 6 months, 1 year carefully, and maybe even on a longer time frame, you'll realize that if an investor had a proper mix, a proper dilution between equities, debt funds, commodity funds, which is gold and silver, the returns would have been far, far superior. The moot point here is risk-adjusted return. So for a lesser unit of risk, or for a much balanced unit of risk, you get perhaps higher returns, or you get almost equivalent returns from just holding a pure play equity portfolio. So were you in 100% equity versus you were in a 60-40, 65-35, or a debt equity portfolio, or a 50-30-20 equity, debt, commodities kind of a portfolio, your returns would have been much superior in last 6 months to last 1 year. And risk adjusted, you would have slept very, very peacefully.
Oh, absolutely. And I think we'll just pull up some of the data points there. If we can drop the comparison of asset classes per se, the Nifty 50 has obviously corrected. The Nifty 100 has corrected even more. But the reason we've picked up some of those other funds is to give you a flavor or an indication of how other asset classes have done. That's the CRISIL Hybrid Fund, which has a mix of 35-65 equity and debt. And as we can see, on a 6-month basis, it's fallen less than equities. On a 1-year basis, also it's an outperformer. And if you look at gold and silver, Edelweiss is just an example. We picked up one AMC as an example, but because of the way precious metals have rallied, look at the returns for that fund: 31% versus 1% on the Nifty. So they say the market is the best teacher, and the market has definitely taught us that lesson in the last 1 year. Ihab, come in on this. But, if I could argue from the investor side, sometimes it's also confusing, because all you folk also say that when we are young, when we are earning, especially young investors, they should load up on equity in a big way. And maybe that's another reason why people tend to ignore. When you're young, you don't want to think fixed income or debt or too much diversification. So how would you approach it?
Yeah. So see, basically it's important to understand how these asset classes have performed over a long-term period. And if you look at last 10 years data as well, so debt has come out as a winner 2 out of 10 times. Equity has come out as a winner 3 out of 4 times, 4 times out of 10 times. And similarly, gold as an asset class has come out as a winner. So it is important for us to understand that these each of these asset classes perform differently in the different phases of the market. So for us, it's important to understand what is the outlook for each of these asset classes and how we should allocate them in a balanced portfolio. So obviously, over a long-term period, equity tends to do well versus most of the other asset classes. But when equities tend to do well, it is to some extent important to do some profit booking and shift to the other asset classes, because there have been historical precedents that these asset classes also do well versus equity.
Yeah. And now I guess, Mohit, the numbers are telling us that story, right? Equity has been struggling, but gold completely shot up. Yeah. So, okay, fine. Point taken. We need to have diversification and separate asset classes in our portfolio. Now, where do we begin? I mean, there is the simple get a hybrid fund approach. There's also maybe I'll do my own equity funds. I'll add my own debt funds. What would you advocate?
Surabhi, I think it totally depends on the profile of the investor. If you are an investor who's kind of involved in your portfolio, who understands the nuances of the markets a little bit, who understands the different kind of asset classes, what does each asset class entail in terms of risk and rewards, right? Then perhaps the better approach is to determine your asset allocation yourself or by sitting alongside a financial advisor, right? So there you can decide whether a 50% equity composition or a 65% equity composition is good for you, and simultaneously also decide what kind of debt and commodities composition you want. And depending on what your objective, financial goals, risk profile, other things are, you kind of allocate assets accordingly into pure play categories, which means a pure play equity allocation, a pure play fixed income allocation, and a pure commodities allocation, which could be a debt, which could be a combination of gold and silver or whatever, right? So that's, to my mind, the best and the right approach, which also requires one to be being involved in the portfolio. If you're a little hands-off investor, you don't want to get into the nitty-gritties of asset allocation yourself, don't want to study so much, don't want to determine the right choice, right mix, and the reshuffling between these, which is the most critical part, which is often ignored, and often the retail investors can't do that, is the reshuffling between these three asset classes. Then perhaps you say, okay, I am just putting my hands up and I'm giving it to better money managers and fund managers and professional advisors, and then taking cushion in hybrid funds, in balanced advantage funds, in multi-asset funds, which will give you the best of all the worlds. And perhaps the good part is managed by professional fund managers and systematically managed with discipline and with proper research, good allocation mixes, and which keeps changing timely, right? So you get best of everything, and you can just, again, as I said, just be peaceful.
Absolutely. Leave it to the experts, so to speak.
Absolutely.
Ihab, what would you say? Because as an asset manager, you offer both options. Someone can come and individually pick debt funds that iPru offers along with equity funds, or maybe even, you know, a gold fund. Or you can go for some of these composite products, for instance, balanced advantage funds or a multi-asset fund. Personally, what approach do you think is right for a retail investor?
So generally, if an investor is a bit confused in which asset class one has to invest in, I think the easy way out is to just invest lump sum in these hybrid schemes, because ultimately, like Mohit suggested, was that it is for us to determine what allocation we have to do for each of these asset classes. And it's important to understand that these asset classes will perform differently in different phases of the market, like I mentioned earlier. So I would still suggest that hybrid schemes is a better way of doing it, because an individual will find it a bit difficult to determine which asset class is expected to do well in the near term. So I think it's best left to the professionals to determine that. And one more point I wanted to highlight was that it's more cost efficient for an individual to do it through the hybrid schemes versus to do it at an individual level, because the reallocation or the calibration which we would be doing across these asset classes, I think it's more cost efficient in the hybrid scheme versus doing it at an individual level.
Oh, fair enough, yeah, because every time you are selling and moving some money to a different asset class, you'll have to deal with the capital gains tax, whether you're shifting from debt to equity or equity to debt. Got that point? Point well taken. So hybrids are the way to go. But now hybrids as a universe is a fairly complex universe, Mohit. I mean, it's not an easy, world out there. Absolutely. I might argue that it's even more difficult than picking a, mid cap or a small cap, where the definitions are absolutely watertight. So within hybrids, just revise the universe for us, what our options are, and then what should be the first parameter? When I'm thinking of, getting into a hybrid fund, what's the first filter that I should apply?
It's a massive category. It's a quagmire of funds out there. You have hybrid, you have balanced advantage, you have dynamic asset allocation, and you have multi-asset, right? I hope I have not missed anything, but yeah, to my mind, I think those are four broad-based categories. The first things which an investor needs to know is what allocation does he want in equity and debt. What is the kind of allocation he's looking for? What are his long-term objectives? What are his long-term financial goals? And how much risk is he willing to take? So he has to be very comfortable as to, let's say, if I'm investing for 1 or 2 years, or I'm investing for 5-7 years. That's number one. Whether I'm okay to go with a slightly aggressive tilt within the asset allocation model itself, or I'm wanting to keep it low profile, conservative, very less equity oriented kind of a thing, right? So you need to answer these 2 or 3 questions, basis which you will determine what kind of allocation do you want. So I could be an investor. I say no, at every point in time, I need to have a fixed allocation between equity and debt, and that allocation will be more in favor of debt. So
Okay.
then I go for a conservative hybrid fund,
Okay.
where the allocation is broadly streamlined, that equity won't cross 25% and the remaining portion will be debt.
That's a conservative hybrid
That's a
fund.
conservative
Okay.
hybrid fund.
Okay.
Then you have a moderate hybrid fund and you have an aggressive hybrid fund. But the allocations between equity and debt are fairly stable. It doesn't change too highly or rapidly. But I'm an investor who say I want to also make use of market movements. I want to shift between equity and debt and let the fund manager take that liberty to move the allocations. Then I'll perhaps go for a balanced advantage.
Which is dynamic asset allocation.
Which is dynamic asset allocation, where the fund manager, now each fund manager will have their own criteria. I think for Pru ICSI, perhaps it could be a price to earnings and price to book value kind of a model, which they follow in Pru Balanced Advantage Fund. And where they will dynamically determine as to what portion of money has to be kept in equity and what portion in debt. And they will keep shifting between the allocations. So if the markets go up frantically, they will reduce equity and increase debt. If the markets are falling, which is the current scenario, they might perhaps be increasing equity allocations in their portfolio and reducing debt, right, to make use of the market movement. So that's been a time-tested, proven methodology. There could be a third approach where an investor says, I want the best of all worlds, not just equity and debt. I want a flavor of commodities. Maybe I want a little international. I want REITs and InvITs in my portfolio. Then perhaps the best way, which is to go as a multi-asset fund, where you will have equity, you will have debt, you will have commodities to the tune of around minimum 10%, which can go up to 20-25%. Some portion of REITs, InvITs. Sometimes some funds do take international investing also as an option. But it gives you a comprehensive world of investing just packed in one single fund.
So again, lots of
yes.
options. You need to know what you want.
Absolutely.
What is it that you're after, and more importantly, how much risk can you stomach? Ehab, on this very point, and we'll go through these individual categories specifically. But you know, overall, let's get the low risk investor out of the way first. Anyone who's low risk, who's not getting into a hybrid fund for high returns. Maybe you know, he or she is retired, or maybe just generally they don't want too much risk. Then what is the category of hybrids? What type of hybrid funds would be suitable for them?
So like Mohit also mentioned, for me as well, I think the risk grading is such that BAF or MAF, and the first is obviously ESF, like you said, it is a lower end of, in terms of risk profiling, it is on the lower side. But if someone wants to take some slightly more risk and is looking at hybrid as a strategy, BAF, MAF, aggressive hybrid, and also there is an asset allocation fund through a fund of fund route also is something one can consider. But my preferred choices have always been a dynamically managed asset allocation, because I feel that, like I mentioned at the start, is that each of these asset classes perform differently, are volatile. So if you have a dynamic model, back-tested model, which has succeeded over a period of time, you can gain out of the volatility and try to generate returns or alpha through the volatility. So my preference would be a dynamically managed fund, maybe a balanced advantage fund or a multi-asset fund.
Okay, so multi-asset or balanced advantage. Got that. That is Ehab's pick. We'll take a break, but we dive a little deeper. Now we've understood that BAFs, as they are called, balanced advantage funds, or MAFs, as they're called, multi-asset funds, they're good funds and they can help you across multiple asset classes. But how do you pick one fund in these categories? Back with that in just a bit.
Let's talk money. worry today, Sabya, that we are at a point which is almost an existential crisis for a whole host of arts and artisans across this country. I mean, you were talking about the fact that this shouldn't be treated like a charity. It shouldn't be treated like a CSR project. What kind of interventions do you believe we need at this point in time to ensure that we keep this soft power alive?
You know, we don't need to do much because evolution will take care of itself. Because I'll tell you, so we were at the age of influence, which is moving into the age of intelligence. AI is going to come in. And I personally think that AI in many sectors, especially in performing arts and art, will be very short-lived. Because after the age of intelligence will come the age of wisdom. And when the age of wisdom comes in and people realize that the greatest gift to humanity is humans themselves, and we should not robotize our existence so much that we forget to be human beings, then people will realize that art and craft is going to be the most important expression of humanity. We don't have to do much. Evolution will take care of itself.
We certainly hope so. Speaking of the dynamics changing, and you were talking about the consumer and the consumer being your biggest influencers, so to speak. You know, the Sabya bride, you kind of turned that on its head, right? I mean, the Indian brides were always coy, demure, shy. There was almost this invisibilization, and you kind of turned that around completely. How did that happen? I mean, was this because of the influence of the strong women in your life? You know, what was it that you were trying to tell by way of attempting to sort of turn this on its head?
See, I don't really understand gender inequality because in my head it doesn't exist. You know, I've been raised by, you know, thank you. And you know, sometimes I tell that, you know, the problem with gender inequality actually starts with bad parenting. Because I think if you raise your boys to believe that they're not better than women, but they're equal to women, I think men will be far more sensitive to gender parity than they are today. And, you know, I have grown up with women who I've looked up to. You know, my friends growing up, my girlfriends growing up, they were very strong women, and you know, I was in awe of them. And let's talk about the bridal market, for instance. You know, so I'll tell you a small story. So I meet a lot of women in India, mothers in India, who believe that I can matchmake for their daughters. And
can you?
No, no, I don't even have a social life.
About the consumer, not just the Indian consumer, but also the global consumer that you're hoping to tap into now, Sabya. What's changed? You talked about social media. You talked about the world of influencers and content creators and how that's also shaping the choices that consumers make. In your experience, as someone who understands the fashion industry, as someone who's been part of the fashion industry, what's the big change that you're seeing in terms of consumption and consumer behavior today?
I think self-confidence and self-expression.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are talking about hybrid funds and why you probably definitely need to have them in your portfolio. Asset allocation is key. Mohit is with me in the studios, and Ihab of ICICI Pru is with us, joining in remotely today. So, gentlemen, like we've now sort of established the broad categories and the big popular ones as well, before I talk about balanced advantage or the multi-asset allocation funds, very quickly, Mohit, is there any reason for a low-risk investor, maybe a retiree, maybe someone who doesn't want to take aggressive bets in the market, is there any reason for such an investor to consider conservative hybrid funds? Wouldn't they just be better off in a fixed deposit in that case?
Look, Surabhi, I firmly believe that if you're a conservative, very conservative investor, you should try and seek some portion of your allocation into equity savings category or conservative hybrid category. Okay. Now, both these categories suffice different needs. So if you're into equity savings category, the pure equity composition can vary between 15 to 25% odd. Okay. But the remaining composition is arbitrage to take the overall composition of equity above 65, which is the taxation limit. And the remaining
so
composition
the total, this is really important. I'm going over this again. So the total equity exposure becomes 65% in the equity savings category.
Absolutely.
So you actually get the benefit of equity taxation.
You get equity taxation, which makes it highly effective as a category.
But it's a safe category of funds.
It's a broadly safer category because you are into predominantly arbitrage and debt portion. The pure equity portion is hardly 10 to 15%. Again, it varies between fund house to fund house, but yes, it's a predominantly a very, very safe category and gives you equity advantage as in form of taxation. The conservative hybrid category will have equity composition between 10 to 25% and the remaining portion is debt.
Fully debt.
Yeah, this is more for an investor who's still looking at a 3 to 5 year kind of a view and who wants some element of capital protection built in by virtue of a large debt allocation, but a little kicker of equity. Just a little upside out there.
All right, got it. Makes perfect sense. Now, equity savings, that's a good one to look at because it's tax efficient and it's relatively safe returns, perhaps stable returns. Got it. Now, Ihab, I want to move to your favorite category, which is dynamic asset allocation, where the fund manager has the flexibility, the asset manager, to decide how much equity, how much debt, how much commodities, etc. Right? So let's start with first, BAFs, balanced advantage funds. Now, all BAFs are not similar, right? Different mutual fund houses have their different criteria in terms of what is the algorithm, how much should be equity, when should it be rebalanced. So in general, what are the industry practices and how should I, as an investor, pick the right BAF?
Correct. So see, broadly, the method of managing the net equity level can be classified into two halves. One can adopt a counter-cyclical approach. That is, as and when market is correcting, your net equity rises. There may be few products which have adopted a momentum approach where, like, as market falls, you try to reduce your net equity level. So I think the thought process which I like is a counter-cyclical approach because it helps you average out better as market keeps correcting, you keep increasing your net equity, and as market does well, you do some profit booking, you reduce your net equity level, and you shift to the other asset classes. So these are like broadly two basic methods of maneuvering your net equity level. Having said that, there can be the frequency of change can also vary. So there can be a daily rebalancing which is done and which can be a gradual increase or decrease. At times you can see a sharp reduction or sharp increase in your net equity level. Few products may follow that process. I think the preferred choice is a gradual method of increasing or decreasing net equity. So broadly, these are the two differences, but I feel most of them would be under the equity taxation, at least in the balance advantage fund, meaning that the gross would be at 65%. But the net can vary. So for example, it can go as low as 30% net equity, can go as high as 80% or even higher. So the variation can be quite high in terms of the net equity level.
Okay, so it could be very, very different. Mohit, let me ask you. I mean, so like I said, not all BAFs are equal.
Yeah.
So how do you pick and choose?
Look, I think broadly the style of picking, I think, is highlighted pretty well on that front. My choice still, Surbhi, would be a multi-asset fund for investors, basically, because they get the best of all the worlds, right? So I firmly believe in that approach that one size doesn't fit all, right? So you need to have some commodities in the portfolio to give it a good texture. We have seen at the start of our conversation today that how a little element of gold and silver could have really propped up your portfolio in terms of last 1 year, 6 month kind of returns. So a multi-asset gives you commodities, it gives you some element of REIT InvITs, it gives you some element of debt. And then it always will try and keep your equity between 50 to 65%. Again, you will have to select a fund depending on your choice as to what kind of equity do you want in your overall portfolio. If you want a slightly aggressive tilt, you will have to go with a 65 and above kind of equity. If you want a little moderate tilt, then you go with a lesser equity composition and higher debt and commodities.
But this is not static, right? I mean, if you pick a multi-asset fund, which right now might be having a higher equity exposure, but that could change when the fund manager feels the cycle has turned.
Absolutely, and that's the beauty of it all, right? The captain and the selector of the team will have to decide whether they want Varun Chakravarti or they want a pacer, right? Depending on the pitch and the market mood. So if they want to go 10% in commodities, which is the minimum stipulated regulatory level, they can. Or they can go 30-40% in commodities and reduce equity. It all depends on how dynamically the fund manager is doing.
So as a mutual fund investor, what should I look for? I should back the the fund manager who I feel is more adept, or because I can't stick to that. I want a MAF with at least 50% equity exposure, because that is not cast in stone, right?
I think the philosophy of the fund house or the fund manager will have to be understood before investing. Broadly, they will tell you that this is how we look at it and this is the range within which we can move. We will make aggressive movements, or sometimes the fund houses will tell you that, okay, no, we will always at all points in time keep 50% and above equity, right? So depending on that philosophy, you'll have to go, and you'll also have to see past record of asset allocation as to how they dynamically have they moved between the categories. Have they really shuffled across, or they've just kept a very static composition going?
That's a lot of hard work. So why don't you do it for us? We're almost out of time. So let's end this by asking you the most important question for all, which is the best hybrid funds to consider, including in the portfolio.
Look, if I have to choose a balanced advantage fund, I will go with Yahab's choice, which is a counter-cyclical choice, which is a true balanced advantage. If I have to go a slightly more technical choice out there, I'll go with an Edelweiss balanced advantage. On the multi-asset side, I'll go with a UTI multi-asset fund. If I want a very conservative multi-asset, I go with a DSP multi-asset. Or if I want a very broad platter of things involved, I go with a Nippon multi-asset fund.
Just quick reasoning on your multi-asset choices. Why that order?
No, it's not. It's in no particular order. It's just as to how I recall the names, basically. So I think UTI has a good composition of commodities. The performance has really stacked up, and they have shuffled the allocation fairly neatly. Same goes with Nippon. They have some element of REITs and InvITs also in their portfolio. The broad mix is pretty nice, right? DSP, because they are a little conservative in their overall approach on the multi-asset side. Their equity is not very high. So if you want a little conservative tilt on your multi-asset side, then you go with DSP.
Okay, all right. That's a quick crash course. We have lots of questions, but unfortunately, we're out of time. I mean, these are very technical aspects of, hybrid funds that we need to consider. But it's a start, at least. I think something for investors to think about. Thank you very much, Yahab, for joining us. And thank you, Mohit, for dropping in and explaining some of these very interesting funds to us as well. Well, with that, we're out of time on this edition of Let's Talk Money. Thank you very much for joining in. Keep sending us your queries and keep telling us what more do you want to know about. We'll take up that issue as a theme on the show in the coming weeks. Thank you for watching.
Let's Talk Money.
Truth be told, and I've said this in many forums, that fashion has made a lot of money by feeding on people's insecurities. So the more insecure you kept your consumer, the more they wanted to buy your product because they wanted to feel good about themselves. But what fashion didn't realize for the longest time, that the consumer was getting smarter and sharper. And anyways, I think the Indian consumer is probably the smartest consumer in the world. And, I think that when you have and also at a time, a lot of luxury goods were consumed by the idle rich. Today, if you look at the people who are really buying luxury in India, everybody's working, nobody has time, everybody's self-reliant, everybody has self-confidence, everybody has self-expression. And, then the consumer shifts from being brand supreme to product supreme. A consumer just wants to buy the right product, not the right brand. And at Sabyasachi, we want to get the product right. Whether the brand becomes a super brand or not, it's an outcome of the product, not the brand. And I think globally, when the consumer is going to now realize that that luxury is based on rarity, craftsmanship, authenticity, and provenance, where else can you find a luxury product more unique than what you would find in India? So I think whether people, no matter what happens, no matter how much artfully the spin doctors and the global markets try to dominate India, they can't put India in a corner because it's just not going to be possible because the consumers won't let them.
Here today, what globally, and I did address that in the remarks that I made early on. There's this talk about the tyranny of diversity and inclusion. Do you worry that we're likely to see a pullback, a retreat from some of these issues that require urgent intervention and action?
So thanks, Shireen. I think firstly, Shireen, the minute you combine diversity and inclusion together, I think the likelihood of pullback is very, very low. Because what that says is that we're going to get in people who are different, gender being one of the ways you can get in people who are different, and make sure that they feel included in an organization enough to be able to stay and progress. So I'm really glad that you combined the two words together, because the concern really is, and if I may, to your point, the concern on putting targets is that it signals, whether you mean it to signal or not, that you are willing to compromise on meritocracy. And I don't think there is any woman in this room or anywhere else who wants us a
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Indian equities end with minor losses after a healthy intraday recovery raises most early losses. Sensex and Nifty both close around 0.1% lower, but Nifty Bank gains nearly 0.5% as financial counters find their stride. Equity mutual fund inflows take a 26% hit in February amid the market sell-off. Net inflows into mid and small cap funds see a bigger dip. Steady SIP inflows, the sole silver lining. Elon Musk SpaceX ties up with both Jio platforms and Bharti Airtel individually to offer Starlink's broadband services in India. Telecom department sources say Starlink is yet to comply with the prescribed security norms to qualify for a license. US government's 25% tariffs on steel and aluminium imports come into effect from today. The European Union announces retaliatory tariff, says levies will take effect from April and target US products including bourbon, whiskey boats and motorcycles. The White House also pauses its plan to charge an additional 25% levy on metal imports from Canada. Banks conclude sale of Jayaprakash Associates loans to the National Asset Reconstruction Company for 12,000 crore rupees. 25 banks, including SBI, ICICI Bank and Axis Bank, to collectively get 1,800 crores upfront and the remaining as security receipts. India is Blackstone's best performing market globally with gross returns of 40%, says founder and CEO Stephen. Adds the PE firm's assets under management could double to $100 billion in the future. Also says rising global tariffs are a short-term issue that will stabilize over time. That's a money control exclusive. Ukraine agrees to a 30-day ceasefire in the ongoing war. Russia launches an air attack on Kyiv hours after Ukraine's declaration. USA says that the ball is now in Russia's court, says that it will lift the pause on intelligence sharing and resume military aid to Ukraine. Kremlin says it is waiting for America to inform them about Ukraine's proposal. Pakistan security forces claim that 190 hostages have been freed in the train siege as rescue operations entered day 2. 30 militants belonging to the Baloch Liberation Army have been killed so far. The militants had stormed the train, which was carrying over 400 passengers and was en route Peshawar. And we'll come to that and much more in a bit. But first, the market action of the day. Indian equities end with minor losses after a healthy intraday recovery raises most early losses. Sensex and Nifty both close around 0.1% lower, but Nifty Bank gains nearly 0.5% as financial counters find their stride. The government has just released inflation figures for the month of February and IIP data for January. The consumer price index for the month of February has come in at 3.61%. This is at a 7-month low. My colleague Lata Venkatesh is here with more. Lata, take us through the CPI and IIP inflation data.
This is about the best set of data that we've got because inflation is lower than expected and growth is higher than expected. You can't ask for a better combination, but more important are the inflation numbers because interest rates are set on the basis of the CPI number. CPI number has come in at 3.61. The CNBC poll was 3.8%, 3.85 actually to be precise. So this is a good 20 basis points lower than what the street was expecting. And it's 40 basis points below the mandated number given to the Monetary Policy Committee. Monetary Policy has to keep the committee has to keep the inflation at 4% at 3.61. This is crying out for an April rate cut. Even more important is the food inflation. For all these months, if inflation was above the 4% mark and well above the 4% mark, it was because of food. It was between 8 and 11% for 18 months up until December 2024. January 25, we saw it come down to 6. And today, the expectation was it will be around 4. It has come at 3.75. So much below. As you can see in the bar chart itself, you can see how much it has fallen from previous months. Let's get to the food inflation. That's the bar chart that we should be really looking at. That is a huge relief for both the government and the Reserve Bank, simply because the less you pay for food, the more money there is available for other consumer durables. So in a way, it becomes even a pro-growth number, this 3.75. We will get to the core inflation in just a bit, but the numbers that I'm just reading out to you, food and headline inflation, are going to be hugely positive for the economy. I'll just give you a few other numbers. The CPI for oils and fats is up only 0.1% on the month. Edible oils were flying away, especially after the government raised the import duties on edible oils to protect farmers. And that appears to have just come down a bit. Not a great deal, but at least it's come down a bit. Likewise, the food price index is also down 2% on the month. You have cereals and products which are up only 0.8%. Now, that would be a bit of a worry. One would have liked it to be flat or negative because this is the height of the Kharif arrivals, but cereals are still 0.5% up on the month. Vegetable index is down 11.2% on the month. Very important, pulses are down 3.6% month on month. That was a very high inflation contributor. That's come down. Oils and fats, as I told you, is still up a bit. Now let me come to the growth numbers. The index of industrial production, or IIP, that's come 5% higher, and our average was 3.8 for the CNBC-TV18 poll. So that again, growth coming in way better than expectation. I'll just tell you, actually the IIP number has come in at, the average that we got was, 4.8%, I think. It is still much better than what the poll said. So that again is a positive. Within the IIP number, the consumer durables growth is 7.2%. Again, very encouraging. It is the non-durables output which is going to be a bit of a worry because it is minus 0.2, and that's been persistently the problem. That is the informal sector. Consumer non-durables would be all the milk, sachets, shampoo, soaps. Over there, if growth is not picking up, that's a bit of a worry. The bottom of the pyramid is still not demanding enough. But otherwise, infrastructure growth plus 0.7%, very good number. Intermediate goods up 5.2%, again, a very good number. Consumer durables, like I told you, it's a good number. And capital goods growth is 7.8%. So on IIP, it's a positive number. And on inflation as well, like I told you, largely a very positive number. One should expect bond prices to react positively. But of course, there is the US CPI number coming later on in the evening. We don't know if that is a spoiler. Bond prices will not react. But otherwise, there is enough in this number for the bond prices to react positively tomorrow.
Right. Thank you so much, Lata, for that comprehensive update. Moving on, inflows into equity funds fell 26% in February compared to January as the market sell-off intensified. Inflows into small caps and mid caps saw a bigger dip. However, steady SIP inflows was the sole silver lining. Surbhi Upadhyay is here with more. Surbhi.
Large cap inflows are actually fairly okay. There's a minor dip, even month on month in large caps. But the bigger issue is with the mid and small cap side of the market. It finally seems that with the market correction ongoing, some sort of sentiment souring has actually happened. So now you can see that dip. In the small cap and the mid cap tally, that dip is a lot more apparent. The flows there have dipped about 33 to 34%, depending on which one you're looking at. The silver lining, however, is that the SIP number is still very, very strong. It's intact. 26,000 crores of flows coming in a month, by the way, which you must remember has a lesser number of days, 28 days in February versus the others. And this kind of a market environment, look at those pillars, rock steady and solid on SIP. So that's the good news. Why are the overall flows down then? Well, a couple of reasons. First, of course, is market sentiment. The market has been really testing the nerves and patience of retail investors. So that's something that you can't escape. Number two, the whole era of big bang NFOs, that's behind us. Even this month, the total cumulative inflows coming in through the NFO route, they've been dwindling down. Now it's sub 4,000 crores. Which is actually a 13% decline even month on month. So NFOs are not pulling in the money. Then I mentioned lesser number of days. More importantly, in mid and small caps, there is a dearth of now lump sum flows. A lot of advisors are telling investors to stagger out their investments, which is why SIPs are not falling. But that big lump sum gush of money, that's missing in the market. And for mid and small caps particularly, some SIPs where the terms are ending, the maturity is happening, those SIPs are not getting renewed. This is the feedback that I've picked up from the industry. Plus, there is redemption in mid and small caps. No denying that or taking away from that either. Again, one more interesting aspect of trade beyond the equity space is actually gold. Remember, gold funds actually blew through the roof because gold has been doing so well. In January, the inflow was as high as 3,700 crores. It's come down a little bit in February, but nonetheless, the number is not bad at all. I mean, gold funds have pulled in about 1,980 crores. So gold is still shining. People are chasing those returns. Equities are steady, but mid and small caps, that's where some profit taking seems to be happening.
Right. Thank you, Surbhi, for that. The Reserve Bank will buy government securities worth 50,000 crore rupees in the open market. This in a bid to inject liquidity in the banking system. This will be the first tranche of the transaction. The second tranche will be conducted on the 18th of March for the same amount. The central bank will also conduct a dollar-rupees currency swap auction amounting to 10 billion rupees for a tenure of 36 months on 24th of March. Shares of IndusInd Bank rose 6% in intraday trade after falling 26% yesterday. Remember, the stock fell after the bank revealed a 2,100 crore rupee pre-tax loss due to incorrect derivative accounting. Speaking with CNBC-TV18 yesterday, IndusInd Bank CEO Sumant Katpalia said the accounting lapse was a one-off event while defending the timing of disclosure. He also promised the bank will post a profit in the fourth quarter, but alerted that interest income might be impacted.
Around October, and that is where we started our internal assessment as well as we hired an external agency. At that point of time, we did not know the difference, and we knew that there were two deals getting accounted incorrectly, but there's so many deals in that, so we did not know the real impact. And I think as soon as we got to know the impact, we held a board meeting and we informed our board and we did the disclosure. There is no 1 year which will show the blip. I think it was evenly spread out over a period of time. We will absorb this loss in this quarter itself.
US President Donald Trump's 25% tariffs on steel and aluminum imports have come into effect with no exceptions or exemptions from today. The duties will affect Canada, Australia and the European Union. Among others, the EU was quick to respond by announcing retaliatory tariffs on over $28 billion worth of American goods from April. These include metals, agricultural products, motorcycles and bourbon whiskey. Now, the tariffs also sparked criticism from Australian Prime Minister, who said that they were entirely unjustified. However, the Australian Prime Minister ruled out imposing reciprocal tariffs on US imports. Earlier, Trump also threatened to double import duties on metals from Canada after Ontario revealed plans for a 25% tax on electricity exports to the US. However, that won't be happening as of now, as Ontario put a hold on the 25% surcharge following talks with US Commerce Secretary Howard Lutnick. Meanwhile, India's Steel Secretary believes that the tariffs won't impact the country much, as it exports less than 1 lakh tons of steel to the US.
As you know, there's a very strong man in Canada who said he was going to charge a surcharge or a tariff on electricity coming into our country. He has called and he said he's not going to do that. Okay, he's not going to do that. And it would have been a very bad thing if he did, and he's not going to do that, so I respect that.
Will you make a different decision now about the tariffs on Canada? Will you reduce it?
At that, but probably so, yeah. He was a gentleman.
And speaking of President Trump, speaking to the media, he once again dismissed concerns about a potential recession. While answering a question on the topic, Trump said, and I quote, "I don't see it at all. I think the country is going to boom." End quote. Trump's statement comes at a time the global market is taking a massive beating amid the tariff threats.
ruling out a potential recession seemed to rattle the stock markets. The Commerce Secretary said there wouldn't be one.
Boom. Just so you know.
Just specifically on the recession.
Yeah.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom. But as I said, I can do it the easy way or the hard way. The hard way to do it is exactly what I'm doing, but the results are going to be 20 times greater.
All right, time for a short break. Coming up next, banks conclude sale of Jayaprakash Associates loans to the National Asset Reconstruction Company for 12,000 crore rupees. More on that when we return.
There is a willingness to compromise on meritocracy. I think the answer may be a little bit to the question is, as you get them in for interviews, for discussions, that the slate is balanced, and then let the best person win to get the job. And if I may, sorry to Mr. Dave's point on, if I may say to the women in this room and beyond, there are many jobs that we've traditionally thought are not a great idea for women. And coming from an FMCG background, sales is one of them. Attracting women into sales actually is very, very difficult, because all said and done, it is a difficult job. But honestly, it is fantastic learning. And if you put yourself out there, the rewards that it gives you are tremendous. So if I could just urge the women in this room to take these challenges and take some of these leaps, it would really help as well.
What happens is that it makes a trade just a little bit less efficient. And therefore, if anything, it's got a positive impact on the market, as you said. The concern is if there are widespread tariffs, then it actually affects economic growth and underlying demand for the commodity, in which case that becomes a negative. On a ton-mile trading pattern basis, it's good for shipping. But if it affects demand for commodities, then that's bad for shipping because of general economic impact. Now, every day you have some added uncertainty around US tariffs, trade, etc. So I think it makes sense to wait for a bit. In the last term of President Trump, where there were some China tariffs put there, and China put some tariffs on US products, which they've already done, where they put some tariffs on US grain. And US is a significant exporter of soybean to China. So when those tariffs came in, basically the trades rerouted. China imported from Brazil, Argentina instead of the US, and US, instead of exporting to China, exported elsewhere.
Welcome back. India's top telecom operators, Jio Platforms and Bharti Airtel, have joined hands with Elon Musk's SpaceX to introduce Starlink internet services in India. The agreement will help Starlink provide fast connectivity in remote areas. Ashmit Kumar joins us now with the details. Ashmit, from competitors to collaborators, what will this mean for India's telecom space now?
Last few years, our social media feeds are full of Elon Musk's SpaceX rockets taking off and landing, making for fascinating visuals. But ever wondered what exactly were they shooting up in space? Well, the answer, a web of over 6,000 satellites to connect the entire world with the internet. And in the last 24 hours, Musk has announced his first major step towards bringing that constellation to India. Musk's SpaceX-backed Starlink has inked agreements with world's largest telecom network, Jio Platforms, and its largest competitor, Airtel. Last evening, Airtel announced the partnership with Starlink, and just hours later this morning, Jio made the big reveal. The two telecom behemoths who once looked at SpaceX as a competitor have now opted for a hybrid approach to bring the terrestrial and satellite networks together. Now, Starlink's agreement with Jio and Airtel seems to be configured towards penetration of the Indian market using the vast distribution network and on-ground presence of both the telecom bellwethers. Now, Jio Platforms in its release has proposed offering Starlink solutions through its online and brick-and-mortar stores. Other than equipment, Jio also expressed willingness to provide installation, activation and customer support solutions to Starlink users via its network. Similarly, Airtel has proposed to offer Starlink equipment in its stores. Airtel has also proposed exploring how Starlink can use Airtel's network. Additionally, Airtel is also keen on exploring how it can offer Starlink's bevy of enterprise solutions to its own business customers and communities. So how exactly does Starlink work? How is Starlink different? Well, broadly speaking, a terrestrial network works by connecting your mobile device to the local telecom towers. We've seen lakhs and lakhs of them around our homes, around our workplaces. Now, Satcom works a little differently. It has no towers. Instead, Satcom players like Starlink deploy a web of low Earth orbit or LEO satellites. Now, users of Starlink can buy a dish for their home or business. This dish will then use airwaves for transferring data and providing internet connectivity directly via the satellite. But does it make sense for India? Well, the latest data by the TRAI reveals that teledensity in urban India is at an impressive 131%. But for rural India, this number falls off a cliff to just 58%. For internet penetration, the number of those connected is pegged at 944 million. Clearly, large geographies and large segments of the population are yet to be covered. Despite several attempts by the government, conventional telecom networks comprising of towers and fiber have struggled to cover rural and remote areas. Satellite-based players can help provide stable internet connection to such areas. Moreover, Starlink offers a bevy of enterprise solutions that can help businesses operating in remote areas. But there are three key regulatory hurdles that Starlink will need to cross. Number one, the DoT has maintained that Starlink is yet to address security issues. DoT officials are open to granting a license, but only after security concerns are met. Similarly, Starlink will also require authorization from the space regulator in space. While in advanced stages, few issues such as monitoring and sensitive locations still remain. And finally, how will spectrum for satellite communications be assigned and priced? Key questions that the telecom regulator, the TRAI, is yet to answer. Now, speaking of pricing, is Starlink even affordable? Well, just for context, for residential connections, Starlink charges rupees 31,000 for equipment and a monthly charge of about 4,000 rupees in Indonesia. It charges 33,000 rupees for equipment and a monthly charge of 2,100 rupees in Nigeria. This when India already has one of the lowest data charges. Starlink may have taken the first big step here in India, but there are still a few challenges on penetration, regulations and affordability that Musk will need to manage.
Right, banks have concluded the sale of Jaiprakash Associates loans to the National Asset Reconstruction Company for 12,000 crore rupees. Ritu Singh is here with more. Ritu.
Well, in what is a landmark resolution for banks nearly a decade in the making, we understand banks have concluded the transfer of stressed loans belonging to Jaiprakash Associates to the National Asset Reconstruction Company or NARCL, and against a principal outstanding amount of 14,500 crores, these 25 banks led by State Bank of India and ICICI Bank get 12,000 crores from NARCL. Of course, the total outstanding debt for JP, including all of the overdue interest, penalties, etc., is well over 52,000 crore rupees. Now, the deal follows a 1585 structure, meaning 15% upfront cash, which is about 1,800 crores, and the rest in the form of security receipts. But importantly, this will reflect in the bank's balance sheets in the current quarter itself. Among the key lenders, SBI alone has recovered about 500 crores in cash and another 840 crores in security receipts. ICICI Bank has received 270 crores in cash, another 1,550 crores in security receipts, and IDBI Bank, Axis Bank, LIC FDIC and Canada have also secured recoveries through the transaction, among others. Now, while most of the banks did agree to the transfer, Yes Bank and DBS Bank, with very small exposures, we understand, opted not to participate in the sale. But importantly, even though banks have now transferred this exposure to NARCL, the resolution of the company will continue under the IBC. We understand the deadline for submission of expressions of interest has now been extended to the 25th of March, and the ultimate recovery through the security receipts will be dependent on this resolution. Nonetheless, a significant development for banks in the case of JP Associates, which has been an NPA since 2016 and at the center of one of India's most protracted corporate debt struggles.
Thank you, Ritu, for that. The Prime Minister Internship Scheme was launched in October 2024 with an initial outlay of 800 crore rupees to provide 1.25 lakh internships in its pilot phase. However, it has faced challenges in attracting and retaining candidates. Sources in the Ministry of Corporate Affairs tell CNBC-TV18 that the ratio of registrations to internship opportunities remains low during the second phase of the pilot as well. Shivani Bajaj joins us now. Shivani, what's the government's game plan?
Well, yes. Now, the government has extended the registration deadline for the Prime Minister Internship Scheme from the current March 12th to March 31st now, aiming to boost participation in the scheme. In this phase, applications have reached 70,000 following intensified state-level campaigns. That's what sources are telling us. MCA has been doing campaigns in smaller cities and villages in various states to spread the word about the scheme and attract more applications. However, with 1.18 lakh internship opportunities available, there's concern about potential low acceptance rate. Sources have told CNBC-TV18 that in the previous phase, out of 80,000 offers made, only 30,000 were accepted and merely 8,700 candidates joined the internships, indicating that just 10.8% of the total offers were taken up. Now, MCA sources say that many candidates declined offers due to relocation costs outweighing the provided remuneration. In response, companies are now offering additional incentives like free food and travel to attract more interns. To enhance engagement and transparency, the government plans to launch an internship portal app this week also, detailing these extra benefits to assist candidates in making informed decisions. Back to you.
Right. Thank you, Shivani, for that. With that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable.
Hello and welcome to Startup Street. I'm Arundhati Ramnan and with me is Ritu Singh. These are the top headlines from the startup world. Investment firm Chris Capital Management secures $2.1 billion for its latest private equity fund. According to Bloomberg report, this fund raise makes it the biggest capital raising by an Indian buyout fund. Bessemer Venture Partners announces the close of a $350 million India-focused fund. This is its second dedicated India fund. This new fund will prioritize investments in artificial intelligence, enabled services, SaaS, fintech, digital health, direct-to-consumer brands, and cybersecurity. The co-founder of Flipkart, Binny Bansal, launches a new venture, Optra. This will help consumer brands take their local expertise to different Asian countries. Ola Electric stock gains after EBITDA guidance for first quarter. Management tells CNBC-TV18 the positive impact of the implementation of its network transformation and OPEX reduction program will reflect in Q1 of FY26, and that path towards profitability began a few quarters ago. Ride-hailing startup Rapido is reportedly in talks with restaurant partners to add food delivery services on its platform. As per ET report, this puts them in direct competition with Zomato and Swiggy. It's believed that Rapido is trying to introduce a new commission model different from that of Zomato and Swiggy. Zomato founder Dipinder Goyal takes a bet on aviation startup LAT Aerospace by investing $20 million. According to an ET report, the startup will develop low-cost short takeoff and landing aircraft. India is Blackstone's best-performing market globally with gross returns of 40%, says founder and CEO Stephen Schwarzman. Adds the PE firm's assets under management could double to $100 billion in the future. That's a Money Control exclusive. Specialty chemicals manufacturing startup Simplify lands $40 billion of investments in Series B funding. This fund is to scale the platform and expand its global footprint. This brings Simplify's total funding to $54 million following seed and Series A rounds. Those were the headlines that we're tracking for you this evening. But on what's brewing today, Marico Innovation Foundation, which drives impactful innovations in India, successfully hosted the 10th edition of the Indian Innovation Icons at the Geo World Convention Center. 7 game-changing innovators were identified through 2 rigorous jury rounds led by business and social impact experts. Selected from over 1,000 entries spanning diverse sectors, the winners are revolutionizing industries with their breakthrough ideas. The winners in the business category include Astrom Technologies, Chara Technologies, Indra Water and Skyroot Aerospace. In the social category, Assist Tech Foundation, Rocket Learning and People's Archive of Rural India won, while National Payments Corporation of India won the Global Game Changer Award for democratizing digital payments in India and globally. Joining us now are 3 of the winners: Surya Prakash K, the co-founder and board member of Assist Tech Foundation; Krunal Patel, co-founder and CEO of Indra Water; and Bhakta Keshav Char, co-founder and CEO of Chara Technologies. Gentlemen, thank you so much for joining us on the show today. And, congratulations to all of you. Surya Prakash, let me start with you. Assist Tech Foundation focuses on empowering persons with disabilities, right? If you could sort of take us through how you do this and the kind of impact that you've created.
Thank you.
Good evening, and thank you for having us, and big thanks to Marico Innovation Foundation for recognizing our efforts, and congratulations to the co-panelists also. See, Assistech Foundation is a social impact NGO working in the space of disability. We are India's first AT Assistech ecosystem that focuses on empowering people with disabilities using technology. We try to make an impact on 3 dimensions, which we call the 3 Ls: learning, living with independence, and livelihood. I mean, most of our programs, we pivot on leveraging technology to enable disruption in this space. And our aim is to build one of the world's leading innovation ecosystem for disability tech. I mean, what we did get recognized for was our flagship program, which is the Accelerator for Assistive Tech Startups. In this accelerator, we have nurtured over 54 startups over the last 7 years, and we have built a pipeline of around 450 startups that we tap into for various programs. In the accelerator, we have established what we think is a unique multi-stakeholder approach that promotes collaboration between a startup, a corporate, an NGO, policymakers, government initiatives, impact investors, and give them access to also top-notch tech and business leaders as mentors. Through this, we try to make these startups sustainable and scale, and eventually empower India's assistive tech ecosystem to develop scalable and affordable solutions. I mean, we're proud to say that we have enabled about 110 plus 80 products and that have secured 50 patents and enabled a fundraise of 80 crores in this space.
Right. Krunal, at Indra Water, you recycle sewage, industrial wastewater. If you could sort of take us through what it means to win this award and tell us about your impactful innovation.
Yeah. So again, thanks for inviting us and this opportunity. At Indra, we have developed decentralized, compact, modular, electrically driven wastewater treatment technology. We use our patented process Electrox, which essentially is non-contact microelectrolysis, which destabilizes and removes some of the most stubborn, tough to treat pollutants, which are generally observed in industrial as well as non-industrial wastewater streams. The very basics of it is using electricity to destabilize these pollutants and then filtering out. Our plug-and-play modular reactor makes our entire solution more easily accessible and available to these industrial wastewater treatment requirements. And of course, like winning this award was a great, we felt a lot of joy and pride, especially it's a testament to our team who have put in a lot of hard work in the background. And it's a sense of pride as well as motivation to continue pushing boundaries of engineering and development in the water treatment space, productization of a solution, which is something which has not been seen in this industry before. So it's a sense of pride as well as motivation to continue doing our good work.
Absolutely. And you know, Bhakta, at Chara Technologies, you're developing rare earth magnet-free electric motor systems for both EVs and industrial machinery, right? If you could take us through this winning innovation and, you know, what it means to have won this award.
Yeah, thanks for having me on the show. And of course, thanks for Marico for recognizing our work. After exiting EasyTap, my previous startup, I was looking for a bigger challenge to solve with wider impact and deeper impact. And that is when we came up with this huge energy transition that's happening in this world from hydrocarbons to electricity. And in this electric future, motors will be at the heart of every machine. And today, all the motors pretty much have this rare earth-based magnets which make them work. Rare earth is a well-known problem. They're expensive, they're difficult to mine and extract. And of course, our friendly neighbor China has 90% control over the supply chain. So we wanted to build a sustainable and an efficient motor with all the technologies developed from first principles. So we have made fundamental innovation on motor design, hardware architectures, and critically the software algorithms that control the motor. And we have made this motor a reality. We are building a synchronous reluctance motors. Reluctance motors is a known technology. Original paper goes back to like 200 years ago, but nothing has been built and deployed mainly because of a bunch of engineering issues. We have solved all of that, and we are very proud to say that we are now shipping to 30 plus customers across the world, manufacturing the motors and controllers in our own factory in Bangalore.
Right, absolutely. And you know, we're running out of time, but Surya, if I could bring you back into the conversation and you could tell us in 30 seconds, you know, the big targets and milestones for 2025 and the kind of revenues that you're making.
Yeah, we'll probably have to skip the revenue question because we are an NGO.
Right.
See, so far we have done we've impacted 1 million people with disability through our various programs. Our goal is to impact about 5 million people over the next 3 to 4 years. Yeah. For this, we'll do 3-4 things, right? First one is we have to increase the pipeline, right? I mean, we have about 450 startups from which to tap for our innovation network. We have very many CSR programs that we keep looking for more and more startups. We'll increase about 100 more startups. We'll run our cohort for maybe another 30-40 startups. We'll bring some, we're trying to take these products into the high street by partnering with companies like Microsoft to display these products. We are running with CSRs to take these products and bring them to the poorest of the poor. Doing all this, we hope that we will do a linear growth of this 1 million to 5 million over the next 3 years. Yeah.
And, you know, Krunal and Bhakta, if you could quickly tell me your targets for 2025. Krunal, you first.
Yeah, so we have a very strong order pipeline upwards of 350 crores. And we are deploying our solution across industries like steel, manufacturing, chemical, pharmaceutical, even cooling towers, and of course, sewage. And a couple of our key installations are with few of our marquee customers like IHCL's Taj Mahal Palace in Mumbai, the likes of Aditya Birla Group, Tata's. So we are very confident on the foundation that we have built to scale up and have a hockey stick kind of a growth in the next financial year.
Right. And Bhakta, quickly, if you could tell us.
Sure. Our goal is to ship 1 million motors by the end of the decade, saving 500,000 kilograms of rare earths on this planet, which is equivalent to planting 10 million trees. That's the target. And in terms of revenue, we are starting now. We're about 5 crores this year, 40 crores next year, and go to about a few hundred crores by the end of the decade.
Great. Surya, Krunal, and Bhakta, we wish you all the best on this journey going forward. Thank you so much for taking time out and being here with us on Startup Street.
Well, American venture capital and private equity firm Bessemer Venture Partners has announced its second India fund, raising $350 million to support technology and innovation-driven startups. The fund is going to focus on early-stage startups and support them through subsequent growth stages across AI, SaaS, fintech, digital, health, consumer, and cybersecurity. Now, Bessemer first established its India presence nearly 2 decades ago and has since invested in more than 80 startups in the country. All right, so let's bring in Anant Vidurpuri, partner at Bessemer, for more on this. Anant, thanks very much for joining us here on Startup Street, and congratulations on your second India fund. Tell us about this second one and the unique investment approach that this fund is going to take compared to what Bessemer has done previously in India.
Of course. First of all, thanks for having us here, Ritu. It's always a great thing to be here. So yeah, we've just closed our BVP India Fund 2. This is a $350 million fund. We were heavily oversubscribed, and we kind of closed the fund at a hard cap of this 350 number. Our sort of strategy in India is a 2-decade-old one. We're a very roadmap-focused firm. We started investing in roughly around 2006. Currently our most active roadmaps are around AI, around fintech software, around health tech, and around consumer internet. And we expect a large part of this current fund also to be deployed in those similar roadmaps. The tools that we are most excited about, of course, are the one around AI and the one around fintech software.
Well, how many startups are you looking to invest in with this $350 million? What will be the average check size? And are there specific themes across AI, SaaS, fintech, etc., that you're particularly looking at?
So we're actually a stage agnostic fund. While a majority of our investments tend to be super early at like the Series A stage. That being said, we can write $1 million seed check. We can also write a $30 million growth check. So we're stage agnostic. What that means is that it's really hard to predict the number of companies because we may find an early stage opportunity, we may find a later stage opportunity. But given our stage agnostic nature, we expect to make a healthy number of investments over the coming years. Specifically, I think the sectors that we're most excited about, I think I talked a little bit about the opportunity that's being created by AI. And if you break down that opportunity, it basically exists in 4 different layers. There's the foundational model layer, which is building India-specific language models. There's the infrastructure layer, that is, how can you use those sort of AI models to build applications. Third is the application layer, and the fourth is the AI-led professional services layer. And if I was to pick, I think the last 2 are the one we're most excited about. That is building verticalized AI applications, as well as using AI plus a combination of humans to build the next generation of AI-enabled services companies.
Well, how soon will you start deploying the money then? And do you have any investments already in the pipeline?
So we expect to start deploying this fund pretty soon, so in the next quarter or so. We have a very full pipeline. I think the level of entrepreneurship in India has just reached a very different scale. So we have a full pipeline, and we're really excited on how to sort of go about to deploying this fund.
Well, just to put this in context, in the last 5 years, more than 80% of your investments have been in Series A or earlier. Several of these companies have gone on to become unicorns. 9 of your portfolio companies have IPO'd as well. So keeping that in mind, what is the expectation from the second fund?
Look, I think, we always hold ourselves to, the highest bars of investing. And actually, we feel that, when we invest in a company, we always want to see that is an IPO, a path here, because that's the ideal path that we look for in all our investments. And as we think about companies, we expect all of them to cross $100 million of ARR and really scale, because eventually that's the sort of gold standard for large companies. So yeah, the bar is high. We've been really thankful to have been involved with some very high quality founders, and we hope we can find more of these founders, because we hold ourselves to the highest standards.
Well, Bessemer globally has listed Apple, Facebook, and so on as companies in its anti-portfolio, companies that it missed out on investing in. Do you maintain a similar anti-portfolio for India as well?
Yeah, no, I think we've got a great, we don't get everything right, and a lot of times we don't, get things right at all. I think there are definitely companies in India. I think companies like Nykaa, companies like BillDesk, which we didn't invest in, and maybe we should have. They've gone on to become very large companies, yes, there's always the ones that you'll miss. I think that's the sort of inspiration for us to keep on improving, to keep on trying to give even higher sort of bars for ourselves, and just make sure we try to find great entrepreneurs who are building great businesses.
All right, and any of your portfolio companies that are going to be IPO ready in the next 3 to 4 years, if any?
Yeah, I think the Indian public markets have actually grown a lot in terms of just the level of domestic capital that's there. And what that means is that they are far more receptive to these professionally managed, well-run companies that are often backed by VCs and PEs. So we think that's a very viable exit path for many of our companies. As we speak, several of our companies are in various stages of this IPO journey. It's obviously very difficult to time these markets and to time these things, but what I can tell you is that many of our companies are very actively looking at that path right now.
Well, lastly, what are your expectations when it comes to returns given the current market conditions?
See, I think the market conditions are not something that we control. It's also not really our core business to predict how the markets will grow. We take a very long-term view to investing. We think that we want to invest in companies that could be generational, which 10, 20, 30 years on could still be around and be large companies. With that lens, I think markets are less of a variable for us. If the business is good, if it's scaling and there is a consistent sort of compounding in the business, we know eventually we will, be pretty happy with that investment. So we don't actually spend that much time thinking about the markets. And we think even as a founder, that's not something you can control. Our core kind of job is to find great entrepreneurs building large generational companies, and that's what we try to do.
All right, Anant, we leave it at that. Thank you very much for your time here on Startup Street today.
Thank you so much, Ritu. Thanks for taking the time.
On that note, it is time for us to head into a short break. But coming up on the other side, co-founder and CEO Mohit Yadav, in an exclusive conversation with CNBC-TV18, said that the company will continue to operate independently despite the acquisition by HUL. Stay tuned for more.
In 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
We just don't know how the tariffs are going to be imposed on different countries, whether this is going to be sector specific or it is going to go down to the product specific levels. So what we have done is we have done a very simplistic analysis of equalizing the weighted average tariff rates of both the countries. US will probably have to then increase tariff by about 8 percentage points. And given some elasticity estimates that we have, we think that's worth about $7-8 billion of impact on India's export, everything else constant. That's about 0.2% of GDP. However, we are very much conscious that this will not be as simple as it looks like. This game could be played from India's perspective by cutting down import duties.
Welcome back to Startup Street. Now onto a CNBC TV18 exclusive. Minimalist co-founder and CEO Mohit Yadav has said that the company will continue to operate independently despite the acquisition. Hindustan Unilever is set to acquire Minimalist for nearly 3,000 crore rupees post-regulatory approvals. Speaking to Shireen Bhan, Yadav added that there will be no changes to their team and the operation will continue to be based out of Jaipur. Take a look.
You pretty much will continue to operate as an independent island within the large HUL framework. Now, how did that come about?
It was an easy decision. We needed this to happen. They were also aligned that this is how it should work, right? We should continue to operate where we are doing. We should continue to do what we have been so far. So I guess.
So you run the ship?
We run the ship, yeah. So
there's no change in that?
No change in that.
Even though ownership has changed completely?
Yeah.
Give me a sense of how you turbocharge the growth ambition and the growth plans for the company from here.
I think the three very easiest growth lever, one, as I said, is our offline expansion. So with them, we know which store, what data, what is relevant, not relevant, then exploring this entire piece, understanding, for the next 2 years, how many stores are relevant for us, how to plan. They already have an on-ground team. We can leverage a lot of those things, right? So I guess so far we are in some 2,000 stores and we took almost 12 to 18 months to be here. In next 2 years, we can easily target anywhere between 15 to 20,000, right? 10 times more than what we have achieved. And all that, again, can be done very seamlessly. Second is international. While, of course, we started working in these markets, we have some bit of retail partnership. But every new market you enter, you have to, again, figure out who are the right channel partners. Yeah. You have to have those relationships and all.
And that's where the Unilever system will kick in.
And that cycle take anywhere between 4 to 6 months, right? Again, with HUL, given they are present in most of these markets.
Yeah.
And now, because of their prestige portfolio, even we know, say which channels have performed better, say for Paula's Choice, K18, other brands, then what should be our distribution strategy? All that is now easily accessible. Third is the global R&D centers. Whatever we have been doing in terms of our own clinical studies, test, evaluating ingredient, they have been working on multiple things.
Yeah.
So we have a easy resource we can tap in.
And before we wrap up the show, we leave you with a story on India's venture capital landscape, which is experiencing a powerful transformation. For many years, foreign venture capital powered the growth of Indian startups. However, a distinct trend is now emerging. The next wave of Indian companies is being built on Indian capital. How will this shift mark the redefinition of India's entrepreneurial landscape? Aishwarya Anand decodes. Take a look.
Indian startup ecosystem has raised over $12 billion in 2024. However, 85% of that capital has come from overseas investors, large sovereign wealth funds, large private equity players. Only 15% of domestic capital has flown into the ecosystem. Now there is a big push to get more domestic capital invested into venture capital funds that will then go on to invest that into Indian startups. But how do we unlock its full potential, create deeper pools of limited partner capital and more supportive policies? Let's find that out from some of the prominent voices in the startup ecosystem.
Family offices is one pool of capital. Another pool of capital is balance sheets of corporations. Can companies invest directly into startups? Now, there are a number of regulatory issues around companies investing in other companies. They might get classified as NBFC or core investment companies. So if some of those roadblocks can be removed, it will help a lot.
We see lots new players have come in, but there is an entire, companies don't simply wake up and grow on their own, right? It's not simply about transacting. A lot of it is about, making sure that companies are able to access the right talent pools. It's about making sure that they understand the need to build the right culture appropriate for their business. It's about, the scaling up errors and issues that happen at different points in their life cycle. It's about understanding the Peter Principle kind of issues which inevitably happen in high growth businesses. It's about adapting to customer needs in an ecosystem and environment which is evolving rather rapidly. It's about, even evolving to economic cycles and customer shifts in preferences. So it's a lot, there's a lot which goes into making companies succeed, not just transacting. And I think that the onus is on participants in the industry, including ourselves, to make sure that we are actually, we can facilitate and aid these fabulous entrepreneurs that we see in a more effective way.
And what would be that more effective way, if I have to ask you? Because of course you need more, LPs need more funding from family offices. So how do we bring in all the factors together?
I don't think that it is because of lack of capital that we have an issue.
Yeah.
The other thing that I think that, systematically the government could do, and I think they are doing it in some form and fashion, is to give preferential market access for Indian startups, right? Yeah. And sort of promise that if you can develop A, B, C, D, E in different parts of the ecosystem and you're a domestic company, we will give you some kind of protection umbrella, etc. The sense I have is that the intent is there. Again, in terms of execution, if that's a little bit better, it would help.
Mr. Bhasin mentioned that there's no dearth of capital in the ecosystem, right? But it's players in the ecosystem who need to really work it out so that the inflow is much better. So if there is no dearth today, what are some of the roadblocks? Whether it could be, are there regulatory hurdles that you feel that exists for more domestic capital to flow in? Should that be eased a little bit more?
We have to understand and create a different classification, what's called an accredited investor. Right? Somebody who has a net worth of more than $1 million. In India, I say बहुत लोग हैं आज की date में. I don't think they need to be given this. They don't want the same level of regulation on their fund investments as maybe probably a mutual fund, which is also targeting a 1 lakh, 2 lakh rupee investor for a year. Because of the over-regulation is becoming much more difficult to raise money. The cost of even running such funds is going up. like a 200 crore fund will have a custodian, it'll have a trustee, it will have a valuer, a separate auditor, a separate accounting firm. अब यार इन सबको manage करते and you have to be very fast at deploying money.
Yeah.
Same thing in the US is or other developed markets is very quick.
Yeah.
Now we're not targeting investors. Like all my investors are family offices. They all have net worths of $25-30 million plus. They know what sophisticated product they're getting into. They're not your typical retail investor. But I'm subjected now to the same regulation as them. So I think that has to change. The regulations around their fund investments need to be lower. I'm not saying just it's free for all, but you have to understand that in other ecosystems they're moving much faster than us. Today, if a company approaches me, it'll take me 6 to 9 months before they'll ever see money from me.
Yeah.
Simply because मुझे इतनी सारी processes करने हैं before
you can start
giving in the money, right?
Yeah, correct.
Compared to the US, people can get funding within a week, within 2 months, within a month. That's the speed AI is moving at, and if you're not able to match that speed, talent is going to move to other markets.
Items. We have used a very operative phrase that at least 50 basis point of rate cuts. Our City House view on Fed rate cut is 5 rate cuts this year. So we have taken that into consideration as well. However, I must say that
It's 25 years of Sabyasachi Mukherjee and it's 25 years of CNBC-TV18. So we couldn't have planned this better, Sabya. Thank you so much for joining us, and what an honor and a pleasure to have you join us here this evening.
Thank you. Likewise. This crowd makes me very nervous, but
this crowd makes you nervous, guys. Really? Should we give them a big cheer before we start? But yes, Sabya, this is where I want to start by talking to you. 25 years ago, when you decided that you were going to veer into the world of fashion, as a young man from Calcutta, I know that you were inspired by your grandmothers, both paternal as well as maternal, and you had a very strong backing of some strong women who've shaped your narrative, who've shaped your storytelling. But when you look back at your journey so far, is there a sense of disbelief sometimes? Do you have to pinch yourself to say, how did I get here?
not really. I was always sure of what I would do, but I wouldn't have done it without the women in my life. As a man, I might have birthed Sabyasachi, but it's the women who raised Sabya. And I think whether my grandmothers, whether the women in Calcutta, and they're very strong, and I think the women in that city lead, I think they've always urged me to follow my dreams. And I think at a time when you have a dream and you have a conviction, when your conviction is shared by people around you, then you realize that it just makes the journey a little more easier.
Speaking of the journey, and you said you always knew or you always believed that you were going to make this what it is today. What was the ambition 25 years ago? I mean, what did you imagine Sabyasachi Mukherjee to be?
When you grow up in Calcutta, I mean, culture becomes a default setting because, whether you like it or not, it becomes a part of your life through osmosis. A lot of people in my family are educationists. From my mother's side, people are doctors. My mother's a painter. And, I've grown up seeing world cinema, listening to music, reading great literature. My father's elder brother used to take me to all the film festivals to watch movies. And, I've always felt at a time, when I was seeing Ray and Ghatak and Govind Nihalani, and I used to read books and, read Tagore, I never felt India was a third world country. I always felt India was a first world civilization. And I was like, why are we not doing our best to represent ourselves right? Because there is so much of misrepresentation of India. And I think within that, I saw an opportunity. And I said that, I know that at some point of time we'll get to the top. It's just a matter of time, and I wanted to start the journey 25 years ago. Well,
and kudos for you for making that journey. But, you talked about India being on top of the world, and often the storytelling around India has been stereotypical. And as you look at taking the India story global with your brand, with Sabyasachi, and taking the world by storm, so to speak, what is the ambition that you have now to create a premium luxury brand out of India for the world?
I always believe that the world is round and history is cyclical. And if you just look at India's cultural heritage, we were the golden country, and everything was plundered, taken away from us. And a lot of it was appropriated. A lot of what I see as global luxury, if you look at the genesis of it or the roots of it, it comes from this country. And I think it's time that some of us took it back home. And, I don't know how far I'm going to, when I sold my company to Kumar Mangalam, I told him only one thing, that Mr. Birla, the company does not belong to me, it does not belong to you. It belongs to the country at large. And we have to do it right, because what happens is there is a lot of younger generation of artists and students who look up to the brand. And as a middle-class boy, if I could have broken the glass ceiling, I don't know how far I will be able to take this journey forward, but a lot of people will come up and say, if he could do it, so can I. I think for me, the legacy would be to leave behind a possibility that if we decide to do it collectively, India is going to go straight on the top.
Well, more power to you and more power to the people that you're working with to ensure that that vision, in fact, is a reality. But, speaking about selling your business to Kumar Mangalam Birla, and your journey as an entrepreneur, the decision to actually, in a way, move back, give up, whatever you'd like to, or however you'd like to see it, was that a tough emotional decision? Or did you believe that it was the right thing to do for the brand?
No, I'd already planned it, always. You see, I'm not a selfish entrepreneur, because when you create something that becomes bigger than who you are, with possibilities that can change and shape the trajectory of a country, you have to step back and realize that it doesn't belong to you anymore, it belongs to the people. And I still remember I was, I had already made up my mind that I would do it, but I remember, and if that girl is listening to this telecast, I was at the New Delhi airport, and a girl meets me at the airport post-COVID, and she says, Mr. Mukherjee, I just wanted to come and tell you that you cannot die. And I was like, and that was a strange conversation to have. And I was like, why would you say this to me? And she said, no, we look up to you. You have so much of idealism in your business. What will happen to us? Because your brand continues to inspire us. And, I called up Kumar the next day. I said, okay, fine,
I'm ready.
Let's do the deal. No, we have been talking for a very long time. And you see, often what happens is when personal hubris of an entrepreneur takes over, then you decide to keep the baby or the child just for yourself. And then you grow old, and then you can't transition, and the brand dies with you. And I was very clear that, it doesn't matter what happens to me, Sabya has to live on. And I don't have any children. And even if I had children, I don't believe in nepotism. I would not give it to them if they were not qualified enough or the right people to transition it to. And I said that, okay, let's collectively create a corporate Sabya, and let me spend the next 20 years transitioning it, so that even, when I leave, this brand is going to stay on.
This brand is going to stay on. But, speaking of nepotism, Sabya, and I don't know if it's true, but have you really decided that you're not going to design for Bollywood anymore?
No, I didn't say that. I said there was I never said that.
I'm not sure if it's true, so I'm asking you.
No, I never said that. I think me and Bollywood has had a great partnership. But, I think the way people look at communication keeps changing. And I think there was a time when people were underconfident, and they needed to have influencers and leaders to look up to feel good about themselves. The good thing about the internet is it connected a lot of people. And when you feel like you're a minority and you start connecting with people, and then you realize that you have a community, your confidence rises. And today, I think what's happening, if I look at the influencers, the biggest Sabyasachi influencers are the customers. They don't feel they are any less than Bollywood. And I think the narrative has shifted from influencers. Anyways, I've never really used Bollywood on my runway. Deepika was the only exception. And I told her that when I was doing my 25-year show, this is probably the first and the last time that I'll use a Bollywood star, because this was a special moment. We've had a great relationship, personal relationship together. And I truly think in so many ways she represents Brand India. But I think we've always focused on our consumers because for us, our consumers are the real stars.
Well, the consumers are the stars. So let's talk about the consumer, not just the Indian consumer, but also the global consumer that you're hoping to tap into now, Sabya. What's changed? You talked about social media. You talked about the world of influencers and content creators and how that's also shaping the choices that consumers make. In your experience, as someone who understands the fashion industry, as someone who's been part of the fashion industry, what's the big change that you're seeing in terms of consumption and consumer behavior today?
I think self-confidence and self-expression. Truth be told, and I've said this in many forums, that fashion has made a lot of money by feeding on people's insecurities. So the more insecure you kept your consumer, the more they wanted to buy your product because they wanted to feel good about themselves. But what fashion didn't realize for the longest time, that the consumer was getting smarter and sharper. And anyways, I think the Indian consumer is probably the smartest consumer in the world. And, I think that when you have and also at a time, a lot of luxury goods were consumed by the idle rich. Today, if you look at the people who are really buying luxury in India, everybody's working, nobody has time, everybody's self-reliant, everybody has self-confidence, everybody has self-expression. And, then the consumer shifts from being brand supreme to product supreme. A consumer just wants to buy the right product, not the right brand. And at Sabyasachi, we want to get the product right. Whether the brand becomes a super brand or not, it's an outcome of the product, not the brand. And I think globally, when the consumer is going to now realize that that luxury is based on rarity, craftsmanship, authenticity, and provenance, where else can you find a luxury product more unique than what you would find in India? So I think whether people, no matter what happens, no matter how much artfully the spin doctors and the global markets try to dominate India, they can't put India in a corner because it's just not going to be possible because the consumers won't let them.
You can't put India in a corner. So, let's talk about the strategy now to ensure that you actually tap into this big opportunity. You're in the heart of New York City, Sabya, today, and I know that there's been a lot of chatter around just what you've been able to create and how you've been able to showcase India there. What's the initial learning and the experience been of taking Brand India global?
Even before I took it to America, I think so much of how America views India is so stereotypical. Firstly, I wanted to change that and break that, and I always feel that luxury is built from a point of confidence and never from a point of subjugation. And the problem has always been that we have never believed in ourselves for the longest time. And I think that when you start believing in who you are, and that's when the dynamics change.
Speaking of the dynamics changing, and you were talking about the consumer and the consumer being your biggest influencers, so to speak. The Sabya bride, you kind of turned that on its head, right? I mean, the Indian brides were always coy, demure, shy. There was almost this invisibilization, and you kind of turned that around completely. How did that happen? I mean, was this because of the influence of the strong women in your life? What was it that you were trying to tell by way of attempting to sort of turn this on its head?
See, I don't really understand gender inequality because in my head it doesn't exist. I've been raised by, thank you. And sometimes I tell that, the problem with gender inequality actually starts with bad parenting. Because I think if you raise your boys to believe that they're not better than women, but they're equal to women, I think men will be far more sensitive to gender parity than they're today. And, I have grown up with women who I've looked up to. My friends growing up, my girlfriends growing up, they were very strong women, and I was in awe of them. And let's talk about the bridal market, for instance. So I'll tell you a small story. So I meet a lot of women in India, mothers in India, who believe that I can matchmake for their daughters. And
can you?
No, I don't even have a social life. So and then they come and tell me that. I have a real problem, I'm not being able to sleep at night. I said, why? I said, my daughter's not getting married. She refuses to get married. And I'm like, all right, and she's 36, her biological clock is ticking, maybe she'll not be able to produce children. And like, all right. I said, okay, I want to ask you a question. Where did you send your daughter for education? She said, oh, I sent my daughter to Stanford. I said, so you will send your daughter to Stanford, you will give her the best of education, you will give her wisdom, you will give her experience, you will give her confidence, and then you'll tell her to come back, be subjugated to a man and make babies. I said, that doesn't work anymore. So, the way we look at weddings in this country is also going to shift, because, today, women have realized, either through communication or through social media or just being there, watching forums like this, that they don't need a man always to fulfill their destinies. They can do it themselves. And so the entire construct of marriages in India, which was about patriarchy trying to, so I'll tell you, there were so many reasons why people got married. Sometimes it was never love. Sometimes it was an escape. Sometimes it was just an arrangement, like a business arrangement. And sometimes it was just a hopelessness that my life would change. But today in India, when I see younger kids, they don't even come with their parents to buy a bridal outfit. They'll come, they're wearing jeans, and they'll come with an American Express card. They'll swipe the card and say, I can't even come for a fitting because I have a boardroom meeting. Just send the outfit home. And I see how the country has changed. When I look at my stores and I look at my consumers, I could not believe that these consumers would have existed 20 years ago. So India has completely changed.
Isn't that a very small minority that we're still talking about, Sabya?
There is something called trickle down. But even if it exists on top, slowly and slowly it's going to trickle down. What excites me is the fact that there is visible change. I'm not going to quantify the change, but what gives me hope, if change exists, it's going to percolate. It's just a matter of time.
In the context of the conversations that we're having here about women and around women, is important to hear what you have to say. You don't believe in perfection. You, in fact, believe in the magic of imperfection, right?
Perfection is so much of a societal construct that, I think, we are constantly telling people that you're not good enough to be able to make them buy more. And, somewhere down the line, this constant marketing to tell people that you need to buy more because you're not good enough doesn't really work, because A, it's not sustainable. Secondly, you lose the confidence of the consumer, because then the consumer is saying, okay, you know what, this is enough, I'm walking out. I think you grow businesses beautifully by giving your consumers confidence that you're just good the way you are. And, at Sabya, we have always said that to our consumers, because I don't think we try to create imagery that is so far away that you can't reach. I think
the price tags.
No, there's a reason for the price tag. You see, one of the greater agendas of Sabya is also to keep craft harnessed at its highest stages. And let me tell you, a lot of my craftspeople are women. And I think, if you don't rise the price of craft up, if you don't rise the acknowledgement of craft up, craft is going to disappear. I say that, there is a lot that a lot of global economies can do that India cannot do yet. But there's a lot that India can do that other countries can never do, and that comes from India's soft power. And I think if corporate India was not to understand how valuable India's soft power is, and if we didn't do it to protect it, craft needs to be made into a business. Craft should not be about pledges and charity and craftsmen need to get their children back into the business. And I've always said, I've seen this movie called Help, where a lady tells another woman that, courage often skips a generation. And I took a little from there, and I said, courage can skip a generation, but craft cannot, because if craft skips a generation, craft dies. And if India's craft was to die, India's soft power would crash. I think this country still probably does not realize, and corporate India still probably does not realize how powerful India's soft power is, and how, You can have medical services, you can have IT, but a lot of other countries can do that too. But what you can do with your soft power, because it is so unique to this country, nobody else can do.
No, and that's a very, very important point that you make. But do you worry today, Sabya, that we are at a point which is almost an existential crisis for a whole host of arts and artisans across this country? I mean, you were talking about the fact that this shouldn't be treated like a charity. It shouldn't be treated like a CSR project. What kind of interventions do you believe we need at this point in time to ensure that we keep this soft power alive?
You know, we don't need to do much because evolution will take care of itself. Because I'll tell you, so we were at the age of influence, which is moving into the age of intelligence. AI is going to come in. And I personally think that AI in many sectors, especially in performing arts and art, will be very short-lived. Because after the age of intelligence will come the age of wisdom. And when the age of wisdom comes in and people realize that the greatest gift to humanity is humans themselves, and we should not robotize our existence so much that we forget to be human beings, then people will realize that art and craft is going to be the most important expression of humanity. We don't have to do much. Evolution will take care of itself.
We certainly hope so. We certainly hope so. But, you know, what keeps you grounded? What keeps you sane? What keeps you centered in the world that you live in? You know, how do you ensure that Sabya stays true to who Sabya is?
Calcutta, my friend circle from school, you know, for them, you know, if I'm talking about the fact that, you know, I could not make a shipment in time, they will say, what are you talking about? I have real problems. My child failed in geography. And also my family, you know, my aunts, when I go to a wedding and go to a family wedding, they'll ask me 2 questions. And, you know, and I have the answer for the first one, the second I can't answer ever. Because they say, who wears your clothes and where do they go? So I think there's always reality check when you're in Calcutta.
There always is a reality check. But who's your current muse? Where are you drawing inspiration from today?
You know, Tagore had a very beautiful poem which loosely translated said that, you know, I've traveled all over the world looking for beauty. I've spent a lot of money, traveled over forests and hills, only to realize when I came back home that beauty lay on a dewdrop on a blade of grass right next to my doorstep. And, you know, I'm 51. I've traveled all over the world. And when I come back home to my muse, which is Calcutta.
That is wonderful. That is wonderful. But, you know, as you look back at your entrepreneurial journey, and for many women and men who are watching this, you know, what are some of the lessons, some of the non-negotiables that you would leave us with in wanting to set something up that has an enduring legacy that lives beyond you?
Oh, I could go on and on, but I'll make it. I think idealism matters. I think what also matters is excellence, because I think the problem that I face with a lot of people is we constantly keep shortchanging excellence for profit. That's not sustainable. You know, if you look at Hermes, for instance, they were never shortchanged excellence, and they're probably one of the most profitable company with a very strong EBITDA. And they continued to grow when every other brand was in crisis. And to entrepreneurs, I would only say something that, you know, don't complain about your journey. Because if you're an entrepreneur, you're supposed to be alone. Because if you're a visionary, you're always going to be ahead of everybody else. Don't complain if people don't understand, because you have to believe in yourself. Again, quoting Tagore, he had said that, you know, the fight or the tempest is not outside, it's within you. You have to overcome your own fears. It's always going to be a hard journey. It's always going to be a tiring journey, and it's always going to be a lonesome journey. But if you stay on the path, there will always be light at the end of the tunnel. Don't give up.
So if there was to be a movie on Sabyasachi Mukherjee, what would it be called?
My Life in Calcutta.
Sabya, thank you so much for joining us here this evening. Ladies and gentlemen, Sabyasachi Mukherjee, we wish you the very best of luck with all your future endeavors. The next 25 years, may they bring you more success, more happiness, and may you truly take India global. Thank you so much for your time here this evening.
Thank you, everyone.
Thank you very, very much.
Welcome to Genomics. The world is changing geopolitically and economically at a rapid clip. President Donald Trump's swift yet shifting imposition of tariffs on many regions, including allies like Canada and Europe, and his near withdrawal from the NATO has turned the world order upside down, as it were. It now almost seems like US and Russia are in one camp and Europe and China are in the opposing camp. Separately, on the economy side, with Europe going in for a 1% higher fiscal deficit, bond yields, inflation, growth forecasts have all got to be raised. In the East, China seems to be rising after almost a decade of slowdown, while Japanese yields are now at 16-year highs. To understand the seminal changes in the world and in the world's largest economy, that is the US, I have with me Professor Kenneth Rogoff, Professor of Economics at Harvard University. He has been Chief Economist at IMF and author of several well-known books, so an undoubted expert on international economy as well. Professor Rogoff, thank you very much indeed for your time. Thank you, sir. I'm going to start the conversation closer to your home, the United States. One of the pressing problems of investors all over the world has been this US exceptionalism over the past 12 months, particularly since the election of President Trump. Now, with fresh doubts over US growth, is this exceptionalism coming to an end?
Well, I don't think the exceptionalism is coming to an end. I think the next 10 years for the United States are going to be very strong. But near term, President Trump has just sort of intimated that, oh, by the way, a recession might be in my master plan for making the economy better. So as confused as investors were already, they're even more so.
Okay, but would you still wonder if in the near term, for the year 2025, US growth forecasts may have to be lowered because of tariffs?
Not just because of tariffs, but the sort of aggressive and somewhat random cutting of government spending, the unpredictability of policy. I think it looks like US growth is downshifting to maybe 1% towards the end of the year. I don't think that's normal, but yes, absolutely. The risks are going up and up. I mean, whatever Trump's master plan is, it's very hard to know where he's going, and that unpredictability